That this is going to prompt hesitation from investors to getting involved in the sector. Watch gambling businesses as well, as Lizzie was telling us earlier on, because of some of the headlines coming through from the Labour Party conference.
Lots of individual sectors to watch, lots to see how it's going to show up at the open. And that, of course, leads us right here to the opening trade. The markets open here in the UK. We'll see as the others kind of slowly make their way. Positive start for the FTSE 100 by only a marginal number. I spoke too soon, already going down to the downside. Like, this is very crucial here because, of course, we are talking about some of the major sectors that we were watching as Anna was talking about. But I've got to say, I've got one eye on the SMI here because Anna was mentioning UBS. Does that ultimately show up in the index as a whole? Weakness across, does that ultimately show up in the index as a whole? Weakness across the board, though, but perhaps not as pronounced as we saw in the futures picture. As Valerie mentioned there, this is the last day of the month. It's the last day of the quarter as well. Does that mean rebalancing flows that have already kind of spanned for the whole week just means people sit on the sidelines for a little bit? Remember, we also have cues coming out of the U.S. We have cues coming out of Asia as well. How does it all shake out in the opening trade? Val, walk us through the sector price action.
Welcome to the sectors picture. It is fairly negative. We do have around 12 in the red, the remaining 6 in the green. Funny enough, basic resources, which did outperform yesterday, is underperforming this morning, even though we still have gold headed towards another record high. Basic resources, one of the worst performing sectors, down 0.5%. We also have energy at the bottom of the basket here. The sector is down nearly 1%, probably falling on the weak session from Brent crude yesterday, which had its worst session, should I say, in 2 months. So the energy sector at the bottom of the basket. When it comes to the top of the basket, we have financial services, insurance, and telecom. I'm wondering if UBS shares are open when we're talking about financial services in the banking sector after they strictly warned the Swiss regulator that they're in opposition to those strict Swiss capital requirements. We are seeing UBS, yes, in the green, up around 1% off the back of that.
Yeah, it's just almost an even split between negative and positive now in terms of those sectors, isn't it? It started out much more negative, now sort of some of the upside finding its feet, but financial services, yes, the best performing sector. It is interesting, isn't it? Basic resources weaker in defiance of the higher gold price, in defiance of the higher copper price, both of those not cutting through today, although we do see some of the gold miners themselves actually not doing too badly. Fresnillo at least is flat, which, you know, it is not bad performance. But the energy story does catch your eye, doesn't it? Because it is an area of weakness, and you might welcome a 20-step peace plan for Gaza, but that does seem to have weighed on the oil price, as you say, Valerie, yesterday, and continues actually to do so because Brent down another 0.5% in today's session.
It's fascinating as well. I just want to point out that one of the major movers within the energy space is Total, which you had mentioned from a macro perspective. We should mention yesterday's session as well. We did see some news that they were looking to acquire a lot of the U.S. natural gas assets. So you saw weakness there in terms of just some of the bid going into that. I wonder how much of that is reflecting and maybe bleeding over into today's trade as well. Seeing some heavy volume there on the downside.
Well, let's talk about these macro markets with a guest around the table, Madison Fowler, global investment strategist at JP Morgan Private Bank. Thanks for coming into the studio to speak with us. First, your thoughts on these markets this week. A lot of attention on the U.S. shutdown, but is that something that's going to affect materially your outlook on asset classes?
I do think that historically speaking, we tend to see a lot of noise around government shutdowns. But when we do look historically, typically markets do remain quite unaffected between the beginning of the event and then when it ends. But I do think with that, there are more important drivers for markets. But I think that's also going to play out in terms of what's a little bit different this time around for this potential government shutdown. Firstly, you have the administration talking about potential for permanent job cuts rather than just temporary furlough. You have the potential for a delayed jobs report that could, muddy that decision making for the Fed. And then, of course, you also have globally fiscal stress rising as well. So I think those factors might create a little bit more noise this time around. But broadly speaking, we do believe in the underlying strength of the economy and the market.
Yeah, well, at least it's something that really surprised the market last week, that beat in second quarter GDP, the final reading, upgraded by 0.5 percentage points. How are you viewing the U.S. economy? It's really surprised everybody in the second quarter. Back in April, everyone was talking about recession, about the back of tariffs, and here we are with a near 4% nominal growth. How are you viewing the U.S. economy faring into the end of the year?
Sure, and I think what was really interesting about that GDP report is that revision upward had a lot to do with strengthened consumer spending. And I think now the question is how long that can persist, given some weakening in the jobs market, which of course the Federal Reserve has pointed out time and again. I think when we're looking at the economy from here, we do expect a slowdown as tariffs work their way through the economy. But I think what we've seen so far is that corporations, as a result of resilient margins, have been able to manage through those costs quite effectively, and households have as well. But again, we do expect a slowdown from here and also an increase in inflation as well.
Madison, how do you think about valuations at this point? I keep seeing lots of stories, people thinking about whether something has fundamentally, structurally changed that justifies PEs perhaps trading at a much higher multiple than their recent history, or than history would suggest. And lots of people pointing to some sensible reasons why it might be different this time, and we should expect things to be more expensive than they were. And some saying, that's a constant drift upwards in valuation, and others saying, no, we just drift up once and we re-anchor at a higher level. How are you thinking about the valuation story?
I am in the camp of believing that these higher valuations are justified, and I do think that it's important to point to those structural and those cyclical reasons. Structurally, we know that the index, mix shift has changed quite considerably over the course of the last 20 years, with a much higher proportion towards technology and communication services, and those have driven the lion's share of not just the market rally, but I think this brings into the cyclical point of earnings growth as well. So we've seen the Magnificent Seven grow earnings last quarter 28% year over year. That matched what we saw the quarter prior. We do think that shifts back down to around 15% year over year in the next quarter, but importantly, that's still quite, I think, profound earnings growth. And then from there as well, when we historically look at Fed easing cycles, typically risk assets tend to outperform quite meaningfully when the Fed starts cutting.
Okay, so you clearly have lots of reasons why you think this is different this time. There are reasons for these higher valuations. What role do private markets play here? Because there could be an argument that with the rise of private markets, maybe that's where a lot of capital is going, and maybe it's not going to be in the public markets, and maybe that's something that weighs on valuations. How do you look at the link between the two?
I think it's really important to do so. I think when we look at high valuations, we're also looking at the risk around concentration as well. And when we're seeing that happening more so in public equities, I think that signals to us, can we also achieve similar levels of growth and opportunity in private markets? And I think especially now with where the CapEx cycle is in terms of AI, but also in security spending, a lot of that is happening in private markets. And so I think from our perspective, we would want to take more of a barbell approach between public and private markets when we're talking about capital for growth.
Part of the issue with private markets right now, even though everyone seems to be super bullish on it, is that ultimately they are long duration assets. And you're seeing in some places, like endowments, for example, pulling back from some of the private asset classes because of the geopolitical volatility, some of that including some of the shutdown worries as well. So given that we are less than 24 hours away from a government shutdown, things aren't looking very rosy. How do you play a government shutdown in a portfolio? If not now, then I'm sure in 2 or 3 months' time.
Yeah, and I think when I think about government shutdown risks, when I think about geopolitical risks or inflation risks, it comes down to the same type of anchor for me, which is on portfolio resilience. So how can I position for my base case outcome for continued growth and stability, even if it's a slowdown, but how do I also prepare for the tail risks? And I think in that scenario, we want to continue to be mindful of duration risk when it comes to fixed income. We want to be quite careful around probably not focusing too much on that long end of the curve, which is more, I think, is less immune to those fiscal risks, as we've seen bond yields spike quite meaningfully. So we'd be more focused on that 5 to 7 year part of the curve, which is more insulated and also still offers a pickup in yield. But I think importantly, we want to have exposure to real assets if things become a little bit more unwieldy as well. So thinking, again, gold, which we've had a big conversation about already this morning, thinking infrastructure, and also outside of that, structured notes around managing volatility in public equities.
Are steepeners a crowded trade in this market?
I think it's certainly a big focus, and I think that we do continue to expect the curve to steepen out a bit from here as the Fed cuts. But I think, you know, when I look at that, I also take that as a warning sign to reconsider any cash allocations. So we know that cash still has quite a high yield today, but we've already seen interest rates fall across the curve. From the 2-year to the 10-year space quite considerably. And so I think with that in mind, we do expect cash yields to fall in tandem with that. So we would want to move and leg out of cash, I think, as that first step.
Madison, you had mentioned that traditionally risk assets outperform when the Fed is in a cutting cycle. But how are you viewing AI in the middle of that? Because you can argue that it's already outperformed. It's at precarious valuation levels. But at the same time, it's really powering a lot of the gains across the U.S. equity market. So how are you squaring those two arguments?
I think we expect technology broadly and AI-related names to continue to rally from here. And again, that comes down to not just optimism and sentiment, but specifically the earnings growth that we are seeing. So while we might see a slowdown in earnings growth from here from those hyperscaler names, I still do expect that to be quite strong and robust into this next quarter. But importantly, I think if you are a little bit worried about AI valuations, one way to play that instead would be focusing on the power gap instead. So we know that there is a lot of demand for AI, but there's not enough assets to ultimately power behind it. And so there's a huge capacity gap around that. So I think if you are a little bit worried about how AI might evolve over the coming quarters, focusing on utilities, focusing on data center infrastructure assets are one way to play that as well.
Yeah, we have a great big take story out this morning, don't we, which talks about the way that they're seeing localized price of energy increasing in certain parts of the US when they're very close to data centers. So clearly there's something to that. Let me ask you, before we were, as we've been excited about AI, we've also been a little nervous about tariffs. We heard from the CEO of PIMCO yesterday, Manny Roman, saying that the impact is broadly yet to be seen. How does that fit with our, resilient margins narrative that we talk about, justifying stock valuations?
Sure, and I think to be clear, we do expect margins to moderate a little bit from here, but I think importantly we are at historically high margins as well, which has, I think, enabled the tariff cost framework to ultimately take some time to impact the economy. From here, I think we would be looking at how much margins could take a step down, because ultimately deteriorating margins are typically a precursor towards layoffs. But I think we're still a far way away from that. But that's certainly a risk that we would be watching out for.
When we talk about the margins picture, how much of the margin compression comes at the expense of really rich cash flow, liquidity on balance sheets? And is that something that would ultimately haunt the stock market?
I think it's possible that we see a step down in the cash flow resilience that we've seen from these corporations. We've already seen a moderation, especially from the hyperscaler group from here. But I think what we're watching for more acutely is whether or not all the capital investment that we've seen ultimately results in an analogous payout. And I think if that point in time that we reach where the capital spending starts to outstrip that, that's the time in which we would be a little bit more worried. But I think when we look at future expectations for earnings growth, even as we are starting to see free cash flow start to moderate a bit, we are still looking at rising earnings expectations, not falling.
All right, Madison Fowler, Global Investment Strategist over at JP Morgan Private Bank. Thank you so much for joining us around the table this morning. In the meantime, let's get a quick check on the core six, of course, the heavyweights that move this market in a very big way. Your biggest mover really is a continuation of the drop we're seeing in Novo Nordisk, down about 1.2%. Nestle, however, seeing a bit of a bid on the surface. When you look at the core six, that looks like a defensive trade to me. Tech seeing a little bit of love, and Nestle is a consumer staple seeing a little bit of love. But of course, the luxury space and the healthcare space on the back foot. Rheinmetall also down by 0.8%. Interesting story there. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that for us. Chloe.
Good morning, Christy. Let's start with the gambling space. So there's a little bit of weakness across those UK gambling stocks after UK Chancellor Rachel Reeves hinted that she's open to raising taxes on that industry. Rachel Reeves is trying to figure out ways to boost the UK finances without raising taxes on working people. And it seems that that gambling industry could be a potential target. And therefore, there's a little bit of weakness that's driving the shares down for Evoke in particular, which is down 1.5% this morning. Moving on to UBS, which is actually up after pushing back on Switzerland's plan to increase its capital requirements. It said that that would hurt competitiveness, it would put its future into doubt. And there was also a report from Reuters about the fact that there's a willingness to reach compromise on both sides about those capital requirements. And so that is received pretty well by the market, and we are up 1.2% this morning for UBS. Moving on to ASOS, the retailer, the online retailer, is down quite a bit this morning, is down 8% after saying that the adjusted EBITDA for this year would be at the lower end of the consensus range. It's trying to, it's in the middle of a complex turnaround plan, and it also follows the update that we got from Next, another retailer recently that flagged weaker sales because of a slowing UK economy. So there seems to be now a bit of a pattern there. So definitely something to keep an eye on with those online retailers, the UK retailers in particular. And finally, let's end with another UK stock, Close Brothers. The earnings disappointed this morning. It is down 4.7%. It also said it was offloading its vehicle hire business, and that is weighing on the stock this morning for Close Brothers.
All right, Chloe Melly from our equities team walking us through some of those early movers. Chloe, we thank you so much. Coming up on the program, Zijin Gold soaring on its Hong Kong debut. We'll have more on the world's biggest IPO since May next, plus what it means for deal volume around the world. Stick with us. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 18 minutes into our European session, and gains actually disappearing, fading on European equity markets just a little bit, down around a 0.1% overall on the Stoxx 600. US futures fading a little too, down 1 or 0.2% at this early stage of the day stateside. Now let's go to Hong Kong. Zijin Gold has jumped in its debut in Hong Kong after going public in the world's biggest IPO since May. This seems to be incredibly well timed with these record gold prices. I should, though, correct something we said earlier on Bloomberg TV. We said that Zijin Gold raised $32 billion. That was not correct. In fact, they raised $3.2 billion. Let's get more, though, on the deal, and it's clearly had a big pop on the open. So let's get an update from our Bloomberg Deals reporter, Manuel Bagori, who is with us this morning. Manuel, so tell us a little bit more about this IPO, this very well-timed IPO.
Very exciting and very well timed, and you're right. I mean, with the backdrop of gold prices going through the roof, right? It sounds like the perfect timing to IPO assets like Zijin Gold, and $3.2 billion. It makes it the world's largest listing since May. Hong Kong actually is bringing, some of the largest equity capital markets transactions this year. We saw CATL, the battery maker, also the largest so far this year in May, and now Zijin Gold, the second largest so far this year. So people are very excited. Deal makers are very, very drummed up after this transaction. There is a ton of activity here in Hong Kong, and obviously in the case of Zijin Gold, when the shares are rallying on their debut, is always very welcoming. Obviously, as explained, the rally in gold prices is supporting that. And also, as we've reported in the past few weeks, the fact that Zijin was able to attract some very important cornerstone investors as well, that helped as well solidify the deal.
Yeah, gold miners, at least in the past 2 months, have really outperformed even the price of gold. I'm sure those lower short-term interest rates have been helping them in their efforts. But being the world's top IPO since May, what's really backing the deal-making environment, and how does it look like at the moment?
Yeah, there is a lot of optimism around, especially here in Hong Kong, around equity capital markets. There's been a lot of second listings. There's been some IPOs. There's been a lot of convertible bond offerings, exchangeable bonds, placements. So there is a lot of activity on that. Part of that driven by the fact that there is more hopes for China deals after many years of being very subdued. Finally, we are seeing international investors coming back, and that's supportive or conducive of larger deals like the ones that we've seen so far. Deal makers remain very optimistic into the fourth quarter and into next year. Geopolitical, challenges aside, Hong Kong is definitely coming back, especially when you compare to other venues, say London or even the US. Activity is definitely booming here. We've also looked into deal making, and for this third quarter, obviously beyond ECM, we're seeing a lot of activity also on mergers and acquisitions, which is also very encouraging.
Well, speaking of, let's talk about one deal that, of course, has taken the world by storm. It feels like EA, Electronic Arts, which is, of course, the game maker behind FIFA, among many others, getting the world's biggest LBO ever. We're looking at $55 billion. We're seeing a take-private deal, basically. Manuel, 3 months ago, if you told me we were about to see the world's largest ever LBO, I would have said, that's insane. The geopolitical volatility, the capital markets would not support it. What's changed to make deals like this more juicy?
Well, exactly, Kriti. I think what you said is perfectly right. There was a lot of doubts coming into this year. The expectations with the Trump administration were very high with regards to a deal-making boom. The year started somewhat slow, but now definitely is picking up. And I think the momentum is building into the first quarter and into 2026. I think the fact that we're seeing these large, massive deals like the one that we just saw overnight is just very, very encouraging for others to explore transformative deals. And especially we saw this deal in particular was supported by a $20 billion financing package by JP Morgan. That is the largest we've seen so far.
Yeah. All right. Bloomberg's deals reporter, Manuel Bagore, walking us through some of the deal space. Thank you so much. In the meantime, he was talking about some of that geopolitical volatility. Let's go there next. President Trump has ordered 10% tariffs on U.S. imports of softwood timber and lumber, in addition to levies on kitchen cabinets, vanities, and wooden furniture. Sounds like everything you need in a home. Brendan Murray, who leads our global trade coverage, is all over this story. Brendan, another day, another tariff salvo. Do we care?
Yeah, exactly. Well, I think we care because this one shows how targeted the Trump administration can be with its tariff authorities. Remember, the Supreme Court is looking at its broader tariff authority on the universal country-by-country tariffs. There's a hearing in November, so the administration is lining up some of these so-called 232 cases to be able to hit the tariffs and protect industries that they're looking to protect. Remember, back in April, this was a big universal tariff on every country in the world. These are tariffs that are going to help furniture makers in North Carolina. So we go a lot more micro with these.
Yes, absolutely. Helping make North Carolina great again, I think President Trump was saying. Let me ask you about the movie industry, the film industry, because yesterday I saw talk of tariffs on furniture and movies, and then the movies part seems to have faded from the coverage. So what's happening with the movies side?
So this was brought up originally a few months ago, back in May. Apparently, President Trump had a conversation with the actor Jon Voight, who has been a supporter of President Trump. Came away from that and said, what we need are tariffs on movies, on foreign-made movies. And the president reiterated that yesterday. It really opens up a can of worms into a realm of services trade, really. We haven't seen tariffs on services. A movie is obviously made with actors and cameras and actual things, but the actual movement of movies across borders is an electronic one, a digital one. And so it really opens up this question of whether you can put a tariff on a service, and if you can, what does that do to services that Google or Facebook or Netflix provide to other countries around the world? So it opens up the trade war into the digital space.
All right, thanks to Bloomberg's Brendan Murray on the latest on Trump tariffs. My question on my mind is, do these Section 232 investigations still continue if we have a government shutdown? I guess they're under the executive branch, so probably they're still staffed. But coming up on the show, we'll check in on the U.S. political situation ahead of a looming government shutdown, which could happen later tonight at midnight on Washington time. More on that story next. This is Bloomberg.
Do you think the dollar will remain the only reserve currency in the world, and are you as comfortable with the dollar as you used to be?
The dollar has been, as you say, a reserve currency for about 80 years. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars, and that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back to the opening trade, and happy month end, happy quarter end to those who celebrate. We're 30 minutes into today's cash equity session here in Europe, and it is looking fairly negative, but not as negative as it did just 15 minutes ago. Eurostock 600 just really flat to the downside. Some underperformance in France. We've got the CAC 40 down 0.3%. Some real weight on the energy names today. Perhaps the reason for the underperformance there. That was the back of the oil prices yesterday and today continuing to slide further. Kriti, how's it look under the hood?
Absolutely. Total, one of the key movers when it comes to the downside in the CAC Iran. You also saw a lot of the luxury names see a little bit of weakness, but I think that just kind of amplifies what we're seeing, and it comes to the members moving higher versus lower. Literally almost split, almost is the emphasis there. 315 lower, 264 higher. Volume is also lower. As Val was mentioning earlier, we are seeing some rebalancing flows this week. It's the end of the month, end of the quarter. Maybe a little bit sitting on the sidelines when we get some of the reaction out of the U.S. when it comes to the shutdown. A ripple effect there, of course, we're all on standby for. There is one 52-week high I want to put on your radar. Anglo-American is hitting one. We are seeing a massive metals rally to the upside this morning, and you're seeing it happen globally. Anglo-American benefiting from that and hitting a 2-year high when it comes to stock price, Anna.
Kriti, let's get an update on some of the big stories we're covering this morning. The UK Prime Minister Keir Starmer is looking to turn around dismal poll ratings as he addresses the Labour Party's annual conference later today. In reference to Nigel Farage's Reform UK party, Starmer is expected to tell the country the choice is between, quote, decency and division. The UK Prime Minister has previously said Reform, quote, want to tear the country apart. The governor of the French central bank says the nation must overcome its political impasse to tackle its debt burden. Francois Villeroy de Gallo told French TV concerns over high government debt are weighing on corporate investment and hiring and pushing consumers to save rather than to spend. This, as a new opinion poll suggests the far-right leaders Marine Le Pen or Jordan Bardella would easily win the first round of any presidential election to take place in France if it were to be held this week. And on to gold prices. Gold has hit another record as Vice President J.D. Vance says the U.S. government is heading for a shutdown. Federal agencies are preparing for a possible shutdown with plans that call for temporary furloughs, but not permanent mass firings. More than 400,000 employees may be sent home as non-essential. And Valerie, this for markets is a big topic of conversation. Yes, there's always the temporary furloughs. I think some of our coverage has suggested that there could be more permanent firings this time around. But also the market is very much focused on the data and whether we're going to get the data that we're used to.
Yeah, that's right. With the government shutdown, we don't get the data from the Bureau of Labor Statistics. And this week, that includes the weekly jobless claims on Thursday and non-farm payrolls on Friday. The rest of the market is the Fed does not have a clear steer on the labor market or inflation before its decision later in the month. Well, staying with this story, Vice President J.D. Vance says the U.S. government is on track to shut down after a meeting with congressional leaders, blaming Democrats just a day before the federal funding is set to expire.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
We've had 45 days and 45 days and 45 days and 45 days. We asked to meet earlier, they didn't want to. So we think when they say later, they mean never. We have to do it now, first because of the timing issue, and second, because now is the time we can get it done.
Let's get more with Bloomberg's Jill Desis. Jill, Vance is blaming the Democrats, but what exactly is holding up talks for funding the government?
Right. So, Valerie, ultimately what this is coming down to is a debate over some of these healthcare issues that Democrats have pursued here. So one of those, and I believe that Chuck Schumer was just referring to this in this clip that you've just played, but this idea of that they may not be extending some health insurance premiums under the Affordable Care Act. So those are set to expire. The idea of these subsidies kind of continuing. That's something that Democrats have said that they want to be resolved in part because if those subsidies aren't extended, then that could mean that for quite a lot of Americans, you see healthcare premiums increase fairly soon. So that's one thing that Chuck Schumer is talking about when he wants to get that sort of priority dealt with as they move toward these shutdown talks within the next day. The other thing, too, that they're really concerned about from the Democratic point of view are actually cuts to Medicare that passed under Trump-led tax legislation earlier this year. That's something that I think might be a little bit more difficult for them to actually bring the Republicans to the table on, but you kind of see there this idea from the Democratic perspective that they want these issues addressed now because I think there's a concern that the Republicans may not actually bring those issues back up if they get past the stopgap spending bill and to talk about something longer term. Of course, from the Republican perspective, they're saying that the Democrats are essentially using these types of wedge issues to hold the government hostage, and so that's where you see a lot of this communication breakdown actually happen. I will say that for what J.D. Vance said earlier about the fact that it does seem like the government is headed toward a shutdown, he did say that the president sees some of the Democratic perspective as, quote, reasonable. So it may be that there's something that they can kind of compromise on, or maybe they focus on one of those priorities, but obviously we're nowhere near that yet. We'll have to see what the next 24 hours really looks like here.
Jill, without an open government, that means no jobs data. What do we do without jobs day on Friday?
Yeah, I mean, I think that's really, as we've talked about, one thing that the markets are really looking at is not having that BLS data. I mean, we've been talking about all summer the idea of, how do you, some questions about BLS data, what exactly happens in the absence of something. I think that that's really where some of these jitters come from. I mean, look, I think, as you're setting up through the rest of the year, kind of preparing for, what future FOMC meetings ultimately look like, you obviously want to see what those non-farms are going to look like, what those jobless claims are going to look like. I mean, it could be the case, though, that the government does shut down. You don't get that data this week. Maybe there's a bit of a delay in terms of when we actually see the BLS reports. I think it's, a pretty, obvious concern as we head into the end of the week. But, this is a really, really fluid situation. I think, when you are dealing with some of these shutdown deadline stuff, often, is still unfolding into the very, very, very last minute. So I think it's going to be a pretty fluid rest of the day here in the U.S.
Bloomberg's Jill Deesa is walking us through the state of play over in Washington. We thank you so much. Let's get a little bit more on that subject. Certainly something the markets are watching in terms of the shutdown risk and, of course, what's top of the Trump administration's agenda. Let's bring in Scott Lucas, professor of U.S. and international politics over at the Clinton Institute at University College Dublin. Scott, pleasure to have you as always. Thank you for your time this morning. It feels like a foregone conclusion, both by officials at the White House, including Vice President J.D. Vance himself, and market participants, that we are indeed headed for a shutdown at midnight tonight. Scott, my question to you is, how long does it last?
Well, that's a question that can't be answered at this point because it depends on, to be honest with you, the sides, whether or not they're willing to compromise, which side blinks first, if one does blink first, how much do they dig in? What I would say is what I was looking at this morning in terms of the immediate divergence. What was striking is that you did have the Democratic leaders in Congress, Chuck Schumer and Hakeem Jeffries, come out and say, not only, do they want the deal, which restores some of this health care funding that was cut, they want the extension of the Obamacare subsidies, but they thought that the deal was possible. They thought that Donald Trump is open to the deal, even if some of his advisors were not. So they were holding up the idea that this could be a short-term shutdown. There's room for negotiation. In contrast, although J.D. Vance offers some glimmer that there might be a room for negotiation, Donald Trump, a few hours ago on his Truth Social account, retweeted, or actually tweeted, a racist deep fake video in which Hakeem Jeffries, over Mexican music, was dressed in a sombrero with a large mustache. Chuck Schumer's voice was faked to have him declaring that undocumented migrants get free federal health care. And then just after that, Stephen Miller, who I think is Trump's key advisor here, doubled down on that falsehood. So certainly, at least in terms of the public presentation, you've got Trump and key advisors not only not giving ground towards a deal, but actually pushing disinformation to dig in even further.
Scott, talk to us a little bit about, you outlined there beautifully, I think, just how much division there is and how much animosity there is between both sides. It looks like we're going to have this conversation again about healthcare subsidies in about 2 or 3 months' time. Just walk us through, when it comes to the average American consumer, of course, we're a financial network, we're watching the inflationary pressures here, just how much of an impact some of these not extended subsidies could have when it comes to Americans?
Well, I think it's going to be key because, and your viewers will well know this, we're going to have a convergence of factors over the next few months. We're going to have the continued pressure on inflation in general, including because of Trump's unpredictable approach to tariffs and the effects on American consumers, on producers, on importers. You then have the prospect beyond that, which is this spike in unemployment you're going to get when you get hundreds of thousands of federal government workers who are coming off payrolls at the end of this month because of forced retirement, or redundancy, I should say. And then on top of that, you get this question of how much will healthcare costs go up if the subsidies are not extended? Now this has been an issue. I've lived with this for decades in terms of the American healthcare cost amongst the highest in the developed world, because of the nature of the system. Obamacare was trying to check some of those inflationary pressures. And if you start to gut that, you get back into unpredictability, as well as the rising prices. And I think that's why you're seeing some Republican senators, Josh Hawley of Missouri is one who came out yesterday, who are breaking from the administration on this. They're saying that we have to look hard at these subsidies and whether or not we allow them to lapse. And we have to look at the related issue of rural hospitals closing down. So I think for the first time, perhaps on an economic issue, over health care, I think Trump may face some pressure from with his own members in Congress.
Scott, can you talk to about the technicalities of what happens during a shutdown? Because some could argue that maybe Trump doesn't mind the U.S. government shutting down because he gets to decide what's essential and what gets funded while the government is shut down. Do you think there is any credence to that argument?
Well, let's look at the history here. Donald Trump presided over the longest shutdown in U.S. history during his first term, 42 days, if I remember. And that, of course, was trying to pose over the issue of immigration and over the need for his wall with Mexico. So he was willing, to extend this for a few weeks. But going back to your initial question, then he backed down. After 6 weeks, you did see that concern over the effects on services begin to chip away at him. Now, I think in the short term, you're going to have posing by the Trump administration because the U.S. military, for example, continues to function. And what do we have today? Defense Secretary Pete Hegseth summoning all the military commanders back for either what is a pep talk or a declaration that they have to pledge loyalty, depending on who you're reading. Well, that shows Trump's control over the military. You're going to see Trump's control over some essential services. I think the administration will play up the idea of law enforcement, especially in connection with their push regarding migration and the ICE sweeps on the streets. But when you get to the nitty-gritty of day-to-day life, are those support checks going to be in the post? Are you going to be able to get the essentials that you need in terms of federal support regarding health care, regarding Social Security? Is the transport system going to function effectively? Are you going to see any disruption in your life from what you consider normal? That's when the rubber hits the road for the Trump folks, because they can't declare that Trump is going to sweep in and make it all okay, because he can't if the funds are frozen.
Scott, is there anything he could do, perhaps maybe to stop the funding to the Supreme Court? We know that the Trump tariff case is currently scheduled for early November to be heard, those initial arguments. Could he perhaps do something, I guess, extraordinary to shut down the Supreme Court in the meantime?
I'd be really surprised at that, because to be honest with you, the Trump, so far, the Supreme Court, it has in some cases not ruled in the Trump administration's favor, but in most of the time, it's actually given the Trump administration more time. It's actually referred cases back to lower courts. And while doing so, has supported for the time being the Trump administration being able to wield this executive power. And I think the Trump administration's play here is to think the Supreme Court will do the same thing in November, that they may not make a final ruling on that tariff case. That will give the the Trump folks, weeks, maybe even more months to go ahead with, the tariff unpredictability.
Scott, so interesting that the focus, of course, will be on the shutdown in the very short term. Yeah. Looking ahead, we've had a few guests mention the midterms and the role that might play. From the politics perspective, how would you expect things to shift as we approach the midterms? What is going to be on President Trump's mind?
Well, both for Trump and the Democrats, that what we're going through with this shutdown is already factoring in terms of how do they think that will play for November 26. Will the Democrats take the blame for freezing government because, they're holding the administration hostage? That's going to be the Republican play. The Democrats are saying, well, look, you're holding our health care hostage, and we need to make a stand here. Which side benefits? But I've got to tell you, Harold Wilson, the British Prime Minister, once said a week is a long time in politics. 13 months seems like an eternity. The range of the imminent issues that are faced here, when you've got the military on American streets, when you've got an economic policy which is it's certainly not settled, when you've got this mixture of bullying and intimidation, and I think most importantly, when you've got an administration, politely people would say it is the expansion of executive power. This is an unprecedented attempt to overrun other agencies, overrun other branches of government. Now, that doesn't mean that they'll lose votes because of that. Some people may support that extension of power, but I think you're going to see this divide widen between the Trump folks saying our way or the highway. And the question is, how many Americans say, look, they really want to get back more to a notion of consensus? It starts with an issue like the government shutdown, and it plays out all the way into November 26.
Scott, thank you very much. Scott Lucas, Professor of US and International Politics at the Clinton Institute, University College Dublin. Thank you so much for your time. Let us go to the commodity sector now, where we have some news just breaking. China's state-run iron ore buyer, this is China Mineral Resources Group, has told major steel makers and traders to temporarily halt purchases of all new BHP Group cargoes. This is widening an earlier curve as contract talks have stalled. So no resolution of these contract talks. This is all according to people familiar with the matter, and it's having an impact on BHP shares here in London, which is why we bring this to your attention, currently down by 2.6%.
Absolutely. Let's go to our next story. President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. It's unclear, however, if Hamas will accept the proposal, which calls for the group to disarm, relinquish control of Gaza, and release all hostages.
I also want to thank Prime Minister Netanyahu for agreeing to the plan. If accepted by Hamas, this proposal calls for the release of all remaining hostages immediately, but in no case more than 72 hours.
I believe that today we're taking a critical step towards both ending the war in Gaza and setting the stage for dramatically advancing peace in the Middle East.
Let's get a little bit more inside analysis here. Our Horizons Middle East and Africa anchor Jumana Bersetchi is in London this week. Jumana, just walk us through the details of the plan and where we go from here.
Yeah, well, I think the most important part of the plan is that the war will immediately end if both sides sign on to the proposal. So that's the main takeaway here. It could be a watershed moment. Of course, we're waiting to hear back from Hamas. There's been no official response yet from Hamas officials. They said last night that they're reviewing the proposal, but of course there is a 72-hour window by which, by the end of it, they would like to get a response. And what we heard yesterday from the U.S. President Donald Trump, is that they've been working very hard behind the scenes, not just with Israel, but also with their Arab allies in the region as well, to get this across the line. And perhaps that is one incentive for Hamas to sign on to the deal, because you have the likes of Qatar, who obviously have been playing an increasingly very important mediation role in all of these talks. And the war has been going on for almost 2 years now. Prior to this 20-point proposal being released, there was reporting suggesting that a phone call had taken place between the Israeli Prime Minister and the Qatar PM, whereby Israel, quote-unquote, apologized for the attack that took place in Doha. They actually expressed regret that it had happened and really re-emphasized the attack in Doha was an attack against Hamas and not necessarily an attack against Qatar. Why is that important? Because in order to get Hamas to agree to some of the terms of this proposal, it is very important for the region that Arab states were also involved in the solution. And if you look at some of the terms of the proposal, of course, it talks about the immediate release of hostages. It talks about the disarming of Hamas, but then it also talks about what happens next in post-Hamas governance, establishing an apolitical Palestinian committee with oversight for what President Trump is deeming a transitional board of peace chaired by no other than himself, alongside Tony Blair. So there are plans for the future. The question really is whether, number one, Hamas actually sign on to this, and number two, whether Israel, from the Israeli government's perspective, they deem that these steps taken by Hamas are sufficient for them to say and declare that their war objectives have been achieved.
All right, thanks to Bloomberg Horizons Middle East and Africa anchor Jumana Bersetchi on the latest in Gaza. Well, coming up, can Keir Starmer stare down the threat posed by Reform UK? We're live from the Labour Party conference in Liverpool next. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back to the opening trade. About 54 minutes. I'm going to get my math right there. 54 minutes into today's session. Red on the screen across the board. Serious weakness, though, when it comes to the French markets. The CAC 40 down about 0.6%, but the rest of the market down, we'll call it circa 0.3%. This just does feel like a little bit of a cautionary day, maybe pulling back from some of the action we've seen last week as well, not to mention the rebalancing flows last day of the month. Last day of the quarter. We'll see if that all shows up a little bit more throughout the rest of the session. In the meantime, one eye firmly on focus in the UK. After the UK Chancellor's address, the Labour Party conference concludes today. The main event, a speech by Prime Minister Keir Starmer less than 15 months after winning a landslide election victory. Starmer's party is languishing in the polls behind Nigel Farage's populist Reform UK. Bloomberg's Lizzie Bird is all over the story for us. She's live in Liverpool and joins us now. Lizzie, a lot of pressure on the Prime Minister today.
There is, Critty, and in moments like these, we always wait for a rabbit out of the hat, the policy that is going to turn around the fortunes of a Prime Minister, and he could really do with that, as you say, languishing in the polls behind Reform UK. I'm looking for hints from what the Chancellor said yesterday. She was asked on ITV whether she'd be open to raising the gambling tax, and she signalled that she would, and indeed we're seeing the gambling stocks down at the open this morning. Interestingly, the cost of that is what it would raise is the cost of lifting the 2-child benefit cap. So maybe that's the rabbit that we'll get from the Prime Minister today. But really, policy isn't going to be enough. The focus is on the change of message from the Prime Minister. He says that Labour is fighting for the soul of Britain against Nigel Farage. And indeed, that is a battle that extends to business. We had reports that Nigel Farage had a business dinner yesterday to lure some of the business leaders away from Liverpool. But speaking to some of them here in Liverpool, the CBI, for example, saying that actually business is a bit worried about Farage's policies and that they want to retain the access to global talent. So we'll see what's on offer for business in the Prime Minister's speech today.
Bloomberg's Lizzie Burden in Liverpool, live at the Labour Party conference. Thanks for joining us on the latest. Let's look ahead to the risk events on the horizon for markets. We do still have some CPI readings out from across Europe. At 10 a.m. is the Italy reading. At 1 p.m. is the Germany reading. And then attention goes to the U.S. We get JOLTS data. That's the job openings data out at 3 p.m. We also get consumer confidence. This could be some of the last readings on the labor market as we head into that government shutdown to be taking place at midnight tonight if an agreement is not reached between the Democrats and Republicans.
Okay, so the market focused very much on the shutdown dynamics. On a programming note, I should tell you that tomorrow we will have special programming on the opening trade covering the Bloomberg Women, Money and Power conference that is taking place here in London. The event convenes the most influential female voices in finance from around the world to discuss consequential themes facing the future of business. Plenty of conversations about the global world of finance, about private markets, around public markets too, of course. We will bring you some of the highlights. We'll be building towards the conference which takes place here tomorrow. European stocks are down. The pulse is next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
A U.S. government shutdown looms as President Trump and top congressional leaders failed to reach a spending deal. Gold hitting another record in the meantime. And sticking with Washington, the U.S. President Israel's Benjamin Netanyahu agreed to a 20-point proposal to end the war in Gaza. Hamas has yet to respond. Plus, in the corporate space, UBS warning that planned capital reforms may put the firm's Swiss future in doubt. The story we've been following, we're going to watch for the market reaction. In the meantime, let's dive into how the markets are doing. The Stock 600 on the back foot this morning. You are seeing it down by about 0.3%. Similar story across the Atlantic with S&P futures just over 6,700. Euro-dollar as well, 117 handles. Weakness in the dollar, strength in the euro is a theme across Europe and, of course, across the currency picture as well. And Brent crude, one eye firmly on the geopolitics, 67 handle on the oil benchmark. Let's talk about what's going on in the broader European story because, of course, we are seeing red across the screen. I think this is really important because your weakness, your main pain point this morning is going to be in France. You are seeing the luxury story drive down that metric. LVMH, Pernod Ricard as well. You do see some moves in the tech space. Schneider Electric, for example, defying gravity in that benchmark, but the CAC 40 as a whole is your key decliner across the board. And as we, of course, monitor those markets, we do have some economic data crossing the Bloomberg terminal, some inflation data coming out of Germany. Let me walk you through the numbers. Germany's Bavaria September CPI rising 2.4% year over year. And Germany's Saxony September CPI numbers as well, higher by 2.2%. We're going to monitor the market reaction. Lots to digest. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, sitting in for Francine Lacqua this hour. To our top story, Vice President J.D. Vance says the U.S. government is on track to shut down after a meeting with congressional leaders blaming Democrats just a day before federal funding is set to expire.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what the Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
We've had 45 days and 45 days and 45 days and 45 days. We asked to meet earlier, they didn't want to. So we think when they say later, they mean never. We have to do it now, first because of the timing issue, and second because now is the time we can get it done.
Let's get more on this story. Bloomberg senior editor Balazs Pence joins the program. Balazs, just walk us through what's holding up some of these talks. What's the pain point here?
Well, Kriti, at the center of the issue is healthcare spending. As we have seen so often over the past decade, particularly in this case, the Democrats are pushing for keeping some Obamacare subsidies going. These are subsidies that help keep premiums down for lots and lots of Americans. And they're also trying to reverse some Medicare cuts that the Trump administration enacted earlier. And while we have seen some daylight in these statements that we just heard from J.D. Vance and from Chuck Schumer, which does suggest that there's some room for a compromise, both sides are very busy kind of framing the debate in a way that would allow them to blame the other side if there's a shutdown, which suggests that we could be in for an end of government funding for the first time in more than 6 years since that historic 35-day shutdown during the first Trump administration, because right now both the incentives and the frameworks and the sort of nature of the debate suggest that neither side is particularly interested in reaching the compromise. Although it has to be said, we've seen this many, many times before. These shutdown negotiations often do go to the very, very last minute. So there could be another solution, but it's going to be a very interesting, very volatile last 24 hours in Washington.
Balazs, the longest shutdown on record lasted about 14 days back in 2019. If we do go into a government shutdown yet again, which seems to be the foregone conclusion by market participants and strategists around the world, as you just outlined, what is the impact on Friday's jobs numbers?
Well, that would be like Christmas being canceled for markets, right? The Jobs Day is always a great, very exciting day for markets. It's a notoriously difficult number to predict. It's a very volatile number, so it's always room for great trading. And it's also a key number, perhaps the most important indicator when it comes to predicting which way the Fed will go. And you have to wonder, if there's no jobs number, how comfortable will Fed officials feel with perhaps continuing with rate cuts when there is still more inflationary pressure in the economy coming from the continuing introduction of more and more tariffs. So that would create a certainly very interesting situation in markets and a very difficult position for the Fed to be in.
Balazs, I love that you said that. Christmas being canceled potentially on Friday. The question, I think, for everyone is, who's the Grinch? Is it the Democrats or the Republicans? Balazs Pence giving us the rundown on that story. We thank you so much. Setting us up nicely for our next conversation in terms of how the markets are supposed to play all of this. I'm joined now by Temos Fiotakis, of course, the global head of FX strategy and EM macro strategy over at Barclays. You're in the hot seat today. What does a government shutdown mean for the FX markets?
I think, as you said, for some days or maximum a couple of weeks, we're going to get some uncertainty around the numbers, around what's going to happen with the Fed. And, you know, there might be also some interruption in spending from the government, which it could weigh potentially in a couple of numbers. But historically also the case is that once the government reopens, arrears clear, money gets paid back, and then the economy moves on. So while the market will trade, you know, the weaker dollar, the off-risk sentiment, and so on and so forth, at some point that will become an opportunity as well. I'm not even sure if this becomes even a tradable sort of like mini cycle or not.
Well, it's interesting that you say that, because if we do get through this iteration of the government shutdown, it looks like when you look at some of the bills that are in Congress at the moment trying to make it through, we're due to revisit this exact conversation in November and in December as well, which I think is a good moment to broaden out for a moment and talk about the fact that a lot of the dollar weakness has been attributed not just to some geopolitical volatility emanating out of Washington, but a lot to do with its balance sheet. So let's talk about the numbers here. When it comes to the U.S.'s fiscal debt issues, should the dollar be trading off that, or are we looking at something else?
I think it's, you know, you're touching on an angle of the story. You know, obviously there's a pretty big stock of trade, of debt in the U.S., but against that you have assets of U.S. households and corporates that are 6 or 7 times GDP. So I don't think the issue is necessarily the stock of debt. The main issue for the dollar has been that over the last decade, the ownership of U.S. assets has increased in numbers, basically, right? So 2014, on net, foreigners used to hold 500 billion of U.S. assets. Today, that net number is close to 25 trillion. That ownership being increasing because there's no huge investment alternative to the U.S. There hasn't been for the last decade. And as a result, people are worrying that if the markets lose faith in the U.S., or if markets lose faith in the currency proportion of U.S. investments, they'll take the money out or hedge the FX risk, and the dollar will weaken as a response of government policies. However, we have argued that this line of logic is not without fail, I would say.
Well, walk us through, keep going. I mean, elaborate here, because at the end of the day, one of the key reasons that you're seeing the euro outperform has been this sell America trade as well. But you've seen it rebound in the equity market. You've seen it rebound in the bond market, arguably in the commodity market as well, in terms of, I'll say, WTI and dollar-denominated commodity contracts. Why is the dollar so uncorrelated with the bond market right now?
I would argue that the dollar has been stable since June, roughly speaking. It hasn't rebounded, as you rightly point out, but it hasn't massively sold off. And it hasn't sold off despite the fact that you've had a lot of bad news for the U.S. economy, a lot of noise around Fed independence, and a pretty big widening in rate differentials in favor of Europe, basically, right? So you've had this cyclical shift, you've had this narrative shift in favor of the euro, but the euro has not made progress. Why? First of all, we haven't seen the outflows from the U.S. In fact, very soon, outflows became inflows in a very rapid way as U.S. assets rebounded. Second, we haven't seen the increase in hedge ratios in reality that the market was worried about. People are not hedging their dollar assets in droves. In fact, in our estimates, the amount of hedging that has happened in terms of dollar asset has actually decreased over the last few weeks or months as a share of AUM. And on top of that, you've had a lot of the big pools of assets in Asia being worried about floating their currencies, what I call fear of floating. No one wants a strong currency during a time of trade pressures. And on top of all that, the U.S. economy has done better than people would have expected. And we are about to see an acceleration in the U.S., given easing in financial conditions, given some fiscal stimulation as well. Who knows how much that is, but at the very least, you can make some statement that the worst is likely sort of like behind us. So if you put that all together, you get a sense that maybe some macro forces are pointing to a bottoming out for the dollar.
So due for some strength then when it comes to the greenbacks. Let's talk about the other side of that currency pair. When it comes to the euro specifically, I'm looking at a 117 handle on euro dollar right now. If we're looking for a rebound in the dollar, does that set us up for kind of a crash to parity when it comes to the euro? And I say this because you talked about this in the context of Asian currencies and the strength being something that they don't love and are actively pushing against. Well, you're seeing the same thing in the euro as well, that a stronger dollar could hit, or stronger euro, could hit the exporters of the continent. How realistic is a parity conversation at this stage?
I think you're raising an excellent point of conversation. I'm not sure parity is what we could be looking at. Maybe something like 113, 115 is something closer to our range of forecasts over the last few months. And mainly because, you've had fiscal stimulus in Europe, so that puts some kind of a floor. There's also this Fed independence concern that is looming. Maybe we have a negative outcome for the Fed in terms of the Cook trial. So all those reasons are probably unlikely to drive the euro much weaker. But what is not commonly understood in markets or commonly admitted in markets that the euro per se is one of the most expensive currencies here. First of all, you've had euro-dollar appreciation on top of tariffs. So European producers since February are now nearly 28% less competitive than they were in the beginning of the year, which is something which is not commonly acknowledged. Second, the euro has increased in value against a lot of its key competitors. Look at euro against Korea, Japan, China. A lot of the industrial nations of the world have kept their currencies stable to the dollar as the dollar was weakening. So the euro has now become a lot more expensive and less competitive to all those currencies. On a trade-weighted nominal basis, the euro is sitting at multi-decade high. And it's not that the European economy is backing this. It's mainly the anti-dollar logic. This is why we don't see a huge amount of upside on the euro per se, and why the euro against trading partners could potentially weaken a little bit from here.
So you're talking about this from a terms of trade perspective. Let's fold in the monetary policy as well. Does the hawkish stance of late, and I say hawkish with a grain of salt when it comes to the euro, but I should say maybe not dovish or overly dovish stance that you're hearing from the ECB, does that basically create a floor under the euro? And if so, where?
For now, it does. Our medium-term forecasts are about 115, I would say. I would say that if you look at what's priced in, the market is pricing very little chance of easing for the ECB. And I do think that if you look at the midpoint of next year, inflation rates will be below target, even in the ECB's forecast. And the ECB's growth forecast is relying quite a bit on the fiscal impulse and the impact it will have on growth. If you had that trade impact that we were talking about on exporters, you could see some risk to the downside. And you can start seeing risks for rate cuts starting to get priced in. Maybe later in time, but that's the direction of risks. I don't see the risk for hikes. There's more risks for cuts in our view, in our house view. So I think from a monetary policy perspective, rates in Europe have widened a lot versus the U.S. or tightened relative to the U.S. The pool of gravity, barring aside some kind of interference with Fed independence, which is our big risk for the dollar, is probably for the other direction.
A final question to you on the Fed. If we do see inflation risks skew to the upside, whether that's tariff-oriented, whether that's we don't see an extension of these healthcare costs going into the end of the year, that's going to, of course, hit the U.S. consumer as well. How quickly are people positioned in the market to price in inflation risk come January 2026?
I don't think that the market has its head around that.
Should they?
I think that they should. I mean, our research shows that not the entire sort of like tariff package has been priced in full. So that's one thing. Second, we have had some pretty sort of like soft-ish numbers relative to what the market would have expected. And third, you're pricing in the full gamut of the cuts that we think are likely. So the risks, to your point, if these things materialize, that's the upside. To me, I think all these things are within the daily range of volatility. You get some higher numbers, you can price out some cut from next year, etc. The main question, I think, for the Fed will be whether the market thinks that given growth and inflation, the Fed will be very dovish because of political reasons. That, to me, is the main question.
I think that's the main question for everyone. Temos Fiatakis, Global Head of FX Strategy and EM Macro Strategy at Barclays, walking us through the dynamics on both sides of the Atlantic. I want to leave you with a story before we go to the commercial break. BHP shares are under pressure this morning, down about 2.4% in London after Bloomberg reported that China's state-run iron ore buyer has told steelmakers and traders to temporarily halt new purchases from the company. The move expands a previous curb as contract talks with the Australian miner remain stalled. Now, China is the biggest consumer of iron ore, while BHP is one of 3 giant companies that supply the bulk of the material to the country's steelmakers. We're going to watch that price action very, very closely. Coming up, though, we pivot the conversation to what's going on here in the UK. Keir Starmer giving his annual party conference speech later today. UK PM looking to revive his premiership. We're live in Liverpool next. Stick with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Tune in to to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. It's unclear, however, if Hamas will accept the proposal, which calls for the group to disarm, relinquish control of Gaza, and release all hostages.
I also want to thank Prime Minister Netanyahu for agreeing to the plan. If accepted by Hamas, this proposal calls for the release of all remaining hostages immediately, but in no case more than 72 hours.
I believe that today we're taking a critical step towards both ending the war in Gaza and setting the stage for dramatically advancing peace in the Middle East.
Let's get the latest on this story. Bloomberg's Dan Williams joins the program. Dan, just walk us through what's in the 20-point plan.
Good morning. Yes, it's basically the modalities of a winding down and ultimately an end of this war, a war that the U.S. president has recast, an end of war deal that the president has recast as effectively a peace deal. That would not be peace with Hamas. Hamas won't make peace with Israel. I think the idea is to remove Hamas politically and perhaps pave the way for a future Palestinian government making peace with Israel, perhaps wider peace deals in the Middle East, while regional powers are calmed by the end of this almost 2-year-old conflict. So basically, there are immediate issues to be addressed, the step-by-step issues of a release of hostages within 72 hours of both parties agreeing to this deal. If both parties do, that's still an open question when it comes to Hamas. And then longer-term issues such as a staggered Israeli troop withdrawal and efforts to stabilize the Gaza Strip post-Hamas and bring in rehabilitation and reconstruction.
And just walk us through the Prime Minister Netanyahu's comments when it comes to the strike in Doha.
That was a strike just a few weeks ago on September 9th. Bolt out of the blue, quite literally, the Israelis attacked a Hamas delegation, the senior Hamas delegation based in the Qatari capital. They did this in a manner that certainly surprised the Qataris. Apparently the Americans, who have a very large Air Force base there, were given minimal advance notice of this. The effort, it was clear, was to assassinate the top echelon of Hamas as part of Israel's efforts to expedite a military victory against Hamas in the Gaza Strip and elsewhere. That apparently failed. Some junior members of Hamas were killed alongside a Qatari security officer. So not only was this a breach of Qatari sovereignty, a blow to Qatari security, there was also a cost in terms of the life of a Qatari. Now, Qatar is an important ally of the United States, a non-NATO ally is how it's defined. So the Americans have to heed its concerns as they do the concerns of the Israelis. And it's clear that for Qatar to continue to be playing a useful role here, it also hosts Hamas, but it also mediates between Hamas or Israel, or it has done in the past. Quite crucially, for Qatar to get back in that saddle at this crucial juncture, it needed some kind of face-saving overture from the Israelis. It says Netanyahu apologized. Netanyahu's office and the White House do not use that word. They say that he voiced regrets, a slightly softer version of contrition, one that does not necessarily accept culpability. And certainly the Israelis have argued that they had to strike at this group. They were not intending to strike at Qatar or its personnel. It would appear that what was said was enough to clear those decks, to draw a line under this dispute, bring Qatar as well as other major stakeholders in the Arab and Muslim world into this effort to bring Hamas into this end of war deal.
All right, Bloomberg's Dan Williams joining us from Jerusalem. We thank you so much for your time walking us through the state of play on this issue. Let's talk about some of the other stories around the world. President Trump has ordered 10% tariffs on U.S. imports of softwood timber and lumber, in addition to levies on kitchen cabinets, vanities, and wooden furniture. As Trump's latest move to use import taxes to shore up domestic manufacturing, tariffs are set to apply from October 14th, with some increases targeted to take effect from January. And right here in the UK, the Prime Minister, Keir Starmer, is expected to directly address the threat he faces from Reform UK, telling delegates at the Labour Party conference that the choice is between, quote, decency and division. Yesterday, the Chancellor described Reform's leader, Nigel Farage, as the, quote, greatest threat to working people. Rachel Reeves also reaffirming her commitment to fiscal responsibility.
There are still people who peddle the idea that we could just abandon economic responsibility, cast off any constraints on spending. They are wrong, dangerously so. When spending gets out of control, when market confidence is lost, that doesn't just show up in some OBR report and some difficult headlines a few months later. It is felt immediately in the growing cost of essentials and rising interest rates.
Our very own Lizzie Burden is all over this story. She joins us from the conference in Liverpool. Lizzie, just walk us through what else we heard from Rachel Reeves.
Well, Christy, when I spoke to the Chancellor yesterday, I read out Labour's manifesto and the commitments that they made on tax, not to raise income tax, the payroll tax or VAT, and asked her, yes, no, do you stand by that? She said yes, the clearest wording yet, that she stands by that. But there's still a bit of room for fudge here. She could, at the November budget, widen the scope for VAT. She could freeze the income tax threshold, neither of which you could say would break that manifesto pledge. But the big question remains, is that enough to raise the £35 billion that our economists estimate she needs to meet her fiscal rules? And what if she needs to spend even more? I asked her, are you going to lift the two-child benefit cap? And she said, I'd love to do more on child poverty when we can afford it. But interestingly, in a later interview with ITV, she signalled that maybe she would be willing to raise the gambling tax. And indeed, you're seeing the impact on the gambling stocks this morning in response to that. And notably, the revenue she could raise from that gambling tax matches the cost, almost, of lifting that two-child benefit cap. So perhaps that'll be the policy surprise that we get from the Prime Minister today, when we know that Labour right now is really caught between the left wing of the party and the bond vigilantes.
And we're not quite done yet. Keir Starmer still has to make his speech later today. What can we expect from that, Lizzie?
Yeah, this is at 2 p.m. We'll hear from the Prime Minister. It seems like he has managed to somewhat tighten his grip on his party. The Mayor of Manchester, Andy Burnham, who'd been out criticising the Prime Minister, walking back a bit of the speculation that he's contending to be the new leader by saying that he's very happy in his job. So the fight, the focus remains now on Nigel Farage's Reform UK party. As you say, the Chancellor talking about reform as the greatest single threat to working Britons. Starmer expected to pose a choice between Labour and Reform in his speech. Decency and division will be the choice that he sets out. The danger, Critty, is that by fighting the right, trying to reclaim populism, he alienates the left wing of his party in this speech.
Bloomberg's Lizzie Burden covering that for us over in Liverpool, of course, at the Labour Party conference. We thank you so much. Coming up on the program, Siegen Gold shining on his Hong Kong debut. We'll have more on the world's biggest IPO since May next, what it means, of course, for the deal volume that we are seeing. This, of course, is on top of the fact that EA, Electronic Arts, the maker of FIFA, also talking about an LBO to the tune of $55 billion. We'll dive into the deal volume story next. This is Bloomberg.
the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced. SPAR being where it is and how competitive the South African market is, we really just want to refocus on our home markets. Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country. Our business has the ability, and our independent retailers have the ability to compete directly with the chains. And we are now the second biggest supermarket brand in this country.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets?
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Let's get to our top stories this hour. A U.S. government shutdown looming as President Trump and top congressional leaders failed to reach a spending deal. Gold hitting another record on the back of it. And the U.S. President, Israel's Benjamin Netanyahu, agreed to a 20-point proposal to end the war in Gaza. Hamas has yet to respond. And in the corporate space, UBS warning that planned capital reforms may put the firm's Swiss future in doubt. More on that story now. This is, of course, going to be one of the major movers in the Stock 600. UBS reiterating its scathing critique of Switzerland's planned changes to banking regulation. The Swiss bank estimated to face as much as $26 billion in new capital demands as a result of the proposed regulation changes, now unveiled earlier this year. Bloomberg's Tom Metcalf joins me right here on set. He's all over this story. We know this has been a push and pull between Sergio Armati and the Swiss regulators for quite some time. We know it's moved the stock quite a bit and kind of put these handcuffs around UBS, at least they claim, in terms of competing with some of the deregulation you're seeing in other parts of the world. What is the latest in terms of this struggle?
Yeah, today's very useful, and it's basically UBS's fulsome, full-throated rejection of these Swiss plans. So it's multi-page report, and just very clearly lays out the argument they've been putting forward through various avenues. For them, this is basically just an untenable situation. And you reading through the tea leaves, reading the language, and it's really interesting, but you can certainly pull out from it that basically certainly what UBS is saying right now is if this stands, then they don't necessarily see a future for themselves, at least in their current shape and form, in Switzerland. So pretty fiery stuff. Of course, as ever in Switzerland, we're many years away from the final decisions and stuff like that. So it'll be interesting to see how the two sides continue to sort of evolve their positions. But right now, everyone's looking for signs of compromise, and certainly the language here, the report suggests that at least for now, UBS and the government's official position, they're still very far apart.
But talk to us a little bit about the Swiss side of things. There's still more to do here. There's more intervention that could potentially be had. Walk us through what that looks like.
Yeah, absolutely. So look, it's a parliament, right? And you're going to have various political parties coming in and various sort of constituencies and stakeholders and that which will direct things. I mean, right now, the Swiss government, very much hardline approach, basically going as severe as they can. But what you are starting to see is sort of across the political spectrum, people starting to, particularly against the backdrop of tariffs and Switzerland needing to find its place in a kind of geopolitically fraught world, like, is this the smartest thing we should do? Really put the pressure on one of our kind of global champions. So you've seen one party, the SVP, come out and say, let's find a compromise. And I do think as the months go on, maybe even the years, you'll see sort of that position kind of gradually soften, perhaps from both sides. And, I do suspect there'll be sort of a meeting in the middle.
All right, I'm going to put you on the spot here. What does it look like? When this whole saga ends, what comes at the end of it?
So I certainly think there'll be an increased ask on the capital side. So right now, the one that's causing all the contention is, let's call it the $26 billion figure. You know, let's put right in the middle there, 10, 15 billion, maybe that's something UBS can kind of live with. I mean, and there's an interesting argument as well, just to put the flip side out there, that actually these higher kind of CET1 ratios can in some cases sort of benefit banks up to a point, because obviously they're viewed as like the safe haven. There's, you know, they've got so much sort of reserves to, you know, kind of weather any storm that's coming. But no, I think if you had to put me on the spot, let's say 10 billion, and I'll immediately retract from that later.
Yeah, it's like asking what the jobs number is going to be on Friday.
Exactly.
It's like you just throw a number out there and hope it's right. Bloomberg's Tom Metcalf walking us through the latest on UBS. We thank you so much. I want to stick with the world of finance. I think it's fair to say Zijin Gold has jumped in its debut in Hong Kong after the international unit of China's biggest miner raised about $3.2 billion. It marks the world's biggest IPO since May. Bloomberg Steel reporter Manuel Bagori is all over the story. Manuel, just walk me through the details of this IPO.
Kriti, a very, very exciting and large IPO, the biggest in the world since May. We saw a big pop in stock here in Hong Kong today. I mean, obviously, with the backdrop of gold prices going through the roof, that's supporting companies like Zijin Gold and others that are looking to tap markets and sell shares right now. I mean, we saw an interesting kind of like theme here too, which was how Zijin and others are attracting international investors. We saw some big names supporting Zijin in the last few days, and that also helped support some of these larger deals. We saw a similar case back in May with CATL, the battery maker as well, that did a second listing in Hong Kong back then for more than $5 billion.
Is this a Zijin Gold specific story? Is this a mining specific story, or is deal making coming back?
Yeah, mining definitely is a hot space. We've seen a lot of interesting deals, capital markets wise, but also on the M&A front. Just a couple of weeks ago, we were very busy also this part of the world with the collapse of ADNOC's roughly 20 billion, 19 billion potential purchase of Santos, which also fell apart. So there is being a lot of interest. I think it's a sector that is definitely attracting interest globally, not just in Asia Pacific. We've seen some large deals also in the US. So definitely one of the sweet spots for deal making this year, both in terms of ECM and M&A.
All right, Manuel, we got to go to my favorite topic. When I was a wee intern at Bloomberg, my very first beat was the video game beat, and EA was part of my coverage arena. Now it's about to go private in a $55 billion leveraged buyout. I've got to say, when I started covering this company, I did not have this on my bingo card. What can you tell us about this LBO?
That's a fantastic story, Kriti. Well, it's a phenomenal deal, right? And it's also a great example of how we are seeing and anticipating larger mega deals. Definitely an interesting one with some private equity firms and also sovereign wealth funds supporting the transaction. We saw the Public Investment Fund of Saudi Arabia, also Silver Lake and Affinity getting together to buy EA out. $55 billion, that's a massive deal. And interestingly also, we saw a $20 billion package from JP Morgan, which is the biggest we've seen so far of such deal. So interesting. I think the expectation is that more and larger deals will come to fruition over the coming quarters. So we're all super excited into the fourth quarter and into 2026.
All All right, Bloomberg Deals reporter Manuel Begori walking us through the investment environment on both sides of the Atlantic. We thank you so much for walking us through really just the major deals in the last 24 hours or so. Let's stick with that theme. Investment giants, of course, have been grappling with a prolonged slowdown of deal making. I think today might just be the exception to that. There's now talk about a renaissance of private credit in Europe, with the sector's top players keen to diversify away from the U.S. market. You know, we spoke to key players at the EPAM Private Capital Conference in Paris last week about the outlook when it comes to this side of the Atlantic. Take a listen.
Europe definitely is having its moment.
We remain bullish on Europe.
Europe looks, oddly enough, quite stable.
What investors like is stability regarding the fiscal regime. So everything that is new, changing, and yes, it can encourage, push the capital to relocate from other jurisdictions in Europe.
Interest rates are lower. GDP is now heading finally in the right direction. And Europe as a continent still needs trillions of dollars of capital to upgrade the existing infrastructure and to build new infrastructure for AI.
Despite all the challenging aging society, a pension system that needs reform, low productivity growth, fragmentation, things are happening, things are changing. There's a real resolve forward to make reforms and to bring it to the future.
That makes for a relatively favorable environment for investment.
For more on the outlook for Europe, I'm joined by Antonio Alvarez III, Europe head over at Alvarez and Marcel. Lovely to have you. Thank you so much for coming. Of course, we're thrilled to have you. You just heard from a series of guests over at the EPAM conference representing the biggest firms in the world, saying that Europe is having a moment. We've been saying that, I want to say, since January 20th of this year. Would you agree? Is Europe having a moment?
I think in certain aspects where Europe is having a moment, you talk about private credit, and Europe has not been a front runner in that. It's been really a U.S. phenomenon, and like most capital market solutions, it takes time and eventually gets over. From our perspective, we're seeing pretty modest to low growth across the European space and the UK. We're seeing weakness in some key industries like manufacturing, automotive. You saw the quasi-government bailout of Jaguar. Of Rover recently, you saw the Claire's administration. You're going to see other consumer retailers battling inflation, battling tariffs, battling really a paring down of export markets as geographies are kind of retrenching to more localized. So I think from a financial aspect, there's a pull towards Europe, and there's an exit away from or redistribution away from the U.S. over to Europe, hedging bets. And there is a need for that credit, but I also see some fundamental weaknesses in several sectors. Of course, there's positive sectors like AI technology, infrastructure that was mentioned, some aspects of tourism, travel in the southern part of Europe. But I think it's a mixed picture. I wouldn't be so bullish as of yet.
There's a stat that was floating around at the EPAM conference last week that of Mario Draghi's 800 billion euro ask, that 80% of that could be funded by private capital. That, of course, coming from some of the bulls we just heard from. But it begs the question that if we do see a lot of these private players fill that sovereign funding gap that is undoubtedly there, do we start to run into the risk of the fact that Europe's biggest infrastructure, public infrastructure projects are dependent on private funding? Yeah. Is that a risk?
That is a risk. It's also an opportunity, because right now the governments, post-COVID, post-financial crisis, have really been expended. And you're seeing that play out right now in the political scheme. We got to cut costs or we got to raise taxes. And there's this back and forth in most major modern economies. And so if there can be a segment of the funding that could be made up by the private sector, I think that's a welcome result for Europe.
How much is the increase of private funds, not just in Europe, but around the world, maybe prolonging some of the zombification themes that we've been seeing when it comes to corporates? If you can't access the public markets, does this prolong that? If you're getting, whether it's credit financing or equity stakes, does this prolong maybe a flush out that the economy or that the business climate is looking for?
There's certainly a number of companies that are stuck. You've seen the exit from the UK financial markets over to the US markets, but the opposite is happening. You're seeing more valuations in the U.S. as opposed to the London market. You're seeing companies like AstraZeneca double list as a hedge against the UK market. So on the one hand, I see sort of a hedging of the UK financial center market, so to speak. Definitely credit is coming in because Europe has not been Europe and Middle East have really been financed by banks. And there's a big opportunity everywhere else, as markets have been becoming more sophisticated, there's a big opportunity for that to be made up by private credit, which is what you're seeing. In terms of the underlying businesses, you see a number of continuation vehicles in private equity where they're stuck.
Yeah.
They can't sell them, so they got to find a novel solution to kind of recirculate that money. You're seeing companies go from public to privatize because they're just not getting the valuation. So I think it's an interesting dichotomy of, yes, positive signs. Credit can come in, can help boost the economies. But the overall markets that it's underpinning are challenged, and governments are being challenged.
You bring up a key point around the private credit story. A lot of folks are saying that this is going to be, given that it's so new in the financial innovation, ultimately scary and could create some sort of systemic risk, not just in the States, but certainly in Europe as well. There's also a major theme in private markets right now, which is basically the democratization, the access to some of these funds. Does that alleviate some of the pressure when it comes to the exits that GPs are facing from their LPs?
It could. I think we're looking at that right now. We're looking at, are there ways to raise quasi-debt to help continuation vehicles, to help exits, to recirculate? It's a supply and demand. You're always looking for the supply and demand in the financing markets between equities and debt, and most of these funds now can move from equity to debt in a nanosecond.
Yeah.
So mega hedge funds. And so I think you look for the best financing you can get to operate. The underlying basis for financing, though, I think, and we're seeing it. We're seeing in the consulting market, you're seeing stagnation in general consulting market. And we're seeing a growth in our segment because there is a need for operational improvement. There's a need for just not financial solutions, and so I think that's what we're gonna see for the next couple of years.
What opens up the capital markets? What gets people more excited for seeing more days like today, where you do see really two massive deals in one day on two different sides of the world? Are we looking for more rate cuts? Are we looking for stability out of the White House? Are we looking for deregulation? What's the perfect recipe to get these markets opened?
Stability is always the perfect recipe. You heard that and I think the view is Europe may potentially be more stable in terms of a marketplace. And we've learned anything in the last 10 years, there's no such thing as stability. A pandemic can hit, a financial crisis can hit, there could be a weakening of confidence. There's so much geopolitical positive signs coming out of the Gaza peace, negative signs coming out of the Ukraine-Russia situation. You still have this competition between China and the United States and Europe. Any of these factors can trigger, as we've seen in the last 10 years, an event that moves. I don't think any of the sentiment is so hardened today that it's unmovable. It's actually quite fragile.
Yeah.
Because of the different elements that are affecting the economy.
All right. Always a pleasure to have you. Thank you so much for coming on set. Tony Alvarez III, Europe head over at Alvarez & Marsal, joining us around the table. Coming up, we're going to dive into one of the sources of volatility on the show. Vice President J.D. Vance saying he believes the U.S. government is heading for a shutdown. We'll discuss the potential implications, maybe a way out, coming up next. Stick with us. This is Bloomberg.
world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. We do see opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin and so on and so forth, and we don't know that. And so there's a whole leg of the equation that we haven't really seen.
PIMCO CEO Manny Roman there saying that the full impact of President Trump's tariff policies is yet to be seen. And that question may, of course, weigh on the prospects for U.S. stocks and the broader markets. Let's pile on top. Vice President J.D. Vance saying the U.S. government is on track to shut down after a meeting with congressional leaders. Didn't really come to fruition, didn't really yield any results. They go on to blame Democrats just a day before federal funding is set to expire. So how do you play this in the markets? Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income over at Neuberger Berman, has all the answers for us, right? And joining us around the table, thank you for your time this morning. This time feels different, and I feel like those are famous last words because we go through this iteration every couple of months now, it seems. Is there a trade in the bond market?
It's really difficult, right? Because what does this mean for Fed policy? What does this mean for interest rates and those type of things? So the Fed may meet in October without a jobs report and without a CPI report if this extends for a period of time, and it's going to impact the data collection. So the market does have other things that can go on. We get the ADP report later this week. We'll have we get the Adobe price stats type of thing. So the market will have data points. It's just not the official data points in which to extend. But agree, it does feel a little bit more different than some of the other threats that we've had of late.
Well, let's talk about what's at the core of some of these negotiations, which is one of the key sticking points is healthcare policies and whether or not you get an extension of the ACA, which is otherwise known as Obamacare, just for our global audience. Basically, these extensions that expire at the end of the year, if they are not extended, then it increases healthcare costs for millions of Americans. That being said, that is something that is still 3 months down the road. It's a key sticking point for Democrats. If we were to look through the volatility of the fourth quarter that I'm sure is coming, do we need to be pricing in inflation risk come January 2026?
Well, the question is that an inflation risk or is that an economic growth risk, right? Because as you're spending more money on healthcare benefits, does that mean you're spending less on other items? And we'll have to see how that trade-off plays itself out in terms of growth versus inflation. We had a call yesterday. One of the big investment banks had sort of put like a growth slowdown associated with the shutdown as sort of 15 bips of growth per week, right? So it's not small, but it's not huge either. So for us, in terms of inflation next year, maybe that's a possibility, but does that take funds away from spending on other goods and services?
I'm going to ask a very novice question here. If we do see a government shutdown, there's a political rhetoric in Washington at the moment that says, well, maybe the White House does want to see the government shut down because in theory, it would save money on the U.S. balance sheet. Is that a credible way of framing the conversation for a bond market investor that is worried about outstanding debt?
It really depends on how long it goes on, but I mean, it's a short-term savings, right, that will probably be made up then as you bring back the furloughed workers, back pay, these type of things. So there's an argument to be said for that, but on the long scheme of things, the debt challenges are greater than a 2-week or 1 month or 1 day shutdown. But again, we've had these things where we felt like we're on the brink, and they get solved hours before they happen. And although, look, 2018, 2019 might be a good example, right? We had a 35-day shutdown, and frankly, economic growth in the first quarter was okay, and that was supported by Fed cuts, and we do expect those Fed cuts, to help growth a little bit.
Talk to us about those Fed cuts. Is the market over dovish right now?
So it had been. So it priced the terminal rate below 3%, and now it's sort of back above that. So we're a little bit below 2 hikes or 2 cuts price for this year. Probably around 2 is the right number for this year. So the market's sort of straddling around fair value right now.
What changes that narrative? Are we still waiting, as Manny Roman, the PIMCO CEO, says, that the effective tariff is yet to be seen?
We're really waiting on the labor market, right? If the labor market does deteriorate faster, the Fed's going to cut faster.
Yeah.
If the labor market's fine, the Fed may cut slower. So it's really more about the labor market, we'd say, than anything else.
Let's talk about some of these trades that are permeating through the bond market space. It feels like everyone's favorite trade right now is the bond steepener. You sell the long end, you dive into the short end, you go all in on the Stephen Myron argument, basically, and but in both ways that you play that. Is the steepener trade a crowded trade?
So look, it's been a painful trade for the past 2 weeks for the market, right? As the curve is flattened. Probably feels less crowded than it has been. But, go back to basics. Pick your fair value, 5s, 10s, 30s, up, down. And if it results in a curve trade, great. If not, doing a curve trade to do a curve trade sounds smart, but sometimes, causes more losses than needed.
All right, give us a range when it comes to yields here. I'm looking at 4.13 on the 10-year. We were asking someone in the last hour about this. Just how low do yields go if we are pricing in this kind of volatility?
Right. So it depends on 2 things. One of which is how low does the Fed go? And, there's this tension between greedy, meaning the yield of 10s versus your cash funding, versus what does the fiscal and what does long-term inflation look like? And so it really depends. If Fed settles in around 3%, then maybe we're around fairish to maybe a little bit lower. If the Fed settles in higher, maybe things are a little bit higher. But it really depends on that, whether the market's concerned about greedy and carry, or whether the market's concerned about inflation and fiscal.
There is an argument, again, coming out of the White House, that if you see a series of rate cuts, one that would permeate across the yield curve, including on the 30-year, that would actually help alleviate the risk of a housing crisis. We're seeing the opposite right now, and that as we see cuts priced into the front end of the curve, the back end is actually selling off. Again, bringing back to the steepener point. If we do see the 2 cuts you're expecting by the end of the year, does that bring down the back end of the curve?
Again, potentially, yeah. I mean, because again,
even in the face of Fed independence.
Right. Now, even the curve may steepen, right? But 30s may rally less than 5s or 10s in that example. But the long end, in that example, could rally some, right? Because again, you have that gap between your cash funding and what you're actually earning on treasuries.
Robert Dishner, the man with all the answers, senior portfolio manager for multi-sector fixed income over at Neuberger Berman, walking us through the market impact of a shutdown, some of the other conversations in Washington. We thank you so much. A programming note for tomorrow, Bloomberg Television will have live coverage of the Women, Money, and Power event right here in our London headquarters, convening the most influential female voices in finance from around the world. We'll discuss key themes facing the future of business with the women at the helm of one of the best firms in the business. Stick with us. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Shutdown looms. Vice President J.D. Vance says the U.S. government is on track to shut down, blaming Democrats. Fresh tariffs. President Trump orders 10% levies on imports of lumber and timber in a bid to boost domestic manufacturing. And stocks under pressure. The looming shutdown weighs on futures and the dollar. Let's have a look, because we are up 3% for the S&P so far this month, with one trading day left in September. We're up more than 5% on the NASDAQ 100. Looks like we might put a stop to that today, depending on the tone, and of course the geopolitical tone as well, because we're waiting on responses out of Hamas and other leaders in the Middle East to that 20-point plan that President Trump came out with yesterday. But as you can see, futures pointing lower. There's also the prospect that we won't get the jobs report Friday, but we do have ADP on deck today, so that may give us some kind of an indication as to how the economy is faring labor market-wise. Let's take a look at yields, because they were down about a basis point across the curve a few moments ago. So 360 on the 2-year, 413, and we're back to 470 on the 30-year yield. I wanted to mention gold as well, because we hit a record. We were well above 3,850 an ounce just a couple of hours ago, but that rally has stalled now too. We are under that record. Let's get to some individual stock movers now. Valerie Teitel is in London for us. Valerie.
Good morning, Bonnie. Let's start with EchoStar. Bloomberg has been reporting that Verizon is eyeing some of its assets when it comes to its wireless spectrum licenses. Now, these licenses are very important to carrying 5G wireless signals, and it's not only Verizon who has been eyeing EchoStar's assets, also AT&T and SpaceX. EchoStar is jumping over 7% in the pre-market trade on the back of this. EchoStar is selling these assets on the back of an FTC probe. Now let's move over to the aerospace space. Firefly Aerospace on a back foot after one of their test flights went awry yesterday in Texas. Shares are down nearly 11%. All personnel were safe, but this goes to show that Firefly, who went public just a few months ago, is still struggling to turn around. It went public at $45 a share. We're trading around 25% under that at the moment. Lastly, let's head out to Asia. Hong Kong, a splashy IPO from a Chinese gold miner. Shares rallied near 70% over in Asia. And Bonnie, this is a sign of the times. The three-year bull run for gold is tempting some of these miners to go public. Also, perhaps a sign that the IPO market is heating up. This IPO was $3.2 billion. It marks the largest IPO since May for the global IPO markets. Bonnie?
Certainly a nice run for that stock. Valerie, thank you so much. Well, in just moments, we're going to be joined by Isabel Mateos Ilago of BNP Paribas. Later in the hour, we're going to speak to Kevin Mann of Hennion & Walsh. Counting down then till federal funding runs out, unless congressional leaders can find a way to end their impasse. Isabel Mateos Ilago of BNP Paribas writes this: while the risk of a government shutdown appears elevated, this would likely not derail the growth outlook, given ongoing dynamism of the private sector. She's chief economist at BNP Paribas and joins us now. Isabel, I hear you, but how long can that dynamism continue if we're going to get chaos at the federal level?
Well, good morning first. I think we shouldn't equate necessarily government shutdown with chaos. For better or for worse, this is something that has happened repeatedly, and historically, I think both markets and economic agents are kind of used to seeing it happen. And of course, it could drag down, but historically, the economic impact is fairly limited. The government workers who are furloughed get their back pay once it's resolved. And frankly, there's no reason to expect this time would be different. And also, let's never forget, and sitting here in Europe, I like to remind people of this, the government sector is a much smaller share of the economy in the US than it is on this side of the Atlantic. And so you would need to see actual chaos for perhaps to have an economic impact, but that's absolutely not the baseline scenario.
Sure, but there is a very real threat to the unemployment rate, right? And the Fed is particularly dependent on an unemployment rate coming out right now. There's also the idea that at some point it could lead to some kind of downgrade. Now, is that not in the back of your head anywhere?
So I assume you're referring to a threat to the employment report, potentially not being released on Friday as expected.
And also too, if federal workers are laid off en masse, that would increase the unemployment rate.
Oh, I see. Correct. Well, you would need to see indeed some mass layoffs, and you're right that the White House has threatened that this could happen. But again, we're in a political negotiation. I don't think this should be the base case scenario. In any case, there are also a number of legal protections that for federal workers, and so while in the fullness of time this may well happen, there's no time to factor that in as the base case. What we do expect, though, is that there will be an uptick in the drag from the government sector in the October employment report, simply as a result of the deferred layoffs that were signed, that were agreed contractually several months ago when the DOGE was trying to persuade a number of federal workers to leave the government. So that will happen in next month's report, no matter what. But as far as the threat of massive layoffs, this seems to be more part of negotiation tactics than something that should be in the macro baseline at this stage.
So what kind of easing does this economy need then by the end of the year, Isabel, if it is in good shape and, as you say, corporate dynamism is out there?
Right. So I think that's really the question that the FOMC members have to wrestle with. And the answer is not completely clear. And that is because the economy has been sending conflicting signals from the labor market side and, frankly, from the whole rest of the economy. Number one. And number two, we've had very large, unusually large data revisions that seem to change the picture after the fact. So most recently, last week, we had a large data revision for Q2 GDP, which suggests that the U.S. consumer is actually in fine shape. And the PCE report also last week suggested the same. And as a result of this dynamism, we're seeing, the Fed, the Atlanta Fed, NACOUST, our own forecast, everybody revising up their forecast for Q3 GDP. So if you just look at that, it's not clear that the economy needs any easing at all. On the other hand, the labor market has slowed down quite a lot. There is this curious kind of balance where unemployment is stable, but with very low hirings. And so if we were to see a sudden acceleration of firings, you could see a spike in the unemployment rate. And I think that's what the Fed wants to guard against. And in that context, there is likely to be a majority on the FOMC for delivering 2 additional rate cuts by the end of the year, and probably a couple more into next year. But it's a fine balance, and as Chair Powell stated, there is no risk-free path, and so they have to walk this tightrope between overstimulating at a time when inflation is well above target and rising, and the employment market is giving very mixed signals.
I want to ask you about France. You're in Paris right now, and obviously, you know, we've had the Banque de France governor talk about confidence getting suffocated. There's obviously, you know, a lot of issues when it comes to the next couple of months. A new French government expected this week, a budget expected by mid-October. What's the outlook for OATs and just in general for the French economy, Isabel?
So the outlook for the French economy is better than most people realize. Let's put it that way. But it's true that it's been lagging the strengthening that we've seen in other parts of the Eurozone. And it's been lagging behind precisely because of this lack of confidence that you were alluding to, which is true both for households and businesses. We're seeing confidence indicators still far below their long-term average. They're stable. They're not further deteriorating, but they're below their long-term average. And that's because of the political uncertainty and the risk of this new government, which has yet to be formed, not managing to get a budget through Parliament. But nevertheless, we're seeing signs of very encouraging signs of reacceleration of the economy, particularly on the production side. The aeronautics sector, for example, has been recovering very fast. We're seeing job creations back in positive territory. We're seeing an above historic level business starts. So not all is gloomy, but you're right. The spread, the OAT spread to Bund, it has been trading recently towards the top of the recent range. So, you know, a little above 80, and it's likely to stay there until we see some path to budget adoption. And here I should say that as of yesterday evening, but obviously it's a daily moving story, it seems as though there may be a path to find a compromise with that would keep on board enough political forces for this government to survive long enough to pass a budget. It's too early to be sure, but things seem to be moving in the right direction.
Isabel, thank you so much for your time this morning. So appreciated. That is Isabel Mateos Ilago of BNP Paribas. Now to other top stories trending on the terminal this morning. UBS reiterates its critique of Switzerland's planned changes to banking regulation. The bank says those changes may put the firm's role in the country at risk. The Swiss bank is estimated to face as much as $26 billion in new capital demands as a result of the proposed regulation changes. French inflation picked up on an acceleration in the services sector and smaller declines in energy prices, though it remained well below the European Central Bank's 2% target. Consumer prices in the euro area's second largest economy rose 1.1% from a year ago in September, after a 0.8% increase in August. BHP shares are dropping on the deepening dispute between China and the world's biggest miner. Sources say the nation's state-run iron ore buyer has told major steelmakers to temporarily hold all new purchases from BHP. China is the top consumer of iron ore globally. Coming up, the U.S. government set for a shutdown. We'll bring you your DC update next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
U.S. Vice President J.D. Vance there speaking after meeting with congressional leaders at the White House. Senate Democratic leader Chuck Schumer said Democrats have large differences with the president on the stopgap bill.
We've had 45 days and 45 days and 45 days and 45 days. We asked to meet earlier, they didn't want to. So we think when they say later, they mean never. We have to do it now, first because of the timing issue, and second because now is the time we can get it done.
For more, we're joined now by Bloomberg's Suzanne Lynch. Suzanne, if nothing changes, then the shutdown begins at midnight, less than 19 hours from now. What can we expect immediately?
Yes, I mean, there was no white smoke from this meeting that took place on Monday between Donald Trump and those 4 leaders. And as you heard there from J.D. Vance, there's a lot of blame game going on from both sides, really, with Republicans accusing Democrats of keeping the country hostage. Now, I mean, what's going to happen is that we are heading towards a situation of the first government shutdown since in almost 7 years. People may remember that period of 35 days of a shutdown that happened at the end of 2018, right through Christmas and the new year into January 2019 during the first Trump administration. And that looks like we may be heading there now. Now, there is some time, obviously, for negotiations to continue. The Democrats are digging in on this healthcare issue. That has been their issue with this bill. They are concerned about some of the Medicaid cuts that were introduced by Donald Trump, and also the expiration of Obamacare subsidies. They are saying that some consumers, could face up to 75% increase in premiums if these cuts go through, and they're concerned about that. And I think they really sense a political opening here, that the issue of healthcare is obviously a huge one for voters ahead of next year's midterm elections.
Kim Wallace of 22V Research was telling us yesterday there might not be a shutdown because A, how do you explain it? And B, you still have to come to a compromise at some point, even after a shutdown. So are there any suggestions the two sides might reach a compromise on some issues before we even get to the shutdown point?
Yeah, I think there is a possibility. Today, the Republican Senate is going to put forward the House-passed bill, which is, in a sense, daring the Democrats to vote against that or not. It's maybe symbolic, but it shows that there is going to be a movement again today in Washington on this. And the big question is, will there be enough for Democrats? Will there be some kind of provision made for health care that it might not be in here at the moment, but something further, that would be enough to get them over the line. Republicans need Democratic votes on this. They don't have that 60, that magic figure in the Senate. So in a sense, I think Democrats are sensing they do have the upper hand on this issue, on this particular vote. But as you said there, no one wants to be the party that shuts down the government.
For sure. Suzanne, thank you so much. That is Bloomberg's Suzanne Lynch there. And President Trump's latest bid to use import taxes to shore up U.S. manufacturing now. The latest, ordering 10% tariffs on softwood timber and lumber, 25% tariffs on kitchen cabinets, vanities, and so on. Joining us is Bloomberg's Brendan Murray, who leads our global trade coverage. So it's signed. We have new rates. The president says these duties will strengthen supply chains and boost resilience, even create jobs. But it's not really the view shared by the industry, is it, Brendan?
Yeah, exactly. Like with a lot of these other sectoral tariffs, it helps the producers of those, but it hurts the users of those. And you've seen already some statements from the home builders in the United States saying, you know, this is going to make our production costs more expensive. So I think what we're seeing is the Trump administration originally came out of the gates at the beginning of his second term with this broad sort of shotgun approach to universal tariffs. A broad authority. That's now being challenged in the Supreme Court, so they're going to this more targeted sectoral tariff approach, but they're showing that they can hit a lot of products, that derivatives of timber and lumber, these cabinets and furniture and those kinds of things. We'll probably see a similar sort of approach when the pharma tariffs come into effect and when the chips tariffs eventually take effect. We don't know what the status of that 232 case is, but we would anticipate that semiconductor tariffs would be among the next batch to come down the pipeline.
Brendan, if there is a shutdown, how does the government plan to continue these tariff probes? You know, you mentioned some of the 232 investigations. What state are they in broadly? And if there's no staff, how do they continue?
Yeah, well, they're in various stages of those investigations. They can take up to 9 months, and several of them are in the sort of 3 to 4 month range already. So from what we're hearing, those investigations are going to continue. They're not going to stop if Washington, the federal government, shuts down at midnight tonight. And of course, tariffs are going to have to continue to be paid by importers as they report their goods that they're bringing in from overseas to the Customs and Border Patrol Agency. Those are going to continue unimpeded. If they were to be caught up in some sort of shutdown, you would see bottlenecks at ports and rail hubs and places where supply chains can get congested. So they're going to try to keep those more essential services open to keep the flow of goods across borders going through however long this shutdown lasts.
Brendan, thank you so much. Our trades are there. Bloomberg's Brendan Murray. Coming up, President Trump and Defense Secretary Pete Hegseth's meeting with top military generals. More on that and what else is making headlines in your front page news. That's all next. This is Bloomberg.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Willow Bay. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg Brief, I'm Bonnie Quinn in New York. Time now for your front page news. First up on the Washington Post, military leaders are voicing serious concern over Defense Secretary Pete Hegseth's new Pentagon strategy. Hegseth is reordering U.S. military priorities, centering the Pentagon on perceived threats to the homeland, narrowing U.S. competition with China, and downplaying America's role in Europe and Africa. President Trump will attend the gathering of generals and admirals today at Marine Corps Base Quantico in Virginia. Next up on the Wall Street Journal, Boeing has started working on a next-generation single-aisle aircraft that could eventually replace the 737 MAX. According to sources, the new narrow-body aircraft is in early-stage development, which includes internal design efforts and exploratory talks with engine makers. And on the Financial Times, President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. But it's unclear if Hamas will accept the proposal. It calls for the group to disarm, relinquish control of Gaza, and release all hostages. Let's take a look at how markets are shaping up for the U.S. trading day, the last in September. Well, we look to futures pointed lower after a more than 3% rise for the S&P 500 this month alone, more than 5% rise for the NASDAQ 100. Weight to the US dollar index, of course, shutdown looming is having an impact there. Also, the idea that we may not have a full jobs picture by the end of this week if we do get a shutdown. The 10-year yield down less than a basis point to 412.90. We're down about a basis point across the curve. A little bit of paralysis maybe until we know what happens past midnight. Coming up, we're going to speak to Kevin Mann of Hennion and Walsh. Stick around. This is Bloomberg.
not sitting around waiting for politics to dictate what's important here. It has already been a leader and is continuing to be so.
People come to me and say, well, Trump's been, sort of saying, well, we shouldn't be focused on this, but yet the corporate world knows that it needs to support this.
Asia's role in global supply chain allows it to influence the transition in ways that many other regions cannot.
All the companies that I've been talking to they have not stopped the work of looking through their supply chains with ESG in mind, because that is just where the puck is going.
Our focus is really to understand what are the technologies that are part of our portfolio for the future and scaling those technologies so that we can meet our demand with clean energy.
Resiliency is just not an operational response to what is happening out there. Resiliency could and will be a strategic advantage that companies will start to look at.
There is still hope to actually get back down to something of a livable world if we get our act together.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Shutdown looms. Vice President J.D. Vance says the U.S. government is on track to shut down, blaming Democrats. Fresh tariffs. President Trump orders 10% levies on imports of timber and lumber in a bid to boost domestic manufacturing. And stocks potentially under pressure. The looming shutdown weighing on futures and the U.S. dollar. Also, gold, it would seem, which had hit a record earlier on. The last couple of hours saw gold above $38.50 an ounce, but it's now well off that again. As you can see, we are pointing lower, just fractionally, really. I mean, when you think we've had a 3% gain for the S&P this month and a 5% gain for the NASDAQ 100, well, we're not doing too badly. We also had those 3 days of sell-offs last week, and we're still up that much for this month. And there is one full trading day left, so we'll see what happens. But the U.S. is, again, barreling towards that shutdown. There are mass layoffs potentially going to happen. And the international environment also should be noted. I want to mention the 2-year JGB auction. That produced weak results for a second time. Traders obviously expecting a BOJ rate hike in October and want higher yields. Let's take a look at U.S. yields. They're down about a basis point across the curve. Not too much happening there, but we did get down to 470 on the 30-year yield. So we'll see what happens tomorrow if indeed we do shut down. Let's get to some individual movers now for some stocks to watch. Here is Bloomberg's Valerie Teitel. Valerie.
Good morning, Avani. Let's start with EchoStar. We do have Bloomberg reporting that Verizon is interested in some of their wireless spectrum assets. And off the back of this reporting, EchoStar is up just over 6% in the pre-market. Now, these wireless licenses that EchoStar has are vital for carrying 5G systems. And we've also heard that AT&T and the likes of SpaceX have also had deals with EchoStar in the past. We should note that the EchoStar is selling off these assets due to an FTC probe earlier this year, but is looking good for divesting more of these instruments. Let's move over to the aerospace sector. Firefly Aerospace. This is a company that launches satellites into orbit, uses those rocket launchers to do so. Down near 10% in pre-market. They had a test of their new rocket launcher that went awry in Dallas, Texas. No personnel were harmed, but Firefly is trading decently below its IPO price of $45 a share. Lastly, I want to head out to Asia. Vani, Hong Kong saw one of the splashiest IPOs of the year, $3.2 billion IPO for Shenzhen Global. This is a gold miner from China. And it tells us a few things, that this bull market in gold has really helped out these gold miners alongside the fall in interest rates. They've really been benefiting more than just the price of gold of late. And also, Vani, the IPO market is possibly heating up. This marks the biggest IPO for the global market since May. Vani?
Valerie, thank you so much. Shaping up to be an interesting day. That's Valerie Titel there. The Nasdaq 100 up more than 17% year to date. That's despite visible headwinds, including a potential shutdown in the next 19 hours. Kevin Mann of Hennion and Walsh writes this, though. More growth opportunities are available ahead, particularly related to the information technology sector and companies that derive revenues from the role they play within the overall AI ecosystem. Kevin joins us now. Kevin, if indeed some of these headwinds become, real difficulties for the economy, aren't tech companies going to pull back? Won't AI be put further down the priorities list, and won't some of the spending not happen?
Well, the way I see it, I've been doing this for 32 years now as a portfolio manager, and I've always lived by the adage of follow the money. Where is all the money being spent right now? It's being spent in two areas that I see. One, aerospace and defense, to your prior segment. Two, AI infrastructure. We've seen hundreds of billions of dollars being spent on building the capabilities through data centers, cooling solutions, and the power solutions to power the AI revolution. In fact, NVIDIA CEO Jensen Huang just recently forecast that between $3 and $4 trillion are going to be spent on AI infrastructure by the end of this decade. We're about $600 billion right now. That's a lot of spending ahead. So as a portfolio manager, I want to follow that money and look for who's likely to be the benefactors of all that additional spending.
So we've seen the data centers do particularly well, getting a lot of private equity money as well.
Absolutely.
If you want to be a benefactor and you're using the public markets, where do you go?
Yes, look beyond just NVIDIA. Look, we hold a lot of shares of NVIDIA, and I still contend that NVIDIA sits at the hub of the AI ecosystem. But let's look beyond that in terms of the entire ecosystem. How about a company such as IES Holdings? A lot of people never heard of IES Holdings. They supply the electrical connectivity to data centers. Their stock's up over 80% year to date. Or how about a company like Comfort Systems, ticker symbol FIX? They supply the cooling solutions to data centers. They're an HVAC company in the industrial sector. They're also up over 80%. And then with respect to NVIDIA themselves, maybe a lot of investors don't realize NVIDIA doesn't manufacture their own chips, even though they're the largest chip seller in the world. Taiwan Semiconductor does. But Taiwan Semiconductor doesn't do their own lithography. ASML does. So every time we hear another knockout earnings report from NVIDIA, recognize that Taiwan Semiconductor benefits, ASML benefits, and their stocks are actually outperforming NVIDIA year to date as well.
Sure. So two questions there.
Yeah.
First of all, these gains that we've seen year to date in some of these companies, I mean, they're massive. So has the repricing happened? Are they now perfectly priced for the growth that they're going to see, or are they still cheap?
Yes, some of them are cheap, some of them are not so cheap. Some are certainly overvalued, as is the U.S. stock market as a whole right now. But I think about a company like Taiwan Semiconductor, the largest dedicated chip foundry in the world with a market share of over 60%. On a forward PE basis, they're around 24 right now. Not too rich for that type of growth that we expect going forward. You look at some of those other names, though, you want to pay attention to valuation, because perhaps on a pullback, they'll present more attractive entry points, but opportunities still exist.
On Taiwan Semiconductor,
Yes.
don't you have to price in some geopolitical risk there, particularly what we've seen in the last few days with China pushing the U.S. to get stronger on its stance about Taiwan independence?
100%. But also recognize that Taiwan Semiconductor not so long ago built a massive plant in Phoenix, Arizona. That's where NVIDIA anticipates onshoring the manufacturing of their chips going forward to try and navigate this new world order and the new trade and tariffs environment. So they've tried to navigate away from some of that, and I still think there's growth ahead for them as a result.
We did also see that market sell off brutally when it looked like, NVIDIA wasn't going to be able to sell certain or maybe all of its chips to China. Aren't there risks like that out there too?
There are, but NVIDIA continues to pivot, right? Last quarter, just looking at their earnings report, 88% of their revenues didn't come from chips, came from data centers. They're building now AI capabilities in a box, if you will, whether you want the chips and processing power or the actual data centers. NVIDIA handles both, so they've diversified their revenue stream. I think they're doing the best that they can to operate in this new world order.
Beyond all the AI plays, you say the Fed is actually playing catch up for the rest of the year, that the Fed has been late to the party.
Yes.
I mean, what do we see then? What would you want the Fed to do?
Yeah, well, first let's talk about the looming federal government shutdown, right? Unfortunately, it looks as though these federal government shutdowns has become part of the political process here in the United States. Going back over the last 5 decades, as I understand it, there have been 21 shutdowns of the federal government with the average duration around 8 days, the longest one around 35 days. Why do I bring that up? Well, 35 days from now brings us to the next Fed meeting, right? Between October 28th and October October 29th. We certainly don't want the Fed flying blind into that meeting without current and fresh jobs data or inflation data. As it stands right now, I'll go with what the Fed is telling us from their most recent dot plot chart. 2 more rate cuts at 25 basis points this year at their final 2 meetings of the year based upon their updates for jobs and based upon their updates for economic growth. Sub 2% economic growth and also an unemployment rate that they're forecasting to hit 4.5% by the end of this year.
So are you comfortable with that kind of an economy? So if we get 2 more rate cuts by the end of the year, are we in balance? Do we have our eye on inflation while also keeping the labor market intact?
If we don't get those 2 rate cuts, I won't be as uncomfortable with the economy because I think the Fed is scared. I think when we saw that jobs revision with 911,000 less jobs created over the last 12 months, that wasn't in their calculus. So they had to reset their expectations for the labor markets. We'll get the JOLTS report today. Hopefully we get another jobs report on Friday. That's going to give them more clarity on the jobs front. But I think they're more attentive now, Vonnie, to the employment side of their mandate as opposed to the price stability or the inflation side of their mandate. That could change. Sure. But right now, they're more attentive to the job side, and that's why I see 2 more rate cuts ahead.
Okay, so September, assuming the NASDAQ 100 doesn't fall more than 5% today, will have been a positive month, at least for tech. Where beyond tech would you be looking, or is it not yet time?
I still like aerospace and defense, considering that NATO countries recently pledged to spend up to 5% of their respective GDPs on defense. Look at the European Union, who pledged to spend the equivalent of $840 billion US on their own defense capabilities. Who's going to benefit from all that spending? Look to the large defense contractors, but also look to some of the smaller ones, such as Kratos Security Solutions, which is a manufacturer of drone technologies, which you could argue is the future of military warfare. Follow the money once again, and the 2 places it's going is defense and AI infrastructure.
Speaking of follow the money, we've seen this massive run up in China. We've had to wait a few years for it. Now it's happening, or maybe has happened, not quite sure. Are you allocating any money outside of the U.S. and any of it to China?
Yeah, I'm still very dubious to Chinese securities right now for a variety of reasons, but emerging markets as a whole, many investors are surprised to know, our clients are surprised to see that emerging markets are actually outperforming international developed markets in totality, both U.S. markets and international. So you need to consider dipping your toe in the water, building a globally diversified portfolio, but perhaps navigating around some of the more concerning emerging market economies such as Russia and China. But the opportunities are out there, but I wouldn't shy away from the U.S. and I wouldn't shy away from international development.
All right, Kevin, thank you so much.
My pleasure,
and thanks
Bonnie.
for joining us in the studio this morning. That is Kevin Mann of Henyon & Walsh. Now, 2 other top stories trending on the terminal this morning. UBS reiterates its critique of Switzerland's planned changes to banking regulation. The bank says those changes may put the firm's role in the country at risk. The Swiss bank is estimated to face as much as $26 billion in new capital demands as a result of the proposed regulation changes. French inflation picked up on an acceleration in the services sector and smaller declines in energy prices, though it remained well below the central bank's 2% target. Consumer prices in the euro area's second largest economy rose 1.1% from a year ago in September, after a 0.8% increase in August. And BHP shares are dropping on the deepening dispute between China and the world's biggest miner. Sources say the nation's state-run iron ore buyer has told major steelmakers to temporarily hold all new purchases from BHP. China is the top consumer of iron ore globally. Coming up, President Trump fails to reach a deal so far with congressional leaders, setting up the U.S. government for a shutdown. More next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
President Trump's latest bid to use import taxes to shore up U.S. manufacturing, ordering 10% tariffs on softwood timber and lumber. For more on all things tariff-related, Bloomberg's Brendan Murray leads our global trade coverage and joins us now. So, Brendan, more new rates. I think we got a tipping, off that this was going to happen, but now it's been signed into law, and there's several of them. It's 25% on vanities and so on. Will these new tariffs strengthen supply chains or boost resilience or create jobs?
Well, that's certainly the hope of the Trump administration, and Donald Trump specifically said this is going to revitalize the industries that have been lost in North Carolina. So he's going very micro on what he has, what has largely been a very macro, broad tariff strategy across the world, putting tariffs on various countries at various levels. And so what they're doing with these 232 cases is getting very specific and taking aim at some industries that the president thinks can be brought back to the U.S. or at least can save what's left of the ones that are in existence today, the cabinet-making industry, for instance. And so that's the goal. These 232 cases, there are something like 10 or 12 of them now. We've already got tariffs on copper and steel and aluminum, and and heavy trucks was another one recently. So we're gonna get this sort of steady drumbeat of sectoral tariffs now, with pharma coming soon, and semiconductors as well.
Yeah, we've been waiting on semiconductors for a while. If the government shuts down, then how does it plan to continue its tariff probes? How would the administration feel about that?
Yeah, well, so those employees are going to have to stay at work, apparently, even if the government shuts down tonight. The folks in the Commerce Department or USTR and in the White House who are working on these investigations are going to be deemed essential, and they're going to continue working on those. The president has said these are priorities. They're time limited. There's about a 9-month period that these investigations have to take place, and some of them are already halfway, a third of the way through that process. And so they need to keep working on those if the president is going to impose tariffs as broadly as he wants to. In the meantime, the Supreme Court is looking at these big reciprocal tariffs, the big country-by-country tariffs, and will review that case in November and could strike those down. So the backup plan is these 232 sectoral cases.
So many questions still to answer. Brendan, thank you so much. That is Bloomberg's Brendan Murray. We have a Wall Street Journal report, and we're watching shares of Boeing off the back of it because we may be getting a new narrow-body plane. The report states that the plane maker has started working on a next-gen aircraft that could succeed its 737 MAX. For more, I'm joined by Bloomberg's Benedict Camel, who leads our global aviation coverage. So, Benny, what do we know about plans for this new plane? Did we know something was in the works?
Well, we know it's very preliminary, and this is something that will seep well into next decade. These are huge undertakings, very costly, very complex. So this is an aircraft that will only see the light of day sometime, probably in the latter part of next decade. It's crucial for Boeing to get this right. The 737 that it will replace eventually is really the bread and butter product on the Boeing side, as is the A320, that's the equivalent on the Airbus side. These are the aircraft that really make the money. Those are the aircraft that are produced in large volumes, and both manufacturers have to get that right. They are now flying these aircraft that are essentially decades old. The 737 is the original design is from the 60s. 20s from the late 80s. Yes, they've been endlessly tweaked and enhanced since, but fundamentally they are designs from that era, and that gives you a sense of why they need these new aircraft. They would want to put new wings on them, put advanced materials on them, put new engines on them, maybe even a totally different design in terms of the engines. So that's something they'll look at hard, and what the Journal is now reporting is that the company is taking those first steps towards that new plane. So looking at the things like the aeronautics, looking at the engines. So early stages, but giving us a sense that something is underway here.
You have to imagine that it's the incidents in the past few years with the 737 MAX that accelerated the work towards this new plane. Would it be in the works anyway?
It would have been in the works because there's really no way around it. But to your point, Boeing had to get out of its crisis first, and they've said as much. They've said our focus right now is stabilizing the company. They had those two crashes with the MAX aircraft. Then they had that door plug blowout at the start of last year that threw the company into a renewed crisis and really weighed on the company financially in every kind of way. So they needed to stabilize the company first, then move on, and that's what we're starting to see now.
Benny, thank you so much. That is Benedict Camel, who leads our global aviation coverage. Well, the U.S. government is headed for a shutdown after Democrats and Republicans failed to agree to a deal for a new stopgap funding bill. Here's what Vice President J.D. Vance and Senate Democratic leader Chuck Schumer told reporters after yesterday's meeting at the White House.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what the Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
We've had 45 days and 45 days and 45 days and 45 days. We asked to meet earlier, they didn't want to. So we think when they say later, they mean never. We have to do it now, first because of the timing issue, and second, because now is the time we can get it done.
For more on the looming shutdown now, Bloomberg's John Harney joins us from Washington. So, John, just more than 18 hours to go. What can we expect as we count down to midnight?
A shutdown with both Democrats and Republicans on Capitol Hill engaged in political trench warfare. Both sides seem to think they have some sort of advantage here, with Republicans calculating that the American people will blame the Democrats for the lack of government services that aren't considered essential, and that's a lot of things that people, take for granted. And Democrats say that they have to do this because if not, subsidies for people who are to take part in the Affordable Care Act or Obamacare face a surge in premiums come the new year. And they say that Republicans, well, even though Republicans say they will negotiate about this after a so-called clean resolution is passed, the Democrats don't trust them. So there's a lot of mistrust and animosity on both sides, and that will almost certainly, come midnight, lead to a closed-down government.
Yeah, I'm sure there'll be a flurry of meeting and calls throughout the day as well. Now, elsewhere, the president has a busy day because the military's top brass have a pretty unusual meeting, I would say, with President Trump and Secretary Hegseth. What details have emerged ahead of that meeting?
Well, reporters are heading out there now to Quantico, the Marine base, which television viewers know from all the FBI-related shows. Relatively little. Generals and admirals who were posted around the world were summoned to Washington, to Quantico, by Secretary of Defense Pete Hegseth about a week ago. It seems to be, according to President Trump, the purpose is to instill a spirit de corps among these high-ranking officers. Beyond that, we don't know a great deal.
Yes.
This is very unusual. And not only that, all these officers some of them may get stranded here because travel is prohibited under a government shutdown.
Oh, John, it's all crisscrossing. John, thank you so much for all the context. That's Bloomberg's John Harney in Washington. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Now a look at what else is ahead today. We have a slew of Fed speak. We'll hear from Vice Chair Philip Jefferson, Boston Fed Susan Collins, Chicago Fed's Austin Gould, and the Dallas Fed's Lori Logan. We'll get JOLTS data at 10 a.m. New York time, maybe more of a market mover than usual, certainly be more watched than usual, just in case we don't get NFP. And after the bell, we get Nike earnings. Let's take a look at some of the movers before the bell. Firefly, one of those after its Alpha Flight 7 rocket experienced an event that resulted in a loss of the stage. EchoStar reportedly in talks with Verizon about purchasing wireless spectrum, and Progress Software raised its revenue forecast. Do keep an eye on the macro environment, though. That's it for Bloomberg Brief. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
The market continues to make new highs.
Higher productivity supports higher valuations. The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the U.S. is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, heading towards a government shutdown. The meeting with congressional leaders failing to deliver a breakthrough as the BLS is confirming this week's jobs report may well be delayed. The equity market is looking to close out Q3 with another quarterly gain. Q4 is coming right up.
And a lot of it's going to depend on the earnings. I just want to note, though, that the dissonance between Washington, D.C. and markets is pretty shocking right now. In markets, there is this feeling that Q4 will bring more earnings, more gains, a sense of euphoria around AI spreading out to the rest of the universe with Fed rate cuts on tap. In Washington, D.C., can't get anything done, and they're facing off with constituents that feel very differently because it's only a small cohort of the overall consumer base that really is feeling such euphoria that's being reflected in earnings.
Wall Street united, D.C. divided. These are the statements from Senator Schumer. It's in the president's hands. The Vice President, J.D. Vance. Democrats won't do the right thing. The blame game continues.
And I was there yesterday when they came out to the microphones to brief the press, to both basically throw stones at the other side about why they're stuck right now in this paralysis. And the vice president said it directly. I think we're heading into a shutdown. It's not a matter of if, it's how long this shutdown is going to last. Because guess what? The House is not in session. So the only way we can avoid a shutdown right now is if Senate Democrats decide to vote for that clean CR that Senate Majority Leader John Thune could put on the floor. That's not going to happen. Senate Majority Leader John Thune said yesterday those discussions were lively, they were spirited, but they resulted in no outcome, no solution. It is not if, it's for how long we're going to be shut down.
The market cares about one thing. Will we or won't we get a jobs report on Friday? So this is what the BLS has got to say. If the government shuts down, the BLS will suspend all operations and cease all active data collection activities. So Wall Street might be flying blind, kinda.
Kinda, because it's going to be ADP week. This is Make ADP Great Again week, which is what we've seen for a number of months now in terms of its importance, how people trade it. What's interesting to me is, yes, the non-farm payrolls report, but then it's CPI next week, and then it's the fact that come the Fed's meeting at the end of this month, you might not have any new data, and they might have to make a decision at a time where there's an increasing consensus around cutting rates by another 25 basis points. That, to me, potentially is more interesting.
At a time when the hawks are starting to make a little bit more noise.
Yeah, exactly.
What a 24 hours. Hammock, Muslim, making their points, and the daylight between them and the Governor Murray of this world could not be wider right now.
And it's an honest and important economic debate, and it's a debate that can be had. What I keep hearing from all of the people who come on our show is right now they're betting on equity market gains. Do they think it could get excessive? Maybe. Do they think that we need rate cuts? Probably not. Are they going to ride it? Absolutely, because they are judged by how much money they make, and they want to be on this train.
Max Kettner, HSBC, not getting off that train anytime soon. Equity futures on the S&P negative here by almost 0.2% as we close out September and Q3. Coming up this hour, Jay Pawlowski of TPW Advisory as we close out the third quarter. Terry Haynes of Pangea Policy on the growing risk of a government shutdown, and the former White House trade advisor Kellyanne Shaw as President Trump adds a fresh round of tariffs. We begin this hour with stocks heading towards a fifth straight month of gains. Jay Pawlowski of TPW Advisory writing, the latest US economic data does not suggest an economy in need of multiple rate cuts. We see reflation, not recession. Jay joins us now for more. Jay, is that the view into year-end and beyond?
Yes, indeed, John, it is, because not only are we going to have reflation in the U.S., I mean, what else can you have with 6 to 7% budget deficits and a Fed cutting into 3% growth? But you also have China, the other major global economy that is reflating, right? Focused on fighting deflation and stimulating their economy. So in our view, it's very simple. You have the U.S. Stimulating, you have China stimulating, and therefore it's reflation, not recession.
Jay, give us an idea of some numbers, just how hard are policymakers about to run this thing? Talk to me about growth, the inflation numbers. What do things look like in your mind?
Well, in the U.S., I think you have to remember that with no growth in the labor force, growth is going to be slow in terms of numbers, right? So we're seeing that already in the jobs report, right? It takes 40,000, 50,000 jobs to keep the unemployment rate around 4.3%. A year ago, 2 years ago, it was 200,000 jobs. So you have to put that into context. That's a key contextual point that we make to our clients and others as we talk about the economy. So U.S. grows at 2%. Inflation is going to run hot. That's clear. So let's call it 5%. And this is a point, John, I remember talking with you about this back in the COVID days. So that means nominal growth in the U.S. is going to run somewhere north of 5%. So you're going to have earnings growth, right? Remember, the key is that sales, revenues, and earnings are denominated in nominal dollars. So if you have 5 to 6% nominal growth, you're going to have 5 to 7% kind of natural earnings growth. Then you squeeze out a little bit more in the margins, buy back some more stock, and you have single-digit earnings growth in the U.S., and that's sufficient to keep the U.S. Stock market in decent shape. And that is the key to us anyway, because we're focused on the non-U.S. markets. Again, as you know quite well, that's been our position for well over a year now. So the key is that the best time for non-U.S. to outperform is if the U.S. is doing okay. And so we see better growth opportunities coming in Europe. We see better growth opportunities in Asia. China is going to grow at its normal 5% rate. But again, the important thing is earnings. And here, as China defeats deflation, earnings growth is going to pick up. That means multiples will pick up. That means stock prices will pick up. And that means you're going to do better in China than you would in the U.S. or other markets. So we remain very keen on China, very keen on emerging market equities, very keen on commodities as well.
I feel like the world isn't necessarily divided into regions, it's divided into sectors. How much are you focusing the international investments on tech that is ex-US versus the rest of the universe that's been left behind for the most part?
Yeah, great point, Lisa. And you know, I might disagree somewhat, but point taken. And look, again, China tech has been dominating U.S. tech in terms of equity performance for the last 2 years. Again, we've talked about it on this show many times. K-Web is up 50% this year to date, and versus the Qs that are up, what, 10, 12%? So tech in China is a key position for us. Energy is a key position for us. We think that's the biggest opportunity right now. It's the one that Wall Street is going to get completely wrong. So we really like energy. We've been adding there. We like financials outside the U.S. Again, an old favorite European banks continue to outperform the U.S. as they have for the last several years. You know, people are finally starting to wake up that the non-U.S. markets offer significant outperformance potential. That's been the case for 2025. I think we're in the beginning of a secular leadership change away from U.S. equities to the rest of the world, led by emerging markets, which are the big beneficiaries of a Fed cutting and a weak dollar. That allows central banks and EM to cut rates, support their growth without worrying about their currencies. And lo and behold, what have we seen this year? Bank of America points out over 100 rate cuts in emerging markets.
Jay, there's also this political overlay. At what point is it extra risky to invest in a place like China at a time where there could be some safeguards or walls put up to international investors, something that we've seen before, something that we've seen even from the U.S. in terms of certain restrictions as the relationship is increasingly fraught?
Yeah, that's a key point for us, Lisa, but we flip the script there and we focus on the opportunity that we see coming up in China. We see that kind of risk much more in the United States under a Trump administration, right? The policy, erratic nature of policymaking is not in China, it's in the United States. And that's why the dollar is weakening as people start to protect themselves first via hedging. And then we believe over time, just letting their U.S. positions go back to a normal weighting. Right now, the world is overweight the U.S. But here's the point about China. We think the last couple weeks, Splinternet, where the China and U.S. tech stacks completely divide, has finally materialized. This is something we've been writing about for years. In the last 2 weeks, China has said their companies cannot use NVIDIA chips. You've had Huawei come out and publicly state how they're going to compete with NVIDIA, which is very unusual for China tech. Usually they don't talk about that stuff. And then last week you had Alibaba come out and say they're going to join the hyperscalers and spend $50 billion on compute. And so to us, what's really significant here is that before any summit, right, Trump and Xi are going to meet at some point in Q1, not talking about South Korea at the end of the month, Q1 summit meeting in China. And we think the Chinese have sent the shot across the bow that the leverage the U.S. thinks it had with NVIDIA chips no longer holds, and that China does have leverage over the U.S. via the rare earths. And so we're looking for the exact opposite. We're looking for a rapprochement amongst China and the U.S. that will signal that China is once again investable. And so we would not be surprised at all, and the TikTok deal is an early indication of this. We would not be surprised at all that in Q1, Q2 next year, the signal is sent that for U.S. institutions, who I agree with you, are not exposed to Chinese equity in any way relative to the benchmark weight, are given the signal that it now is okay to buy China again, and that's going to set off the next leg of Chinese outperformance versus the U.S.
Jay, domestically, we're about to have a government shutdown. Does this matter at all to financial markets?
Nope.
Even though we might not get the jobs report on Friday?
No, not really. Again, I think people are understanding that the job market is in flux due to the labor numbers, and therefore the focus is going to shift right away to earnings. That might be convenient for the market, right? We're going to talk about earnings for the next couple of weeks. They're going to be okay, et cetera. I do think if we still have a shutdown by the end of the month, it could impact the Fed meeting, and that might be, a reason for people to pull back a little bit here. But in essence, again, Emery, you and I have talked about this. Our view has been basically for the last 8 months to pay zero attention to what this administration says. We focus on what it does, and what it does, it's already done, which is namely ensure that we're going to have fiscal deficits of 6 or 7% as far as we can see. And we are now politicizing the Fed such that we know the Fed is going to run the economy hot, and the market doesn't need to know anything more than that.
Record highs, just about. Jay, thank you, sir. Jay Pawlowski at TPW Advisory. Do you care about the shutdown? Nope. Care about earnings 2 weeks away. JP Morgan, just around the corner.
A lot of people say this will be the risk event going into the fourth quarter. Do you see the proof behind all the high expectations? And if you don't, how big is the potential downdraft?
Equity futures this morning down by about 0.2% on the S&P 500. Let's get you some news worldwide. Some breaking headlines from Exxon just moments ago. With a wrap, here's the Bloomberg Brief with Ronnie Quinn. Hey, Ronnie.
Hey, John, good morning. Yep, we'll get to that Exxon news in just a moment. But first, on that shutdown, the U.S. likely headed for it. Senate Republican Majority Leader John Thune said Democrats' refusal to approve a short-term spending bill amounts to hostage-taking. Democratic Senator Chuck Schumer said Democrats could settle for some of their priorities, such as extending subsidies for Affordable Care Act premiums. President Trump and Israeli Prime Minister Benjamin Netanyahu have agreed to a 20-point plan designed to end the war in Gaza. But it's unclear if Hamas will accept the proposal, which calls for the group to disarm, relinquish control of Gaza, and release all hostages. And Exxon planning to cut about 2,000 jobs globally as part of its long-term restructuring plan. The reductions account for about 3 to 4% of its workforce. Other major oil companies, including BP and Chevron, have also recently announced cuts as crude prices fell this year. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the program, heading towards a government shutdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
We're headed to a shutdown because the Democrats won't do the right thing.
That conversation up next with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tons of economic data this week. Might not get payrolls data on Friday. That might be delayed. There are other data points to look for. The PMIs, ISM coming up on Wednesday. Jobs data coming up later on this morning, so keep an eye on that. And we will get some earnings. Nike, after the closing bout. Nike worth a look. Just how they're dealing and confronting the tariff story of the last 6 months.
Yeah, and the supply chains. With the tariffs, there's a question of how much they can pass along to consumers. What we've heard more broadly from retailers is that they are incrementally increasing prices and taking it on the margin, also passing it on to suppliers. But in the years to come, in the months to come, expect those prices to go up.
Nike, results after the closing closing bell. Look out for that. 2 days of gains on the S&P running into this. We're down about 0.25% on the S&P 500. On the Nasdaq, we're down by 0.2. In the bond market, yields just a little bit lower at the front end of the curve. 2's down by 2. On a 10-year, down by 1. Let's call it 4.13. Under surveillance this morning, we're heading towards a government shutdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
You don't say the fact that you disagree about a particular tax provision is an excuse for shutting down the people's government.
Their bill has not one iota of Democratic input. That is never how we've done this before.
We're headed into a shutdown because the Democrats won't do the right thing.
So here's the latest this morning. The Senate planning to hold a vote today in a final effort to avoid a government shutdown with funding set to lapse at midnight. Joining us from Washington is Bloomberg's Laura Davison. Laura, welcome to the program. Senator Schumer said this, that our differences on health care, on their ability to undo whatever budget we agree to, are very large. Can you just elaborate on that? Where is there space for a compromise here?
So the space for compromise here is Democrats need about 8 of them to pass this bill. Republicans need to convince about 8 Democrats to join with them. Democrats' big ask is a renewal of these Obamacare tax subsidies. Democrats want to extend these indefinitely, permanently. Where we'll probably see the negotiations go is that they will look at, whether to extend them for just a couple years, maybe scale down the eligibility. But the point he is here is that just, less than 24 hours ahead of the deadline, these talks haven't even started. It's very clear that both sides are very dug in. They had this meeting at the White House yesterday. We just heard those clips of Vance and Schumer coming out of that meeting. Both sides are ready for a fight. And, absent some sort of last-minute 11th-hour agreement, we are going to head into a shutdown at midnight.
Well, Laura, can they even have a last-minute agreement in the sense that House Republicans, the House isn't even in session right now. So isn't the discussion in Washington how long this could last? And what's your sense for how long we could be shut down?
It's clear that there's going to be at least a couple days here. As you mentioned, the House isn't even in town. Lawmakers would have to fly back. But this could be a much longer shutdown. We saw, a shutdown of more than a month in Trump's first term. It really is, each side is testing out whether, they are going to have the political advantage here. We're going into the shutdown because both sides, both Republicans and Democrats, think that the other party will take the blame. Of course, someone will end up, taking the political risk on here. But Democrats think that once people realize, how much healthcare premiums could go up, that they will be the victors. Republicans say that this is Democrats forcing the shutdown. They want to keep the government open, but their opponents won't let that happen.
Laura, appreciate your time. Laura Davison there of Bloomberg down in Washington, D.C. To build on this, Terry Haynes of Pangea Policy joins us now for more. Terry, this shutdown has been your base case for quite a while, and as you indicate, a lot of other people are now finally catching up. Question we've got on Wall Street for markets is just how long this is going to go on for, how delayed some of these data points might be.
Well, my instinct, John, is this probably goes on for about a week. I've been writing this for a long time, but on Sunday I wrote, basically performative politics plus policy procrastination probably prevails, and I think it does. But both parties want their little demonstration, if you will. But I don't think either party is interested in shouldering the blame of a longer shutdown that actually becomes more dangerous to the underlying economy. Certainly, Trump wouldn't want that. He just got really good economic numbers. Democrats don't want that because they don't want to be accused of undermining that. So here we are. So they both get their little moments in the sun, and then I think they move on.
Terry, when it comes to the politics, Republicans have control of the House, the Senate, and the executive branch. Was it a mistake for Senator Schumer and Minority Leader Hakeem Jeffries to actually go to the White House and have this meeting that nothing came of?
No, I don't think it's a mistake. I think you always want to look like you're engaged on either side. A Democrat's problem, and it is a Democrat problem, simply because what Republicans want is very simple. We want to keep the government open, and we're going to do a clean bill to let that happen for a little while. Democrats want stuff, so they have to figure out how to get it. Senator Schumer's problem is that now he looks like he's willing to shut the government down, not on anything substantive, but it's all very procedural and technical. Republicans have agreed, Trump agrees, to have a negotiation about the Obamacare subsidies, for example. Republicans just don't want it on a temporary spending bill. And, Schumer always says, well, they didn't want us to negotiate. They didn't do this, didn't do that. Well, Democrats weren't clear about what it is that they wanted until about 2 weeks ago. So both sides are kind of gaming this a little bit. But procedural arguments never win, and with the public. And so what's going to happen is, Democrats have a win in front of them that they could have taken any time in the last week, which is, say that Republicans agree to negotiate. We're going to do that. We're going to keep the government open, which helps all those unionized public workers that actually support them, and kind of move on to the next thing. But when you're trying to show everybody you want to stand up to bad orange man, that's a tough lift, because you have to have that performance.
Well, yesterday when the vice president was briefing us, he talked about how rural health care funding is potentially one area of compromise. If this was to be the area for potential off-ramp, how quickly could we see that?
Well, that's why you need to me, that's why you need an extension, and why an extension of time to negotiate is part of the my 40% case, because the details of that are simply too difficult to be worked out very, very quickly, and the prospect of harm is very great.
Terry, it did feel like something was different with the threat of widespread layoffs in a government shutdown. Why do you discount that and just think that this is more performative?
I don't discount it. I just thought the Democrats got an opportunity out of it. Well, firstly, let me say that the widespread layoffs have now morphed into furloughs for the vast majority of the government, according to your reporting and the situation on the ground. So, exactly what might happen should there be a shutdown to federal workers is fairly unclear and varies by agency. Secondly, I discount it because if there's a shutdown that ends, the implicit promise here is that the vast majority of those workers come back. That's very true if there's a furlough. So what they're trying to do is engage in kind of a technical exercise to save money, but understand that that's a pressure point. That's a pressure point on Democrats to not have a shutdown in order to help the public sector unions, just like threatening no data from the BLS, for example, is a pressure point on, among other places, markets in order to get Democrats to think twice about this.
Just quickly here, Terry, is the shutdown only going to end when the Democrats cave?
I don't think they cave. I don't look at this stuff in a binary manner generally. What they need to do is take the win that's in front of them, frankly, and they have a win. If people want to negotiate on their priorities, that's a yes, right? So you take the yes, and good things happen. But I think what my 60% base case now is that you have to have, at least from the Democrats, you have to have at least a little demonstration that you're willing to stand up to the bad orange man, which you haven't really had all year.
Terry, appreciate it. Terry Haynes there of Pangea Policy. Let's think about the calendar here. We've got payrolls on Friday. You talked about CPI. I think it's 2 weeks tomorrow. So depending on how long this goes on, that depends on the kind of data points we'll miss out on.
Yeah, and that leads us up to the Fed meeting, which is October 29th, 30th, which means that we might have no new information that is the gold standard for the Fed to work with before cutting it again 25 basis points.
Do we need Fed officials? Can we confirm that? Are they going to be kept on?
Terry Haynes said that it's a threat from BLS. There's a chance potentially President Trump deems them essential, and we get the report.
Chair Powell's essential, isn't he?
I think so. Absolutely. If he doesn't get paid, he's still showing up.
Steve Byron's essential these days for this administration.
Couldn't agree more. From New York City, this is Bloomberg.
look at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced. SPAR being where it is and how competitive the South African market is, we really just want to refocus on our home markets. Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country. Our business has the ability, and our independent retailers have the ability to compete directly with the chains. And we are now the second biggest supermarket brand in this country.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Two-day winning streak on the S&P 500, lower this morning, down by 0.2%. Likewise on the Nasdaq, on the month so far for September, up on the month by 3% on the S&P. On the Nasdaq 100, up by 5%. For the benchmark, the S&P 500, we're looking at a 5th consecutive month of gains. That's equities. Turn to the bond market. 2s, 10s, 30s. 2s on the month, virtually unchanged. Yields down just a basis point on the session, 360. Something that's not unchanged. Check this out. Gold, up 10% for the month of September. A monster rally for precious metals.
Yeah, it's been a haven, and it continues to be as people try to understand the resilience of the bond market. I'm actually more focused on the bond market today. The idea that Saudi Arabia, the Bank of Saudi Arabia, is single-handedly reducing borrowing costs around the world because of their increase in production, and how that is driving some of the action that we saw yesterday in the bond space. Not the Fed, it is the central bank of the Middle East.
Tick crude yesterday morning. This morning, just to finish on gold, up 10%. Month to date, the biggest monthly gain potentially since 2020. 3 hours away from the opening bell, let's get you some single names, some morning movers. With the latest, here's Yahira. Hey, Yahira.
Hi, John. We start with EchoStar. Those shares are surging 7% in the pre-market. On our reporting here at Bloomberg, that Verizon is the latest company showing interest in buying some of its wireless spectrum. Remember, AT&T and SpaceX also bought some and paid well above book value. So investors are hoping this means another big payday for EchoStar. And moving on to Coty, this is the company behind the likes of Sally Hansen and CoverGirl. Shares are rising 1 3/4% as investors hope that a newly announced strategic review will revive its consumer beauty business, which has been struggling, sales falling for 3 straight quarters. So they are weighing options such as partnerships or even divestitures while doubling down on fragrance, which is a hot area in the beauty market. And we end on Firefly Aerospace. Those shares are plunging nearly 10% in the pre-market after the company said that one of its rockets that was due to launch in the coming weeks was destroyed during a test yesterday. It's the latest mishap. It had another incident back in April, and it just went public back in August. So it is still trying to prove that it can compete in the ultra-competitive commercial launch market, dominated, of course, by SpaceX. John?
Yahira, thank you. More from Yahira in the next hour. On our radar this morning, the Vice President J.D. Vance saying a government shutdown is imminent and pinning the blames on Democrats. Yesterday's meeting at the White House failing to bridge the divide over Democratic demands for healthcare subsidies. Elsewhere, President Donald Trump unveiling a 20-point plan for a potential end to the Israel-Hamas war, calling it a historic day for peace. The proposal, backed by the Israeli Prime Minister, calling for an immediate ceasefire and the release of nearly 2,000 prisoners. And finally, the president also announcing new tariffs on imported wood products, including a 10% tax on lumber and up to 25% on kitchen cabinets. The move, which starts October 14th, is designed to boost domestic manufacturing.
So once again, we see the president going into just looking at sectors and using 232 as an avenue, a path forward to enact these tariffs. All of this is happening while we are waiting for the court to decide whether or not IEEPA was legal or not. If the courts come down and say it was illegal to use IEEPA, well, look, this administration is going to be able to raise funds via another avenue. And potentially we're going to see more of this if IEEPA is struck down.
Nathan Sheet of Citi says this story is about to bite. Manny Roman of PIMCOM on the programme yesterday said something similar, that this could be a thing for the equity market into year end.
Especially if we start seeing the actual cost to margins from some of these tariffs. Who are these tariffs for? Especially if they are supposed to protect industries. And with the home builders, it's even more interesting because there has been a groundswell to support home buying and home building in this country. And all of a sudden you have the National Association of Home Builders saying our housing crisis is a bigger threat to national security than imported lumber or timber. It disproportionately hits Canada. A real question here about how much companies are going to have to adapt and adjust as they start seeing the real world impact.
Remember the earnings call when the RH CEO was throwing around F-bombs? He also said, God forbid they throw another tariff our way. He said, give me a call. I run the biggest luxury brand in the world. Give me a call. Well, good morning. Here's another tariff.
Yeah, the RH CEO not in a good place, that's for sure. Nike's going to be in focus with the tariff story absolutely dominant. Earnings are due after the market close, with investors eager to see the impacts of tariffs on the company's turnaround progress. Jay Soul of UBS raising its price target on the stock to 71, but writing, we don't expect Nike to provide formal full year 26 guidance, and tariff policies remain uncertain. Jay joins us now for more. Jay, welcome to the program, sir. Thanks for making some time for us. Let's just talk about your channel checks first. How do you think demand has held up?
Well, I think demand is getting a little bit better for Nike, but it's still weak. On a year-over-year basis, sales are probably down year-over-year for Nike this quarter.
What's preventing them from guiding into 26 with a little bit more clarity?
Well, I think you touched on it before. I think tariffs is one factor that's really limiting their ability to have to give guidance, because obviously there's the cost impact, but also they don't know what impact the price increases will have on consumer spending as we get into the all-important holiday season. Because they don't know how to forecast that, they're going to be hesitant to give guidance, we think.
That said, Jay, a lot of people said that the back-to-school season is a good predictor of holiday demand. Do you think that that correlation is broken down this year?
Well, I don't think it's broken down. I just think we're going to have a different environment in holiday than we've had in back to school. Back to school was good. By all accounts, people were out shopping. There was good fashion trends. A lot of companies reported upside to consensus estimates when they gave their earnings updates. But in holiday, maybe we see prices go up a little bit more because of tariffs, and that could create a different dynamic, which causes the consumer to pull back. Now, there's a chance that might not happen. If you ask consumers right now, we do a survey of 8,000 U.S. consumers every month. You know, they're saying they're feeling pretty good and they want to have a great holiday season. But, you know, maybe that attitude will change once they see price increases at retail.
What's interesting to me is a lot of CEOs of retailers don't know themselves how much consumers are going to be able to absorb these price increases. They're kind of testing the water. It seems like some brands that have more staying power, more popularity, more flash, are able to raise prices more than others. How is Nike doing in that competitive landscape?
Well, I would say Nike's sort of in the middle of the pack. You know, I think the key in the world of athletic apparel and footwear to raising prices is innovation. When you have new innovation that consumers really excited about, you know, the brand that offers that innovation can raise price and the consumers will happy to pay it. But right now, Nike doesn't have that much new innovation. They have some, but they need more. If they had more, they could raise prices better. But right now, like I said, they're sort of in the middle where they need more to really get the price increases they need.
What about when it comes to just being cool? My 9-year-old nephew called me because he wanted on shoes, sneakers, for back to school after his mom bought him Nikes. Is Nike's just still struggling to be relevant?
Well, first of all, that's a great story. Your 9-year-old wants on. I think that's a pretty great anecdote there. You know, I think the issue for Nike is that for the last few years, they were really depending on 3 or 4 key styles. You know, the Air Jordan 1, the Air Force 1, you know, the Air Max. And consumers really bought so much of these styles. Now they're sort of looking for something different, and Nike doesn't quite have enough to offer them yet in that important lifestyle category for, you know, kids who just want to go to school in a cool-looking shoe. So, and that's kind of related to what I mentioned before. Is they don't quite have enough innovation. When they fix that issue, you know, Nike's going to be strong again.
They just did a mashup with Skims, and of course the World Cup is next year. Are these avenues where they could potentially get some of their mojo back?
Perhaps. You know, the World Cup is a great event. Obviously, it's a great global sporting event. Nike obviously is one of the biggest, if not the biggest, soccer brand in the world. So that should be a good opportunity for Nike to show what it can do, both in terms of product innovation and marketing. The Nike Skims thing, we'll see. It's new. You know, obviously Nike has had big ambitions over many years to do better in women's apparel. This is the latest attempt. We'll see if it works.
Jay, the losers, the real losers are elsewhere. The second biggest loser on the S&P this year, Lulu. The third biggest loser on the S&P 500 this year, Deckers, think Hoka. Jay, what's happened with those two companies? What's going wrong?
Well, I think what's going right, first of all, there's still a great trend toward athletic footwear. Consumers are buying a lot more athletic footwear this year than they did last year. But with those stocks in particular, the market had super high expectations at the beginning of the year, and neither company really lived up to those expectations, and that caused huge PE multiple contraction. The industry is still very healthy in our view. It's like sometimes, there's stocks that outperform others based on, the companies just do better. And for Lulu and Deckers, the situation is, like I said, both companies just didn't quite live up to what the investors were hoping for.
How much, Jay, do you expect announcements of layoffs going forward in the next 6 to 12 months? We've already seen it on the margins at a number of retailers with a greater adoption of different technologies. I'm thinking AI, algorithmic machine learning.
Well, I think AI is certainly helping a lot of companies in the world of apparel and footwear. I don't really expect a lot of layoffs. I expect productivity gains to be used to offset maybe margin pressure in other areas from tariffs. I think that AI is going to open up some employees within companies to do more high value add tasks. Making apparel and footwear is a very creative process that requires, smart people. And it's better if they can use their time thinking creatively than doing maybe easy tasks that can be passed off to AI. So I think the employment outlook for apparel and footwear is actually still pretty good.
Hey, Jay, appreciate your time. Jay Solder of UBS. Jay, thank you, sir. Lulu, down 53% year to date. Deckers is down about 49. Those stocks cut in half. Best performing stock on the S&P 500 this year, guess what? Robin Hood.
That's
Number one performing name on the S&P for 25.
How many clothes do you have to actually buy if you're sitting in your basement trading stocks?
Up 267%.
Bitcoin, gold.
It's not bad, is it?
Bitcoin.
Does that speak to the year so far?
It basically does. The average person isn't going out and bulking up on beautiful or even mid-tier clothes.
Well, the other thing, too, is the styles are changing. So this is not as cool anymore for a lot of these brands. They're just not innovating in a way and connecting with the younger generation.
Nike reporting after the closing bell. Look out for those numbers a little bit later. Equity futures on the S&P just a bit softer. We're down by 0.2%. With an update on stories worldwide, let's get to your Bloomberg brief and cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump and Defense Secretary Pete Hegseth will address U.S. military officials in person at a Marine base in Quantico, Virginia today. Last week, Hegseth summoned top military commanders to the base for the meeting. A Pentagon spokesman did not provide a reason for the meeting, nor say what Hegseth plans to tell the high-ranking officials. BHP shares are dropping this morning on the deepening dispute between China and the world's biggest miner. Sources telling us here at Bloomberg the nation's state-run iron ore buyer has told major steelmakers to temporarily hold all new purchases from BHP. Boeing has started working on a next-generation single-aisle aircraft that could eventually replace the 737 MAX. The Wall Street Journal reporting the new narrow-body aircraft is in early-stage development. It comes amid growing concern about the safety of the current 737 MAX. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the program, adding to tariff risk.
Life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff. There's a whole leg of the equation that we haven't really seen.
Up next, we'll catch up with the former White House senior trade advisor Kellyanne Shaw, live from New York City this morning. Good morning to all. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Two-day winning streak on the S&P 500 as we look to close out the month of September with another monthly gain. We're looking for 5 consecutive months of gains on the S&P 500. Futures this morning down by 0.2 on the NASDAQ, down by 0.16. One single name to look at, Exxon. News this hour that Exxon plans to cut about 2,000 jobs globally. That stock is pretty much unchanged this morning, but that effort from Darren Woods that goes back to something like 2019 to restructure this company continues.
Yeah, and this has to do with a Canadian outpost that's cutting a significant amount of jobs. It comes after a number of job cut announcements from big oil companies. ConocoPhillips cutting 20 to 25% of their staff. Chevron idling 15 to 20% of the staff. BP, 15% of the staff. Halliburton, up to 40% in some of its units. You look at this, you think, okay, lower oil prices. What is that doing to the labor backdrop for the oil sector? That's an interesting story.
The Dallas Fed puts out a quarterly energy survey, and this was the last one for the current quarter. 3 big issues here for exploration and production firms. Excess in the global oil market is restraining oil prices near term. There is continued uncertainty from OPEC Plus unwinding production cuts. And finally, trade and tariff changes and the resulting geopolitical tensions. Costs are up. This is a problem for the oil patch right now. They're struggling.
They're facing costs. They're facing new technologies that can allow them to perhaps trim around the edges. And then they're also facing just lower energy prices with the Central Bank of Saudi Arabia continuing to gun it in order to lower oil prices. It's a pretty toxic brew for them. It just raises a question of what this does longer term to their productive capacity, given how the U.S. became almost oil independent, energy independent when it came to the oil patch in years past.
The latest from Exxon this morning, planning to cut about 2,000 jobs globally. Under surveillance this morning, adding to tariff risk.
Life in industrial America isn't great. I mean, top line is not growing, and one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin. And so there's a whole leg of the equation that we haven't really seen.
So here's the latest this morning. President Donald Trump ordering a fresh round of tariffs on lumber, cabinets and furniture set to take effect in the middle of October. John gets now to discuss as the former White House senior trade advisor, Kellyanne Shaw. Kellyanne, good to see you. You are charged with explaining where this ends. Where does this end? What are the limits of this strategy, this policy?
Well, I don't think there is an end in sight, at least not for the duration of this administration. I mean, the president is continuing to roll out various tariffs. We obviously saw timber and lumber last night. We're expecting pharmaceutical and trucks this week. And there's at least 11 more 232 investigations in queue, if not more, that we don't quite know about.
The problem is you put tariffs on one sector, you might help them out, you'll hurt another. Lisa was talking about house building. We need to build houses in this country. You put tariffs on lumber, great for domestic lumber. Not so good if you're trying to build a house. You see this across the board when it comes to things like furniture. Put tariffs on furniture. Fantastic if you're a furniture maker in North Carolina. Good news maybe, but if you're Restoration Hardware, to Anne-Marie's point, you've got a problem. What's the overall strategy here? Are they thinking about who this hurts, who this doesn't hurt, if it helps people upstream, who it hurts downstream? Are they going through all of that?
Yeah, I think it's a great question, and we are seeing some of this tariff inversion issue where all of a sudden the parts and components that you need to manufacture become disproportionately more expensive, so it's less competitive to build or create in the U.S. So what the administration is likely going to do over time is try to uninvert these tariffs, but right now their strategy is to get it all out. This is a once-in-a-generation change in terms of the way the U.S. collects tariff revenue, and I think we'll see some changes over time to try to make some tweaks along the margins, but right now you're right. There's just a lot happening right now.
Is this more about the revenue right now than it is about really shifting where manufacturing happens?
I have always been of the view that the revenue is not the most important part of the president's strategy. I think that this is about rebalancing the trading relationships. It's about the trade deficit, and it's about national security and supply chains. I think the revenue is a happy circumstance from the administration's perspective. I also think it's really important to the markets in a way that for some in the administration, it doesn't quite register.
If I were an investor trying to understand what national security means, and I think about lumber as a national security issue, but TikTok, at least if it's owned partly by Oracle, not being a national security issue, and some of the chip exports maybe not anymore being a national security issue, is there any cohesive thread as to what is and what isn't a national security risk?
So I think it's a great question, and part of it depends on the sector or the good or the service that's being targeted. So when you look at these sectoral tariffs, the concept behind it is there are certain things that we need to produce in the United States in the event of wartime event, pandemic, some sort of force majeure. We need to be able to have production capacity. And so those are on the goods themselves. These other export controls and other types of investment screening mechanisms, those are about services and other types of economic behavior. So I do think you can separate those a bit.
If IEEPA is struck down in the courts, is that why you think they're doing all these sectoral tariffs? You said maybe a dozen more are set to come.
Yeah, and there could be more that we don't even know about because they aren't announcing when they launch these investigations. What I would say is I don't think that replacing the current IEEPA tariffs with 232 strategy is very good policy, in part because the IEEPA tariffs are about countrywide tariffs. These sectoral tariffs are really about products and specific products. They don't quite match up. Now, that's not to say that the administration isn't going to use all the different authority they have to try to replace IEEPA, but I do think that creates a bit of a messy patchwork if that's in fact what's going on.
We also had the Commerce Department expand the entity list yesterday. What does that mean for the U.S.-China ongoing trade negotiations?
Yeah, I think that's a great question, too. And those negotiations were continuing just this last week when you had Chinese negotiators in town. So we had understood that this move was previewed by the U.S. to the Chinese side in advance, which often happens with some big moves on either side. So you try to take the temperature down and you don't have this immediate reaction. But I think what it shows is that the U.S. and China are going to continue to walk and chew gum at the same time, meaning they're going to continue to take measures that hurt one another at the same time as try to make progress where they can.
Are they going to buy some soybeans?
It sure looks
it's
like...
It's becoming a massive problem.
Yeah, it sure looks like they're gearing up for that. You had Chinese officials visiting the Midwest, talking to business leaders, potentially flagging some interest for farmers. I think that's going to be a top ask by the Trump administration. But you've also had, on the other hand, the president say that he's going to give some of this tariff revenue to farmers to try to make up for some of the difference. So you've got two things going on.
The government needs to be open in order for them to vote on giving this bailout to the farmers. But why is the purchasing agreements not in the forefront? Why have they not been brought up on the number of trade negotiations Bessent, Lutnick, Jameson Greer have all had with the Chinese?
Well, I strongly suspect they have been discussed, in part because the Chinese already committed to purchase soybeans, aircraft, and energy products as part of that phase 1 deal from way back in Trump 1.0, and they didn't live up to those commitments. But for China to make some of these big purchase announcements, that to me signals something that will happen alongside a leaders summit. So we could see that as soon as the APEC meeting, but most likely some sort of Beijing trip when President Trump goes to meet formally with President Xi.
When do we have this APEC meeting potentially between Xi and Trump? I mean, they said at minimum there's going to be a pull-aside as they attend this summit. Who has the leverage going into this?
both sides have leverage. I mean, clearly the Chinese have leverage over the United States when it comes to rare earth magnets, critical minerals. They've got choke points on certain aspects of the U.S. economy, which is what is so concerning to the administration. But you heard Secretary Bessent last week talk about chemicals, the fact that China can't fly their airplanes without the United States. There are choke points both ways, and I think both countries are trying to navigate that dynamic.
It was always clear that the U.S. and China were something of adversaries. Do we have a clearer sense of who the U.S.'s friends are right now?
Well, I think this administration is a bit more transactional than we've seen previous administrations, meaning we can be friends, we can be allies, but we can also go after you for economic reasons and on the trade front. And the opposite can be true as well. We can cooperate on trade and be national security adversaries, which is some of the dynamic we've seen play out with India and purchases of Russian oil. But I would say our traditional allies continue to be our allies, but there is friction on the trade and economic front.
Are the Europeans picking a side?
This is something the Europeans have always struggled with.
Big time.
Yeah.
And something we need to sort out too, because you look across the EU right now and you ask Spain, I think they've got one view. Ask Italy, they've got another.
This is the feature and the bug of the European Union, is that they don't speak with one voice, and that continues to be an issue. I just wonder, can you distill the idea of an economic relationship from a geopolitical and strategic one? Is there really a dividing line between these ideas, or are these typically intertwined, that economic and strategic tend to go hand in hand?
Well, China's been an adversary for a long, long time, and we've still traded with them. I think it's the first time really that we've had tariffs that are so high that trade has started to break down.
And you were the one that pointed out that the initial thought was the more that we do business, the more you actually increase some of the ties and increase the global system. Right. Well, at what point, if that's not true, does that break down? But that doesn't undermine the idea that typically, I mean, the idea of money, sorry, I'm going to get a little philosophical,
sure,
but the idea of money is actually rooted in debt. It is the social ties that bind one another. It isn't necessarily, I owe you this for the number of apples, so I'll give you 2 shoes. It's the idea of, you know, I owe you this and them sort of social relationships. So at what point are those connected?
Yeah, Russia, kind of the example of the moment to show you that doesn't work.
That's true. Exactly.
Russia and the Europeans. That's what Angela Merkel thought. We'll trade with the Russians, we'll keep them on side, and look how that worked.
It hasn't worked, so what's the new order? This is a new moment.
Coming together in real time.
Yeah, exactly.
Kellyanne, it's good to see you. Thank you. Thanks for being here. Kellyanne Shaw there, the former White House trade advisor on the push forward between the United States and China and a whole lot more. The tariffs keep accumulating. If you are just joining us, welcome to the program. Equity futures just a bit softer here on the S&P 500 on the final trading day for the month of September and for Q3. Coming up next, Phil Orlando of Federated Global Investment. We'll catch up with Monica Guerra of Morgan Stanley, Vinu Krishna of Barclays with a new report on AI and lots of questions about bubbles. And later, the Citizens Financial CEO, Bruce Van Saun from New York City, the second hour of Bloomberg Surveillance, up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Market continues to make new highs.
Higher productivity supports higher valuations. The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the US is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 a little bit softer, following 2 days of gains and heading towards a fifth consecutive monthly advance on the S&P 500. In a bond market, 2-year and 10-year, looks like this. Yields unchanged on twos on the session and on the month so far for September, 361.65 as we count you down to a week full of economic data with a major question mark over payrolls as this government heads towards a shutdown.
It seems like it's looking less likely that we'll get that. Interesting. Markets are shrugging it off, saying we care about ADP more and it's been more accurate anyway. At the same time, it raises a specter of not getting CPI next week and having no new official information, the gold standard type of data, coming before the Fed has to make another decision. This goes to the stasis you're seeing in 2-year yields. That balance between hawks and doves kind of staying in the same place since the last time they met.
The Fed meeting is October 28th and 29th. CPI is October 15th. The question in Washington is not if there's going to be a government shutdown. There will be a government shutdown. It's for how long it's going to last. And how are you going to be a data-dependent Fed if you do not have the data? Which is why I think, even though the BLS came out with their contingency planning, I could see a scenario the president says, actually, this is really important, and I'm going to deem a certain amount of workers at BLS essential to make sure that these economic reports come out. That's not thinking right now because we have the statement from BLS, but it's a possibility.
This Fed can't agree on the data they've already got. I'm not sure what difference additional data makes at this point for some of these officials.
If I were a conspiracy theorist, I would say maybe it's actually in the best interest of policy and of the president to keep these people furloughed for a while. Because ultimately, if nothing changes, insurance is to still cut rates. And if you're going to cut rates into a reacceleration, which is what a lot of people think, then, well, you don't want any data that might actually be an upside surprise. I'm very curious to see about ADP. And if it surprises to the upside, what kind of signal this market
We're
gets.
hiding positive data now. Is that the conspiracy theory?
I'm just making stuff up. I don't think that we're actually hiding anything, just to be very clear. I'm just saying that I think that right now it is likely that we're not going to get the data, and ADP is going to be more important. That's all I'm going to say.
the Fed meeting at the end of October. Equity futures right now in the S&P negative by 0.2%. Coming up this hour, Phil Orlando at Federated Global Investment as Wall Street looks to close out the month on a high. Monica Guerra of Morgan Stanley with the clock ticking towards a government shutdown. And Bruce Van Saun of Citizens Financial Group with the U.S. economy at a crossroads. We begin this hour with stocks inching lower ahead of fresh jobs data through the week. Phil Orlando of Federated Global Investment sees momentum building. He writes the following: given the potential for a strengthening labour market and moderating inflation, economic growth could accelerate in the second half of this year. Phil joins us now for more. Phil, good morning.
Good morning. Thanks for having me back.
Thanks for being here. Just to build on that quote, is that the story we're priced for?
Stock market's up 38% since the Liberation Day lows back in the middle of April. So clearly they're not jumping out of the upper floors of the towers because they're concerned that the labor market's collapsing. Has the data been soft the last 4 months? No question. But in our view, the data was sort of troughing here and has the potential to accelerate going into the next couple of months.
Relative to what? This is what I want to understand. Clearly, we're priced for a lot of this going into 26. Expectations have already picked up. We've had the equity market rally. How much of that has been about earnings? How much of that is just a better economic story already?
So the earnings situation we think is excellent. You look at the first quarter and the second quarter revenues up 6%, earnings up 12%, much better than expected. The consensus expectations for the third quarter starting to come in. Those numbers look pretty strong. We're in the process of upgrading our earnings estimates for full year this year, full year next year. So the earnings picture is in pretty good shape. Clearly, the labor market has been the weak link. Now, you look at the August jobs report, it was terrible, admittedly. But there are a couple of things associated with that. Number one, August tends to be the quirkiest month of the year. You've got, schools starting and starting up again, factories taking downtime to retool, temporarily furloughing workers. So the August non-farm payroll report historically is the quirkiest report of the year. So you look at, for example, Kevin Hassett, the national chairman director, came out and said that they're expecting 70,000 jobs to be revised up over the course of the next couple of months. That's consistent with what we've seen historically. All of the noise and the nonsense in August tends to get revised up. All right, that's point number one. Point number two, when we saw the initial weekly jobless claims the first week of September, the numbers were terrible. I think it was about 264,000. The market was freaking out a little bit, but we suggested take a deep breath. Number one, it's a holiday shortened week. And number two, you had the allegations of claims fraud in Texas. So as we went to the next week, which was the survey week for September, the number came down to about 230,000. And then last week came down further to about 217,000. So we think the claims are pointing to the fact that the numbers are going to be pretty good. And then, we were talking about non-farm versus ADP going into this. The expectations for ADP, about 50,000 plus. That's kind of the number we're looking for non-farm. That would be a number roughly double what we saw in the month of August for non-farm. So we think the labor market, there may be a little too much pessimism built in. So our expectation that the numbers probably troughed here and we'll start to see some improvement.
Given that backdrop, there's a mystery, and we were unpacking that ahead of the Nike earnings after the bell. This idea, even CEOs don't know how much consumers will absorb price increases. What is the connection right now between corporate profits and potential inflationary pressure?
No question. If you look at the piece that I wrote last week focused on how good the back-to-school season was. Back-to-school was up 4.2% 3 months through August. Back to school a year ago was only up 2.3%. So the consumer's in pretty good shape, particularly at the high end. But I think there is absolutely some consternation about what pricing is, particularly at the low end of the price spectrum. So companies are going to have to, sort of weigh that situation. High-end consumers can afford a little bit more in pricing, but the question of are there going to be any forced pricing issues because of the tariff situation that companies need to pass on in order to maintain profit margins. Profit margins have been pretty strong up until now. Is that situation going to deteriorate in the third quarter and the fourth quarter? We don't know the data yet, but that's something that we're going to have to see.
The big question mark over this has been holding back the broadening out in the S&P 500, in the Russell 2000, in the S&P 600, pick your index. How much are you betting that we are going to see that broadening out versus just this consolidation in big tech, this idea that the profits will continue to be driven by the biggest 10 names?
We're absolutely in the broadening out camp, and that's been our call for the last year. And case in point, look how well the small caps have done, both growth and value, over the course of the last couple of months. In our view, the small caps were completely mispriced. And once we began to see the Fed tipped over their cards, they're going to cut interest rates. An interest rate reduction cycle is usually beneficial to the small cap companies. It improves their ability to self-finance, kicks off an M&A and an IPO cycle. And you've got a situation where domestically we think economic growth is accelerating. Small cap companies do 80% of their business here. If the U.S. economy is doing well, that's going to benefit small cap companies.
But aren't more tariffs going to hurt small cap companies? Even if they do business here, a lot of the imports could be coming from other countries.
Well, again, that's a case-by-case situation. I was on Bloomberg Radio recently, and we were talking about this, and I got some random person that sent me an email when I got back to the office asking that question. Isn't that going to impact pricing and imports, and won't Christmas sales be a disaster? And the answer in our situation is we think it's going to be a case-by-case situation. How is a company sourcing what they're selling? What's the pricing of that? Can they source more domestically? What's their labor situation, immigrant versus native born? There are a lot of factors here that are going to dictate the answer to that question.
Is there an area within the small caps that's immune to a lot of this?
We love healthcare, and within healthcare, biotechnology. Our biotechnology gurus are telling us that the pipelines have never looked better, yet the valuations have never been more extreme out of favor. And what we've been waiting for is some catalyst, and we think the interest rate cutting cycle is that catalyst. The big cap companies, Pfizer, Merck, et cetera, will start to think about M&A activity. Lower interest rates, again, will make it easier to self-finance. And people are now going to focus on the really good phase 1, phase 2, phase 3 clinical work that these companies have done with their drug development. That's a sector we think is poised to move higher.
Phil, it's good to see you.
Thank you so much for having me.
Thanks for dropping by. Phil Orlando there at Federated Global Investments. Small cap futures on the Russell 2000 a little bit lower this morning. On the S&P 500 down by close to 0.2%. With an update on stories worldwide, here's your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Federal agencies preparing for government shutdown with detailed plans that call for temporary furloughs but not permanent mass firings. At least 8 cabinet departments comprising more than 2/3 of the federal workforce had detailed their shutdown plans as of Monday afternoon. Together, they called for more than 400,000 employees to be sent home as non-essential. President Trump ordered 10% tariffs on imports of softwood timber and lumber, also a 25% duty on kitchen cabinets, vanities, and upholstered furniture. The tariffs are set to apply from October 14th, with some increases targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. After a decade, McDonald's is bringing back the fan-favorite Monopoly game in an effort to boost sales. The promotion returns October 6th for a limited time, but with a digital twist. Instead of a physical board, customers will play through the company's mobile app. Prizes apparently range from free fries to a $1 million cash prize. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next on the program, a shutdown, showdown.
We have very large differences on health care and on their ability to undo whatever budget we agree to.
We're headed to a shutdown because the Democrats won't do the right thing.
A conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning.
astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equity futures on the S&P just a little bit softer as we close out the month of September. We're down by close to 0.2%, softer by just 0.1% on the Nasdaq 100. Under surveillance this morning, a shutdown, showdown.
We have very large differences on healthcare and on their ability to undo whatever budget we agree to.
You don't say the fact that you disagree about a particular tax provision is an excuse for shutting down the people's government.
Their bill has not one iota of Democratic input. That is never how we've done this before.
We're headed into a shutdown because the Democrats won't do the right thing.
So here's the latest this morning. The US closing in on a government shutdown with funding set to lapse at midnight. To discuss, joining us now is Bloomberg's Laura Davison. Laura, welcome back. Walk us through how this cascades through the government over the coming days. What happens just after midnight tonight?
Yeah, so even starting today around midday is all the federal agencies start all of their shutdown procedures. So they each have plans that designate certain employees, about 60% or so, as essential. They will stay on the job, they will not be getting paid. And then about 4 in 10 employees will be sent home and will cease all their work for the duration of the shutdown. There is a law that says all of these folks who are furloughed will get back pay. But this, if the shutdown lasts for several weeks, it could be, several weeks before they get that pay. We saw, back in 2018 when there was a 34-day shutdown, that started to cause some economic ripples as people went 2 paycheck cycles without getting paid. In addition, the White House has also threatened that certain non-essential employees could be fired. We have not yet gotten any indication from agencies about who might be in scope there, but that is another pressure point that the White House is putting on Democrats to end a shutdown.
Laura, appreciate the update. Laura Davison down in Washington, D.C. MH, how are you thinking about this? What does this actually mean for Wall Street?
For Wall Street, the only thing they're really going to care about is the economic data. BLS has put out what they think is going to happen if we have a shutdown, which is we're going to cease to have any economic data. I still think there's a chance that the president would deem some members of BLS essential and then basically say, at least minimum, release the jobs report on Friday, because all the work for the jobs report would have been done, maybe potentially won't get CPI on October 15th. Besides that, this is just pure politics until they reopen, and then there's going to be a lot of discussions about things like a bailout for farmers and appropriation bills that need to get done to actually fund the government.
I think about Libby Cantrell and her notes, but the one but that I would say to that is the market will care if you start to see some pretty widespread layoffs, and if you start to see an appropriation of power in order to cut some of the federal workforce. Do you start to see some more ramifications priced in?
I do like the second paragraph of a Libby note.
I love that.
If you're not familiar, there's always a but,
yeah,
and then a paragraph.
But I can hear her voice like, there's this, and this could be, but, and I think about pretty much every topic through that lens now.
Let's get to some of that now with Monica Guerra of Morgan Stanley. Monica, welcome to the program. A lot of people looking through this. Wall Street saying it doesn't matter, just show me the economic data and everything's okay. Do you think about it slightly differently?
I think you have to look at it, from where the risk actually could bubble up. Now, historically, markets do look through. You get markets outperforming at average about 4.4% during periods of shutdown. Granted, they can last from 3 days to 34 days, so that's a huge window in time. But typically, even with the long shutdowns, you still have markets outperforming. So the risk comes in which industries and sectors are most reliant on those government contracts, and that's defense, healthcare, et cetera. Is this a nice buy opportunity? Potentially, if you're trying to, take a tactical approach. But again, it's typically a short window where markets like to look through.
Well, that last shutdown, that was 34, 35 days in the end. What kind of impact did that have on Wall Street and the economy?
Very little, because the macroeconomic factors, right, were really important. The other thing that's critical here is that it was a partial shutdown. It wasn't a full shutdown. So in 2013, we had a full shutdown, and I think the estimate from the CBO is that they lost about 24 billion or so in productivity. In 2018, even though it was a double the length, right, twice as long or more of a shutdown, they only lost 11 billion, 3 billion net at the end of the day after everyone was made whole. So even with that length of time, there could be, a variety, right, of factors that could impact growth.
The conversation I'm hearing out of Washington yesterday, today, this morning, talking to people is obviously the government is shutting down. It's the length. What are you thinking about in terms of how long the government will be shut down?
So when we're thinking about the political factors here, right, with the Democrats, they are taking a stand. Earlier this year, when Schumer came to the table and they passed the CR, there was a large outcry within the Democratic electorate, right, upset that they moved so quickly. So I think it does behoove them from a voter standpoint, right, of speaking to their base to actually hold a firm line. But then they have to balance that with pressures that could potentially come from the White House. They were calling for mass layoffs. That's likely not to happen. But other areas that could be a catalyst is potentially, apportionment control, meaning that the president could deny a transfer of funds post or during, right, this shutdown as essentially a catalyst opportunity to look under the hood and see where they can cut.
Why has that been the shift in focus away from possibly some sort of mass layoff program and more just shifting where money goes in the government?
So if we look at what happened with DOGE, they were largely unsuccessful, right? They were able to get some cuts through. There was such significant power within the federal unions, right, protecting status of workers, and the legal response, right, was essentially a significant pushback. They don't want to run into that sort of hurdle again. So I think it's more of an issue of which agencies, which programs, which departments are ideologically aligned with the president, and could those areas actually be in trouble if they choose to withhold funds?
Okay, so let's talk specifics. What are the areas that could possibly see reductions in funding? What are the areas that could potentially see increases in funding as soon as the next few weeks if there is some sort of shutdown?
I mean, you could see some risk. I mean, this is pretty high level and widespread. It's already happening right on the DEI front. That's likely to continue. They could also look at anything that's clean energy related. You could maybe see some impacts to EPA. And then the other areas that I think are critical is on the Medicaid healthcare front. They're continuing to want to clamp down, especially on those ACA subsidies that the Democrats are looking forward to extending. Do they get that? That's the big question.
What's the off-ramp?
The off-ramp here, I think, is if you start getting really notable aggressive activity from the White House, and then that could move the Democrats forward, because there's significant amount of programs that they don't want to lose, and they want to make sure that their support outside of ACA subsidies. Right now, this is their bargaining chip. This is the thing that they want to get a win on. If they can't get that, and everything else starts to see this, you start to see the train go off the tracks in other ways, that could be the catalyst that gets the Democrats to the table.
The vice president yesterday was talking about rural health care policy and how potentially that is one place where they can come to an agreement. Is this where the off-ramp will be, though? It will be in the healthcare policy sector.
If Democrats get a concession, that's their off-ramp. The other piece that I'm talking about is the stick off-ramp, right? That if the White House says, no, we're not negotiating with you, we're not giving you those subsidies, then you have to come to the table because we're going to cut other things, right? And it's more of a fear tactic. Now, on the ACA and rural healthcare component, when you're looking at red states, rural red states, they're most reliant on ACA. They didn't do Medicaid expansion, so the Medicaid rollbacks don't really impact them. So it is really all about ACA subsidy extension, and that is an area where you do get bipartisan consensus.
Taking a step back and looking at some of the macro implications, not clear what the longer-term macro implications are for bond yields based on just sort of this broader sense that it is essentially an economic issue. You do see, though, longer-term, an impact on the dollar. There has been a weaker dollar associated with shutdowns. Do you expect that to be correlation that continues this time around?
Yes, this is a historical, relationship. One of the things that we want to note, though, is that the length of time, right, is going to impact how weak it goes, right? So if we get a week, that's going to be very different than if we get another 35-day window.
Monica, good to see you. Thanks for being here. Monica Guerra there of Morgan Stanley. No idea how long this lasts. Pleased you brought up gold. It's having a massive month. I think that's taken the temperature of government dysfunction, not just in America, but worldwide, across Europe and elsewhere.
Yeah, for those who say, well, the euro is going to gain against the dollar, then there's France. And people say, well, just kidding. At the same time, you're right. Gold is the barometer of international developed market dysfunction. And that is the only place that people have found as a reliable haven. It is fascinating to see the correlation as long as this goes on, how much more gold surges.
There's risks in the Middle East, gold goes up. There's concerns about if France's government's collapsing, gold goes up. Fear about government shutdown in the United States, gold goes up. Gold is going up even if the S&P 500 is going up. It has basically become this absolute risk-free bet that everyone wants in their portfolio.
The Russia piece of this is absolutely critical. The Europeans are still flirting with the idea of taking frozen Russian assets. Then that's a massive piece of the gold move we've seen over the past few years.
This is driven by central banks. We should put that into perspective. And the amount of buying from central banks, particularly from places like Russia, like China, that want to diversify away from the dollar, has been a big driver of it, but everybody's getting on the train. Everyone who comes on, they say, well, you know, privately, I'm doing it for myself. I've got gold bars in my closet. But for clients, I can't really recommend that as a massive hedge. But you hear that more and more. I don't have any gold bars in my closet, so if you're looking to come to my apartment,
neither do I, for the record.
Don't even look, because it's not going to help you.
It was a seismic move for the Biden administration to freeze those frozen assets, and the Russian central bank was thinking, well, we can't buy dollars anymore. Can we buy euros? What can we actually buy that we think is going to be safe? And not just the Russians did it. You see the Chinese doing it. You see other governments do that because they think it's the only real safe place to go when the U.S. government basically is showing that they can just freeze all of your assets on the drop of a dime.
Have we had the tour of Fort Knox yet? Do we know the gold's
I
there?
asked about that.
What's going on with that?
I think it was just a conspiracy theory.
Cue the conspiracy
But I would
theories.
love to get a tour of Fort Knox. But the Treasury Secretary said on this program or on this table that if any senator wants a tour, so maybe I need to write my senator and say, can I come along for a tour of Fort Knox with you?
Want to know if the gold's there or not.
Well, I know that the value is supposedly surging to record highs, so there you go. I mean, that was wasn't there a story yesterday about that?
$1 trillion now, yeah.
Yeah, exactly. So we've got $1 trillion. Maybe monetize that, pay back the debt.
Well, what this government could do is market gold to its actual value, change it. That would be, as you say, trillions of dollars to add on their balance sheet.
Gold right now pulling back from all-time highs. We're down about 0.6%, up on the month by something like double digits. Coming up on the program, Vinu Krishna of Barclays saying the AI bubble concerns are overblown. Plus, Yahara has your morning movers. Wolf Speed soaring as the firm is set to emerge from Chapter 11 bankruptcy. That stock is up by 16%.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Heading towards a fifth month of gains on the S&P 500, the longest monthly winning streak since last September. As we close out the month of September, equity futures down by 0.2% on the S&P, on the Nasdaq down by 0.1, on the Russell down by 0.3. In the bond market, 2-year, 10-year, 30-year, 2-year, totally unchanged on the morning, on the month as well. This debate at the Federal Reserve is becoming clearer. If you thought this was a one-way trip to another rate cut, 2, 3, 4, 5 of them, the debate of the week, the Fed speak we've seen, I don't think indicates that at all.
The problem is that the debate on the Fed is ideological. It has nothing to do with actually the data unless the data comes in decisively in one direction or another. Right now, there is a bias to cut unless there is evidence of inflation to the other side. You are seeing that inflation if you look at it in certain places. So the question is, which data do you prioritize? And that continues to be the question.
We'd just like some data this week. Maybe payrolls Friday. Let's see if we get there. As we count you down to the opening bell about 2 hours away at 7:30 Eastern Time with your morning movers. Here's Yahara. Hey, Yahara.
Hi, John. We start with Wolfspeed, a company that has been in the doldrums after piling up billions of dollars in debt. But today, shares are surging 17% in the pre-market as the chipmaker completes its bankruptcy restructuring, slashing debt by 70% and cutting its annual interest cost by 60%. That gives the company a little bit of breathing room as it tries to refocus on its core semiconductor business. Meanwhile, we have shares of EchoStar also rising now 8% in the pre-market on our reporting that Verizon is the latest company to show interest in buying some of its wireless spectrum. AT&T and SpaceX have already bought and paid well above book value, so investors are hoping this is another payday for EchoStar. And we end on shares of Semtech. They are also rising 3.8% after Oppenheimer upgraded the stock to outperform, citing a big data center opportunity. Analysts there say that its active copper cables could start grabbing market share as soon as the next quarter, and they expect Alphabet to be a first major adopter. Oppenheimer setting a price target of $81, which represents about a 26% gain from these levels. John?
Yahara, thank you. Appreciate the update. More from Yahara in about an hour from now. On our radar this morning, the U.S. moving closer to a government shutdown, with bipartisan talks at the White House ending without resolution. Democrats and Republicans blaming each other for the stalemate. Government funding set to expire at midnight tonight. Elsewhere, Delta Airlines CEO Ed Bastian expecting most U.S. carriers to lose money this year. Bastian saying premium seats and a resurgence in business travel will drive most of Delta and United Airlines profits for 2025. And finally, the $55 billion leveraged buyout of Electronic Arts, pushing global mergers and acquisitions activity above $1 trillion in the third quarter. A series of mega deals this summer, bringing back hopes of an M&A boom under the President, Donald Trump.
And if you were believing in that and looking at the leveraged loan issuance and how it's at a record pace as well, Jefferies yesterday came out with earnings, which just put the hammer on the point, which was a record in terms of profitability because of this incredible rush of deals. So people have been saying there's a big pipeline, and we kind of raise an eyebrow each time. It seems like it is coming to fruition and that this market is wide open. So anyone who's worried about easy financial conditions, it seems like, at least when it comes to M&A and debt deals, it's pretty wide open.
Wall Street Journal, a number of newspapers in the past few weeks were talking about, as well as this red-hot market of Wall Street banks basically poaching bankers. They're saying this is a red-hot market now. They want to pull the trigger, and they want to make sure they're ahead of this because they see this continuing under this presidency for the next 3.5 years.
This will be a major feature of the conversation with the banks when they report earnings in 2 weeks' time. JP Morgan, first of all, at the gate. That's going to be a topic of discussion in 2 weeks.
Yeah, how much are they ready to pull the trigger? How much are they going to follow Jeffries with record advisory revenues, given the fact that you are seeing companies truly engage? What sectors are driving this? Is it tech M&A that's going to be driving this? Is this media M&A? Is it being driven by necessity or opportunity because of the open markets right now? These are all questions to understand the longevity of it and whether it indicates really a revival in economic activity or just simply trying to execute when the window is marginally open.
The doors for financing are wide open right now, and there's a willing regulator down in Washington given a green light to do a little bit more.
Some of them. That's the question also. Which deals are going to be green-lighted and which ones aren't going to be green-lighted, and how much is that going to affect which deals go through? In other words, if you think that you're going to get a friendly Washington, D.C., well, you might as well pull the trigger, and if you think not, maybe wait a couple of years.
Let's talk about tech. Lisa mentioned it. Let's turn to it. The sector continues to drive markets higher, fueling fears of a bubble. Vinu Krishna of Barclays saying AI fears are overblown. He writes, we remain constructive on AI, but even an upward path may not be without speed bumps. Vinu joins us now for more. Vinu, good morning.
Good morning.
You promised us a major research piece. You delivered it in the last week. Could the AI narrative stumble? My advice to everyone out there, reach out to the team at Barclays to get the full note. You're putting this out, that the data contradicts some of the ideas that have been pushed out there at the moment. The fears of overcapacity, oversupply. What are the data points that contradict those fears?
I think the biggest sort of concern of the market is, are we in some sort of a bubble? Which is a legitimate concern because given the scale and the speed of capital deployment right now, that is astounding. And the problem is that the comparisons are to the dot-com era, which is 25 years ago. And so, what we did is undertook an exercise in comparing who are the biggest spenders right now, basically the hyperscalers, and then who was spending during that period, which was the major telcos, the biggest spenders. Of course, you also had smaller companies which were using the high yield market, the convertible bond market at that time, tapping. And there's a problem there because those companies which were tapping those markets in the telco space didn't have revenues. In fact, the revenue to debt ratio was 100 to 1, right? Debt to revenue ratio. But the ones who were spending, the larger companies, they were also increasing leverage. So their credit quality was deteriorating. And if you compare to what is happening right now, by a series of financial metrics, whether you look at spending relative to sales, or whether you look at the margin profile of companies who are spending, it's very, very different. Or the amount of leverage deployed, the leverage deployed right now is minuscule compared to that period of time. Now, operating expenses are increasing even for the big spenders right now, but what's interesting is because of the diversified businesses, their revenues are growing at a faster clip than their operating expenses. So our view is that this threat is something worth paying attention to. It is very important. But comparisons to certainly that bubble period is sort of, it's not the right comparison.
I'm pleased you bring this up because I struggle with the dot-com comparisons as well. I understand the need for a benchmark on Wall Street. You want something to compare to. But continuing to compare it to the most extreme period of valuations in arguably financial history, I'm not sure it's a particularly useful exercise. What do you think is a credible threat to what is happening right now? What's a decent example of saying, okay, it's not that, but it could be problematic?
I think the credible threat is in the next, I would say, 12 to 18 months, this spending is intact because they have the capital, they're committed, and the race is on. But if you take a step back and based on the work we have done, there are some real constraints. For example, the power wall being hit. In other words, you can build all the data centers you want, but the power constraint is quite acute already. So that could be a problem. The second is, what if the models are no longer incrementally as powerful, like the GPT-5 wasn't as strong, as was only an incremental improvement. And what if the other efficiencies pick up in rest of compute such that you don't need as much compute power? So the demand wall can be hit as well. And third, of course, given the scale of spending, funding, right? Right now, finally, even though their operating cash flows are massive, and they're spending 50-50 on buybacks and capital spending, but they are turning to the debt capital markets as well to fund some of the DC growth, which means that as this keeps gaining momentum, the funding will become a bigger and bigger issue. And it's not an issue right now, but it could. So that's the reason why I think our main point is the theme is real, and in the near term, right, 18 months, we're in good shape. But it does not mean that you don't pay attention to what can go wrong, because a lot can go wrong. I would say that Powerwall is probably the biggest constraint, which can start reining in the amount of capital spend. And we've looked at the scenarios, right? What if capital spending goes down 20%, which, by the way, may not sound as huge, but when you compare it to the fact that consensus expects capital expenditure to increase 30% over the next 2 to 3 years, 20 is a big decline. What you find fascinatingly is that the earnings impact is relatively modest, call it about 3 to 4%. But the bigger impact, we think, comes on valuations. That could be a 10 to 13% impact. So when you combine that, we're talking about 15+% impact, even for a 20% decline in capital spending on AI over the next 2 years.
We're definitely going to be talking more about that energy constraint going forward, because it is something that we keep talking about. And Bloomberg put out a great piece talking about how globally data centers are expected to consume more than 4% of electricity worldwide, which would make it the fourth biggest in electricity use behind China, the US, and India. So definitely something to watch. I do wonder about everyone outside of the big magnificent 10, magnificent whatever number you want to put in there that are actually large enough. I love this quote from Warren Buffett: "Nothing sedates rationality like large doses of effortless money." This comes from Kevin Gordon, who highlighted it in a recent report. At what point are the other sort of smaller companies that are getting money thrown at them for just saying the word AI part of something that feels a little bit different than the very solid story you just told?
I think it's already spread. So one of the things we found in our work is that the AI exposure is really not so much about hyperscalers right now, because they have the financial wherewithal. But a good chunk, I would estimate roughly 20% of S&P companies, or actually 1,500 if you look at, are benefiting. So these are in the energy, in the power, in parts of industrials, in parts of tech outside the big tech. So all of them, to varying extent, are benefiting from AI. But two things actually gives me a little bit of comfort. One is these companies are not including in their guidance the amount of AI-related revenue pickup quite substantially. In other words, the guidance is somewhat de-risked for these companies. So that is quite important. So, and if you look at the scale of revenues right now, the AI-related revenues are growing much faster, but at a much smaller component of their overall revenues. So from that standpoint, the risk is not that dramatic, even though it's there. Though I would say this, though, at the same time, what we have looked, the amount of euphoric behavior in the equity markets is extremely high right now. In fact, beginning of the year, our derivatives team created and launched a euphoria index in equities. And that has clearly been going up and up since the AI bubble, I wouldn't call it a bubble, spending picked up quite dramatically.
So just quickly, does that make you less optimistic for valuations, or does that mean you ride this euphoria for as long as you can?
I think you have to pick your spots. Riding it through the hyperscalers who have the capital wherewithal, whose valuations have actually come down, and who keep earning into their multiples, I still think is a safe way to do. Outside of that, there are enough names where the earnings impact is minimal, but the valuation impact is quite high. You want to stay away from it. So one thing we are talking about is that because we do expect speed bumps, to buy protection outside the hyperscalers, on this side of, call it 100 names which are exposed, buy where there's cheap puts to buy some hedging, because it's not going to be a linear path.
Vinu, it's good to see you. Thanks for sharing this report with us. We appreciate it. Vinu Krishna there of Barclays. We've talked lots about the amount of paper that's moved over the last month or so, how much debt has been issued. Take a listen to these numbers from the team here at Bloomberg. Investment grade and high yield note sales, respectively topping 200 billion and 50 billion for just the 5th month ever, with both markets logging their busiest ever Septembers. Leveraged loan launches setting a quarterly record, and about $4.5 billion shy of reaching $400 billion for the first time.
Yeah, you've seen all-in borrowing costs go down to something like 6.5% on average for all high-yield bond companies, and something well below that for investment grade at a time where the market's also wide open from the private credits funding. So this isn't just coming in the public markets where we can measure it, but beyond as well. With those markets wide open, people looking to put money to work, the golden age of income has to be made somewhere.
Or the golden age of issuing debt, at least for the month of September so
far.
Together. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over for Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Trump ordered 10% tariffs on imports of softwood, timber and lumber. Also, a 25% duty on kitchen cabinets, vanities and upholstered furniture. These tariffs set to apply from October 14th, though some increases are targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. Charlie Javice has been sentenced to 7 years in prison and millions of dollars in restitution for defrauding JP Morgan. Javice was convicted in March for faking user data in a $175 million acquisition of her student finance startup named Frank. She remains free on bail during her appeal. Javice's lawyers and JP Morgan declined to comment on the sentence. The 2025 MLB postseason starts today with the best-of-3 wildcard series kicking things off. The New York Yankees will take on their longtime rivals, the Boston Red Sox, in Game 1 tonight at 6 p.m. Eastern, right here in New York. As for the Mets owner, Stephen Cohen, he issued an apology to fans yesterday after the Mets failed to reach the playoffs. That is your Bloomberg Brief. John.
Bonnie, thank you. Story construction, painful, isn't it?
It's
like Yankees this and then that line. As for the Mets.
I'm sorry, I'm hiding. I'm under the desk. I don't want to hear it.
As for the Mets.
Honestly, it's a travesty how much money they spent on that and the lack of show. And they
Stevie's apologized, hasn't he?
He did apologize. What's he supposed to do? Now what? I mean, honestly, it's like the curse of the Mets.
Do you accept his apology?
I mean, honestly, it was a painful night, and all I can say is, I mean, why are we spending more time on this? Talk about your Yankees. It's horrible.
Up next on the program, the economy and the Mets at a crossroads.
We have weakness in the economy. The economy is on two very different paths. You've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
That conversation up next with the CEO of Citizens Financial Group, Bruce Van Saun. From New York City, you're watching Bloomberg TV.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
All right, Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Equity futures on the S&P softer here by 0.1%. On the Nasdaq 100, we're down by 0.1%. Also on the Russell, negative by 0.3. Under surveillance this morning, the economy at a crossroads.
We have weakness in the economy. The economy is on two very different paths. Tariffs, of course, are eating into the lower-end consumer goods, into things like food and beverages that already have outstripped cumulatively inflation since COVID. Now you add on tariffs. It's a clear strain on the weaker part of the economy, and they need the rate cuts. You've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
So here's the latest this morning. Wall Street waiting on a busy week of economic data. Investors looking for signals the U.S. economy is heading back towards stable growth or volatility and higher inflation. Bruce Van Saun is the CEO of Citizens Financial Group, which serves approximately 6 million consumer and business customers. Bruce joins us now for more. Bruce, good morning. Good to see you.
Oh, great to be here.
Did we say happy anniversary? 12th anniversary?
Yeah, it's 12 years.
12 years has flown by. You've got to read on both the consumer and businesses as well. We talked a lot about corporate confidence, the M&A, the boom, things picking up. Consumer confidence still held back. What do you see across the business? A difference between the two?
I'd say we're in generally good shape. So I think everybody's still a little holding back because of the uncertainty around tariffs and some of the fiscal policies. But that's become the new normal. And so I think businesses now are leaning in a little more. And I'd say consumer is split. So the higher end consumer is still enjoying life, sees the stock market very strong, spending money. A little more pressure at the lower end. Inflation still is persistent, and real wage gains haven't fully covered that, so they're pulling in a little bit.
What opportunities are available to you and the team right now to lean into that higher-end consumer, just a little bit more, higher income, the private side of the business?
Yeah, so one of the moves that we made a couple of years back was we tried to buy all of First Republic. JPM ultimately was successful, but we hired a lot of the talent. A lot of the private bankers came over to Citizens, hired 150 folks on day one, and then we've ramped that up now to close to 500 people. We're across $10 billion of deposits, and we're going to target at year end hitting $12 billion in deposits, $11 billion of AUM. So the business is basically exploding in terms of new customers coming onto the platform. I think we're delivering really good quality service at this point, and we're integrating that with our commercial bank. So a lot of our middle market companies are successful people. They have families in need of both business services on the commercial side and then individual banking and wealth services for the family and for the individuals. And so we bring that together to provide really robust solutions. And I think we're doing that better than anybody in the market these days.
Can you give a sense of just the rapid rate of growth and what you see over the next, say, couple of years in terms of that wealth management sector that's been driving growth or had been driving growth at a lot of the major banks?
Yeah, so one of the things we said is that by this year, that business would be 5% accretive to our bottom line. So it's basically a startup inside a 200-year-old bank. And so we had all the expenses day one, and now revenues are kind of exceeding those expenses, and we'll be well over 5% of the bottom line this year. You play that out 3 to 5 years, this business could be 15% of our bottom line. So anyway, we're kind of continuing to be finding the sweet spot between growing it at a nice clip, but growing it profitably. So one of the issues that First Republic had is their return on equity never got above 11%. We're running this business today between 20 and 25%. So we have good operating discipline on this thing. As we continue to grow, then we reinvest back into businesses. We're opening up new regions. We opened Southern California. We're going to expand in Florida, put more teams here in New York. Tonight, in fact, we're opening our flagship private bank office on 52nd and 6th. So really exciting times and great initiatives that our team is executing very well on.
It's amazing how many points of contact you have to gauge consumer and business sentiment, as John was talking about. I just wonder, what is the sort of feeling, not just about investors, people who are trying to manage their wealth, is it risk on, is it risk off, but also the companies in terms of, are they moving past that waiting pattern, the holding pattern that we were talking about earlier this year?
Yeah, I'd say there's not fully leaning in yet, so we're not seeing our credit lines that we have out with companies really being taken down to invest in growth, in CapEx and things. But having said that, all of our businesses are having very strong years. So cash flow is good, businesses are solid, we see no real credit issues. I think with a little more certainty, they'd be leaning in more and they'd be doing more investing. So I think that's still to come. The good news is on the private equity side, on the kind of financial sponsor side, there's now a kind of tick up in deal flow, which we've been waiting for over 3 years to see that. And so our commercial bank has been positioned for this to happen. We've really invested in it. We've got great people. And so I think we're having a great quarter in terms of our capital markets revenues. The deal machine is going, the flywheel's going. So I think that'll continue. So that feels really good. So the corporate side has a little bit to catch up, but the financial sponsor side, that's ticking up very nicely.
You mentioned Florida. How much wealth have you seen move down from Florida? But you're still doubling down on New York, and I wonder if you're concerned about the mayor race.
Yeah, it's interesting. So we're focused big on 3 regions right now for growth. One is the New York Metro. So we bought HSBC's East Coast branches to get a foothold in New York. We bought Investors Bank, so we now have 200 branches in New York City. We've invested in middle market banking teams here, so we're really gaining market share in New York. The other 2 regions, one is Florida, as you mentioned, and one is California. So we now have over 300 people in both locations. Florida has a lot of tailwind. During COVID, a lot of people moved down to Florida. That's continuing. And so we started with a private banking team in Florida, and now we've added middle market. So we have both corporate and private bank working together. That's a market where we don't have a lot of retail yet. So in New York, we have the full ground game with the retail. Florida, I say that we're coming in over the top of that market to really bank successful people. Same thing in California, over 300 people there coming in over the top. We have private banking teams, we have corporate banking teams, and seeing a lot of growth there as well.
Bruce, it's good to see you. Thanks for the update.
Okay.
Appreciate it. Thank you, sir. Bruce Van Stillen there, the Citizens Financial Group CEO. I'm going to say this, Phil, Bruce, maybe a blessing in disguise not getting hold of First Republic, but getting hold of the talent instead.
He didn't have to pay the price, but he got the business, and that seems to be playing out.
Up next on the programme, Julie Beale of Kane Anderson Rudnick, Jason Bazinet of Citi, David Seif of Nomura, Mark Haefele of UBS from New York City, the third hour of Bloomberg Surveillance. Up next.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And So far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have 2 crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The market continues to make new highs.
Higher productivity supports higher valuations. The market clearly is pricing in a decent amount of expectation for forward growth.
Let's not just focus on the expectations, but also about the market action.
You need to put your money somewhere. And the reality is the US is the only place where you can actually put scale.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
I'm going to say this about 10 times in the next 24 hours. I cannot believe Q4 is literally around the corner. 3 more months to go for 2025. 6 months since Liberation Day. Where has that time gone? From New York City this morning, good morning. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P negative by 0.2% on the S&P. On the Nasdaq, we're down by 1/10. On the Russell, we're down by 1/3. In the bond market, 2s, 10s, 30s look like this. Your 2-year bond yield down a basis point. Likewise on 10s, 4.1290 on a 10-year maturity. And a week ahead looks like this too. It's full of economic data. Even if we don't get payrolls, we'll get a whole lot more. ISMs, PMIs, jobs coming up a little bit later this morning.
Yeah, you framed this really well. Everything has changed, nothing has changed heading into the fourth quarter, given the fact, I can't even believe it is fourth quarter, given the fact that the economic data is still a Rorschach test. You're still seeing the sort of, is this an economy that's reaccelerating, or is this an economy that really needs accommodation? The data is going to be key because ultimately we are not going to get probably a lot of the key points that the Fed looks at. So ADP, jolts later this morning, ISM manufacturing, how much will that really provide the temperature that the Fed has to work with?
I think a thing for us over the last month is this market has moved on. It's looking ahead to 2026 and has done throughout the whole of the summer. It's looking for a re-acceleration, believing that the worst of the data is behind us. And I think you're starting to see that. Companies have moved on too. I mentioned April, 6 months since Liberation Day. Do you remember that line from Jim Zelter of Apollo? Macro paralysis. That's no longer the story for corporate America. You see that in mergers and acquisitions. We've talked about the leveraged buyout of yesterday. You see it in the debt issuance, high yield, investment grade, leveraged loan. Companies are financing themselves. They're investing in things. they're moving on.
Yeah, and Jefferies, which came out and usually is a bellwether for the investment banking sector, came out yesterday with an unprecedented revenue for their advisory business because of that mergers and acquisitions activity. It is clear that companies have more confidence. Whether consumers also reflect that confidence in being able to absorb what will inevitably be higher prices this Christmas shopping season, that's the key. And even CEOs are not sure of that. And this goes to the question of, is the Fed looking at the same economy that is driving the profitability and the success of a lot of these companies? Or they're two different economies that are kind of moving in very different speeds.
And what we saw in the first half of the year is this pull forward effect. Companies might not be able to do that anymore. At the same time, the actual tariff impact might actually start to hit them. And the president continues to levy some of these penalties, as we saw overnight, and we heard from Kellyanne Shaw, there's going to be a dozen more when it comes to sector Pacific. And next year, they're going to have to figure out how to either diversify their supply chain even more or push more of this cost onto the consumer.
That's a process, not a one-off event, and that process is ongoing. I'm with you, though, Bramo. The risk that this does start to bite. I mentioned Nathan Sheets of Citi. He's talked about it too, that it will start to bite into year-end, that you will start to see those higher prices. You will start to see those changes.
Yeah, how offsides is this market to the idea of an earnings report that comes out and shows that either companies are not absorbing the prices, that you're seeing the hits to the margins in order to offset that, or that some of the demand is falling off in select areas? Not to mention an AI giant coming out and saying orders aren't as robust, and then the moon's going to fall.
Then it's all over.
Yeah, then basically you're going to see this massive, and we're going to come here and say, I'm sorry.
With the sound effects, hey?
Something like that.
The best counterpoint right now, I think, comes from Neil Dutta on all of this. I understand all the enthusiasm. I'm right there with you. I hope things get better for 2026. Neil's point is, if companies really believe in that right now, where's the hiring? That's why the jobs report's so key this week.
Yeah, the one caveat to that, and this is what a lot of people have raised, including some Fed officials, you don't understand, or we don't understand, the total ramification of artificial intelligence and how much that is acting in lieu of, say, a new hire that could potentially go through your lists, maybe go through your schedule. I mean, you can get an AI assistant to do that. So how much is that factoring in? How much is this that companies really just are not expanding? It's probably something of both of them. That's my guess.
I think the Fed chair also, if he doesn't know where the break-even rate is for the labour market, then how does he know what is a good and a bad jobs number? And I think we're all wrestling with that into Friday.
Yeah, I think that no one has any answers, which is the reason why you just see steady yields, because why vary from something when you have absolutely no conviction?
And equities keep riding higher for another month. Lower this morning by 0.2%. This morning, this hour, we'll catch up with Judy Beale of Kane Anderson Rudnick as stocks trade near all-time highs. Jason Bazinet of Citi as he calls the timing of the EA buyout surprising. And David Seath of Nomura as investors await a fresh round of payroll data later this week. We begin this hour with stocks on track for 5 straight months of gains as we close out September. Judy Beale of Kane Anderson Rudnick writing the following: the strength of earnings, even outside tech, tells us the ingenuity and resilience of corporate America remains strong. And that's great for the long term. Judy joins us now for more. Judy, welcome back to the program. Should we just stick with what's working? Because what's working is working well.
I think that what's working in terms of what's actually delivering earnings growth should probably continue to do that. I think companies where you see a lot of speculation that AI is going to be able to reflate and really create a lot of business for them, that still feels very speculative to me. You know, I think we talk about, yes, we're in the age of AI. Why am I still filling out paperwork when I go to the doctor's office, right? Why is Outlook still completely unable to pull up any email that I request? I think there's still a lot of just regular innovation that still needs to parse through the system. I agree that AI is going to be transformational, but the way that it actually filters through our economy is limited by us as human beings to adapt. And at least for me, that's not always great, to be honest.
I can't short your doctor's office, so can you tell me what's publicly traded, where that pockets of speculative fervor actually are at the moment?
I think you see it in some of the small cap names, some of the crypto names. It still remains to be seen how these business models are really going to make money over the long term, especially when we're talking about an asset that's as speculative as crypto. So I think that there are places, even in the power generation side, where, you know, those businesses are still utilities. They still are governed and regulated, and it's not easy for me to see how they're going to suddenly be able to generate the capacity profitably without it negatively impacting us as ratepayers. So there are pockets kind of throughout that I think we can really see there's too much speculation and the valuation has run too fast.
What's the trigger, Julie, to understand that maybe markets will come to grips with what you're talking about, that maybe valuations have outpaced the capacity to adapt as quickly as some people are expecting?
I think that, any kind of tech transition that we have goes in fits and starts. I agree with your previous guest that the telecom boom is not necessarily the best way to compare this wave. However, what we did see in the telecom boom was a level of overbuilding before we really needed all of that capacity. That is something that I do think is relevant to today, that we are building the level of capacity that we are, and that corporations are still only in the experimental phase, just like I was in the experimental phase in college, right? Same idea. It takes time to really figure out who you are. But I think what's really relevant and needs to be understood is that we can still build ahead. We can still have a lot of capacity growth ahead, and AI can still be extremely relevant and existential. It just means that it's going to move in fits and starts. We can all agree that if there's any kind of hiccup in the mega cap, that's going to be problematic for the whole market. But I even think at the margin, with the marginal player, some of the, even let's say the service delivery models, some of the consulting firms, I think if you see weakness there, that's going to be an early indication that we're in the kind of air pocket of earnings that I would expect over a long 10-year cycle transition.
It seems like everyone who comes on the show, Julie, is incredibly bullish, at least for the medium term when it comes to equity performance, let alone the AI transition. Are you pushing back against that? Are you more bearish? Are you expressing this and actually selling some of those names, or is it just marginally shifting some of the investments away from the highest flyers?
I think that you can continue to own mega cap tech because most of those businesses by themselves are just unregulated monopolies. AI is only helping Meta do better in terms of its ad sales. So to me, it makes sense to have an investment in that company, not even necessarily on the hope that their AI is going to be a massive business. I think they've already integrated it in a way where they can generate a lot of real earnings, and that makes sense. Where it's more marginal, where it's more speculative, where you have had a really large gap in the multiple, that's the place where I would have the most hesitation, because I just don't think the earnings durability is going to be there for the next 10 years. I think those businesses have great prospects over a 10-year horizon, but most investors don't have that kind of patience.
Julie, you talk about tariffs in your note, how they are a bridge, but is the foundation a good one? How are you thinking about the reciprocal country tariffs versus what we got overnight, which was more sectoral tariffs on the likes of lumber and kitchen cabinets?
Yeah, I think that there is more firm legal footing for the Trump administration to be doing some of these sectoral tariffs, even if IEEPA is completely ruled null and void by the Supreme Court, which is, I think, a 50-50 chance. There are stronger legal footings. There are three paths that the Trump administration can pursue for tariffs. I think that when you see the level of complexity that's being layered into our system, that creates its own kind of friction and difficulty in being able to pull back from those tariffs. And I think most economists would agree that creating a government that's overly levered and overly reliant on tariffs isn't a great thing, right? We know that there is a lot of deadweight loss when you introduce tariffs. So my concern is that we become really dependent on these, because we saw with the Biden administration, they were unwilling to roll back the tariffs that the Trump administration first put in, but they criticized them well ahead of time.
So do companies need to think about these tariffs, that even if there was a changing of an administration 2028, that they are here to stay for the long haul?
That is my concern. My concern is that it's really hard when you are unwilling to do the hard work of rolling up your sleeves to pull back on entitlements or figure out how to get us on stronger financial footing. Are you really going to turn down huge chunks of revenue that have sort of already passed through the system and people have already adjusted to? I don't think so. I think it's hard to really walk away from some of that revenue, even if it economically makes more sense to do so for the long term.
Judy, appreciate your take as always. Judy Beal there of Kane Anderson Rudnick. That final point I think is an important one. The systemic risk, maybe that's too much. The financial risk associated with tariffs now, I think is real. The fact of the matter is that this is a huge source of revenue for the government. I'm pleased you brought it up. And it's very unlikely to be repealed by successive governments because they're going to depend on it. And ultimately, we've heard from people in the bond market now who have said this was a bond negative story in April, who now believe it's a bond positive story 6 months later.
It's a bomb positive story because of the revenue coming in. Is it a bomb positive story because of how much it slows growth? That is a question that a lot of people are going to ask. And ultimately, we haven't seen that aspect of this, but that will matter more to the equity side of whether they wake up to tariffs as a negative or whether it's a positive and it brings business back, particularly for domestic producers.
Stocks are down this morning by just 0.2%. Let's take the opportunity to get you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The U.S. is likely headed for a government shutdown. Senate Republican Majority Leader John Thune said Democrats' refusal to approve a short-term spending bill amounts to hostage-taking. Democratic Senator Chuck Schumer said Democrats could settle for some of their priorities, such as extending subsidies for Affordable Care Act premiums. Spotify CEO Daniel Ek is stepping down after nearly 2 decades at the helm of the streaming giant. Ek, who founded the company in 2006, will transition to the role of executive chairman. Spotify's co-presidents, Alex Norström and Gustav Soderstrom, will become co-CEOs effective January 1st. The change comes after the company reported its full first year of profitability. And OPEC Plus is set to discuss fast-tracking its latest round of supply hikes. A delegate tells Bloomberg the hikes would happen in 3 monthly installments of about 500,000 barrels a day in a bid to recoup market share. Crude prices and oil stocks are moving lower on the news. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Crude down on Brent and WTI this morning. Up next on the programme, the morning calls, plus Jason Bastinet of Citi as he calls the timing of the EA buyout surprising. That's next. You're watching Bloomberg TV.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Stocks are negative by 0.2% on the S&P. Likewise on the Nasdaq 100, the opening bell about 1 hour, 13 minutes away. That's the price action. Let's get you some morning calls. First up, Needham raising its price target on Robinhood to 145, calling it the most advanced among financial services platforms. It's the biggest winner on the S&P so far for 25. This morning, we're down by 0.9%. Your second call from Mizuho, initiating coverage on Meta, an outperform rating, seeing the company as best positioned for AI. The stock is just about unchanged this morning. And finally, HSBC, downgrading Electronic Arts to hold, saying going private is a net positive for competitor Take-Two. The stock is positive this morning by 0.1%. Let's stick with EA, the video game maker going private in the largest leverage buyout on record, valuing the company at $55 billion. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the show, buddy. You're going to have to explain this to me, not a gamer. What's Battlefield 6? Why is it so important?
Yeah, it's so important because the market's using the success of Battlefield 6, which is coming out October 10th, to justify the premium in this deal. You know, EA has been going sideways for quite a long time now, and it's not been able to free itself from the domain of video games like others have, right? If you think about Disney or Take-Two or whatever it may be, they have their core IP in video games, but they look to franchise into movies, television, and EA's talked quite a big game on that and never actually done it. You know, I find the comparison with Take-Two's opportunity here interesting, but really it's a deal where, like, look at the equity piece and what Saudi is doing anyway, bigger picture in video games, and then look at the debt piece and ask yourself, historically, LBOs are where the management sees writing on the wall that something's not going well for them or the industry, and I'm not sure which of those pull factors is king here.
Ed, what do you make of the characters involved in this? Kushner, the Saudis?
Yeah.
What do you think of the mix?
So I met with EA management like earlier in the summer, and we now know from the reporting that this deal was being discussed then in the spring, right? And the most important thing is Saudi is the biggest piece of this. They already had a 10% stake. They will end up with a big equity piece. Kushner's smaller, but Kushner plays a role in bringing parties together, right? The relationship between some of the Middle East-based LPs and the private equity arm of this. The debt component, JP Morgan, you know, I think that's quite recent from what I'm hearing. But focus on Saudi. Like, Saudi is the big player here.
Ed, appreciate your take and looking forward to the programme. A little bit later this morning, 11 a.m. Eastern Time, Bloomberg Technology with Ed Ludlow and Caroline Hyde. Joining us now, Jason Bazinet of Citi, remaining neutral on EA, calling the timing of the deal surprising. Jason, let's get to that. Why did you find the timing so surprising?
Well, I guess there's a couple layers to this. It wasn't like EA was out of favor or unloved by the street. I mean, things were going reasonably well for the firm. The valuation, I think, was quite reasonable before this offer. It was trading right on top of its 7-year average, about 19 times forward earnings. When we ran the math on what the returns might look like for the buyers using consensus estimates, we came out with sort of a low to mid-single digit IRR. And so I just don't quite get what's so compelling from the buyer's perspective. Usually when we see LBOs, yeah, we see a lean balance sheet like EA had, but usually there's some controversy there, something that's gone wrong with the company that sort of means the multiple is depressed and it gives opportunity for a sponsor to come in and buy the company. There was just no controversy here.
Is there any sort of growth path, Jason, that EA couldn't accomplish as remaining a public company?
I don't really think so. I mean, they had wide berth. I mean, there was a little bit of a controversy around this Battlefield 6 launch, which is coming out, as you just mentioned. You know, that could help the multiple if EA can demonstrate that it's not just an excellent sports video game company, but a great video game company writ large. Because about a little over 50% of their revenues come from the big sports titles. And then they have this long list of sort of secondary and tertiary titles, you know, Mass Effect, Battlefield, Apex, Sims, you know, none of them really have busted through the way FC has or Madden. And so that's the opportunity. And maybe that's what the buyers see is the opportunity to sort of round out the portfolio with some other big franchises outside of sports.
Jason, if we zoom out a little bit, we keep talking about how there's this incredible M&A activity that has been percolating over the past few weeks and months, and I wonder how much of it is concentrated in the media space. If there is something specific driving this, whether it's AI, whether it's the risk of becoming obsolete, whether it's trying to consolidate revenue streams, an increasingly competitive landscape.
Well, there's two sort of vectors. I mean, if you think about other strategic suitors that might be interested in this asset, one vector would be anyone that owns a big cloud sort of infrastructure. Remember, Microsoft bought Activision a number of years ago. Many investors, and including me, thought that had to do with sort of a consumer-facing gaming subscription, where instead of buying a PlayStation or an Xbox, you just rent sort of your processing capacity from Microsoft Cloud and get with that some games. And so that may be what the sponsors are thinking, that they can flip this to another big cloud provider. The other vector is, you know, firms like Netflix are moving into video games. There, the idea is to use the IP potentially to make movies or TV shows. I think this doesn't really score particularly well because the IP, the valuable IP that sits inside EA, are really those sports teams and leagues. And the rights that EA has don't really extend themselves to movies and TV shows. You'd have to go secure, separate rights from the NFL or, the European soccer leagues. It just doesn't make a lot of sense.
Well, whether it's clouds or maybe Netflix, do you see more consolidation in this space?
I do. But I would say that streaming video companies is probably more likely than I would say cloud, if I had to guess.
Jason, appreciate your time. Thanks for jumping on. Jason Bassano there of Citi. Thank you, sir. On the latest takeout, go private, leverage buyout, biggest we've ever seen. Interesting mix of characters involved in this one.
Yeah, Saudi Arabia among them. This question of how much that money coming from that nation, that sovereign kingdom, has single-handedly boosted valuations across the sports landscape and even the derivatives, the games that are associated with sports. I wonder how much this is trying to consolidate their ownership and influence over just the West in general when it comes to sports.
And I'm sure we'll see a lot more because they want that clout in a way. But also Jared Kushner, who was at the, I wouldn't say press conference, press statements, because neither President Trump or Prime Minister Netanyahu actually took a single question, was at the peace agreement plan rollout yesterday press conference just a day or the few hours after this was announced when it comes to what's going on in EA. So it is an interesting group of individuals behind this entire deal.
And what's your take on his involvement in this deal and his role putting together the money in the Middle East?
He's the bridge between, I think, Western investors and some of these companies and the big dollars in the kingdom and potentially even outside Saudi Arabia, across the Middle East. He has a tremendous amount of connections there. We saw those connections just grow after he left Trump 1.0.
Interesting to see his name alongside the Saudis yesterday following that record deal. If you are just joining us, welcome to the programme. Just a flavour of the price action for you. The opening bell about an hour and 6 minutes away. Equity futures slightly negative as we close out Q3 and the month of September, heading towards another month of gains on the S&P 500. This would make it month 5, the longest winning streak on a monthly basis going back to September of last year. On the NASDAQ, we're down about 1/10% this morning, but on the month, the NASDAQ 100 on the month is up about 5%. We've seen small caps outperform on the quarter, but on the month, we've seen tech start to regain that lead. All the headlines we've seen about various deals after deals, has really boosted these names that dominate the S&P and the NASDAQ 100.
The team over at Charles Schwab, Kevin Gordon, as well as others, have put together this theory that AI-driven stocks have gained 259% since the announcement of ChatGPT in November 2022. It gives you a sense of what is driving this. So, the way that you set this up, how much has changed and how much has stayed the same in terms of what narratives are driving this market, independent of any economic cycles.
The NASDAQ just about softer this morning by 1/10%. Coming up shortly, we'll catch up with David Seif of Nomura as investors await a fresh round of payroll data, a week full of economic data. Later on this morning, we get jolts at 10 a.m. Eastern Time. Tomorrow, we're waiting for ADP and ISM manufacturing. Then on to Thursday, when we get jobless claims. And on Friday, we'll see if we get that payroll support. We'll have that discussion next on the programme. Plus, your morning movers. We're looking at Celsius rising after an upgrade from Morgan Stanley. That stock is up by 5%. Your morning movers up next.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The opening bow is about 16 minutes away, so let's check in on the price action cross-asset. We'll start with equities. Equity futures down by 0.1% on the S&P 500, following 2 days of gains. Looking to close out another month of gains. We're advancing for a 5th consecutive month on the S&P 500. On the Nasdaq this morning, up on the month by around 5%. On the session, we're down by around about 0.1% after big tech outperforms in a big way. Big headline just crossing, and I'm going to share it with you. CoreWeave inking a $14 billion Meta deal to supply computing power. We've seen a series of these headlines over the last month, and here's another one. With the latest, let's cross over to Bloomberg's Ed Ludlow. Ed, what have you got?
Yeah, $14 billion deal for CoreWeave is sizable. It's really understand what's happening here. CoreWeave is what we call Neo Cloud. It's data center capacity dedicated to either the training or running of AI models. And the story with Meta is exactly the same as it is with Microsoft or Microsoft on behalf of OpenAI. They don't have the capacity in their own clouds to handle all of the workloads relating to AI. And so they basically outsource and offload. The issue here, debt is playing a very big part in what CoreWeave is doing to move quickly to build out the infrastructure. They are supply constrained, and that's probably a massive understatement. So while they're onboarding all of these new deals, remember it was only last week that they expanded their relationship with OpenAI beyond $20 billion worth of capacity. They're in a situation where if they have 100 units of compute, they're having to decide which customer to give it to. So the headline is severe. It will likely push CoreWeave to the upside throughout the day, but it's still something worth paying very close attention to. When will this come online? How are they going to choose whether Meta, Microsoft, or OpenAI gets first dibs on the capacity that does come online? And how much more financing are they going to have to do to be able to move quickly to build that infrastructure? But the headline speaks for itself. Big deal for CoreWeave. Meta, building infrastructure itself, also needs some help from a third party.
You mentioned that stock, CoreWeave, up by 7%. Ed, you talked about Microsoft. Can you frame for us just how dominant Microsoft is as a customer for CoreWeave?
Yes, basically single biggest. And it was just last week that CoreWeave CEO Michael Intrator was on The Close with Romain and I, explaining that all of these deals that it is doing, expanding the direct relationship with OpenAI, this new Meta deal, which we kind of knew, honestly, John, was in the works, diversifies away from that. But again, it's like this curious situation, which is like you have all these servers running, they're already accounted for, they're already given to customers, and so these are future deals. Call it pipeline, call you what it will, but long-term, moving away from Microsoft is key.
And I just wonder who's running the economy in America right now, if it's Chairman Powell, Secretary Bessent, or Jensen Huang, and Mark Zuckerberg.
Yeah, I don't know how much you guys have been discussing circular financing.
Yeah.
And it also kind of goes back to what's happening in debt and M&A, right? But the circular financing issue is particularly prevalent in AI infrastructure. There's some immunity in the debt portions that go into infrastructure finance from the factors of the Fed. You know, it's a more direct market. But this would be the question, had we the opportunity to ask Jensen Huang, how much is this demand for NVIDIA artificially inflated by the fact that if you hand over $100 billion to a customer to then spend $100 billion on your own gear, I mean, that's circular financing, is it not?
Ed, thank you. Ed Ludlow there of Bloomberg. Again, look out for Ed in a few hours' time on Bloomberg Technology off the back of this deal. CoreWeave up by close to 8%. Meta just about positive. CoreWeave signing a deal to supply Meta with as much as $14.2 billion worth of computing power. That's the latest on tech. As we discuss that story, the President of the United States just engaging with reporters as we stare down the barrel of a government shutdown in this country.
And that's the first question a reporter asked. Is there going to be a shutdown? How many employees, government, federal workers will be laid off? And he said maybe a lot. So he's fielding these questions as we barrel towards that shutdown. Again, I repeat, it's not a matter of if, it's going to be how long. And this is going to be really important, obviously, for the financial community just when it comes to economic releases. And BLS is saying we're not going to get any.
We're not going to get any data. Payrolls, CPI in a few weeks' time. What are we going to do at the end of October when the chairman of the Federal Reserve sits around the table to talk about the economy?
They're going to talk about peripheral data, and they're going to say, let's cut rates. And that's essentially what people are expecting. And right now you're seeing the market respond with a wide opening financing market and everyone piling on the bet that right now this is an economy that's going to be run hot, and you might as well go along for the ride.
Let's go along for the ride and talk about what we might not get later this week with Reed Pickett of Bloomberg down in Washington, D.C. Reed, welcome to the program. We might not get payrolls on Friday. What will we get in between?
Yes. So what we know, in terms of the government shutdown is, how long it is really what matters here. If it's a couple days, then it matters very differently than if it's a couple weeks. So when we're looking ahead, we know from BLS has told us that they will stop data collection, they will stop releasing economic reports, that there will likely be delays with the reports if there is a government shutdown. So if there is a government shutdown on Friday, likely to not get that jobs report. And when we're thinking about what we will get stuff from the private data producers. So not only will we get JOLTS today, which is from the government while the government is still open, but we'll also get reports like ADP. Also, we've seen some data service providers like Revelio Labs come out with their own kind of payroll estimates as well. So it'll be looking at those types of data sets to get a sense of where the labor market is right now. But looking forward, we have to think a lot about data collection too. So if a shutdown extends for several weeks, that will impact the collection of data for key releases like CPI. It could also impact the collection of data for the next jobs report. So it's not just when we'll get this data, it's also the quality of the data going forward.
Reed, appreciate the update. It's good to see you. Reed Pickett there of Bloomberg down in Washington, D.C. With us around the table here in New York, David Seif of Nomura. David, good morning.
Good morning.
Good to see you. Let's talk about this. We've collected the data, haven't we, the payrolls? Isn't this just a case of putting it out there now?
It does seem like the heavy lifting on this report is probably all done at this point, and that it is a matter of choosing whether or not to post it or not. There may be some peripheral stuff that needs to happen that we don't know about, formatting the press release. I mean, little things like that, but things that actually have to happen. Does there need to be, beyond somebody just hitting enter to post it, a backup tech person there just in case, as has happened a couple of times over the past couple of years, the BLS has some issues with that data being posted? All of these things lead us to think that probably this report is not coming out on Friday, and it's certainly why we think the BLS said that all data collection will cease. This also is in keeping with the 2013 shutdown, which was just a couple of days before that October 2013 labor report was due to come out, and they didn't post that one either.
Well, there's a question not only of whether we get the labor market report, but how long a government shutdown could go on, and whether the Fed will have any government data additional to what they had during the last Fed meeting at their one at the end of this month, or at the end of October. I'm already shifting ahead. At the end of October, what's your view of how much that could influence the decision-making deliberation at the Federal Reserve?
Yeah. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot, meaning the more likely it is that they will cut exactly 25 basis points in October, which is what the dot plot indicates. So it's our view that will happen at whether or not they get the data. But the less data that come out, I mean, what would the justification be for saying just 6 weeks ago we implied that we would be cutting 25 basis points in October? We have a lot less new information than we had expected to have at this point had the government stayed open. hard to really say that they won't go ahead and carry out what they had signaled in mid-September under that situation.
Does that make you nervous, the fact that they are going to be cutting rates, most likely, at a time where we don't have the data necessarily, but we do have the data from markets showing a pretty euphoric feeling in markets, really wide opening financing conditions, leverage being baked into the AI trade in a new way? Doesn't that sort of give you pause?
Well, I would say that there was a somewhat of an incongruity between the SEP dot plot and the economic projections. Every economic projection that the Fed changed in September was something that should lead it to be more hawkish. Higher growth, lower unemployment, higher inflation. That's how they changed it versus June. And yet that was coupled with them saying, actually, we're going to cut more than before. We understand why they said that. There are fears about the labor market, et cetera. But the weakness in non-farm payrolls has been somewhat of an outlier compared to almost all of the other data, including in the past 2 weeks, where we've seen beats in industrial production, durable goods, retail sales, lower than expected jobless claims. So all of these things make it seem like Q3 ended up in a much stronger position than had been thought. At Nomura, our tracking estimate was just 1.4% 2 weeks ago for Q3 GDP, and now it's up to 3.0%. And so more than a doubling of our tracking estimate in terms of growth on the back of the strength of the data in the past couple of weeks.
When Jay Powell, though, gets up and briefs the press at the next Fed meeting, if we don't get these economic reports, this is someone who continuously likes to say we're data dependent. What's he going to say?
Well, he's not going to be able to say that they had any data to make this decision. I mean, that's the first thing, of course. But I think there was a bit of a tone shift in Powell at the last press conference. You know, data dependence is a sort of a buzz phrase that is always gets used. But this was actually the biggest break from data dependence, perhaps in many years that we've seen from the Fed, in that they basically came out and said, yeah, the labor market data has lost momentum. But generally speaking, we feel good enough about the data over the past 3 months that we're upgrading our forecasts. And yet, despite that data, we're going to be cutting more.
Is the Myron effect?
It really doesn't seem like it was. I mean, Steve Myron had been on the Fed for about 1 hour at the time that the meeting started. So it does seem as though perhaps the other doves, Waller and Bowman being chief among them, who did not dissent, may have, in what is very typical for the Fed, especially prior to a few months ago, said, okay, we'll get on board with this with this vote, with this decision, in exchange for a bit of a dovish pivot. And there's nothing nefarious about that. That's how actually the Fed has much more typically operated. Try to get a consensus. Myron wasn't there yet, so he wasn't able to participate in those sort of pre-meeting discussions. But it does seem as though they may have had some effect on that.
This is what markets are loving, the fact that you've got GDP tracked at 3, and you've got a Federal Reserve promising more rate cuts, not less.
This is the reason why everybody's bullish. This is the reason why the M&A pipeline is getting absolutely spewed all over Wall Street. That's the reason why you can stomach debt to finance some of these AI hopes and dreams. I mean, really, this is the new territory that we've been breaching over the past couple of months, which is it all had been done by cash. Now it's being done on leverage because guess what? They can. And if there is the demand for it, people will create the paper for them, and that is definitely what's happening.
David, just finally, is this on their dashboard, what's happening in financial markets?
There's no doubt that
Does it matter?
There's no doubt that they see it. It certainly is hawkish compared to the stock market falling off a cliff. But again, it seems like it's not winning the day with them. And despite the strong economic data, maybe ex-NFP, and despite what appears to be easing financial conditions and a steadily increasing equity market, they're going to cut 2 more times this year, and we think once more while Powell is still chair of the Fed.
David, it's good to see you. We'll talk about a post-Powell world next time you're back. David,
sounds great.
Over to Nomura. Thank you, sir. Appreciate it. Let's get you an update on news worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. CoreWeave rising on news of a $14 billion deal to supply computing power to Meta. The deal helping diversify CoreWeave's business away from Microsoft, which has historically been its largest customer. CoreWeave will provide Meta access to NVIDIA's latest GB300 systems as part of the agreement. President Trump ordered 10% tariffs on imports of softwood timber and lumber. Also, a 25% duty on kitchen cabinets, vanities, and upholstered furniture. The tariffs, most of them are set to apply from October 14th, some increases targeted to take effect next year. Trump said the planned actions aim to shore up domestic manufacturing. Exxon is planning to cut about 2,000 jobs globally as part of its long-term restructuring plan. The reductions account for 3 to 4% of its workforce or thereabouts. Other major oil companies include BP, Chevron. They've also recently announced cuts as crude prices fell this year. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Thank you very much. Up next on the programme, Mark Haefele of UBS Global Wealth Management. Plus, we'll get those morning movers with your higher CoreWeave. Shares are surging on the back of that Meta deal. That stock is up by 8%.
When we look at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced. SPAR being where it is and how competitive the South African market is, we really just want to refocus on our home markets. Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country. Our business has the ability, and our independent retailers have the ability to compete directly with the chains. And we are now the second biggest supermarket brand in this country.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
The biggest sort of concern of the market is, are we in some sort of a bubble? The problem is that the comparisons are to the dot-com era. It's not the right comparison. The theme is real, and in the near term, right, 18 months, we're in good shape. But it does not mean that you don't pay attention to what can go wrong, because a lot can go wrong. I would say that Powerwall is probably the biggest constraint.
Veena Krishna of Barclays there, just absolutely fantastic a little bit earlier this morning on the constraints around AI. Let's talk about the societal blowback, the pushback you could see, the political tension in the next 12 months. Electricity bills in this country in certain pockets of this country, absolutely surging.
They're hitting records in parts of Texas. Obviously, Texas is big energy when it comes to wind, electricity, oil, gas. And this is where people want to build, these companies want to build some of these data centers. You have some individuals who are predicting that the energy demand is going to be the biggest since the United States started using air conditioners in 1960s. So this is going to have a ton of political blowback because people are just seeing higher electricity prices. And for what? Are there even more jobs being offered because of AI? So where's the win-win here?
The opening bound is about 42 minutes away. This is a main focus going into the open, with one name in particular getting our attention. The future's just about unchanged with your morning movers. Here's Yahara. Hey, Yahara.
Hi, John. We start with that one name, and it is CoreWeave, jumping 8% after the cloud computing company signed a deal to supply Meta with up to $14.2 billion in AI computing power. The CEO saying that Meta loved their infrastructure so much that it is coming back for more. And as Vonnie mentioned earlier, this helps CoreWeave diversify away from its largest customer, Microsoft. The stock has had quite the run since it IPO'd back in March, more than tripling in value since then. Meanwhile, we move on to Firefly Aerospace. Those shares are moving to the downside, down 11.5% after the company said that one of its rockets that was meant to launch in the coming weeks was destroyed yesterday during a test. This is the latest mishap for the company, which had another incident back in April, and Firefly only went public back in August, so it is still trying to prove that it can keep up in the ultra-competitive commercial launch market. And we end with shares of Celsius. They are rising 4.4% after Morgan Stanley upgraded the stock to overweight, citing stronger than expected top-line growth due to higher prices in the overall energy drink market and higher demand. And investors have taken notice, with the stock up more than 100% so far this year. John?
What a move. Yahara, thank you. Thanks to Anne-Marie as well, I guess.
Once in a while.
For that move.
Once in a while.
Okay, all right. Let's turn back to today's big story. Investors bracing for a potential government shutdown to begin at midnight. Mark Haefele, the Chief Investment Officer at UBS Global Wealth Management, writing the following: with the direct impact of a government shutdown on financial markets likely to be muted, we maintain a positive outlook for US equities. Mark joins us now for more. Mark, welcome back. It's been too long, my friend. Let's talk about what's anchoring that view. What's making you bullish right now?
Well, I think we've had continued strong earnings. We've seen this continued investment on the AI side. And then we have the Fed cutting rates. So those are positive backdrops. Would also add in there, the strong fiscal spend that continues, and that's been supporting the economic picture as well.
Mark, I know that these are real numbers, real revenue, real profits. There's been some concerns recently about circular finance, financial engineering. Do you see any pockets of speculative behavior that concern you and the team?
Absolutely, that there is, and there has been for several years, speculation in various parts of the market. I think a focus on quality is something that we have maintained and will continue to maintain, a focus on cash flows. There are plenty of stocks. It does seem like, you could put .com in your name and your stock would go up. Now you put AI in your name and your stock would go up. That kind of thing is a worrisome sign to a degree, and that's why you really do have to start digging in on, particularly, I think, on the cash flow side.
Mark, until now, a lot of the money that's gone into tech investment has been cash flow, free cash flow. Now we're starting to see more leverage get introduced to more of these deals. I'm thinking of the CoreWeave deal right now that we announced this morning with Meta. CoreWeave is a below investment grade rated company that relies heavily on the debt market, and this comes along with a slew of LBOs and other deal activity. Does that raise concerns about the debt side of the financing structure heading into a really uncertain economic time?
Well, I think it's a good point. As you've noted, I think rightly, we're starting to see really just kind of the beginnings maybe of some of the more excitement on the institutional side about IPOs and other things. So, I think some of this financing is absolutely something to watch, but we still believe some of it around the core, around some of the core of the hyperscalers, that's still very early. But there's no question that there are pockets of leverage as well building up in the system. I think, the way we look at it overall with the AI project, it's something that we think is one of the longer term themes that we want to stay invested in, because we do see the productivity growth. We hear it from our clients who are customers. It's something they're investing in. We still like the power and resources story associated with that. We still like the healthcare story. These are areas, they're big problems for governments, and where there's big problems, there's big money going in. We've seen the President of the United States say, we're going to win it. We must win on AI. These are existential, ultimately defense issues, both for companies and for nations. And so I think that gives it something of a little bit of a different quality. And those are the kind of longer term trends we want to be behind, even if there is certainly the potential for some choppy trading into the end of the year.
Mark, if you do have all of this investment, the IPOs, the deals activity, can you get a real acceleration in growth heading into the fourth quarter without a reacceleration in inflation?
Look, we think there might be some acceleration of inflation. I think it's something about how much the Fed and other central banks would be willing to look through that. But also keep in mind, for if you take just the tech sector, that inflation is not necessarily an issue for them, because if you take the hyperscalers, they're not that reliant on debt financing, right? So there again, I think it could be a time to get a little more selective about who can continue to benefit, given the very large changes we've had in the way the economy has been moving forward this year.
Mark, I've got to squeeze this in. Got about 45 seconds. You're at UBS. I've got to ask you about gold. The move we've seen this year, this month, can you walk us through how investors are taking exposure to the precious metal, whether it's physical, paper, and if it is physical, whether they're choosing to store it closer to home?
All of the above, Jonathan. You should come visit the vault someday. Long equities and long gold has worked very well for us, and we think that will continue to work.
I'll come to the vault whenever you invite me, Mark. We'll make it happen. It's good to see you. Mark Haefele of UBS Global Wealth Management. Long gold, long equities. It's been a big trade, hasn't it?
I just wonder if in the gold room they have special lights that shine on them to kind of be dazzling, so you walk into the room and just have that moment. But yes, this has been the trade that keeps on giving at the same time as equity, which was just an ironic and unusual combination when usually gold does better in bad economic times, not ones of prosperity.
What a time. It's our second invite to a vault, I think, in the last few months.
I'm going to do a show at it.
Secretary Bessent said come down to Fort Knox.
Sort of, not really us. He said senators. I don't think he wants us, lurking around Fort Knox.
It'd be quite a package, though, wouldn't it? Special programming, Bloomberg Originals, a tour of Fort Knox.
I'm dying to go.
I'd watch that. Coming up on the program, George Pollock of Signum Global, Adrian Yee of Barclays, Michelle Weaver of Morgan Stanley, Vivek Arya of Bank of America. We'll see them tomorrow morning from New York.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
understand what are the technologies that are part of our portfolio for the future and scaling those technologies so that we can meet our demand with clean energy.
Resiliency is just not an operational response to what is happening out there. Resiliency could and will be a strategic advantage that companies will start to look at.
There is still hope to actually get back down to something of a livable world if we get our act together.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
Markets kind of chill at the start, 30 minutes until the opening bell. I'm Matt Miller. Danny Berger is on assignment. Open interest starts right now. Coming up, time is ticking away. The U.S. heads toward a government shutdown as the BLS confirms this week's jobs report may be delayed. CoreWeave inks a deal with Meta that underscores the massive costs of developing and running advanced AI models. And speaking of deals, deal making is back on Wall Street. Jefferies records record revenue for the third quarter and signals a positive outlook for bank earnings season as it kicks off those numbers. In terms of the stocks to watch, CoreWeave is up another 10% after a more than $14 billion deal with Meta. Remember, CoreWeave doesn't make the chips, doesn't make the servers, it just sets everything up, and then Meta comes in and uses CoreWeave essentially as a middleman. In terms of banking and the outlook, it is positive. Jefferies is the first one to kick it off, and we still have really a couple weeks to go until the other banks come out. But Jefferies right now up almost 1% as it says deal making is back, and volatility really helped it in the last quarter in terms of trading. Finally, ExxonMobil down a little bit, even though Exxon is cutting 2,000 jobs, continues to take out costs. They've taken out more than $13 billion since 2019 and are far outperforming all of the other major oil producers, even as the price starts to fall. Vice President J.D. Vance believes the U.S. government is on track to shut down. He spoke yesterday at the White House, pointing the finger at the Democratic Party.
Whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there.
The Bureau of Labor and Statistics says they are not planning to release data during the shutdown. If we do have a shutdown, they'll only have one employee left. It could lead to jobless claims, non-farm payrolls, CPI, retail sales, PPI data, all being delayed. And that may have an effect on the market. Joining us now to talk about whether or not this is going to happen, Anne-Marie Horder, Bloomberg's chief political correspondent, co-host of Bloomberg Surveillance. And it does look like, at least for a bit, we'll get a shutdown because they only have, 15 hours left.
Well, also the House is not even in session, so there will be a government shutdown. It's not really a matter of if anymore. It's going to be a question of how long we were going to have this government shutdown. Potentially, of course, that is going to affect, as you mentioned, the jobs report on Friday. BLS already coming out saying that we're going to basically cease when it comes to these economic reports. We saw this in the past with some government shutdowns. I guess there is a way we could see the jobs report if the president deemed it so essential and kept a few members of the BLS on board to make sure that the job report gets sent out, because all the collection would have been done. But then we also have CPI on October 15th, and then, of course, the Fed meets at the end of the month. So this is going to be very challenging for the Fed if it is a prolonged shutdown and they don't have the most up-to-date data in terms of how they view the economy and whether or not they're going to cut interest rates again.
Well, even if it's not prolonged, it's interesting to me because that the Democrats would let this happen, because the Democrats typically are against shutdowns. They're for federal workers, and the president has threatened to use this. You know, typically federal workers are furloughed and then given back pay when they come back, but he's said he's going to fire them all.
Well, there was this memo and talk of that. I think right now that still remains a threat that the Republicans, the White House, is using to try to get Democrats on board to sign up for this continuing resolution and keep the government open. Politically, for the Democrats, you know, they're taking a lot of heat. Leaders like Senate Minority Leader Chuck Schumer and Leader Hakeem Jeffries, because their party feels like they're not doing enough to stand up to this White House. What you have right now is Republicans controlling the House, the Senate, and the executive branch. This is just one way that Democrats are trying to use the shutdown as leverage to get some extractions.
As leverage. So they essentially are okay with holding the federal budget hostage to get what they want.
They want something, they want concessions from this White House, especially when it comes to the health care world and when it comes to the Affordable Care Act and some of these subsidies. They want to have a conversation on this. What was interesting yesterday, and I was at the White House, so I heard from J.D. Vance, the vice president, Speaker Johnson, Senate Minority Leader Schumer, Hakeem Jeffries, talking about this. There was one area where J.D. Vance, it was interesting, he said, I think we're headed towards a shutdown, but he did talk about the fact that maybe when it comes to rural hospitals, this can be a place where they can have a conversation. So potentially there is a deal that gets done behind the scenes that Democrats sign up for a continuing resolution, keep the government open. Not today. I mean, this is going to be a story for this week or next week. But then there is some sort of agreement when it comes to things they need to work out, maybe when it comes to rural hospitals, a place where they can find some sort of consensus.
All right. So fascinating when the shoe's on the other foot. Anne-Marie Hordern, our chief...
It's politics.
Our chief political correspondent. Thank you very much for reminding me of that. CoreWeave, this is not politics, I guess, inked a deal, a $14 billion and change deal to power Meta's AI efforts, helping diversify CoreWeave's business outside of Microsoft. Let's dig into this with Bloomberg Tech co-host Caroline Hyde. And Caroline, their CoreWeave is what's known as a neo-cloud business, right? So they don't make the chips, they don't make the servers, they don't build these data centers, but they, I guess, rent their cloud space out to a hyperscaler like Meta.
And they are buying the GPUs, they are furnishing the data centers, and they're therefore renting compute at the moment to the hyperscalers. And they had about 70% of their revenue coming from one key player, Microsoft, as of the end of June. Now they're really showing this diversification. They just inked a deal with OpenAI, bringing more than $6 billion to enlarge their overall focused a $22 billion contract with OpenAI, and now they've inked another $14 billion with Meta. It's interesting, before this news came out, Evercore ISI had just raised their overall view on CoreWeave, saying this really has a singular advantage for the company, because not only are they going to be focusing on access to compute for the hyperscalers, but they're also going to be winning over enterprise as well. Companies are going to need this sort of compute to run their AI applications more broadly. They think that they could be having a winning formula here at the moment. So you've got CoreWeave, you've also got others like Nebius is one that's here in the United States, traded on the NASDAQ. They've also been doing deals recently. You've got Nscale over in Europe. A lot of these companies are financed on a lot of debt. They've got a lot of very creative financing, perhaps financing on the actual GPUs coming from NVIDIA. And it is indeed NVIDIA that's going to be underlying this compute that's going to Meta.
What I don't get is why Meta, which is, you know, almost a $2 trillion business and knows it's going to need compute for the future, why don't they just do this themselves? What do they get from CoreWeave that they can't replicate?
Access now. I mean, CoreWeave's already been building out its infrastructure, and at the moment you then have, you know, a diversification. Yes, they want to build their own data centers. And remember, Meta just did a $29 billion creative financing of its own, a private credit deal, where it's got money to go into that enormous AI data center that they're building in Louisiana. That's basically the same size as Manhattan. Exactly. And I think at the moment, Meta just itself can't build it fast enough, can't get creative fast enough, and needs to spread its own diversification. You're seeing that's why Microsoft does rely on CoreWeave. That's why you got, Oracle can't build it quickly enough. They're having to finance at the moment and build out, and they've got a big contract, $300 billion with OpenAI. Just the sheer scale is gargantuan, but that is why you're starting to have Moody's and other rating agencies say there are risks built into this system. And more broadly, I think it was Gil Luria who's been writing about the fact that OpenAI itself needs to have revenues of about $300 billion by 2030 to really vindicate and offset some of the overall financing they're having to take on to scale to this level of compute. The infrastructure is just extraordinary, but that's what CoreWeave is as kind of infrastructure as a service.
All right, very cool story, Caroline. Look forward to your coverage of this with Ed Ludlow. Caroline co-anchors the Bloomberg Tech Show with Ed. Later today, actually, Ed is going to discuss AI and home products like Alexa with Amazon's Senior Vice President of Products and Services. I should say Caroline and Ed will talk about that with Panos Panay, so definitely don't miss that interview this afternoon. Tuning to Wall Street, Jefferies reporting record quarterly revenue, or at least for the third quarter, as deal activity picked up worldwide. Bloomberg's Catherine Doherty covers the banking sector for us, and so correct me if I'm wrong. This is the most money they've ever made in the third quarter and the most money they've ever made from advisory.
This is the best quarter for advisory ever on record. And overall revenue is still the best since the first quarter of 2021, when we were seeing deal making really surge in a way coming out of the pandemic. So it's a huge sign for the big banks that are going to report in October. We're going to wait for them to put out their results, but all signs are pointing to a resurgence of deal making and trading. The narrative has been for really the first half of the year. Volatility has been up. That's been good for trading desks. It's bled into a lot of their revenue that we expect to continue for the rest of the year. But it's deals that started out in a tepid moment in 2025. We had a lot of companies that were holding back from M&A, holding back from issuance, and now we're seeing the floodgates open, and what Jefferies is pointing to is not just the activity that they recorded in the third quarter, but for the remainder of the year and into 2026, they're saying all bets are off. This is really go time for us, and our dialogue with companies that are looking for future M&A opportunities is continuing. This is not just a one-off trend.
So the big bank earnings, the other ones, don't come out until October 14th, October 15th. But this is a sign that we're going to get positive M&A advisory from those other big banks, right? And I guess trading too, because that volatility that they say drove revenue all came in April.
That's right. It all came in April, but this quarter was really going through the summertime. And what's interesting is Jefferies' results that we're seeing today, they ended at the end of August. So normally the summertime can be a pullback in activity. Yeah. We didn't see that. So now there's this positive momentum that there's no reason that we won't see that. Even let's look beyond the third quarter into the remaining 3 months of 2025. It looks like it's going to be a record year for the banks. The whole sector has seen a surgence in trading, as you mentioned, but it was deal making that the executives at the beginning of the year came into the 2025 saying, this is our year. We're going into a different environment in terms of regulation that we have been constrained by and that the companies that we bank with have been constrained by. And the expectation was that that was going to come through in their revenue for advisory. We didn't see that at the beginning of the year just because of all the questions that remained around tariff negotiations and geopolitical concerns. So now what we are expected to see to end the year is the positive momentum that the CEOs were talking about to begin. They were saying, this is going to come, this is going to come. Now with Jefferies' results, we're seeing it actually come through.
All right, very cool. So they're basically a month ahead of the other banks. Jefferies' fiscal year ends in November. Catherine Doherty covering all the banks for us here at Bloomberg. Coming up, Exxon cutting jobs as part of a longer-term restructuring plan, but it adds to a number of job cuts we've seen at the other oil majors, and it comes on a day when we hear reports that OPEC could increase production, which pulls down the price of the underlying commodity. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg. Do you think the dollar will remain the only reserve currency in the world, and are you as comfortable with the dollar as it used to be?
The dollar has been, as you say, a reserve currency for about 80 years. Actually, if you wanted to go further back, you could say it's almost after World War I, when the US had lent money to Europe and the UK for ammunition and so on, and then they had to get paid back in dollars, and that's when the strength of the dollar really began. So it's 100 years, 80 years, 100 years of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
Okay, so you think the dollar will stay as the reserve currency of the
Absolutely.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Exxon will lay off about 2,000 employees globally as part of its long-term restructuring plan. Let's discuss with Bloomberg's managing editor for commodities, Simon Casey. He joins me here on the desk, and this is really an amazing ongoing story of taking out costs. Yeah. The new CEO, or the most recent CEO, has taken out $13.5 billion of costs since 2019.
Yeah, that's a lot of cost. But the news this morning is just the latest in a series of restructurings, cost reductions. And the background against this is happening against is oil prices that are not catastrophically low. They're not great. They're kind of like a little bit almost like a Goldilocks level. Exxon can operate just fine, but it's insulating itself from a potential downturn. Next year, we're seeing forecasts of quite a big surplus, maybe. Demand could slow a bit more in China. You've had growing production up to this point in the United States. You've got more production coming online, of course, from OPEC. So prices are under pressure, and oil majors, and Exxon included, have to protect themselves from this pressure on their margins.
You mentioned OPEC. We saw a headline. I think the delegate today reported that they're going to take or increase production over 3 months by 500,000 barrels, even though the prices are already low, right? 62, 67, depending which contracts you look at. Why is OPEC Plus going to continue to boost production?
Saudis want to regain market share. I mean, they've lost quite considerable market share over the last several years. The United States is the largest oil producer by quite some margin now, and that's a reversal from just a few years back. They want to regain that leadership. They see an opportunity here. US production has been growing. It's beginning to plateau out. The shale production that we've seen in the post-pandemic years, it's topping out now. The US companies are focusing primarily on their cash flow. They're not prioritizing production growth just for the sake of it. The Saudis see an opportunity there. If US production goes into a slow, gradual decline, they may bring back even more.
I was shocked the other day when I pulled up to a gas station in Bedford, New York, and saw $7 oil. That's an incredible outlier for New York. But in California, that would not be as shocking. And we had a great story on the Bloomberg terminal yesterday about Gavin Newsom having to pivot away from his attacks on fossil fuel producers because California faces potentially $8 a gallon for gasoline.
Yeah, it suddenly got very real for Gavin Newsom. $7 would be a pretty good deal, I think, in California right now, in some parts of California. He's spent years really sort of leading a campaign against the oil companies, burnishing his environmental credentials. The oil companies have just Republicans have been voting with their feet. I mean, we saw Chevron not so long ago re-domicile, it's moved its headquarters out of the Bay Area to Texas. But on a more sort of fundamental level, we've seen refinery shutdowns when it's very expensive to operate refineries in California, and then there was a proposal pushed by Newsom to cap the profitability of refining oil in the state. Refineries are getting shut down. It's got to the point now where there's a limited supply. It's quite precarious, and when you have refineries fall over, they go on maintenance, they have issues, they go offline. You've got the possibility of real gas shortages, gasoline shortages there, and it's very difficult to sort of import it from another part of the world because they have a specific blend in that state as well. It's a real problem for him. So he is pivoting. He's suddenly being very supportive, and it's quite a contrast from where he was just a few months ago.
I mean, it's all the problem is all the bigger when you consider the fact that they occasionally have to tell people not to charge their cars because the grid can't take it.
Exactly.
So no electricity, no gas. It's a tough situation. Simon, great coverage. Your team has done an incredible job. Simon Casey there runs commodities for us here at Bloomberg. Let's get to high interest right now. Look at what else is making headlines around the world. Global FX trading hit a record $9.6 trillion a day, according to the Bank for International Settlements. That's up 28% from 2022. President Trump's tariffs sparked April's wild swing, sending the dollar down and volatility to two-year highs. The greenback still dominated nearly 90% of trades, but sterling slid while China's yuan gained some ground. London has fallen out of the world's top 20 IPO markets, slipping to 23rd place behind Mexico, Singapore, and even Oman. New listings in the UK are down nearly 70% this year to just $248 million. It's the weakest in over 30 years. By contrast, Singapore and Mexico have surged into the global top ranks, while big names like Unilever have chosen rival European hubs for their IPOs. And Josh Pack, the co-CEO of Fortress Investment Group, has died at just 51 years old. No cause of death has been given. Pack joined Fortress 23 years ago from Wells Fargo and was planning a move to London to drive European growth for the firm. Drew McKnight will continue leading the company alongside new co-CEO Jack Newmark. Pack is remembered as a devoted husband and father.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It is the final trading day of the month, and the S&P 500 is on track for its best September since 2010. Equity positioning doesn't appear stretched, keeping many in the market positive for the fourth quarter, but government shutdown, the potential of that this week could leave many traders in the dark with economic data like the jobs report, like CPI, PPI, retail sales, all of them at risk of delay. Joining me now is Truist's Chief Investment Officer and Chief Market Strategist, Keith Lerner. Keith, let's talk first about, I guess, a statement that I made that I'm not sure if it's true. Equity positioning doesn't seem stretched. Is that true because PEs are relatively high and U.S. households are more allocated to equities than ever before, as are foreign investors?
Yeah, well, first, great to be with you. And when I look at the overall mix of sentiment data and position, you know, I would say it's somewhat high, but it's not excessive. And at this point, it's not enough in our work to make a major call. Typically, sentiment and position data really matters at the extremes. And to your point, you could say expectations for this market are somewhat high as you're trading at, you know, the high multiple of this cycle. But overall, I mean, there's also some trepidation as you think about what's the discussion the last couple of weeks, government shutdowns. There's a lot of calls I'm getting about, hey, valuations, are we in a bubble? So again, expectations are high, but I don't think we're in extremes as far as sentiment as of now.
When we look for further price appreciation, do we expect institutions to be doing more buying? Do you think households, retail traders are going to be doing more buying? Do foreign investors do more buying? I mean, where does that marginal dollar come from?
Yeah, I think it's somewhat of all of the above. I think there's a steady flow of each, and as the economy continues to chug along, and as you have automatic investing and monthly investing, and a lot of, if you look overall at allocations from the sell side, it's somewhat more neutral. So I think there's still some room to move up. Is that the key driver? Maybe not. I think earnings are going to be the key driver for this market to continue to get some gains. And maybe, Matt, I'll throw one stat at you. We bucked the historical weakness of September. When we head into the fourth quarter, one question I'm getting is, when we have this big third quarter, do we tend to see gains? And historically we have. I mean, the fourth quarter, as most of us know, tends to be a seasonally strong period. When you go into that quarter, when you have 25 new highs or record highs for the year, you actually improve on that. You're up about 89% of the time. The average return is 5%. Doesn't mean we're not going to see some hiccups along the way, but momentum tends to feed on itself.
All right, Keith, we're going to continue talking about this, and I want to find out what you think of a possible government shutdown. Keith Lerner stays with us. Quick check on futures as we head to the opening bell. We're looking at the S&P futures down, but only by 0.1%. This is Bloomberg.
Take us inside and tell us what you can, without violating confidences, what it's like to be in a board meeting of Berkshire Hathaway. You've got, for a long time, you had Charlie Munger, you have Warren Buffett still there as the chair, and you've got other people now on the board. Do people ever say, Warren, you're wrong on this? Or Charlie, you don't really know what you're talking about? Does that ever happen?
The difference on the inside versus the outside is really very limited. In other words, this is a company that's valued transparency, candor. I mentioned Warren and Charlie, their ability to teach. And so I would say there were no surprises being on the inside versus the outside because of that culture. I would say the one difference of nuance is it's just amazing how much Warren and before Warren and Charlie together think about the durability of the business, how much they think about risk, how much they are determined that they are trying to build something to last, and the sense of responsibility they feel to their shareholders, the people that have their life savings in it. And that was one of the big lessons from Charlie in terms of our business, was to really reinforce this culture of stewardship.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Moments away from the start of trading on this Tuesday. Danny Berger is unfortunately on assignment. But I'm here, Matt Miller. This is Bloomberg Open Interest. We're looking at a drop on futures, just 0.1% on S&P futures, even less than that on the NASDAQ. Down the New York Stock Exchange, you've got Blue Owl Technology Finance ringing the bell. Craig Packer there, the president. They have just started trading over the summer, lost about 15% of their value since then, but it's a very popular space. We're looking at Crinetics Pharmaceuticals down at the NASDAQ market site. Now, they had more than doubled over the past 5 years, but recent gains have pushed them up almost to triple territory. Gains of 177% over the past 5 years for Crinetics. In terms of your stocks to watch today, CoreWeave has to be the big winner here, up more than 10% after Meta, Facebook, said it's going to buy more than $14 billion worth of compute, or rent it, I guess, as it were, from CoreWeave. That helps the stock rise to almost $135 a share. Jefferies comes out a little bit ahead of the other big investment banks because its fiscal year ends in November, and had great news on deals. They say M&A is back. Trading really picked up in the quarter because of the volatility that you saw there. And then ExxonMobil, actually down by about 1% right now to $113.20 a share. They're firing another 2,000 employees in a restructuring that's been going on since Darren Woods came on as CEO. He's taken out $13.5 billion in costs since 2019. That's more than cost cutting at all of the other majors combined, which really makes you wonder about how much money his predecessor was spending. But let's get back to the broader market. We're back with Truist Chief Investment Officer and Chief Market Strategist Keith Lerner. Keith, we're looking at the potential of a government shutdown less than 15 hours from now. Most people think it's going to happen. How much does this matter for stocks?
You know, by itself, historically, not a lot. Doesn't mean it does add one more bit of, confusion or complexity to the market. But we've looked at the last 20 shutdowns going back to the 70s. And what's notable is stocks during the shutdown period have been up 50% of the time, and the average return is about half. Now, there's certainly some variation between that. But eventually, what happens is we move past these shutdowns. The longest one was the last one in 2018, which was about 35 days. There is a wrinkle with, what happens on the employment side and not having data as an example. But beyond the short term, this is not something that we would change our investment focus based on just some of this near-term uncertainty.
And you argue that, the bull market is the effect of these double-digit gains that we've seen in earnings for quarters. I wonder what would make you defensive? What would change the way you're positioning if not a government shutdown, and we're still expecting earnings to be strong in the third quarter? What would change your mind?
Yeah, it's a good question. It's a fair question, especially as we have valuations of which are somewhat rich. But the North Star of this bull market has been earnings. So it would be earnings. And, even if we don't get some government data releases, in 2 weeks, we'll start to get the start of the next earnings season, which will be really important. But as stocks have made all-time highs here, what we're seeing is that the S&P forward earning estimates are also at an all-time high. We're also seeing that earnings broaden out to the equal weight index. We're seeing small cap earnings move up as well. So what would get us more negative would be that we start to see a moderation in earnings, especially as we're at a higher level, or some really extreme in move in the overall market where we just think that all the good news is baked in. And just as an example, a lot of discussion about are we in a bubble. The technology sector over the last year is up about 27%. What we've seen on a year-over-year basis where that's been problematic has been when you move, up 75%, up 100%. So we're just not there, and it's all about earnings in our view.
You've upgraded small caps, which is brave considering the history of people who stick their head out for these stocks. What are the catalysts here, you think, for small caps? Is this about Fed rate cuts?
Yeah, and I don't know how brave we are because we upgrade them from less attractive to neutral. And we're thinking about it. We still think, the dominant story for this market is tech and AI. That's where the strongest earnings growth continues to be. But on the margin, things have improved. One, we already know they've underperformed by a lot. So that's just a condition, not a catalyst. But what's changed over recent months is we're starting to see those earnings move higher. In this one big, beautiful bill, there was a lot of incentives for more leveraged companies, which small caps are. You're also now seeing, we think at least one more rate cut and more next year. And also positioning you talked about positioning for the overall market. Well, positioning for small caps has been very light. Earlier this year, we saw the most extreme outflows that we've seen in several years. So again, extreme condition, underperformance, better earnings, and the sentiment backdrop is somewhat constructive.
I wonder where the second derivative opportunities are. We've been talking about CoreWeave this morning, and I don't know if that counts as first or second, but we're going to talk to Oklo, for example. Obviously, power has been a huge story. What do you see as, maybe the uncovered investment opportunities in AI?
Yeah, I don't know that it's uncovered yet. I think at some point, and we're not there yet, that you'll start to see, the AI transformation really move down to the 493, the other stocks in the market. But at this point, the equal weight index relative to large caps or the S&P, the market cap index, just made like a 20-year low. So I think that's eventually to happen, Matt. Our strategy is wait for a little bit of confirmation, not try to pick the bottom. But I think that is maybe as we think about next 3 to 5 years, it's not just about these hyperscalers. It's about how everyday companies use this technology to become more efficient, maybe boost profit margins. But we're just not there yet. So in the interim, we're still sticking with, the big boys. We're sticking with tech, which we've been overweight, and communication services, which we've been overweight all year long. I think there are some opportunities still in the power side with utilities. We're more neutral there, but certainly some opportunities acting somewhat better, as well.
All right, Keith, great having you on the program. Thanks for joining us. Truist Chief Investment Officer and Chief Market Strategist, Keith Lerner. Hope to get you back in the office soon. I hear we're going to play pickleball when you and Danny are back here. Let's get a check on the stock market right now. We're looking at losses on the overall index, and you can see we've come down a bit from the top of the middle, I should say, of the hour right now. We have 221 gainers, 277 losers. In terms of the gaining side of the ledger, NVIDIA obviously right up there on top. It's always going to be on one side or the other just because of its size. But you start to see the others. Broadcom, instead of a Mag 7, maybe a Grade 8 creeping higher. And then you see some of the banks, JP Morgan, moving up here as well after those Jefferies results. On the downside, you see Microsoft right now down only about 0.7%, but again, $4 trillion stocks tend to be on the high end of these boards because we have them set up by points rather than percentage change. Meta also down 1 2/3% after we heard it's going to pay more than $14 billion to rent compute from CoreWeave, and then you have the other hyperscalers on the way down. So Alphabet, Amazon are down, as well as some of the other big tech stocks like Tesla and Netflix we talked about, Exxon. Coming up, U.S. nuclear power startup Oklo makes a $5 million bet on a Swedish peer. We'll speak to Jake DeWitt of Oklo and Jacob Stedman from Bleakala next. This is Bloomberg Open Interest.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Time now for our top calls, some of the analyst action and focus this morning. First up, Celsius Holdings is getting upgraded to a buy at Morgan Stanley. The analyst citing top-line growth ahead for the energy drink maker. The stock has more than doubled so far this year, and, well, it looks like they think it can go even higher. Next up, Mitsuho has initiated coverage of U.S. internet stocks, naming Meta as a top pick. The analyst says Meta is best positioned for AI. The firm is also initiating buy ratings on Alphabet, Amazon, and Airbnb. And finally, Bank of America is downgrading nuclear companies like NuScale Power and Oklo because of what it sees as unrealistic valuations and a negative risk-reward. The analyst says Oklo faces a fuel scarcity, and we're going to talk to the company's CEO about that right now. Oklo announced also a $5 million investment in Swedish peer Bleakala. The deal is part of a collaboration between the two companies on technology, supply chains, and regulation. We spoke with Ken West yesterday of Honeywell on the growing demand around the world for power.
The world will need more power tomorrow than it needs today. In fact, many of the forecasts say that we will need more than 30% more energy by 2050 than we have just today.
Joining me now at the desk, Jake DeWitt, Oklo CEO, and Jacob Stedman, Bleakala CEO. Gentlemen, welcome to the program. Thanks so much for joining us. Jake, let me start with you just to get a response to the overvaluation allegations. I mean, there's so many things you can control at your business, but valuation's really not one of them. What do you think about the price Wall Street is putting on your business?
I think one of the aspects here still is this story has so many details to it that people are still unpacking. And I think there's still sort of a recognition of what's happening there. What we announced last month, I guess it was earlier this month, in terms of investing in fuel recycling, is a massive unlock, a part of the story that hasn't actually been fully appreciated about what that does, not just for solving fuel scarcity issues, but changing fuel economics in a fundamental way and opening up different revenue streams. And that's just a small example. Then what we're going to talk about here a little more today, partnering on a transatlantic basis, opens up additional partnership opportunities and opportunities for growth in a more kind of global scale. So I think there's still a lot of details of the story being, unpacked. There's obviously a lot of excitement, which is cool to see. But but at the end of the day, execution proves it all out. So that's what we got to do.
Jacob Stedman, come in here and tell us about the deal that you've made, what you're going to do with the money, and how you plan to work together.
Yeah, thank you for having me here. So Oculus investing $5 million into Blykalla, and it's also we signed a transatlantic partnership. I think it's one of the first of its kind. So we have 3 areas, as you said, about collaboration. So one is, for example, on fuel. Oculus investing heavily in fuel fabrication, and that's great for us because we, as everybody else, also needs fuel. So we hope to procure that fuel in the future, the fuel made here in the United States, and hopefully also maybe co-invest together in facilities like this. So that's one area, and then also working with supplier development, for example. There are big capacity shortages, and we hope to solve them by creating aggregate demand.
Will this, Jake DeWitt, get you to, I have 2 Jakes here on set, will this get you closer to commercial deployment? Because that's, for me, like one of the most exciting milestones that we are waiting to see.
This partnership alone, no. But we are taking a lot of steps. I mean, there's so much happening that's even just transpired since the executive orders. And I agree, getting that first plant built is exciting. But here's how I think about it. If we swing at one plant, you know, that's the wrong thing to do. We have to swing through and beyond, because what we're talking about an opportunity, what you mentioned in your prior segment, 30% growth, I actually think that might be soft. You look at the goals set by President Biden, President Trump, we need hundreds of gigawatts of new nuclear. So this partnership's about scaling beyond that first one, well through it and above. So it's opening up the door for significant, not just domestic expansion, because they might be investing in and buying fuel fabrication capacity from us, but also we can work with them about opening the door for more suppliers to come to the table so that we can actually build more plants both domestically and internationally. So I think it works actually pretty favorably.
You have, I think, a vertically integrated strategy, right? And how do these partnerships, how will this play into it? Will we see more like this?
It does. So we have a lot of constraints, like Jacob was saying, in the supply chain. And we can work together with suppliers to acquire more components together is a great way to sort of unlock some of that and grow that and make investments that we're going to make, that they're going to make, that we might make together in things as well, like fuel fabrication. It's not just about the fuel material, like they talk about scarcity, it's also fabricating it. So we're making investments across the whole chain, and then that will help us serve their needs as well.
Jacob, what are your needs and what are Europeans prepared to do here? I mean, Sweden, my experience is in Germany, where they have gone the other direction from nuclear, right? But the rest of Europe may see it differently.
Yes, I think Sweden is obviously a much smaller place than the United States, but the government is extremely pro-nuclear. So we are going to double the electricity generation over the next 25 years, even more in percentage than here. So doubling means building a lot of new nuclear. The government puts up a roadmap saying we're going to build 10 gigawatts more of nuclear capacity, and we intend to be a big part of that solution.
And your concerns about supply chain, your concerns about fuel, are helped, I guess, by this investment.
Exactly. I mean, I think it's a win-win. It's actually a win-win-win because it's also good for the suppliers. So, you know, if we come together and create aggregate demand, it's much easier for a single supplier to say, here is this customer group that wants the same things, and then they can invest in capacity and get it built.
So when will we see these, your first plants built? Or I know you want to swing through and look at more, but when are we going to see actual deployment? Because until then, analysts are going to say these things about valuations, right? I'm not going to find really a PE or not much of one.
Yeah, well, I think these are the things that start to unpack the story in different dimensions, like we just talked about. But in terms of answering your question, one of the really exciting things that came out from President Trump's executive orders that build on stuff that passed in the Advance Act under President Biden is this acceleration on the regulatory front and opening up the apertures for different regulatory pathways, including, for example, the Department of Energy's reactor pilot program. We had not one, not two, actually 3 reactors selected into that. And that program is built to enable plants to turn on by July 4th, 2026. Now, not all plants and not all designs are going to be able to do that because of supply chain constraints, but we have like sort of the work in place to bring forward. We expect at least one of our reactors to hit that date, and then we expect follow-on plants to come in potentially in that similar time frame or going into 27. Then scaling into full power operations from 27 to 28. When we look at the world, like the U.S. is leading in its commitment to nuclear, and then Sweden was one of the other countries that's really leading in investing in and committing to nuclear power. So partnering up between the two to leverage kind of the best benefits that each country and the technologies give with the nuclear company in Sweden, which is Blykalla, was a kind of a natural fit for us.
Jacob Stedman, what are the milestones we should be watching for from Blykalla? Obviously, Oklo has been an astounding success from an investment perspective because we talk because we're fortunate to talk to Jake. We know the story well. What about Bleakala?
Yeah, so we're not listed yet, but you can still follow us. There are three things we're going to do, also with the proceeds from this round. So first is complete the design and start licensing for the reactor, so to get its first reactor park built. The second thing is the financing, and Sweden has quite an innovative financing mechanism from the government that makes it possible to access cheap debt and also lock in a certain price for a long time. So we're going to access that financing package. And then third, we're going to also work with getting the test facility in place. So Uniper, which is one of the biggest utilities in all Europe, is an important partner to us. And they have a nuclear power plant in southern Sweden, and we're building a test facility, a non-nuclear test facility on their site. They're also an investor in Bleakala, so it's an important partner. And that's something we prioritize in the next year.
When you do list, will it be in Stockholm, or would you look at New York?
So New York is, of course, very attractive for companies all over the world, right?
Yeah, not London, though.
I mean, I would take a stand for now, but I think New York is clearly where most people look at these days.
I don't want to put you on the spot. We just did a story about London IPOs.
Okay,
They've fallen out of the top 20. It's been a tough market.
It's been a tough market. Yeah. No, I know. It's
guys, great having you on the desk. Thanks so much for joining us. I hope we can continue these conversations. Jake DeWitt there of Oklo and Jacob Stedman of Bleakala. Now, CoreWeave inks a deal with Meta that underscores the massive costs and developments for running advanced AI models. We're going to talk more on that next. This is Bloomberg Open Interest. Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. 20 minutes into the trading day, we're looking at red arrows. 66.49 on the S&P 500, down about 0.2% as we're really weighed down by a lot of big tech stocks, but not NVIDIA, so it could be worse. NASDAQ down about 1/3%. You can see gold coming off a record high, but still at 38.28. It is up there. Take a look at some of the stocks that are moving. ExxonMobil, one story today, they're going to fire another 2,000 employees. They've been restructuring for 6 years now, and this is part of that bigger global restructuring. There'll be global jobs lost. You can see Hertz gaining just about as much, about 0.1% right now. A lot of interest in the Ackman investment in Hertz. Spotify coming down 4% after it replaces its CEO and chairman of the company. And then EchoStar rising as there's more talk of spectrum sales, this time to Verizon. Meta Platforms coming down. It's going to pay more than $14 billion for, I guess, compute power to rent compute from CoreWeave. CoreWeave is up 12%, so a massive deal for CoreWeave. And I'm going to go over and talk to Ed Ludlow from Bloomberg Tech about that right now. He joins us here at the desk. Ed, great to have you in New York. This is, to me, such a fascinating story because you were talking to the CEO of CoreWeave the other day on Romain Bostic's show, The Close, and they've done exceptionally well, even though they don't make
They've done well to land contracts.
Yes. They don't make the servers, right? They just set these things up and rent the capacity out to hyperscalers, normally just to Microsoft, but now to Meta.
This is the definition of Neo Cloud. You own and operate the facility, but you're just renting the capacity. And they are shuffling the pack a bit because this is a deal that stretches through 2032. But when is it actually going to come online? Because just a week ago, the CEO told us we're kind of supply constrained. Yes, right now, Microsoft is 71% of our business. And for every unit of compute that comes online, they're having to make a hard choice. Like, who do we give it to? Microsoft or OpenAI, and now Meta. But my sense is that maybe in the next couple of years that Meta will start using this stuff.
It does look like the market believes it. I mean, up 12% today. And this is kind of like, you know, when Rivian takes orders for a car that they don't make yet, right?
Correct.
You don't know how real
it's pipeline,
it is.
But remember, post-IPO, the biggest sort of skepticism in the market of CoreWeave was concentration risk of a single customer, Microsoft being 71%. And, you know, that is something that Intrator has commented on. And this move in the stock, it's a signal that they're getting credit for moving away from Microsoft. Meta is going to be a big spender on infrastructure. And it's a signal that, you know, as that happens broadly in a field of many players, CoreWeave can take on new customers.
Well, I look forward to your coverage of it at 11. Ed Ludlow, co-anchors Bloomberg Tech. Also today, after his program at 12:30 p.m., Ed is going to discuss AI in-home products like Alexa with Amazon's Senior Vice President of Products and Services, Panos Panay. That's an interview you don't want to miss. Very interesting stuff going on in tech today with the Google payout to President Trump and more coding power, longer coding, staying power from Anthropic. So a lot to talk about on Bloomberg Tech. President Trump also is going to announce a Pfizer drug pricing deal today. This according to the Washington Post. He's going to make that Pfizer announcement, I guess, around noon-ish, depending on how quickly he gets out of Quantico. We'll bring it to you live, but Pfizer is going to sell drugs through Medicaid at lower prices, according to the Washington Post, and we'll be waiting for that announcement. Coming up in the next hour, Goldman Sachs' David Kostin expects IPO and deal activity only to get stronger in the new year. This is Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think The question is, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump is addressing hundreds of U.S. generals and admirals right now at a rare meeting at the Quantico Marine Base in Virginia.
We're a team, and so my message to you is very simple. I am with you, I support you, and as president, I have your backs 100%.
He followed Secretary of War Pete Hegseth, who declared an end to what he called woke culture in the military.
Each service will ensure that every requirement for every combat MOS, for every designated combat arms position, returns to the highest male standard only.
Hegseth told top military brass they should do the honorable thing and resign if they don't like his new approach. On his way to the meeting, President Trump blamed Democrats for a potential government shutdown at midnight and furloughs and layoffs that could follow.
Well, we made you a lot, and that's only because of the Democrats. And as you know, they wanted to be able to take care of people that have come into our country illegally, and no system can handle that.
Democratic leaders left a meeting with the president yesterday without an agreement on a funding plan. Correspondent Nicole Killian says Mr. Trump had a quick response.
After President Trump mocked Democratic leaders in a video last night, there is little goodwill on either side, but the Senate may attempt another vote on a government funding bill before tonight's deadline.
The video the president posted to social media featured Democrats Chuck Schumer and Hakeem Jeffries in an AI-generated video. Jeffries had a large mustache and a sombrero. There are now 2 hurricanes swirling in the Atlantic. Imelda gained wind strength today north of the Bahamas. Meteorologist Craig Allen.
Imelda is going to take a sharp right-hand turn, sort of being pulled by the circulation of Umberto, and will then head on out to sea. But this time, the track is going to be closer to the island of Bermuda.
Forecasters expect Hurricane Umberto to rough up surf and rip currents along the East Coast from Florida to New Jersey, potentially through the weekend. Puerto Ricans are defending against critics upset Bad Bunny has been chosen to perform at Super Bowl halftime in February. Tomas Mir, who writes for Rolling Stone, says it shows
that Latinos have power. We are a big part of this country, and we are as American as anybody else.
As for Bad Bunny,
I'm really excited for my friends, my family, Puerto Rico, all the Latino people around the world, my culture.
The Dow is up 36 points, S&P down 6. This is CBS News. A man who became a familiar symbol of the attack on the U.S. Capitol has reportedly filed a lawsuit.
Some reports describe the lawsuit as rambling. The QAnon shaman who wore a horned warrior outfit during the Capitol attack is suing President Trump for $40 trillion. A big change from how Jacob Chansley spoke about Trump while in prison.
I developed a lot of sympathy for Donald Trump because it seemed like the media was picking on him.
Chansley, who was pardoned along with others by Trump, also targets Elon Musk, T-Mobile, the Federal Reserve, Israel, and others in the suit. He alleges they're in a conspiracy to violate the Constitution and that he, the QAnon shaman, is the true American president. Steve Kathan, CBS News.
This morning, prosecutors in New York urged a federal judge to sentence Sean Combs to at least 11 years in prison when he is sentenced on prostitution-related charges Friday, prosecutors calling him unrepentant. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live as well. So head over to youtube.com and search Bloomberg Local Radio. Some economic data coming out at 10 o'clock. We'll get right to that. John Tucker will have a lot of that for us. We're going to check in with Nancy Tengler, CEO and CIO of Laffer Tengler Investments, to get her thoughts on these markets. Vince Piazza, Bloomberg Intelligence energy analyst. He's going to talk to us about Exxon. Exxon cutting 2,000 workers as the oil sector job losses mount there. And we've got WTI crude oil lower again today, just below $63 a barrel. Geetha Ranganathan's going to join us, Bloomberg Intelligence analyst. She covers all the media stuff, talking to us about Spotify, a new CEO, their founder and CEO stepping down. He's 42 years old. What's he going to do? I don't know. But we'll take a look at what's happening here. That stock's been a great performer. Sam Fazeli, Bloomberg Intelligence healthcare analyst. He's going to join us as well, get the latest things on all things in the healthcare space. So Scarlett Fu and I, Paul Sweeney, we have a lot coming up in the next couple of hours on this Bloomberg Intelligence program. Let's kick it all off with John Tucker and a Bloomberg Business Flash. John.
All right, Scarlett and Paul, thanks. This Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. Let's get right to it with the job opening labor turnover survey. JOLTS job openings coming in a little higher than expectations, maybe reflecting a bit of resilience in the U.S. labor market. The openings rate 4.3%. The expectation was for 4.2%, exactly matching the prior month's figures. The Conference Board out with its consumer confidence survey, coming in lower than expectations, 94.2. Economists surveyed by Bloomberg were expecting a reading of 96. As far as the major stock averages right now, S&P 500, 8 points lower. That's down 0.1%. The Dow is down 10 points, and the Nasdaq 100, 71 points lower right now. And Treasuries headed for the third straight quarter of gains. Oil extending sharp decline. OPEC Plus considering boosting the pace of its output hikes. Meantime, Laura Cooper at Nuveen isn't expecting investors to get too rattled in the event of a government shutdown.
From a big picture perspective, we've seen many episodes of these shutdowns. Really, the economic impact tends to be fairly short-lived, and so markets tend to look through this.
Some of the individual shares on the move. EchoStar jumping, the satellite TV company engaging in talks to sell more of its wireless spectrum to Verizon. Those shares up 1%. And then you have CoreWeave signing into deals to supply Meta with as much as $14.2 billion worth of computing power. That's one of the standouts today. CoreWeave shares are 13% higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. We appreciate that. Market Drivers today is brought to you by Van Eck, celebrating 7 years of helping investors stay ahead in a world that never stands still. Visit vaneck.com. Let's take a look at some of the stocks on the move. Today, I'm Paul Sweeney alongside Scarlett Fu And we're joined by Bloomberg's Bailey Lipschultz. Bailey, what are you looking at today?
Yeah, diving a bit deeper on EchoStar, ticker SATS. Stock right now only up about 1%, had jumped more than 5%, but this coming after a Bloomberg News report that the company is in talks to sell spectrum, some of its wireless spectrum, to Verizon Communications. So this comes after deals with AT&T and SpaceX for some of those licenses. Bloomberg reporting that it probably wouldn't be the case for this Verizon deal to carry the value of some of those deals, north of billions of dollars, but we are certainly seeing a rally this morning in shares of EchoStar. This is a company, guys, that has been trying to work its way out and stave off bankruptcy and dealing with some of the pushback from U.S. regulators. So kind of reworking its business, reworking its opportunities in terms of turning those contracts and some of that spectrum into actual cash in their pockets. Stock year to date up more than 225%, so outperforming those mid-cap
We've been waiting
indexes.
a decade for this performance. Literally, we've been sitting there for 12 years. Charlie Ergen investors, like I have always been a Charlie Ergen backer. He bought the spectrum like 13, 14 years ago, and either you're going to build a wireless network what this country doesn't need, or you're going to sell the spectrum, which is always valuable, to somebody else.
But he waited a long time.
He waited forever. So my IRR is like, I don't know. But it was just finally, shareholders and bondholders are going to, I think, get paid here.
Yeah, trading at about $75 a pop, was at 50 back in 2017. Just don't look back towards 2008, 2009 if you've been holding on for the long
This is the old Dish satellite TV company. Okay. I vented there because it was a decade.
No, you should vent after waiting this long. Let's talk about CRH, which is a building materials company, and those shares are up almost 5%.
Yeah, rallying this morning. This is a company that is listed in London, but had pivoted its primary listing to here in the U.S. This comes after the supply makers, so cement, think of things like that, laying out midterm targets for revenue and growth, EBITDA margins into 2030. So they see this year their adjusted EBITDA between $7.5 billion and $7.7 billion. That's midpoints just above what Wall Street was looking for. But when you look at the first blush reaction from analysts, really talking up the fact that they're laying out financial targets 4 or 5 years into the future, averaging an annual revenue between 7 and 9%. So a slow growing business, a buildings material business that has really rallied pretty tremendously since that April bottom on the year, returning about 30%. So a big winner for the company. Again, it also has done tremendously well since it pivoted its primary listing to here in the U.S., but with all the talk about the need for spending not only on infrastructure in the U.S., but around the world, really playing out for that company. And this comes ahead of a capital markets day hosted by the company today here in New York.
Oh, very good. Okay, so yeah, building products.
Building products, boring companies, sure, rallying this morning, but one company that maybe a bit more fun to talk about is Spotify, ticker SPOT, down about 5% today. That's the biggest drop for the company since July 29th, this coming after its CEO, Daniel Ek, planning to step aside after almost 2 decades leading the company. They said that their Chief Product and Technology Officer, Chief Business Officer are going to take the reins jointly effective January 1st. So this is a big move for a company that was co-founded by Ek back in 2006, guys. I think if you're 42 and stepping away from being CEO of a company, not a bad move. I'm not quite there. Maybe someday soon, but the stock still year to date returning about 56%. So lapping the Russell 1000, which it would be comped against, which is up about 14%. So a big run for Spotify since he took the company public. But again, giving back some of those recent gains, down about 5%.
I kind of view it as kind of the Netflix of the audio business.
Yeah, a little bit of a utility, but as you mentioned, he's 42. So is he stepping away in quote marks, or is he really stepping away?
Yeah, in there, he's going to have kind of oversight and still work with the company, but handing over kind of the view, going to provide some support and some guidance. The interesting thing, I remember talking to someone who's been a Spotify bull for quite some time, and his kind of base case was, this is a company that can continue to hike prices as much as they want, and consumers are going to kind of shrug off if their streaming service goes from $13 to $16 to $18 a month. Just because.
I don't know about shrugging off. Complain loudly while it's happening, but.
Are you a Spotify user?
I am, and I've watched the prices go up steadily every year and complain about it.
Well, Rich Go, we've got him at $9.8 billion, 353rd ranked.
Again, 42 years old, Paul.
I know, fantastic. Great service. Great service. Good for him. Stepping away. All right, very good. Bailey Lipschultz, thanks so much for joining us there. Bailey Lipschultz covers all the equities for Bloomberg News. So we got a lot coming up here. So if you like that, it's a podcast, actually. So you can for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We did get some economic data here. Consumer confidence data came out a little bit weaker than expected. Stephanie Gisha joined us. She's a senior economist at the Conference Board. Stephanie, I'm looking at the Conference Board consumer confidence data came out at 94.2 for September. The consensus was 96. Last period was revised higher to 97.8. So down versus last period, down versus the consensus. What do you make of this consumer confidence reading?
So in fact, yeah, you're right. Consumer confidence declined 3.6 points in September. We are now at the lowest level since April. However, we're still way above the April level, which was 85.7. And what has really driven consumer confidence in September is consumers' view of the current situation, which remains positive but has really deteriorated since August.
I also want to ask about the present situation versus the expectation survey. Both of those showed declines from the previous month, but what really drives those reads?
So we have two components in the present situation: how consumers view business conditions and how they view the labor market currently, and they both deteriorated substantially. And this is what has really driven the headline. If you look at the expectations, we also have three components: the future of the labor market, the future of business conditions. They both deteriorated slightly, and we also have consumers' views of future income, which has improved in the month, which means that consumers are still not so much worried that they're going to be losing their jobs and running out of income. So that's kind of the good news of the survey, and this improvement in the income component has really mitigated the decline in the overall index.
So are tariffs still causing concern among consumers at all at this point, Stephanie?
Yes, we asked them what is driving their view of the economy. So number one this month is inflation. So it does, move again at the top of consumers' worries. Second is tariffs. So it's still there, and it's mostly associated with fear of higher prices. And what I wanted to mention is that we see also some increase in reference to the labor market situation, where consumers are worried about the availability of jobs right now.
So I wonder if there's any kind of seasonal patterns to be aware of as we head into the final quarter of the year. What can we expect to see in the months of October, November, December when it comes to sentiment, when it comes to people's expectations?
So our data are seasonally adjusted, and so there is no seasonal pattern. It's going to really depend on what's happening on the labor market front, which is, if consumers keep on seeing that this hiring freeze in some company, the fact that there are fewer jobs openings, this is the variable that could drive confidence further down. On the other hand, if they see some improvement in the labor market, maybe we'll see some improvement in confidence. So I think it's going to be driven by the labor market situation more than any seasonal patterns.
Stephanie, thank you so much for joining us. Really appreciate it. Stephanie Gisha, she's a senior economist at the Conference Board. Coming up, we're going to check in with Nancy Tengler, CEO and CIO of Laffer Tengler Investments, get her thoughts on the markets. Vince Piazza is going to join us as well, Bloomberg Intelligence senior energy analyst. Talk to us about ExxonMobil. They're cutting 2,000 jobs. It's not the first time we've seen some cuts in the oil patch here, so we'll get the latest on what's happening there. And I'm just looking at oil here. WTI crude oil off 1.3% today, $62.60 per barrel. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Newsroom with this Bloomberg Business Flash, we're brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Major stock averages right now, mixed to little change. The idea of a government shutdown rattling some investors, mostly because if it goes on, we won't have any jobs data on Friday, and the Fed needs that data to inform its path of interest rate decisions. U.S. job openings, that is the data that we got at the top of the hour, rising slightly in August, suggesting relatively steady demand for workers. Federal Reserve Chairman Jerome Powell has pointed to weakness in the labor market when they lowered their interest rates earlier this month. And ExxonMobil among the stocks on the move, planning to cut about 2,000 jobs globally. Right now, shares of ExxonMobil down 1.1%. Boeing has started working on a next-generation single-aisle aircraft. Could eventually replace the 737 MAX. That's according to the Journal. And shares right now, Boeing, they are down 1.3%. Overall, S&P 500, 3 points lower. The NASDAQ 100, 41 points lower, and the Dow up right now, just 7 points. And then Brent crude is down right now, 1.2%, 67.15 a barrel. And that's why energy is the worst performing of the 11 major industry sectors in the S&P 500. You see this one? The next must-have luxury? Saxelby Cheesemongers of Vermont sells up to 60 pounds of cult favorite Animal Farm Creamery butter at $60 per pound.
I agree with high-end butter. I don't know about that price point.
Yeah, it's an online-only flash sale. They sell out in minutes. Every other Friday, exactly 3 p.m. is this sale for $60 a pound. What does it cost in the store? I mean, you know, like
nothing like that.
Land O'Lakes is like $4 a pound.
Yeah, but you don't want to bake with Land O'Lakes, right? You want to get Kerrygold butter.
You don't?
Yeah, much better. You want
Butter?
to
Is it butter?
No, butter is very different.
Oh.
If you go to Amish country, you get the hand-rolled butter, much better for baking.
Really?
Like crispier waffles, crispier everything.
Okay.
Then you can get a goat and just make your own butter.
Yeah,
Okay, yeah, you do that when you get home.
Yes.
Okay, maybe I will. We check the markets for you all day long, right here. I am the goat on Bloomberg Radio. Scarlett and Paul.
All right, greatest of all time, John Tucker. Thank you so much. Paul Sweeney and Scarlett Fu here on Bloomberg Intelligence. We're about an hour into trading, and there's not a whole lot of movement here, even though, Paul, it's been a blockbuster September for equities, defying the historical trend of a weak September.
Yeah, exactly. It's been a tough time historically, seasonally, September, and I still have scars from October of 1987.
Yeah, well, a lot of people do. Let's bring in Nancy Tengler right now. Nancy, of course, is CEO and CIO of Laffer Tengler Investments, and she joins us now on a day, the final day of the third quarter, where it feels like sentiment is turning a little bit, Nancy. Maybe I'm reading too much into the latest consumer confidence data report, conference board data report on how sentiment has declined more than expected. But we do have this shutdown looming, and there are a lot of questions about how we're set up for the end of the year. How are you feeling right now?
Well, Scarlett, thanks so much for having me. I mean, historically, the fourth quarter in a year where the market is up as much as it's up, low double digits, the market has performed 100% of the time up 6 to 7 to 8%. So I think we have seasonality in our back pocket, but we also have pretty strong earnings growth, and then share buybacks are putting a floor under the price of stock. So that group has been the top performing group, much contributed more to total return than cash flows from institutional and retail investors. So I'm pretty optimistic. I mean, the shutdown's looming. Markets don't usually care. Beyond that, I think we're going to pay attention to earnings. I think the Fed is on the sidelines. If they cut, they cut. If they don't, they don't. So I'm pretty optimistic here.
Nancy, what is your call on earnings here? We had I would say stronger than expected first half of the year in terms of S&P 500 earnings growth. What's your outlook for the back half of the year?
Yeah, I mean, I think we're going to continue to see acceleration, Paul. We had 6% revenue growth. That was a number that really stood out to me in the first half. And over 80% of companies beating estimates on revenues. I don't recall a time where that's happened in the past. So we're expecting, some modest, maybe margin contraction. We could actually see margin expansion if companies start passing along some of the tariff costs. But regardless, we're near historic highs. And I think we'll see double-digit earnings growth, again, kind of mirroring the first half, or emulating, I guess I should say. Mirroring would be the opposite. I think, we're going to trade on earnings. We're going to trade on fundamentals. And it matters which stocks you own, because some companies are being negatively impacted by tariffs. But overall, it's kind of a wash once you factor in the tax cuts from the tax bill.
Right, and that's something that will filter its way through eventually. Nancy, I was looking at the performances of your funds, and you have something called the New Era Value, formerly Equity Income, and New Era Growth, which is formerly Equity Growth. Why rebrand to New Era? What does that say about where we are in this market cycle?
Yeah, Scarlett. So I wrote a book 20 plus years ago called New Era Value Investing, and I'm actually rewriting it right now in the process, and it'll take a while. But that was a time of a new era that was driven by the internet. And as we all know how that ended, and there were reasons for that. But these technologies are much more robust. The companies have fortress balance sheets. And I think it's a time to be thinking about the technologies that are going to drive us into the future. So we also are launching today a new strategy that is focused on quantum and robotics and nuclear and AI and space. And that is an all-cap strategy that we believe will be focused and benefit from the movement into these technologies. And we're seeing it across the board, Scarlett. I mean, every sector, the companies that we own are talking about how powerfully AI is impacting the way they do business. And look no further than Walmart, who reported just the other day, I think it was yesterday, that they are going to keep headcount constant thanks to AI, but they're going to grow while they grow revenues. And we've seen, mid to high single-digit revenue growth. So that's pretty exciting. That's profitability. That's to the bottom line, and it improves margins.
All right, Nancy, thank you so much. We appreciate that. Nancy Tengler, CEO and Chief Investment Officer of Laffer Tengler Investments, joining us there. Looking at ExxonMobil today, some news. Say they're cutting about 2,000 people from their headcount. The stock's off about 1%. This is a company that has almost 61,000 employees, so a meaningful number there. And we've seen job cuts around other energy companies as well. We're going to get a sense of what's happening there. Vince Piazza joins us here. Vince is a senior energy analyst for Bloomberg Intelligence. Vince, talk to us about what this news from ExxonMobil means. How material is it to you and to investors?
Well, I think it's part of managing through the cycle, right? In prior cycles, the sector was exposed to more extreme volatility, higher highs, lower lows. The industry is trying to manage through what seems to be a rather clouded backdrop right now. So we're sitting here, and you got nat gas somewhere around 330, Henry Hub. You got WTI in the low 60s. You have OPEC bringing back on capacity and maybe even speeding up that capacity adds. You have a more clouded, broader economic backdrop across the globe. You have geopolitical issues. So lots of uncertainty. And not only Exxon's probably going to cut somewhere about 2, 3, 4% of its global workforce. Its Canadian affiliate, a much more substantial cut, roughly about 20% over the next 2 years or so. You're seeing it at ConocoPhillips. You're seeing it at Chevron, even BP, the major European energy conglomerate. You're seeing it across the board. And so, Paul, as you know, when you're not growing revenue, right, you're not getting the revenue increase on price. You're not growing production because your investor base does not want to see that production growth. You are looking at very steady revenue, maybe even declining revenue. You have to manage that net back from the cost perspective, and you have to support that cash flow stream. And so you're doing it via these cost cuts over a number of years, 2, maybe even 3 years, to sort of bring that cost structure in line with the new reality of uncertainty in the marketplace to reduce that volatility.
Well, there's cost cuts, and then there's ExxonMobil's cost cuts. Since 2019, it's trimmed $13.5 billion in annual costs. That is more than all the other big oil companies combined. How much more room is there for Exxon to slash expenses?
Well, it bought Pioneer. So it has a relatively sizable workforce in general. It doesn't necessarily mean that those cuts are going to come there, but there are ways you cut. You gain efficiency in this technological era where we have advancements across the energy value chain. You will consistently and continually seek out ways to get efficiency, to bring down that cost structure and to bring unit costs in line with a very anemic outlook for global energy prices in general, and also a very clouded outlook for the global economy too.
So Vince, kind of looking out, 1 to 2 years, what is the view of the companies you talk to about energy prices, oil and gas? Is it still going to be a challenged market here?
It looks like it. It looks like it's going to be a very challenged market, especially for the WTI side, for the oil side of the equation. On natural gas, Paul, I know you and I have talked about this numerous times. You have a structural growth trajectory for natural gas here in the U.S. via export LNG, whether it's seaborne LNG or whether it's pipeline gas into Mexico to help fuel their economy as well. You have the AI build out, which will digest significant amounts of energy, and that's beneficial for natural gas. But on the oil side, you have very anemic growth. You have your transportation fuels having to compete with alternative and renewable fuels. So there's greater competition there. The growth trajectory and the outlook for the demand side on the liquids fuels seems to be very clouded and seems to be somewhat less secure relative to the natural gas side of the house. And that's why we're much more favorably disposed to Henry Hub and natural gas relative to WTI, Brent, and various liquids fuels.
And before we let you go, Vince, OPEC Plus will be holding a meeting this weekend on Sunday, and there's talk that they will increase or fast track the return of halted production. There's a lot of concern that China and its buildup of its strategic oil reserve might be distorting some numbers or distorting the demand picture. What's your take?
So in general, demand across the globe seems to be less than robust because of, well, you have a global economy that's uncertain. You have tariff policy that has injected more volatility and uncertainty across the globe. So demand concerns are an issue. The supply side, well, we know where the supply is, and OPEC is reasserting its market share dominance. In the U.S., right. We don't want that production growth. And so it's really coming from the OPEC side of the house, and the demand side of the house is going to be somewhat anemic from here.
Right. All right, Vince, thanks as always. I appreciate always talking global energy with Vince Piazza. He's the Senior Equity Research Analyst covering the oil and gas business for Bloomberg Intelligence. Again, Exxon laying off 2,000 employees on about a 61,000 employee base. So meaningful cuts there. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Right now, the major averages, they have all turned lower. The S&P 500, 18 points lower. That's down 0.3%. We're at 66.42 on the index. The Dow Jones Industrial Average, that's down 188 points. The NASDAQ 100, 74 points lower, down about 0.3%. So in the broader index, 5 of the 11 major industry groups in the S&P 500 are higher. Healthcare in the lead right now, and that is home to Merck. Those shares, they were up just over 2.4% right now. Merck announcing positive results from a trial of a drug for pulmonary arterial hypertension. I think this is high blood pressure. Worst performer belongs to energy, as we see oil prices falling right now. And then you have NVIDIA shares. They are the most active, up 1.8%. Investors may be taking kind of a wait-and-see stance in terms of the possibility of government shutdown, which, of course, would mean that we get a delayed jobs report if it extends into Friday. And meantime, Sean Simmons at UBS, he was on the program earlier today. Investing in artificial intelligence, he says, remains key.
People have to be focused on AI. They have to stay invested in that. And not only on kind of the classical AI trade, right? The semis, the utilities, we've seen those things move. But we're also now starting to talk more and more about the peripheral trade. So we want to be starting to talk about the software.
Millennium Management, one of the biggest Wall Street names to get hit by the sudden unraveling of the auto parts supplier First Brands Group. The loss expected for them to total about $100 million. And interior designers and architects say they're seeing the home office falling farther down the list of must-have for clients in the wake of the return-to-office mandates. Homeowners now finding new uses for their existing home offices, converting those spare rooms into, I don't know, I would think...
Workout rooms?
Workout rooms, places for the kids.
Karaoke rooms.
What rooms?
Karaoke.
You pronounce it correctly.
You say karaoke?
Yeah. That's wrong?
Well, I mean, you could say the Japanese way and be karaoke, which would be a little too much.
I'm turning my home
It's like news anchor saying Venezuela.
Venezuela. Or Nicaragua. Managua, Nicaragua.
Nicaragua.
Anyway, I was going to turn my home office into a brewery.
Yes.
Well, there you go. There's a good one.
A home brew.
Sure, why not?
Anyway, we check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett and Paul. Do you like karaoke?
I do. Yeah. What's your go-to song for karaoke?
I've never done it.
What?
Me neither.
Never been
field
invited.
trip.
Yes, exactly. There'd be a lot of sake involved in order to get me up there.
That's fine. We can accommodate that.
All right. John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Spotify. You know, I'm not a Spotify user, so I don't pay that much attention to it. I should. $144 billion in market cap. The stock's up 50% this year to date. Just extraordinary. The Spotify founder, Daniel Ek, stepping down as CEO. The stock's off about 5% on the news. He's 42 years old. I mean, I don't know.
He's got a lifetime ahead of him.
He's got $10 billion, according to Rich Go, is his net worth. Geetha Ranganathan joins us. She's the U.S. media analyst for Bloomberg Intelligence, follows this company. Geetha, talk to us about Spotify. Talk to us about Daniel Ek. What's going on here today?
Yeah, absolutely, Paul. So this is, one of your classic cases of the founder finally kind of establishing a really good transition plan and handing it off to his, two lieutenants here. So we're having a co-CEO structure. And really, I mean, the first, when I heard this, I mean, this really kind of harkens back to what Reed Hastings did with Netflix, kind of left right at the peak, right when the companies, everything was kind of, all cylinders were firing away. And left it to Greg Peters and Ted Sarandos to kind of take charge. And it seems like Spotify is in a very similar position. So they had a couple of things that had to get done this year, which was new contracts with all of the music labels. It looks like Daniel Ek has, accomplished all of that. And I think he's really kind of left the company in a good position for its next phase of growth. And this is really a huge story in the internet space, the possibility to get to 1 billion users very, very quickly. They already have about 700 million.
Okay, so they're almost 3/4 of the way there. He's leaving on top, as George Costanza would in Seinfeld. But my question, Geeta, is you talk about the new phase of growth. How much of that will rely on continued price increases? Unlike Paul, I do subscribe to Spotify, and it's alarming how frequently the price changes come.
Yeah, and it is going to keep coming, Scarlett. There's absolutely no doubt about it. I mean, this whole story is kind of predicated on those price increases. Remember, though, that they never took up prices for the first 10 to 12 years.
Yeah,
and then it started coming fast and furious, right? We had one price increase in 2023, another in 2024. We're going to have probably another one in 2026. But if you kind of look at all of the streaming services out there, Spotify is, of course, the leader in audio streaming. They have a 35% global market share in terms of subscribers. You kind of look at their price, let's say in the US, it's $12 for an individual plan. You compare that to, let's say, the video leader, Netflix. Again, I go back to the Netflix example. They're priced at $18. So I think Spotify still has quite a lot of runway when you kind of compare it to the rest of the field. And the other thing that I like to point out here is when you're kind of subscribing to an audio service, it's typically only one service that you're subscribing to as opposed to a video service. So I think people really like if they like Spotify, they're absolutely going to hold on to it at any cost. And the other thing is, Spotify is adding new features all the time. So they are like really getting down on monetizing more and more, but it's not. They are innovating also constantly. So I think people don't mind paying for it.
What's the biggest challenge to them on the cost side of the business, Geeta?
Music royalties. Well, I mean, that, for every dollar that they make, they're paying out about 70 cents in terms of music royalties back to the labels. So it is definitely a very, from that perspective, the model is hard. But one of the things that they've done very well is, they've obviously renegotiated a lot of the deals, kind of tried to provide investors with a lot more visibility into the cost base. But more importantly for them, they're really trying to go away from, licensed content to more owned content. So kind of going into, podcasts, going into more non-music content where, again, they have a lot more leverage, whether it's audiobooks, whether it's video podcasts, getting away from, just being a core music service to more of kind of an global kind of an audio service. And they're doing that really well. And that's going to help them with their margin expansion story as they get better unit economics.
Right. And introducing premium tiers on top of that, you have to unlock. In order to unlock some of the more, high-profile podcasts, you then have to pay extra. Geeta, talk a little bit about AI, because I keep reading about how AI-generated music is a challenge. But in what way, and could it actually become an opportunity as well for Spotify?
I think so. I think it is going to become, an opportunity as we go. They're already actually using, a lot of AI features when it comes to curation, when it comes to music discovery, when it comes to providing better features. And they're already, and you just brought up the super premium tier. And a lot of that is actually going to be having like an AI DJ type of a feature there, for both listeners as well as music creators. So I think it is definitely going to be, a good opportunity for them to present a much better product. I mean, we've already seen AI being used by a lot of the other platforms. Again, I go back to Netflix because they've done this really well in terms of, having a much better algorithm now to serve up better content. And I think that's exactly what Spotify is doing in terms of its playlists as well.
Keith, I got about 30 seconds left. Where's Apple in this audio game?
So just in terms of subscriber share, Paul, I mean, Spotify, as I said, leads with about 35% share of the market. Apple is really far behind. They have about a 10% share. Wow. So very, very hard for them to catch up in terms of subscribers, at least.
All right, Geeta, thank you so much. Appreciate that. As always, Geeta is our go-to person on all things in the media space. Geeta Ranganathan, U.S. media analyst for Bloomberg Intelligence.
How do you get your music?
Sirius XM.
Okay. But then you can't
radio.
do anything on demand.
No, radio. I mean, radio. I mean, I don't
use
know.
Pandora, but I don't pay for it, so I have to listen to their ads.
You'd have to endure the ads.
But
yeah.
Johnny don't pay.
Yeah. Johnny don't pay. I mean, yeah. So, I mean, I figure I'm cutting edge with my Sirius XM.
Okay. Okay.
I mean,
do you still have your CDs?
No.
You got rid of all of those?
Yeah. Yeah.
Okay. We still have CDs, and I don't want to throw them away, but they're obviously useless at this point.
vinyl's coming back.
I know, that's true.
I would say it's come back.
It takes up a lot of space.
It does. And but, you know, getting the old turntable out from high school, that works.
Crank it up.
Exactly. All right, we're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Hi, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's talk a little healthcare here. I'm seeing something. Wall Street Journal's out with a note here. The White House is planning to unveil a direct-to-consumer website for Americans to buy certain drugs, dubbed Trump RX. Nice. As well as announce that Pfizer plans to lower prices on several of its medications in the U.S., according to people familiar with the matter. Let's check in with Sam Fazeli. He's a director of research for global industries and senior pharma analyst for Bloomberg Intelligence based over there in London. Sam, we've been kind of waiting for like a President Trump with his most favored nations kind of plan for drug costs. Is this kind of the beginning of that with Pfizer?
Beginning. Now, that's an interesting one. The thing is that pharma companies, Paul, have been announcing these big numbers, 50 billion, 55 billion over the next 5 years, etc., of investment in the U.S. for the past 3-4 months. I mean, we've been adding them up with what Pfizer is supposedly going to announce, which is 70 billion. It goes up to over 400 billion. However, when you dig inside, you find that that's actually their normal R&D spend, their normal CapEx, and maybe a couple of manufacturing facilities. We'll see what Pfizer says, but let's say it this way. Pfizer's CEO is probably one of the most outspoken folks as regards to his high regards for the president. So I'm not surprised that they're doing something together in this thing. Whether it's going to be Trump RX or not, a bunch of other pharma companies have already started doing these direct-to-consumer platforms. The first one was 6-9 months ago with Eli Lilly. So even before any of these conversations started.
Okay, so Eli Lilly, and now according to the Washington Post and the Wall Street Journal, Pfizer. Who else is next then?
No, so we've already got some others. So I think AstraZeneca reported one. I think Novartis has talked about one. They're all, I mean, the president said, you guys can do this, essentially. You should do this. Because what you can do is instead of putting your list price at $100 and giving 50-60% away to the middlemen, pharmacy benefit managers, just bring it to this platform at that price. So when we see some of these prices announced, we are launching this price on this particular platform of our direct-to-consumer at a 50% discount. But it's actually the money they get from the deal that they do with the pharmacy benefit managers. So the pharma companies aren't losing. What is happening is what should have been happening for years is cutting out the middlemen.
So who are those middlemen? What companies are they?
The pharmacy benefit managers. I mean, these are essentially insurance companies who own quite a few of these benefit managers who help employers manage their drug costs, for want of a better, for their employees. In the end, of course, because they end up being owned by the same people, it ends up being a virtuous circle, I would use here, not vicious, virtuous circle as it pertains to their profits and what they take out of these higher and higher price negotiations and fatter net rebates and discounts they get from the pharma companies. A lot of which gets passed through the system still in terms of lowering premiums, but not all of it.
So we don't know so far what kinds of medications would be available on this government website at this discounted price. Right. But do you expect that anti-obesity drugs might make an appearance there?
Well, so that then, of course, depends on Lilly, whether they're going to divert some of their efforts from their own platform onto what I think some journals are calling Trump RX. I don't know how that would work. Is it a for-profit organization? Is it a governmental organization? What is it? And if it's just an organization that's going to help pharma companies, so it's run by the government, help pharma companies get access to consumers, then that's a good thing. But we'll have to see the detail. I'm seeing lots of headlines come through, no detail.
Sam, what's the world like for biotech M&A? It's been such a big part of the growth story for a lot of these big pharma companies. If they can't, make it in the lab, they can go out there and acquire it. Is that still the case?
Yeah. I mean, Paul, folks in the lab are much more incentivized to develop the great ideas when they're in the wrapper of a biotech company than when you have 5,000 scientists in a pharma company. And you can't legislate that great science happens in a pharma company. So the pharma companies have to go where the great science has happened. And a lot of that goes into biotechs. So, and this year is possible that we might end up having actually quite a bumper year, not in terms of big deals like 50, 60, $70 billion deals, but the sum of the deals is adding up quite nicely. We had one last week and then one this week. So this week is actually a bigger biotech buying a smaller biotech, which is Genmab buying a company called Mirus. And what I love about it, Paul, if I just can say this quickly, is that some of these companies that folks are buying had share prices that were languishing in the whatever they were levels were. I mean, if you look at Mirus, MRUS is the ticker on the terminal, you see that it's come up way from where it was at $10. It just shows the power of science translating into a good drug for patients.
All right, good stuff. Thank you so much for the rundown on all of this. Sam Fazeli, our Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence, joining us from London. Clearly a lot of developments. And anytime you talk about biotech, it's really a lottery ticket, any of those names.
It is. That's why I think the hedge funds love biotech so much, because you can have some big alpha there.
And that's why, as an individual investor, probably the way to go about it that makes the most sense is through some kind of ETF that exposes you to the sector, because otherwise you'd be picking winners and losers.
That's crazy.
And that's impossible.
And you notice all the analysts and the buy-siders who do healthcare, they're all PhDs or MDs. They're not. They understand the science, unlike us. All right, for our folks in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, Scarlett Fu and Paul Sweeney. We're driving the bus forward here. We're going to take a look at what's happening in the markets with Norma Linda. She'll join us here. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. We're going to get his thoughts on some of this economic data we had today and what it might mean for this Federal Reserve. Anurag Rana, he's the Bloomberg Intelligence Senior Technology Analyst. CoreWeave inks a $14 billion Meta deal. And latest sign of AI demand. Unbelievable the money that's being spent there. Henrietta Trez is going to join us, Managing Partner and Director of Economic Policy at Beta Partners. Going to give us her thoughts on this pending government shutdown at midnight tonight. So a lot happening up. We also have on standby President Trump from the Oval Office. We'll have some remarks, and we will bring them to you when he speaks. Right now, let's go to John Tucker and get a Bloomberg Business Flash, John.
All right, guys, and this Bloomberg Business Flash being brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your terms with a partner dedicated to your success. Go to Commonwealth.com to learn how. Right now, the major stock averages, they are mixed to little change. The S&P 500 down just 2 points, 66.58 on the index. The Dow down 100 points. The NASDAQ 100, that is higher right now, up 16 points. Oil extending a sharp decline as OPEC Plus considers boosting the pace of its output hikes. And as a result, energy racks up as the worst performing indices group in the S&P 500. Now, in terms of the index points, the leading stocks are NVIDIA, Apple, and Microsoft. The laggards right now in the S&P 500 include Amazon, Meta Platforms, and Alphabet. You mentioned CoreWeave, Paul, ticker symbol CRWV. Those shares up close to 16%. They signed a deal with Meta. As much as $14.2 billion worth of computing power is what they're going to provide. And as we wait for word of a funding agreement or not in Congress, Monica Guerra at Morgan Stanley says stocks can actually rally through any government shutdown.
So essentially they see through it, stay exuberant, but where you see any sort of pullback or correction, it's around those industries and sectors that have heavy reliance on contracts, defense, like healthcare in certain instances. And we think, especially on defense, right, that could be a nice buy opportunity.
Is Kindle still a thing? Google's Kindle?
Yeah.
I have one, but I haven't.
Yeah.
I like
Great for the beach.
I like the physical book. But anyway, Amazon's revamping the Kindle lineup. They're going to have a scribe device with a color screen and a slew of home security and TV devices. It's a part of the renewed hardware push.
A color screen? I thought the whole point was that the other black and white screen was better for your eyes.
Yeah, and you can see it in the sun. That's the key thing.
But I can't get over a physical book. I just love the feeling.
I like it too. I like the smell of the pages.
Do you?
Yeah.
Okay. That's cool.
Yeah, I'm into books.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Scarlett and Paul.
I'm into stocks as well, and so is Norma Melinda. And
do you smell them?
No, I don't smell them. Bloomberg's Norma Melinda here with some stocks on the move today. Nora, get us started with Verizon.
Yes, Verizon and EchoStar in focus. Ticker VZ for Verizon and SATS here for EchoStar. We're looking at the two companies right now. We've got EchoStar shares jumping after news that it will be engaging in some talks to sell some of its wireless spectrum to Verizon Communications. If you look more broadly, this stock has really been on a tear this year, up 230% so far year to date. And of course, this news with Verizon in terms of the conversations that they're having definitely follows what we were looking at back in late August about AT&T buying some spectrum licenses from EchoStar for about $23 billion in cash here. So we know EchoStar really has relationships with a few of these other companies, AT&T, SpaceX as well. So lots to really dig into for this company, really seeing some strong gains here for investors.
Again, about time. We've waited for a dozen years for these returns. So there we go. Okay,
Right.
what else?
Also looking at shares of Spotify, that's ticker SPOT here, sliding down as much as 5.6%. That's the worst since July here in terms of daily performance. And this is after news that its CEO, Daniel Ek, is stepping aside after leading the company for almost 2 decades here. He was one of the co-founders of the company, but they will be promoting 2 people here that were co-presidents. They will be jointly running the company moving forward here. But of course, this has really been a challenging time more broadly when you think about Spotify and a lot of these streaming different platforms here, especially as you think about AI kind of coming in and kind of challenging the order here. So it's a bit of a time of flux right now, especially with growth slowing to its lowest rate in years, especially as we have streaming kind of maturing in some of those major markets here. So definitely a lot going on there with Spotify, seeing a slide of as much as 5.6%.
And I'm just bracing myself for more price hikes from Spotify as well.
I know.
Speaking of prices, Nora, you're looking at Pfizer because there's reports and expectations that it will cut some drug prices in a deal with President Trump.
Right. I mean, so there is this expectation here. So we are seeing shares of Pfizer charging higher here, up about 2.7% right now. That's ticker PFE here. And so this is an announcement about plans to lower prescription drug prices. Of course, we know this is an event alongside Trump and including across the board reductions on U.S. prices more broadly. But Americans that are enrolled in the U.S. Medicare insurance program will receive the most favored nation pricing on some of Pfizer's medicines. And Pfizer will launch direct-to-consumer sales of drugs at substantial discounts through Trump RX.
Trump RX, that's a thing.
It's a thing.
All right, very good. All right, Norma Linda, thank you so much. Appreciate that. Norma Linda does all the equity stuff for Bloomberg. Now, part of Bloomberg Television, doing all the equity stuff there.
Yeah,
awesome.
Fun time.
Big moves there. Nora, thank you so much. We appreciate that. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. EcoGo. We got a lot of economic data here today. JOLTS came in a little bit higher in terms of openings out there. We also had the Conference Board Consumer Confidence number came in weaker than expected. I wonder what that means for the bond market, looking at the 10-year Treasury. Pretty much unchanged in a couple of basis points, 4.11% here. But let's check in with somebody who does this stuff for a living. Somehow he's built a career on this. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, we did get some economic data here today. What did you take away? What do you think your Treasury market's taking away from some of this data?
Yeah, I think we're looking a little bit through this data, looking forward to whether or not we get a payrolls report on Friday. I think that's that's still a big question mark with the government shutdown. And certainly if there is a shutdown, it's unlikely that it'll be released on time, even if it's a one-day shutdown. As long as it's, over the weekend kind of thing, then it will get delayed even further. But I think at the end of the day, the market today is looking at that shutdown. The consumer confidence data, maybe a little bit. The JOLTS data was kind of mixed. So like you said, job openings were up a little bit, but then the quits rate was down a little bit because maybe people who are, quitting, they aren't getting the kinds of pay raises that they would want for quitting. So that was kind of a mixed result as well. Yeah, importantly, and I think this is something for at least household psychology, this morning's house price data was actually up a little bit more than anticipated. And, if people are thinking that maybe they're a little bit more wealthy because their house price has gone up, then that certainly is something else that could boost the economy, or at least not arrest any decline in the economy near term.
Okay, interesting point. Even though the numbers are from July, and I know that that's probably something we fixate more on, tracking this data on a daily and weekly and monthly basis, as opposed to those who might just get a glimpse of it. Ira, we've been hearing over and over again about how markets look through a government shutdown, but all things being equal, does it have an impact on, say, the U.S. dollar?
Yeah, so Basically, every market looks through it a little bit, right? Because it really depends on the timing and what the ultimate outcome is. I think the market sentiment in general is relatively bearish, the dollar, and this just adds to that angst that the politics in the U.S. is so fractured that maybe that you don't want to necessarily own the U.S. dollar, and the U.S. dollar has been the outlet for a lot of the the international trade angst that the president has continued to rile up throughout his current term. Whereas you look at equities, you look at the bond market, and you don't see it that much in those markets. It's really the dollar that's taken most of the hit from everything that's been going on.
If the government shuts down, what's that mean for Treasury auctions, Ira?
Absolutely nothing. So remember, it's only non-essential personnel that get furloughed, and people in the Office of Debt Management. Some of them might go home and not show up, but the people who make the decision about how much to issue are going to be there. And the Federal Reserve has a separate budget away from what Congress does. So the people who actually issue the debt at the New York Federal Reserve, they will still be at work. So it won't affect auctions much at all. In fact, you've tended to see a modest rally in treasuries, and that's probably one of the reasons we're seeing this little bit of a rally today is because of just a little bit of flight to quality as you go into these shutdowns. And then afterward, it becomes a blip on daily charts, but you look at a monthly chart, you don't even notice when the government shut down.
Yeah, unfortunately, it's just become something that investors and the public are so not at home with and comfortable with, but familiar with at this point. Shut down, no shutdown, whatever, life goes on. Ira Jersey, thank you so much. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist on, of course, the latest economic data and what the shutdown might mean for treasuries. Let's go now to talk about tech, the opposite of treasuries, and really focus in on CoreWeave. CoreWeave is one of those neo-cloud companies. The shares are up big time today, up 14% after it has secured a $14 billion deal with Meta. Let's bring in Anurag Rana. He is Bloomberg Intelligence Technology Analyst on more of this deal. So Anurag, this is a deal that will provide Meta access to NVIDIA's latest GB300 systems. What is that? Are those NVIDIA's most advanced chips or systems run by NVIDIA's most advanced chips?
Yeah, so CoreWeave is basically is a company that takes all these GPUs and rents it out to people for whatever they want to use. So they do get the dips on the most latest equipment that is sold by NVIDIA, and then the clients can. And now I'm did show that Meta is buying directly from NVIDIA as well. But in this case, they're just going and outsourcing the entire infrastructure for an amount of $14 billion, which may be a very small piece of Meta's overall capex for AI infrastructure, but it's still a start that they are now leasing capacity rather than building it in-house.
So how should we think about this in the overall growth of AI? I mean, this feels like incremental spending to me, but I'm not sure if it's just shifted somewhere else. When you see announcements like this from CoreWeave, how do you kind of weld it in, or kind of weave it into the larger picture?
So every company, every hyperscale cloud provider right now, whether that's Microsoft or whether that's Meta or any other company that's out there that is spending a lot on capital expenditures on expanding their AI capabilities, they have two options. They can either build it themselves or they can go to a specialized vendor like CoreWeave and rent it from them or lease it from them. Microsoft has said that they are really into expanding their leasing capacity or capabilities down the road, which is good for companies like CoreWeave. Their job is to build only this infrastructure and rent it out to whoever wants it.
Okay, got it. My other question when it comes to CoreWeave and all of this, all these deals it's making with these cloud providers is that they're also raising a lot of money. CoreWeave is tapping the debt market, or there's expectations that it may tap the debt market. Is there going to be enough demand to meet what it wants to sell?
Yeah. So here is the case. When it comes to a customer like Microsoft or Meta, which all of us know have a lot of cash flow coming in. If they have signed, let's say, a 5-year deal, 7-year deal, you kind of know that the money is good. It's much easier to raise capital than let's say, from a brand new company that may not have that amount of cash flow coming in. So I would say, one should not be concerned that Meta is not good for that money. I don't think that's going to be, a concern for anybody who's giving them the bonds or the debt for that.
Yeah, Meta raised $29 billion in a financing package for a massive data center in Louisiana. Last week, Oracle raised $18 billion in bonds as it builds infrastructure for OpenAI. So the markets are open for this kind of trade, it seems like.
Yeah, apparently they are. And the other thing with CoreWeave, of course, is that it has an increased commitment from OpenAI. It's got this big customer in Microsoft, I think makes up 71% of its revenue. How diversified is CoreWeave's customer base right now?
See, when you see the CoreWeave's first biggest customer was Microsoft. Microsoft didn't have the capacity to run a lot of their AI workloads, so they went to CoreWeave. So, frankly speaking, I understand that 70%, but, this is an area where everybody needs capacity. So, for us, it is an issue, but it's not like, it's not a deal breaker when it comes to the quality or even you look at the fundamentals of somebody like a CoreWeave. Now, what's happening is other cloud providers are going to them and say, whatever excess capacity that you have, we will take that as well.
Are there other companies that are going to come public here, like CoreWeave, these neo-cloud companies?
Yeah, I mean, I'm sure a lot of them are gearing up for it. CoreWeave is probably the biggest one that's out there. We saw Microsoft signing another deal recently with Nebius, I believe. And that was a very similar arrangement where Microsoft is going to them and saying, okay, for the next several years, this is the kind of money that or the capacity that I want from you. And this is how I'm going to give you the money to fund it, basically.
So, Anurag, when you look at these kinds of deals and, $14 billion here, $10 billion somewhere else, what gets your attention in terms of, I need to look into this a little bit more versus this is just one in a long string of deals that these companies will continue to sign?
The biggest thing you want to think about is what are these companies doing these deals for? So for, say, somebody like a Microsoft, are they giving a lot of their inference workloads or the outcome of ChatGPT running on Microsoft's cloud workloads, or are they giving model training workloads? Because there is a narrative out there in the market that the long tail of the AI revenue comes from people using apps, which we think of this as inference revenue, compared to the model training revenue, which sees ups and downs depending on what kind of technological advancement we see in software development.
All right, Anurag, thanks so much. Appreciate it. As always, Anurag Rana, Senior Tech Analyst for Bloomberg Intelligence. All right, here from Meta, here's a couple numbers. Capital expenditures in 2021 for Meta, let's call it $19 billion. For 2026, the forecast is $96 billion in CapEx.
As Tom Keene would put it, that's a massive jump condition.
That's a massive jump condition. And the key takeaway is, I think, is that investors like that. They think it's money well spent at this point.
Well, they're not hiring people with it. They're spending it on systems or spending it on hardware, and they're building out more things to provide customers, their subscribers, their users with more functionality that they can then glean more data from.
Yep. Meta stock is up 25% year to date, $1.8 trillion market cap. So there you go. Coming up, we're going to get the latest out of Washington, D.C. Henrietta Trez, she's managing partner at Veda Partners. Poonam Goyal, senior U.S. e-commerce retail analyst, give us the latest preview for Nike, which is my shoe brand that I endorse. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. We're brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. Major stock averages, they've all turned lower to little change right now. We did have data today. The JOLTS jobs report, job opening labor turnover survey, suggesting relatively steady demand for workers in the U.S. That comes ahead of the September jobs report, which is at least scheduled for Friday morning. May or may not get that. Depends on whether there is a federal government shutdown. Some of the company news we're following includes ExxonMobil. They plan to cut about 2,000 jobs globally, part of their long-term restructuring plan. And then you guys mentioned EchoStar, SATS, the ticker symbol, up 3.2% right now. And they're in talks to sell some of their wireless spectrum to Verizon. CoreWeave, that's one of the standouts today. Again, up over 13%. They're going to supply Meta with the oodles of computer power. S&P 500, 11 points lower right now, down 0.2%. We're at 66.49. The Dow Jones Industrial Average, 164 points lower. And the NASDAQ 100 right now, 33 points lower. That's down about 0.1%. A consortium of airlines warning that federal employees like air traffic controllers and transport security employees will be working without pay if we do shut down. Other FAA employees are furloughed. Airlines for America, this is a group of carriers also warning of the effects of a disruption in the economy. At least they claim the aviation industry contributes more than 5% to U.S. GDP.
Wait, what about TSA agents?
I believe...
Essential?
I believe there's... Henrietta would know more about it, but yeah, I believe they're essential employee. They must be, right? We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, thank you so much, John Tucker. Let's bring in Henrietta Trays. You kind of front-run us, but let's go right
Sorry
there.
about that.
Henrietta Trays is managing partner and director of economic policy at Veta Partners, joining us now for this potential of a government shutdown. Henrietta, just answer that first question for us. TSA agents, essential workers, they'll be there at the airports?
TSA essential workers, the guys on the ground waving the light up flashlights, whatever those things are called, they will be there. They will not be getting paid though. So that's a tough break.
Wow.
Yeah, that's painful for them.
I want my air traffic controllers to be happy.
Yes.
Yes.
Exactly. I don't want them to be mad or upset and angry about not getting paid.
So, Henrietta, how's this going to play out, do you think? Let's assume the government shuts down at midnight tonight. Is there any call or consensus in D.C. as to the duration?
That's a good question. I was speaking with staff yesterday, just after the White House meeting, and what's going to happen for the next couple of days is you're going to see basically a very real vibe shift. We've gone from not voting and sort of docile action on the House and Senate floor to what is expected to be repeated rounds of voting on the same bill over and over and over again. So the Senate Republicans are going to put that House-passed clean CR on the floor as frequently as possible, possibly every single day and through the weekend until they break this impasse. And the expectation, I would start at the long end, is for 10, 11, 12 days of shutdown. The federal employees themselves will start missing pay cycles on Friday, October 10th. But there is, on the short side, a little bit of optimism that after the Yom Kippur holiday on Thursday, cooler heads might have prevailed. Some of the steam will be let out of the room, and they'll be able to reopen on Friday. That's optimistic.
Okay, what you described sounds kind of like what happened when they were trying to vote for a Speaker of the House a couple of years ago, and that went through many rounds and many days. Yeah. So, Henrietta, what does this mean for the all-important jobs report that investors will be focused on Friday? Because if there is a shutdown, even if it is temporary and it lasts just a couple of days, does it screw things up so much that we don't get the jobs report at 8:30 a.m.?
This is the interesting dynamic. So the government doesn't shut down until tonight at midnight. The employees are all working at VLS, at the Department of Labor. The data has been collected. All we need to do effectively is hit send on that employment report at 8:30 a.m. on Friday. So it's all there. That means that this is an active choice from the administration to suspend activities. Everybody except the commissioner is going to be furloughed. And under furlough, they're legally not allowed to work. So the data will be there, it will be compiled, but they will not hit send on that information. And that is the base case expectation of staff on Capitol Hill, is that we will not see the Friday jobs report. A direct quote from some staffers that I spoke with last night basically said they've normalized the idea that the BLS data is not going to be reported, so we should not anticipate that data set on Friday. And the reason I lay it out like that is because as we get deeper into the shutdown, the people who are collecting the data and compiling it will not be working. So as it gets into the October employment situation, when we're shut down, that data won't have been collected. It won't be compiled, as opposed to this employment situation, which is, in existence. It's already there. We just need to hit send.
Henrietta, from a political perspective, does one party have more risk here from a shutdown?
That's a good question. I would always think of risk when I think of politics as who do the voters blame. Right now, Republicans are 13 points underwater with the American electorate based off of a Morning Consult poll of over 2,000 American voters conducted and put in the field this week. So right now, the American public is blaming Republicans. That's probably got to be because the president is a Republican, the Senate is controlled by Republicans, and the House is controlled by Republicans. So it makes sense that if we're shutting it down, it's the majority's fault. The Democratic Party, in terms of consequence and risk, Senator Schumer and Leader Jeffries are under intense pressure from their base and from rank and file members to shut it down, to do whatever they can to, try to challenge a very aggressive and robust executive branch. And shutting down the government is the best they can do.
What will you be watching for or listening for in the proceedings over the next couple of days? I know a lot of it, as you mentioned, you described it, there's going to be a lot of voting on the same bill over and over, and we're not going to expect to see any much change. But if there's going to be any kind of sea change, where might it appear?
Well, I don't appreciate you calling me out like this, because I will be glued to C-SPAN too, as ever. I'll be watching the Senate floor. The reality of the math here is that the only Republican who needs Democratic votes is Leader Thune. He's going to need anywhere between 10 and 20 Democratic votes to cross the line. What's going to happen here is that even though we only need technically 7 or 8 Democrats, no one wants to be that 60th vote, and they're always going to give each other political cover. So Leader Thune is going to have to try to get, as many as, 10 or so Democratic senators to support whatever he puts on the floor. So it's incumbent upon him to negotiate with the Democrats that Speaker Johnson doesn't have to do, Donald Trump doesn't have to do. So really all of our attention should be on the Senate side. Moments ago, Leader Thune and Leader Schumer did have an exchange on the Senate floor. I got very excited, but there's no movement yet. So that's where I'll be watching.
All right, Henrietta, thank you so much. Appreciate that. As always, Henrietta Trez, managing partner at Veda Partners, giving us the latest on this shutdown. Back to the market, we do have companies still reporting some earnings. We got some retailers coming out. Nike in particular is going to be reporting after the close today. We want to get a sense of how that might look, because when you think about Nike, you think about sneakers, and you think about those coming from China and other parts in Asia, potentially at risk from tariffs. So people are going to be paying attention to what Nike has to say, including Poonam Goyal. She covers all the retailers for Bloomberg Intelligence. I'm looking at Nike's stock here, Poonam. Just today, it's down about 0.9%, down about 9% year to date here. What are you going to be looking for with this earnings?
The most important thing that I'm looking for is inventory levels. They ended last quarter flat, and I think it's important to see that they continue to show declines in their inventory so that they can focus on new things. Right now, inventory is their biggest problem. So for me, that's important. And also on the tariff thing, you talked about it a little earlier, but when Nike talked about tariffs last time, they said that they would have $1 billion hit. At that time, tariffs were largely paused at 10%. Today, the average rate that they would be exposed to is about 20%. So does that mean it's now a $1.5 billion, a $2 billion hit? I think that's going to be important to unlock this evening as well.
Okay, so a lot to watch for there. When it comes to inventory, I mean, Nike has now right-sized its production going forward, but how much inventory is out there that still needs to be sopped up?
still a lot. I mean, if you just think about where they ended, they were just flat, and sales are still tracking down mid-single to low double digits, depending on what quarter you look at. The expectation is for sales to be down mid-single digits in the second quarter. So inventories theoretically should be down by just as much if they were right-sized.
Talk to us about that sales line. What's driving that decline in revenue?
It's really underperformance in its DTC channel, largely online, and it's due to the pressure that we've just been talking about, the inventory. The inventory has to be cleared. It's going to be discounted, and that's going to pressure the top line. I think where they're doing well is in wholesale. I think wholesale will be in a better spot for them because Nike has made a big comeback into wholesale partner doors. When you walk these stores, you can see that it's clearly brought up its mind and shelf space, which bodes well for the brand. And then for the in-store sales within the DTC segment, we think that's also going to do better. The struggle really here is online and North America. China, too, is a little weaker for them than we'd expect, so we are looking to see what they have to say there.
And of course, Nike, in trying to change the narrative, has launched this celebrity partnership with Kim Kardashian's shapewear company, Skims. What's come of that? Because I don't feel like we've seen enough on it. It was announced to great fanfare, and then since then, it's been kind of crickets.
So we were in the Nike store on Friday when it released, and what I can tell you that it was crowded. The New York flagship had a lot of people in there. The bags were mostly Nike Skims that were walking out. So there is fanfare. In terms of the line, I thought, it's pretty good. The merchandise was good. The receptance was good when talking to associates and people. I think it can help them really advance their offerings in the women's athleisure space. Nike holds just about a 10% share in global sportswear in the women's category. So if you think about that versus where it is in men's, it's not really ahead of everyone else by that much. Can Skims do it? We think it's one step forward, and it is a good line.
What's the competitive landscape like these days for Nike?
So there's plenty of competition. The competition hasn't eased at all. Nike is still the lion's share of the athleisure market. It still is a number one player, but Adidas has come a long way, and it is also doing well, especially when it comes to the lifestyle franchises that it owns. Puma's struggling. Lululemon is struggling a bit. On and Hoka are still doing well. So it's really just a matter of making sure that they can pull that share back that they lost over the last few years. And we think they are making inroads in doing that because their new collections are resonating well with shoppers.
All right, good stuff. Poonam, thank you so much. Poonam Goyal is Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence, giving us a preview of Nike's results, which will come out after the close. And of course, Nike had to go back to its internal talent pool to look for the new CEO, Elliot Hill, who's not so new anymore.
Okay.
But it speaks to this idea that they kind of went outside and looked for, the tech guys to run the company, which kind of led them astray, and now they're going back to basics again.
Yeah, exactly. But I just think of that market, and there's so many different brands out there. I just see, just around here at the office with the young people, sneaker brands that...
On, Hoka's, all of that.
Like, where did that come from?
This is Bloomberg Intelligence on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages wavering right now. In fact, they're all lower. S&P 500 down 16 points, down about 0.25%, 66.45 in the index. The Dow Jones Industrial Average is down 179 points, and the Nasdaq 100 is 62 points lower. Let me start with the best performing stock in the S&P 500. They just had earnings. Lamb Weston Holdings, the ticker symbol LW, up over 5%. The earnings and sales topping expectations. And most active, NVIDIA, those shares up 2.3%. Then you have shares of CoreWeave. That's one of the big standouts today. Pairing some of the earlier gains, still up close to 13% after signing that deal with Meta Platforms. Citigroup's Veronica Clark remains focused on Friday's all-important jobs report.
It's still a labor market that is defined by very low hiring, but very low layoffs too, which is good. But nothing has really gotten better. And until I see, hiring picking up, I'm still worried that the next step would be some bigger layoffs.
Well, if there is a government shutdown, though, the jobs report would, of course, be delayed. NYMEX crude down 1.4%. You can blame or credit OPEC Plus with that increasing production. And that means energy is the worst performing of the 11 major industry groups in the S&P 500. Another thing that can run me down on the streets, DoorDash unveiling a delivery robot.
Crazy.
This is a four-wheel...
Run you down?
What?
Run you down, really?
Yeah,
Well-
definitely. Those guys are crazy.
Well, this is autonomous, so maybe it'll be a better driver than all the bikes delivery people in Manhattan. Four-wheeled autonomous robot named Dot. It's big enough to fit 6 large pizza boxes and can carry up to 30 pounds of cargo. It can travel as fast as 20 miles an hour in the bike lanes, sidewalks, and roads. I've yet to see one of
They
these
get the
things.
bike lane, the sidewalks, and the roads they can pick? Wow.
Well,
Ever been on Third Avenue?
It's a little, it's a little road. I wonder what happens if you do get hit by one. Is there a special number to call?
I know.
And Amazon, one of their helpful people
I
gets on the
do
phone.
like the idea of these robots challenging the bikers in the city, because the bikers are a little bit...
They're aggressive.
They are.
Yeah, well, anyway.
Not so much
That's
pedestrians,
progress.
bikers.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and it's your Bloomberg Business Flash, Scarlett and Paul.
All right, JT, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. That's the internet, John. You can go over there and search Bloomberg Radio, and that's where you'll find us. All right, at the height of the Jimmy Kimmel stuff a week or so ago, a piece of research crossed my desk that just made me stop. And the research from this analyst often makes me just stop. You have to read it. And that's Laura Martin. She's an analyst over there at Needham & Company, one of the best media analysts out there on the street. And she's saying Disney should shut down ABC. I thought that very, very interesting. Laura Martin joins us here. Laura, what are you shutting down the network? Talk to us about your rationale on that one.
Sure. So I just want to make the point that if they actually got out of ABC, nothing else in the Disney portfolio would be regulated. So films aren't regulated, theme parks aren't regulated, consumer products aren't regulated. So nothing else in the Disney empire would be regulated. So then the question is, how important is ABC to the economics of the whole? And we calculate that they'd have to have a $10 billion write-off, which would be the free spectrum they get, which is worth about $2.5 billion, and then the present value of the cash flows, positive cash flows over the next 5 years. But as you know, Paul, broadcasters are losing audience. The average age of their audience is over 60, and therefore advertising revenue is hard to come by for that target demographic. And so we thought if they took a $10 billion write-off once, that what happens next is that because that asset is shrinking, going forward, all the other revenue of Disney would grow a lot faster, which would then expand its multiple by 0.2 points, which would actually create about 20% upside to the stock after you took a $10 billion write-off. And let's be clear, like the revenue here is $95 billion a year. So a $10 billion write-off isn't significant, but a markup in the valuation multiple and a quickening of the revenue growth rate is material to the value for Disney shareholders.
Okay, so that would be good news if it shut down ABC. What about the economics of selling ABC?
Right. So, of course, a CEO would, a board is going to prefer to sell an asset if it has value. But the problem is you need FCC approval. So, whereas if you shut it down, you don't need FCC approval. But to transfer those licenses that are the ABC stations, you need FCC approval. So that's probably the more, I think that's probably the more rational approach that the board would take, is try to sell them even at half price to get out. But I was just making the point that even if they just decided to shut it down tomorrow, the economic impact on the Walt Disney Company would be positive, in my opinion.
Laura, you bring up a bigger, broader issue for, I think, a lot of the big media companies that you follow. They have broadcast networks, they have cable networks, and of course, they're all suffering from the same challenges and headwinds of cord cutting. I guess we've seen some announcements from some of these companies that maybe they're going to spin some of those networks out as a separate company. Where are we with those types of announcements?
Right. So, Warner said they were going to do that, but then we're hearing rumors that the Ellisons are going to bid for Warner Brothers. So then that would stop that separation, because the rumor is that the bid is for all of it. Comcast is still saying they're going to separate the two businesses. Now, I will give you a cautionary tale from the Kimmel story. So what Disney should do today, so long as it owns ABC, which is regulated, is it should simulcast every piece of content on ABC on its streaming platforms, which it owns, because those are unregulated. And so if the FCC ever did something and Disney had to go dark, like taking Kimmel off the air, it should put up a placard saying, this content can be seen for free on our streaming platform, Hulu. And in the case of Comcast, today they could do that. If something happened to NBC, which they own, which is a regulated platform, they could put up a placard saying, hey, go and watch our streaming services or our cable companies, which are not regulated by the FCC, to see this content for free. But the minute you separate those assets into different entities, you don't have that flexibility if the FCC gets aggressive at trying to, take your content off the air.
Laura, I got to ask you about the threat by President Trump to impose a 100% tariff on any and all movies that are made outside of the United States. I know that there's so much that we don't know about. There's not enough detail, but how might a Disney start thinking about planning for that?
I think this is about, so other countries are giving very deep discounts to bring movie companies offshore to drive employment. A lot of countries, not America, solve for lower unemployment. So I think what Trump is trying to do is even out the economics so that it looks more expensive to go to Canada or to go to Mexico or to go to London to film a movie if you're going to have a tariff to bring it back in. I will tell you that movies take 3 years to release. So if you started a movie, if you greenlit a movie today, by the time it needed to be brought back to America, Trump will be out of office. And I don't think these tariffs would survive a Trump administration. So I'm not sure. But what it affects is somebody who made the decision 2 and 3 years ago to make a movie offshore. When you bring it back this year or next year during a Trump administration, you're going to pay a tax to get it back to the U.S., which I think is too bad. But it just tries to even the economic playing field of foreign countries giving very deep discounts to have filming there.
Laura, thanks so much for joining us. Always appreciate getting some of your time. Laura Martin, she's a senior analyst at Needham & Company, some of the best research out there on the media space, including some of these technology companies that are becoming into the content business, like Apple and all those other
Absolutely.
types of things. So
but, for those companies, this is not their bread and butter, right? I mean, Apple, as much as it has Apple Plus TV.
Amazon.
Right. I mean, it doesn't have to prioritize it because, those iPhones pay for themselves.
Exactly. And they've got so much cash flow from their other businesses that they can take a movie being a dud or a TV show being a dud. They don't have to worry about the costs associated with their media businesses, unlike the traditional media companies, which it is the bread and butter, and that's kind of always been the challenge there. All right, coming up, we're going to check in and with some more Bloomberg Intelligence. Scott Levine, Bloomberg Intelligence Senior Energy Services Analyst. He's going to talk to us about AI and the power demand that are going to be needed to fuel these data centers. It's like a big number, and it requires a big build cycle. Right now, we're going to go down to Washington, D.C. President Trump is making some comments. Oh, we're waiting for the audio to come up. In just a moment. There we go.
There we go.
Mehmet Oz, Medicare Administrator Chris Klump, and the FDA Commissioner Marty McCary, and I just want to thank them all. They've been working hard on many, many things. I think this is one of the biggest medical announcements that this office has ever made, because we're talking about price reductions, as you'll see in a couple of minutes, that are incredible. For many years, Americans have paid the highest prices anywhere in the world for prescription drugs. They paid far more, 10 times, 13 times, 15 times more than other countries for the exact same product. A major reason is that the American consumers have been subsidizing research and development costs for the entire planet. They put all of that on us, and yet they were the beneficiaries too. So it's being changed as of today. The United States had just 4% of the world's population and consumers, only 13% of prescription drugs, yet pharmaceutical companies make 75% of their profits from the United States. So think of that. We have 4% of the market, 13% of prescription drugs, and yet, Albert, I didn't know you were that violent. I'm surprised you're agreeing to this.
I'm getting better.
No, he's doing the right thing. Thank you. And yet they make 75% of their profits from the American customers, so it's something. That's why I signed an executive order combating this practice, and we signed it very happily a little while ago. Today, Pfizer is committing, as will other drug companies as we go through the weeks, but Pfizer is truly one of the biggest in the world and one of the greatest in the world. Today, Pfizer is committing to offer all of their prescription medications to Medicaid, and it will be at the most favored nation's prices. It's going to have a huge impact on bringing Medicaid costs down like nothing else. I told you that in my first term, I was so proud of the fact that for the first time in 28 years, drug prices came down. And I had a news conference that I explained it was 1/10 of 1%, but it was down. And here we're talking about, in one case, over 1,000%. This is a critical step forward to our work and to improve health care, and hardworking, low-income Americans, especially low-income Americans, will be helped so greatly. In addition, Pfizer is agreeing to provide some of their most popular current medications to all consumers at heavily discounted prices of anywhere between 50 and even 100%, and that's off the price. And in some cases, even more than that. These drugs will be available for direct purchase online at a website operated by the federal government. We're also announcing that moving forward, all new medications introduced by Pfizer to the American market will be sold at the reduced most favored nation costs. So we'll be paying essentially what other countries are paying, who have been much lower for many, many years. Furthermore, Pfizer will invest $70 billion to reshore domestic manufacturing facilities. In other words, they're going to bring a lot of their facilities to make their drugs and make what they make, their product. They're going to make it in the United States. I appreciate that $70 billion investment and fund research and development right here in America. We're working with other major pharmaceutical companies to secure similar agreements. Everyone understands that the status quo where Americans pay more for drugs, prescription drugs, and they pay more than foreign countries who take advantage of us in many other ways, although not so many anymore. I think we've pretty well got that stopped, right? I think so. We've stopped that, but they took advantage of a lot of other presidents, that I can tell you. But we're making this pay to be very unacceptable what they've done in the past. That's why my administration has also taken historic action to investigate the unfair and discriminatory trade practices of other countries that extort our pharmaceutical makers to shift costs onto the American consumer. They say, no, give us a price, a very low price, and just charge the American consumer, charge it to the U.S. The United States is done subsidizing the health care of the rest of the world. It's a big thing. I can't tell you how big this is. And I was all set to go on the first term, but then you had the COVID, and we had to focus on that. But I said, I want to get back here because this is, you're talking about 14, 15, 1,600% reductions in some cases. But by taking this bold step, we're ending the era of global price gouging at the expense of American families, and we're making America healthy again, which is our little theme for the people behind me. And I want to just ask Secretary Kennedy to come up, and we'll start, and we'll go through it with Oz and Klump and Borla and McCary, and we'll go through it, and if you have any questions. But this is a really big announcement. This is something that most people said was not doable. And other countries are going along because we told them that if you don't go along, they didn't have to go along. But if they didn't go along, we were going to put extra tariffs on those countries. And we were going to charge them the amount of money that they should be paying for the reduction in costs. So I think we had a pretty good negotiating position. So, Bobby, I'd like you to speak about this, and what a great job, and thank you very much.
I thank a couple of people who aren't up here, Theo Merkel, Dr. Heidi Overton, who played key roles in this negotiation and helped make this happen. And also Inma Hernandez, who's not up here, but John Brook and Chris Klump, who were the people who were negotiating, in some cases, I think including last night, 24 hours without any sleep. This would not have happened without President Trump's leadership. I told my son last night, we're all under secrecy about this, but I told my son late last night, a 27-year-old son, Connor, who's a very liberal Democrat, and I told him this was happening, and he just paused for a minute, and he said, "Thank you, Dad, I'm so proud of you." Because this is something Democrats have wanted for 20 years, Republicans have wanted for 20 years. Everybody said they're going to do it. Nobody has even taken a step towards doing it. And the reason was because it was such a daunting task. And, even all of the negotiators who say, I also want to thank Howard Lutnick. This would not have happened without him. But even all of the negotiators here and all the people on at HHS and at the White House team, all we could see was all the reasons that this couldn't happen. That everybody had tried. Nobody could make it happen. And it was President Trump alone who, with his doggedness, his persistence, he saw this clearly in a way that none of us other, in its most simplest terms. Why are we spending more on this country than any other country? Why are we spending 75% of the revenues that come to the pharmaceutical industry? We're doing all the research, and everybody else is riding on our slipstream. And President Trump, I would say, harangued and harassed us to make this happen. I was getting calls at 11:30, 12 o'clock at night. Oh, are you asleep? And you got to get MFN done. And at one point, Dr. Oz told me, I can't take the president's calls anymore. I have a lot of reasons. My wife has a lot of reasons to say to me about different things that happen in my life. Doesn't that give you anxiety? And I say, I don't get anxiety. This gave me anxiety. Oh, thank you, President Trump. It would not have happened without you. This is real leadership. It's a president who has a vision and makes that vision happen. And I can't think of any other president of the United States who could have done this in our history. I'm very grateful to you. This is an extraordinary benefit. The American people, thank you for your vision, President Trump, your bold action, your unwavering commitment to health and well-being of the American people. Never has a president stood up so bravely for the American people with respect to health care. And by the way, I forgot to thank Albert Berle. Albert and I have had a long history of antipathy and antagonism toward each other. But I have to say his leadership in this took tremendous courage. And he really created a template for corporate responsibility for putting public health ahead of his individual interests. So I'm very, very grateful to you for that, Albert. Under the leadership of President Trump, the U.S. government is now acting as a tough negotiator on behalf of the American people. Today is about fairness, it's about equality, it's about giving hope to those who are trying to stay healthy, who are managing illness and who are fighting for their lives. We refuse to make the most vulnerable citizens continue to pay an unthinkable price for the world's pharmaceutical breakthroughs, which we pay for. This policy is a shield for the chronically ill who have carried the burden of high drug costs for far too long. It's a signal to every American family that we're finally putting their health and financial security first. And it sets a new standard, one that says we won't write blank checks to the drug industry any longer. No family should ever be forced to choose between filling a prescription and putting food on the table. Americans should not be gouged paying 300 or 400 or 1,000% more than people in other countries for the exact same drug, many times manufactured in the same factory in New Jersey and sold in Great Britain for 1/10 the price that it's being sold for here. This weekend, I was with some friends up in Martha's Vineyard, and an old friend, one of my oldest friends, his wife and daughter have a chronic disease. And that chronic disease last year cost $150,000 to treat. And the mother had to choose whether she was going to take that money and spend it on her or her daughter. And she spent it on her daughter. So she had to make that choice. It's a choice that no mother should have to make. We did a roundtable recently on drug prices. One patient spent more than $180,000 on one drug. One cashed in all of her savings and worked 3 jobs to make ends meet. One almost quit her job and moved to Germany to get the drug cheaper. Some looked at getting the drug on unsafe secondary markets because they could not afford it through the legitimate markets. Today, we begin to right that ship for the mother trying to help her child get better, for a grandmother at the pharmacy counter, and for millions of Americans who want to restore their health. Today is about another promise made by President Trump and another promise kept by President Trump to the American people. And it's only just the beginning. This is all thanks to your unwavering leadership, Mr. President. Thank you.
Thank you very much. There is a fine line between vision and hallucination. People have to follow you.
Speaking now live from the White House
President
on
Trump,
Bloomberg Radio.
A lot of people following you, an idea that most people thought was not possible, even remotely. And when we have that shared vision, and I'll speak to some of the people who are involved in this process because it was incredible effort that gives me great pride to serve in this administration. And the fact that it did not leak is also an issue of pride for us because these were tough challenges. And Albert Bourla looks very calm up here and cat-like, but he is ferocious when you get him in a negotiating room. This is true for all the pharmaceutical companies that we are negotiating with. And Secretary Kennedy, my son Oliver, who I told about this deal as we was walking over here, is a Republican. And you know what he said? Thank you for making us proud. Because it's not just a Democratic problem, it's a Republican problem. This has not happened before. And it took a crusader like President Trump, with the support of Secretary Kennedy, Secretary Lutnick, I see the Vice President's here as well, just unwavering, dogged pursuit of change. And now I have to admit that I know the President has me on speed dial, and most of the time when he would call me, as Secretary Kennedy alluded to, it was about MFN, and he always had reasons why we needed to go faster, why people were being hurt today, because we're allowing the kinds of pricing that had been tolerated for so many decades in America. The time of the day didn't matter, the day of the week didn't matter, and that's how the president was functioning. This was such an important part of what he saw as his legacy, which is why it brings such pride to all of us up here and many others to deliver it. And the laser focus that the president had on this, which he shared with me the day that I was nominated, that he nominated me for this position, and has reminded me frequently since, made it a top priority for us as well at CMS. Now, to do this, you have to have tactics, not just vision, but tactics. And the first tactic the president shared was to introduce me to Albert Bourla. He took us to dinner with Secretary Kennedy, and he argued, and he's a great deal maker, as you know, that if you're going to make a deal of this scope, of this nature, you need trust. So the president lit the kindling. He got the embers going, but he needed us to nurture that beginning of a fire so they would blaze into what today we can announce as the grand deal, one of the greatest ever, certainly in the space of pharmaceuticals. I gained the respect, Albert, and I'll tell you why in particular. It was because he recognized the dangerous problems facing so many Americans, that they had to choose between taking medications prescribed by their doctor that could be life-saving or shopping at the grocery store, paying for their kids a fundamentally important need that would be squeezed out because they couldn't
live to
compromise
Dr.
on
Mehmet
drugs.
Oz, who of course leads the Centers for Medicare and Medicaid Services, live at the White House, flanked by President Trump and Secretary RFK Jr. If you're with us on YouTube, you can get a sense of the room here. Albert Bourla, as you've heard, is also with them, the CEO of Pfizer, who presumably will speak next. And we're going to go back to the room if they do take some questions here. With our eyes on shares of Pfizer and headlines that we brought you earlier today on Bloomberg, we turn to David Gura, who joins us live from World Headquarters in New York at the top of the Tuesday edition here of Balance of Power. David, it's great to have you here. This is something that the president's talked a lot about, and I just want to be deliberate in what we just heard, because he suggested that drug prices could be down by as much as 1,000%, and I'm not sure how the math adds up to all of this, but the fact is the Medicaid insurance program will get most favored nation pricing on some Pfizer medicines. What else do we know?
Yeah, the effort here is to get Pfizer to reduce the cost of drugs overall, and that's what we heard from Mehmet Oz and from RFK Jr. As well, certainly from the president. As you rightly point out, Joe, this is something that President Trump has talked an awful lot about, both on the campaign trail and since he's been in the Oval Office. And this all stems back to a letter that the president sent back in July of this year to not just Pfizer, but many major drug makers, insisting that they come to the negotiating table and reduce some of these costs. I think what will be interesting to hear from Mr. Bourla, who keeps being invoked by these members of the Trump administration, is what this means for the way that Pfizer approaches research going forward. If you think back, Joe, on sort of the arguments that drug makers have made, including Pfizer, against lowering prices, it's that it does two things. First of all, it kind of creates or provides for the innovation that we've seen in the U.S. pharmaceutical sector. They need this money. These drug prices result in companies spending more on research and development of these drugs. The other is, if it were to disappear, companies like Pfizer would have less incentive to embark in that kind of research and embark in that kind of development. And so, again, you talk about the questions that we have, the numbers that we don't know about yet. I think that'll be what will be most interesting for me to listen to here, is how Pfizer plans to compensate for what would be, it sounds like a pretty seismic change here in the way that drugs are priced by this company and others.
Yeah, that's for sure. With the headline that the company is going to announce a $70 billion investment in R&D, Mr. Bourla will have quite the needle to thread here, because when you look at the stock today here, David Gura, I know you're not a stock analyst, but Pfizer's up over 3% as it announces across-the-board reductions in drug prices and a massive investment in R&D, and I'm not sure how you can have all three.
No, it's a very good point. And the way that I think about this is by having this Oval Office entree standing there with these members of the administration. I think there are many investors who are probably looking at that and feeling as though Pfizer has dodged a bullet, might not be the right term here, but has certainly ingratiated itself in this administration in a way that might protect it going forward here. I mean, the backdrop to all of this, of course, is the administration's approach to tariffs on pharmaceuticals as well. So it was just only a few days ago that the president floated these 100% tariffs on pharmaceuticals, levies of that extent on branded and patented drugs, unless these companies build more factories here in the United States. And my understanding of that is that most of these drug makers are in fact doing that. Perhaps they won't be hit as hard here, but I think that it's an effort here on this drug maker's part to escape the strong heat and scrutiny of this administration. Perhaps that's what investors are looking at here as a positive sign.
Yeah. And we should note as well, by the way, Pfizer is having a decent day here, but many had left the stock for dead on Wall Street because of this administration's approach to vaccines. And I'll note that it was in December of 2021, that stock topped out at almost $60. It is now worth less than half that as we spend time with David Gura here on Bloomberg. I don't know, David, if they're going to go to questions or not. Albert Bourla will have some words here, I guess, to make things official, but it is amazing when you step back from this and think about the Oval Office event with Tim Cook, when he presented Donald Trump with the gold trophy, when he's had Jensen Huang come by the office, or Sam Altman. There is a sort of Trump effect that seems to take place to their stocks regardless of what they're announcing.
I think that's exactly right, and you bring up a handful of those executives, but I'm still thinking back on the state visit that the president made to the United Kingdom a couple of weeks ago, and how maybe in the past a president of the United States would be accompanied by artists and writers and sports figures and the like. He was really surrounded by this very same group of executives, tech executives, business executives, who, again, he seems to have brokered these relationships with, kind of mutualist relationships with, and he brought them with him on the road as well. But yeah, you bring up Tim Cook, and it was a very similar tableau when he visited the Oval Office most recently, yes, handing over that gift to the president, but I think giving those investors and Apple a reason to take a sigh of relief as well.
Well, it's an interesting bit of timing here because the president's got a lot to deal with. We're going to talk a bit later on about shutdown politics, David, and you've been through a couple of these here. The president is making this announcement on a day that the government is preparing to turn the lights out. 12:01 a.m. tomorrow is when technically it would happen, and by afternoon, we're going to be seeing some votes in the Senate that I suspect will not make him terribly happy. Then again, there are those who believe Donald Trump favors the idea of a shutdown because it would let Russ Vought, his director of management and budget, run wild and lay off hundreds of thousands, potentially, of federal employees. He actually acknowledged that in the driveway when he was headed to Quantico this morning. David, it's hard to get a bead on exactly where this administration stands because they seem to think they benefit either way.
I was talking with Megan Scully, our colleague who heads up our congressional coverage, just about our shared experience covering these things. And I've lost track of how many shutdowns and potential shutdowns I've covered, but there have been well over a half a dozen, I think, in recent years. And there is a way in which these customarily play out. And what you see historically are leaders of both parties trying to wrest hold of that bully pulpit to make their case to the American people. And I think that both sides of the aisle have had some difficulty doing that here. And you bring up the kind of ambiguity from President Trump. And I think that's something that really stands out to me. There have been moments when he's tried to accuse the Democrats of owning this shutdown, of pushing for this shutdown. There are others when he seems kind of blasé about the fact that it's going to happen here. I just think that what we're seeing on display in the Oval Office here today is strange or different from what we've seen in the past. He's had the opportunity twice today to really dig into this and make his case, the first of which was at that speech at Quantico this morning, and now here in the Oval Office. And I don't hear him making a solid case for avoiding a shutdown. Yes, he's trying to put it on the Democrats' plates here. I could also look at the Democrats and say that I think that there's been a kind of PR deficit on their part as well. But you rightly point out we are ticking down the hours to when this would take effect. And you invoking what is the most unique part of this shutdown, that is the threat from Russ Vought and the Office of Management and Budget, that this would be a mechanism for them to not just furlough federal workers, as has been the case in the past, but to lay them off. And I think that stands to have a profound impact on the U.S. economy in a way that we haven't seen with other shutdowns previously.
It sure does change the dynamic this time around. You mentioned the way the president started his day at Quantico, FAFO, David Gura. He was following the Secretary of War, as he likes to call Pete Hegseth, who opened his speech with that message to, I guess, our adversaries, but also made it clear, FAFO, to some of the top brass in the room. He said, a lot of you need to lose weight and get rid of the beards, no more beardos. And spoke for quite a while, sort of a TED Talk in front of the American flag, kind of a TED Talk style speech. The president followed, and it was a very political speech in front of this room full of top military brass, many of whom got on planes to come from the other side of the world for this meeting. Let's listen to the president from earlier.
I've never walked into a room so silent before. This is very, don't laugh, you're not allowed to do that. You know what, just have a good time. And if you want to applaud, you applaud. And if you want to do anything you want, you can do anything you want. And if you don't like what I'm saying, you can leave the room. Of course, there goes your rank, there goes your future. But you just feel nice and loose, okay? Because we're all on the same team.
Well, they didn't applaud until the end. He spoke for 72 minutes, David, and I'm looking at the official pool report here. Forwarded by the White House. The audience rose and offered polite applause, faces still expressionless. What was the impact of this speech?
I think we approached it kind of wondering what was going to happen here, and you can kind of look at that on a spectrum. On one end, there was a fear or a worry, I think, among many veterans of the military that there was going to be some sort of formal oath being offered by the president, swear oath to allegiance to what he wants to do. That didn't happen, and I think, if anything, we saw the president kind of stealing the limelight from Secretary Hegseth, who was initially going to be the only keynote speaker at this event in Quantico. But it is something to hear a speech like that in another venue would have had applause and pauses, would have had reaction from the audience, and you didn't have it there. But you pick up on the key part of this. If there wasn't a formal oath offered or suggested, there was, on the part of the president and the Secretary of Defense or Secretary of War, you pick your term here, this entreaty to either stay with us or leave. You can leave the room if you can leave the room, leave your post if you don't agree with what they're saying here. And I think it'll be interesting to see sort of what effect it has on these leaders going forward and on down the chain, just the way that these two individuals, President Trump and Secretary Hegseth, were talking about the military and the standards in the military, and the way they're going to measure success in the military going forward here. And you bring up that line, which we can laugh at, the fact that Pete Hegseth doesn't want to see overweight generals and admirals in the halls of the Pentagon. It is a lesson here in the way that we talk and they talk about the people in the Pentagon. And I think that's deliberate. I should mention too, the Secretary mentioned a book that he wrote about the warrior ethos as well. So there was an opportunity to kind of flag that while he was on stage too. But not to draw too fine a point on it, this is a speech unlike we've seen in front of an audience that we haven't seen before. And yes, people flew from across the world. They flew from war zones as well. So this was a serious commitment and something unlike we've seen for a very long time, Joe.
I appreciate the way you frame that, because it's important. And I clearly need to start doing my sit-ups every day.
You and me both, brother, I feel.
But there was, it was an interesting moment where the president invoked domestic enemies. Our history is filled with military heroes who took on all enemies, foreign and domestic. He said, you know the phrase. That's what the oath says, foreign and domestic. We also have domestic. George Washington, Abraham Lincoln, Grover Cleveland, and others all used armed forces to keep our domestic order and peace. Looking, of course, to Portland, the most recent point of deployment here for National Guard troops. You wonder what the folks in that room think about that, David. It wasn't National Guard troops he was talking to today, and I think they all understand the idea of posse comitatus. Maybe he'll send some of those folks into American cities. How should we read that?
Yeah, no, I think that's a very shrewd read on those comments from the president. And speaking about immigration, which he's so fond of doing, he said, "It's the enemy from within. We have to handle it before it gets out of control." So even if you're a combatant commander halfway around the world, you're watching what's unfolding here and seeing an approach by this administration to force being deployed against Americans or people in America in a way that it hasn't been for a very long time here. And I think we would all do well to reacquaint ourselves with posse comitatus, including perhaps the president. But you're right. It signals something different here and something quite serious in the trajectory of this administration, how they're using the military and the armed forces. And I don't think that message was lost on a lot of those admirals and generals who are in the audience there today, who no doubt are thinking seriously and thinking about that in the context of America's long history, Joe.
What a treat to spend some time with David Gura. I didn't know we were going to do this when we started the day, David. Thank you for stopping by, as always. I'll meet you in the gym, I guess. We got a good gym here at Bloomberg. Bloomberg correspondent, by the way, host of the Big Take podcast. If you're not subscribed to David, then you're missing out. Find the Big Take podcast right where you find ours, Apple, Spotify, and so on. We're going to get to the Hill, by the way, because this is shutdown day, right? We're here. This is the countdown, and Jack Fitzpatrick is our man on appropriations. He's standing by to bring us the latest ahead of some votes that are expected to fail today. First, we do want to look at Wall Street. Haven't had a chance to check in with Charlie yet, so we go to World Headquarters in New York with Charlie Pellet and the markets. How are we doing, Charlie?
Right now, we are lower across the board. Joe Matthew, all about the shutdown. Indeed, we got you covered here on Bloomberg Radio. Keep it locked in for the very latest. Stocks falling with the government shutdown looking more likely, stoking concerns about how long it'll go on for and what impact the possibly delayed release of key economic data, specifically the jobs report, will have on the Fed's upcoming rate decisions. So right now we have got the S&P 500 index down 4, down 0.1%. The Dow is down 48 now, lower by 0.1%. NASDAQ down 30, a drop there of 0.1%. The 10-year at 4.13%, with the 2-year 3.59%. Gold is down $9 the ounce. Spot gold at $38.42, down 0.2%, and a retreat for West Texas. Intermediate crude down 1%, $62.80 a barrel. Bitcoin right now down 1%, 113,130 on Bitcoin. Pfizer, you heard the announcement live here on Bloomberg. Pfizer has announced plans to lower prescription drug prices. Drug company announcing across-the-board reductions on U.S. prices. Pfizer shares right now, they are trading a little changed. Right now, we have got shares of Pfizer, PFE on the ticker, and Pfizer up by 3.6%. China's state-run iron ore buyer has told major steel makers and traders to temporarily halt purchases of all new BHP Group cargoes, escalating a pricing dispute that risks upending one of the mining giant's most important trading partnerships. Shares of BHP, the ADRs, they're down by 2%. So again, recapping here, we got Pfizer up 3.1%, S&P just about flat on the day. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcast. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Mr. Pellet, thank you. Great to have Charlie back with us today, the voice of Wall Street and the New York subway. As we see the redhead cross the terminal, Charlie was just talking about Pfizer, and I was asking David Gura why the stock is up exactly. They're lowering prices and increasing investment, and I'm not sure how that adds up to bigger profits, but here we go. Pfizer just got a 3-year grace period from pharma tariffs from President Trump, the redhead that every pharmaceutical company probably wishes they had. And if you're with us on YouTube, you've got the split screen there. Albert Bourla, the CEO of Pfizer, just talking following the president, RFK Jr., Dr. Oz, and others. Bourla speaking at the White House event after another one of his lieutenants from Pfizer spoke, committing, check this out, to onshore 100% of the value of drug imports. This is music to this White House's ears. And we're seeing another company now with a domestic investment and an exemption from tariffs get a nice reward on Wall Street. Pfizer shares up 4% now, approaching $25. As we told you, though, just a quick reminder, we were close to $60 in the throes of COVID and Operation Warp Speed. Now, we've got the big countdown happening. It's 12:01 a.m. when Jack Fitzpatrick's clock will go off and we all turn into a pumpkin. There are going to be a couple of votes today in the Senate. They're going to go back around and do this just like we did last week. When they failed, they're going to fail again, is what we're told at least. The clean CR offered by Republicans that passed the House and the Democratic version that has at least failed in the Senate. They're going to take a swing at both of these again to say, hey, at least we tried. Then we'll wake up tomorrow, start talking potentially about government layoffs and exactly how long this thing's going to stay closed. Jack Fitzpatrick specializes in this as our appropriations expert at Bloomberg Government. He covers Congress and is, of course, a dear friend of the program. He'll give us the straight scoop right now, joining us live from Capitol Hill. Jack, I say this to anyone who's been through a lot of these. You've seen this movie before. Is it different this time with Russ Vogt, or are we shutting down tonight?
It looks like we're probably going to shut down. We are looking at 2 likely failed attempts today to avert a shutdown, and one has already happened. Both attempts appeared futile from the outset. First, House Democrats asked for unanimous consent on the House floor to pass their own continuing resolution to avoid a shutdown. They were not recognized. Almost all House Democrats were there yelling, shame, shame, but the House is not in session, so that didn't work. We are expecting a vote, very likely a failed vote in the Senate on the Republican proposal that passed the House but has already failed in the Senate to fund the government through November 21st. So far we're in the predictable part of this, where both sides are making what appear to be futile attempts to pressure the other side to take up their proposal. The question is what happens as the pressure ramps up as we get closer to midnight. And when you mentioned Russell Vogt, there is an aspect of this that is very unusual. The threat to lay off federal workers, not just to furlough them, and remember that they're now guaranteed back pay if they were furloughed. The layoff threat is not part of the usual shutdown process. It's not really part of the law that governs shutdowns. It's more of a threat by Russell Vogt that he has chosen to make. So there's more pressure than usual, more threat to federal workers, and more of a threat to the economy, because if you look back to the last long government shutdown, 2018 into 19, that was a partial shutdown. This would affect all of the government. Everything that's deemed non-essential, not focused on protecting life and property, would shut down. So it could be a very significant one, and it's definitely unusually pressure-packed.
Well, you put that pretty well, Jack, because that does seem to be the case. And we just got a doozy of a release from the CBO, the Congressional Budget Office, predicting 750,000 furloughs during each day of the shutdown. This is something else. OPM, Office of Personnel Management, CBO, estimating that under a lapse in discretionary funding for fiscal year 26, 750,000 employees could be furloughed each day. The total daily cost of their compensation would be roughly $400 million. This is the kind of stuff that Democrats are going to be talking about when they try to blame Republicans, reminding everybody they control both houses. In the White House, the Republican argument, Jack, is we're just asking you to continue a Biden budget that you already voted for. The blame game seems to be different this time as well. Do they both lose?
Usually both sides lose. It's a question of how much both sides lose. And right now, each side thinks the other side stands to lose more. And it is important to keep in mind that straightforward continuing resolution to just avoid a shutdown and not get into healthcare policy, not get into the whole impoundment and rescission fight, that was passed the House. Republicans did manage to get the votes together to pass that. That's the issue that's being filibustered by the Democrats. That's why Republicans think they're winning this argument. Democrats are banking on the threat of increased premiums and the fact that they feel like they can't really negotiate with Russell Vogt in the first place. That's what has driven them to this point. So both sides feel that they have a compelling argument. The question is, if it shuts down, how long does the shutdown go, and who starts to change their mind? Maybe who gets polling showing that they're losing the argument. After a couple days of a shutdown, the dynamics inevitably change, but we don't know how they're going to change if a shutdown does occur.
I'm curious, Jack, if you've heard anything from Hakeem Jeffries, or I guess for that matter, Senator Chuck Schumer, following the post that the president put on Truth Social late last evening. It's one that I can't play, or I guess even show you on the air here, or we'd have to pay a fine or something. But it's an AI-generated deepfake version of Chuck Schumer making very offensive remarks about Democrats and their love for undocumented immigrants. It also includes the image of House Minority Leader Hakeem Jeffries. Both were in the driveway yesterday. They're standing there at the stakeout position in front of the West Wing, mocked up in what is clearly offensive faux Mexican garb, complete with the mustache and the sombrero. I know that Hakeem Jeffries did reply on social media. He wrote, "Bigotry will get you nowhere. Cancel the cuts." Are they saying anything to reporters in person?
Not a ton. I believe he brought it up this morning. I saw his social media reply. Mostly, the Democrats have been quite disciplined on their message that they are focused on health care. This is a fight over health care. Yes, Hakeem Jeffries has responded to that social media post from President Trump. It does remind you that the Democrats know President Trump has a tendency to shoot from the hip and say things that are not terribly strategic when the pressure's on. Last time there was a government shutdown, he preemptively blamed himself for the shutdown on TV. So that may be part of the Democratic strategy, is that Trump is much less disciplined in his approach. There was a response from Jeffries, but mostly I think you're going to hear Democrats just hammering them, saying there are going to be increased premiums if we don't take action on the Affordable Care Act subsidies, and they're really trying to use this as a spotlight on healthcare subsidies.
Jack Fitzpatrick, thank you so much, Jack. The president has just gone to questions at the White House. We want to listen to what he's saying about the shutdown right now. This is live on Bloomberg.
Next week, it sells for $10 in other countries and $137 in the U.S. and that's coming down now to probably $15 or $18. They'll go up to 18. I think that's pretty much right, Albert. It's not you, but they'll go up to 18, and we'll come down from 135 or whatever down to 18. I mean, that's a massive number. Remember, I was the one that held a news conference because I lowered drug prices by 1/4%. I think it was 1/8 of 1%, but it was the only one in 28 years that brought drug prices down for the year. But it was a very small number. Now we're talking about, you're going to see one over 1,000%. Look at these numbers. So, and this has a big impact, even on the discussion that we'll have with Chuck Schumer, who was here yesterday, along with a very nice gentleman who I didn't really know. You know who I'm talking about. The two of them came, and we had a good discussion, and we're going to see what happens. We're going to see what happens, but this has a huge impact on that because these numbers are going to bring Medicaid. We talk about Obamacare. Obamacare is a failure. Obamacare is not good. It's there, but relative to other healthcare programs, it's in the lower 20%. It's not good. And I asked the Democrat representatives, what do you think about coming up with a better healthcare? This actually allows you to do that because the cost of prescription medicine is a big, I guess, a very big, more than 50% the cost of what we're talking about. So we might be able to do something like that. This is one of the biggest news conferences from a medical standpoint that I think has ever been had by any administration. Yeah, please.
Thank you. I'm curious, where are the other companies other than Pfizer? Are you expecting them to come on later?
They're all with us. And I was honored to have Albert be the first. He's done a fantastic job with, as you know, with the COVID. He did a fantastic job with a lot of things. He's a leader, and Pfizer is right at the top. You know, it's there. Eli Lilly has been fantastic also, your friend, my friend. And they're all coming in over the next week. We're making deals with all of them. And I said, if we don't make a deal, then we're going to tariff them an extra 5, 6, 7, 8%, whatever the difference is, and we'll take it that way. So we took away the advantage by the fact that we have tariffs. We took away the advantage that they would have of just saying no, and we couldn't do anything about it. If they do that, what we do is we'd put a tariff on them of an equivalent amount, and we take it that way. And nobody wants to play that game. So they're going to be, they're all going to be good. We didn't have to mention that to Albert. Well, maybe I whispered it to him very slightly, you know. We had to give ourselves a little bit of an advantage. But no, but the tariffs played a big role because they know that's what's going to happen.
You mentioned the tariff, the exemption of the 232s, but can you share a timeline for when we can expect the results of that 232 investigation?
Let Howard answer that question, please.
Sure. So while we're negotiating with these companies, we're going to let them play out and finish these negotiations because they are the most important thing to the American people. So we are standing by, helping, and working with them. But the driver of the 232 outcomes is our HHS team because, I mean, look what they've accomplished today. So we are on their side helping them, but that is the model that's going to drive.
And you have to understand, Albert's spending $70 billion that he wouldn't be spending because of the tariffs, let's say, and other reasons. I think he liked the winner of November 5th, in all fairness, but because of the tariffs. And that wouldn't happen. He's not going to pay any tariffs because when he moves here, there are no tariffs. So he won't be paying tariffs. That's the beauty of it. If you move here, there are no tariffs. And we have over $17 trillion, Albert. Do you believe these numbers? So Biden had less than $1 trillion for 4 years. We have over $17 trillion for essentially 8 months. Pretty amazing.
When will prices come down, Mr. President? When can
Immediately.
America?
They're going to start coming down. Drug prices? Well, they'll be starting immediately. Yeah.
Mr. President, can you speak to what impact you think this reduction in drug prices will have on midterms coming up?
I think it's going to have a huge. I said, if we can pull this off before midterms, I've wanted to do it from the beginning, from my first day in first term. And we were doing so well. We had the greatest economy we've ever had. Everything was good. And then we're ready to do this, which is complex and big. It's a big change. But what happened is COVID came, and we focused on COVID. We focused on COVID very hard with Albert, with the other companies, with everybody. Regeneron was a great thing. You know, we did a lot of therapeutics that were fantastic. And so we focused on that. And I said, if I pull this off again, the first thing I'm going to do, and you know, we've been working on this for 8 months. This is a very big deal. This is a big shock to the system. But it's not as much as I said. They're going to go up. The world is going to go up a little bit. We're going to come down a lot. But now it's fair. We're going to be paying the same thing. Yeah.
President Trump, in your first term, when you cut the price of insulin, Biden later came in and tried to steal credit for that. Do you worry that the Democrats are going to try to steal credit for these historic cuts?
I really appreciate your question, because I did. I cut the price of insulin down to $35. And the problem is with many of these things, in this case it's going to be pretty quick, but oftentimes you'll do something medically because of the process, and it won't be seen for 2 or 3 years. That happened also with, I could say 4 different things, but just if you talk about insulin, so it was 200, 300, 500, and you couldn't get it, and I got it down to 35. And I said, I hope I win the next election, because otherwise whoever wins is going to take credit for it. Well, what happened is we did win the election. We did great. But unfortunately, it didn't work out that way from a practical standpoint. And Biden, when I saw him get up and take credit for the $35 and even less insulin, that was 1,000% lower than what it was just previous. Boy, I tell you, I didn't like it. I didn't like it. So I did the best I could to let him know we did it, because we want to be given credit. But we are the ones that got insulin down to that number. And you're right, they tried to take credit for it. They had nothing to do. In fact, they didn't even know what happened. All of a sudden, the insulin price kicked in at $35. And they asked Biden about it. He had no idea what the hell they were talking about. But after they explained, and they didn't really explain to him because he was not capable really of understanding it. But when they went out and talked about it, they acted like it was a great feat by Biden. It had nothing to do with him. And it continues, and we'll get it down even further. But insulin was, people weren't taking it, I would imagine. They couldn't take it. God bless you, Bobby. I hope I didn't catch COVID just there. Don't you have Paxlovid? What is it? Paxlovid. He's got Paxlovid. give me a Paxlovid immediately.
While Nancy Pelosi is ignoring what you're doing for the American people, she's going after your administration for cutting taxpayer-funded healthcare for illegal aliens. Last night, Nancy Pelosi, she went on NBC last night, dropped a bunch of F-bombs, told Republicans to go F themselves. Has she lost her mind?
We have done an unbelievable job medically. Just this, if you did nothing else, we've done a lot, like the insulin. But just this, nobody can ever catch this. This is the biggest price reduction times, maybe 10 times, 15 times, that has ever been given before. And this is going to have a huge impact. You know, as I said, Obamacare is not a good thing. It's been bad. And I'd like to make it better. I told them, I spoke to a lot of people, a lot of Democrats recently. I said, why don't we change it? We can make Obamacare much better. We could come up with a new system that would be much better, less expensive for the people and better. This is maybe the biggest breakthrough, because, you know, when you're talking about the prescription drugs, that's a big part of it. So we're going to look. This is prescription, but we're going to be looking at that. We could come up and through this whole thing, you know, because I don't know, we'll probably have a shutdown, because one of the things they want to do is they want to give incredible Medicare, the Cadillac Medicare, to illegal immigrants. And what that does is it keeps them coming into our country, and like they do in California. And no country can afford that. No country. And we have the border stopped up. We have it closed. We have nobody for 4 months. Zero people came in. That wasn't me. That's by the authorities, who happen to be liberally oriented. But just think of that. We have people offering health care to people all over the world that they can't afford to pay. And that's the Democrats. And what that does is it brings people into the country because they want to come in for the health care. But no country can afford it, and they can't afford it. So we cannot allow them to charge tremendous amounts of money for health care for people that aren't even citizens. And in many cases, they come in from prisons, jails, and mental institutions. And we can't let that happen. So we have a big fight over that. We have a fight over open borders. They still want open borders. We're having a fight over men and women's sports, if you believe it. You would have thought they would have learned that it's not a good issue. And we have a fight in transgender, as you know, transgender for everybody. And that, when you talk medically, that's a lot of money too. That's a lot. Those operations are bad. So those things are also being discussed right now. I mean, can you imagine we're actually talking about open borders, and we now have a great border, and we have a great country. Our country was dead 1 year ago. Now we have the hottest country anywhere in the world. Big difference. Yeah.
What does it say about the state of the Democrat Party when they have a 33% favorability rating on average in recent months, and they're willing to shut down the government over health care?
They are shutting it down. We're not shutting it down. We don't want it to shut down because we have the greatest period of time ever. I told you, we have $17 trillion being invested, so the last person that wants it shut down is us. Now, with that being said, we can do things during the shutdown that are irreversible, that are bad for them and irreversible by them, like cutting vast numbers of people out, cutting things that they like, cutting programs that they like. And you all know Russell Vought. He's become very popular recently because he can trim the budget to a level that you couldn't do any other way. So they're taking a risk by having a shutdown because of the shutdown, we can do things medically and other ways, including benefits. We can cut large numbers of people out. We don't want to do that, but we don't want fraud, waste, and abuse. And, we're cutting that. But they want to have illegal aliens come into our country and get massive health care at the cost to everybody else, and we don't have it. And that's I would say, the number one reason that they want to strike is to get illegal immigrants health care. And, Gavin Newsom wants that, too, in California, and it's destroying California. We can't have that. We're not going to let it happen.
Do you have a plan for dealing with drug companies that are responding to MFN only by raising prices overseas as opposed to lowering prices in the U.S.?
No, they're responding. I understand that question very well, but they're responding by lowering prices. They're helped by lowering prices. There's a price at which they can't sell, and they're helped by lowering prices. In the case of Albert and in the case of Eli Lilly, the fact is our prices are coming down massively. You see, that's just a few of the basics, but they're coming down much more than that with many drugs, and over 1,000%. Think of that, over 1,000% reduction. And we'll show you that next week because we have some of them on the board next week where you have over 1,000% price reduction. No, what's going to happen is you're going to have the market will kick in. This way, the market kicks in. The other way, it was just basically, it was just a form of control. You were stifling the market. Yeah.
At this point, is a shutdown inevitable? And how would you describe the negotiations with Democrats yesterday? Are more meetings scheduled?
So nothing is inevitable, but I would say it's probably likely because they want to give health care to illegal immigrants, which will destroy health care for everybody else in our country. And I didn't see them bend even a little bit when I said we can't do that. Okay?
Can I ask a question of Dr. Oz, Administrator Oz? If there is no deal reached on the Obamacare subsidies with the Democrats, is there anything that CMS can do to lower those, to mitigate the increases of those Obamacare subsidies?
Not really, but we have time. We have time till the end of the year to make the changes I know the president is evaluating, but we should have a clean, continuing resolution, get past this budget process as it has happened so many times, and allow the president and leadership some freedom to be able to put some good ideas in front of the legislative bodies.
Undocumented immigrants.
We actually do have time for that.
They're not eligible for the health care subsidies that Democrats are demanding. So can you clarify, what are you talking about when you say Democrats want to protect their health care?
So when an illegal person comes in, a person who came into our country illegally, therefore breaking the law, and look, we all have big hearts. I have a bigger heart than you do. They're all breaking the law, and they're coming into our country. And we just, as a country, cannot afford to take care of millions of people who have broken the law coming in. We want them to come into our country, but we want them to come in legally. Now we have a strong border, very strong border, thanks to Christie and Tom Homan and the whole group. They've done an amazing job at the border. I mean, we had a border that was reckless. We had a border that was a disaster. They were coming in by the millions. I say 25 million people. You're saying less, but I say 25 million people came in illegally. And no system can take care of the health care of all of those people that came. And now a lot of them have gone out. We have over 11,000 murderers. We got many of them out. Many of those people have been taken out of the country, brought back to where they came from. In some cases, put in prison because they're so dangerous. We don't want to take them out. We have to watch them. We don't want them coming back. But if you look at what's happened in Washington, D.C. right now, it is such a pleasure. I just drove through it, and it's clean and nice and beautiful. And people are walking around, and they're not afraid of being mugged. We haven't had murders. We haven't had anything happen in a long time. It took us 12 days to make it very good. It took us 20 days to make it beautiful. And now we're going to Memphis. But I think we should always keep a presence here, because if we don't keep a presence, it's going to come back never like it was, because we got rid of 1,700 career criminals. You know what that is? One career criminal can give you a lousy reputation for danger, because they commit many crimes a day in some cases. But Washington, D.C. is an unbelievable example of what can happen. And now we're going, as you know, to Memphis, which was very similar to Washington, very dangerous. And we're there, and we're working along very well with the governor, the mayor. A lot of these Democrat mayors, you know, what they don't want to have us do well, because if we do well, it makes them look bad, and they shouldn't feel that way. If I were a Democrat and I was a governor or mayor, I'd be calling Trump. I'd say, get your troops over here, just help, because the mayor of Washington is getting a lot of credit for what we did, you know, a lot of credit. But the beauty is, isn't it nice, seriously, you walk down the street, you're not going to be mugged, you're not going to be hit. We had a meeting about 3-4 months ago, and I was saying to the media, how many of you people have been threatened or mugged or accosted during your walk to the White House? And they said, we don't walk to the White House anymore. But the answer was, remember, Brian, almost everybody's, look at this guy. They even attacked this big, strong guy, right? Didn't you get attacked? Did you? But, yeah, just take a look at the other guy, right? What happened to the other guy? I don't know. Those other guys are pretty tough. They're tough with a gun in their hand, right? And, yeah, you were hit pretty hard. But almost everybody was. And now, nobody. Anybody been accosted in the last 3 weeks? If I would have said that 6 months ago, half the hands would have been raised out. No, we have a very safe city now. The country's going to be safe. We're doing one at a time, and we'll be going to Chicago. I told you this, sir. Union Pacific, head of the railroad. He knows this country very well. Started off as a very low-rung employee of the Union Pacific. He's now chairman. He came to me and he said, sir, save Chicago. It's a great city. It's going down fast. They had 11 people killed over the last couple of weeks. 11 people killed. 48 shot. That's not a city. That's a war zone. There's no city in the world like that. And then we have to listen to this Pritzker get up. I know him well. They threw him out of his business, and the family threw him out of the business because he's a loser. But we have to listen to Pritzker get up. He should call me and say, get the troops in. You ever hear that? 11 people over a week and a half killed. And I think it's 48, when you add it up, 48 people shot. And then I have to listen to a governor say how nice it is. It's a wonderful experience. Now, what is a wonderful experience is D.C. People are eating in the restaurants. They just opened 2 new restaurants, which hasn't worked in years. And we had it pretty good 4 years ago. We were just getting ready to do this, but we did it right. And, you know, we have a big victory in the Supreme Court. It's called merit. And so that includes the military. Our soldiers, did you see what they look like? These guys, they look like serious soldiers. They weren't playing games, and they went in there and they did a fantastic job. And Washington, D.C. is now a beautiful, safe city. The restaurants are thriving. The people are walking down the street holding their husband or their boyfriend's hand, and they're not worried about being raped or mugged or shot at. And it's been an amazing thing. And we'll do that in every city. We'll do them sort of one at a time. We'll do a couple at a time. And we have a tremendous force because, as you know, in recruitment numbers, when we put out, 2 years ago, when Biden would put out recruitment, nobody would join. Nobody wanted to be in the military. Nobody wanted to be police. It was just announced this morning. You probably saw my speech over with the military, with the generals, admirals. Record numbers of people signing up for the Navy, the Army, Air Force, Marines, Coast Guard, Space Force. I love Space Force. That was my baby. But we have record numbers of people signing up, and that includes police department, fire department. So, you know, it's been an amazing thing. Well, we're going to have another meeting next week on this. We have another great company coming in, similar kind of numbers. but we're going to show you some 1,000% drops in prices. There has never been anything like this in the history of medicine, and it's an honor. And Albert, I want to thank you, and I want to thank everybody behind me, because you are a great team. We have a great team. Everybody says you have a great cabinet. It's a great team. So thank you, Bobby. Thank you very much. Thank you, everybody.
There you have it. President Trump and company in the Oval Office, and now the press being ushered out by the press wranglers. It's great to have you with us here on Balance of Power. That fit neatly into our first hour, although it started very late. President Trump standing side by side with RFK Jr., Dr. Oz, and Albert Bourla, the head of Pfizer, along with some others from the company there, to roll out this favored nation pricing status, if you will, when it comes to drugs. The president talking about across-the-board price declines in Pfizer's medications, suggesting that we'll see drug prices drop by 1,000% and maybe more. We're going to assemble our panel for some quick reaction to this. With me here in Washington is Bloomberg Politics contributor, Republican strategist, partner at Stone Court Capital, Rick Davis, and Jeannie Shanzano is with us from New York. Of course, Jeannie, a Bloomberg Politics contributor as well, and democracy visiting fellow at Harvard Kennedy School's Ash Center. It's great to have both of you with us. Rick, I'm having trouble with the math. How does a price drop by 1,000%? That would imply that they'd be paying us to take the drugs, wouldn't it?
Yeah, look, I mean, this is the classic Trump. I'm going to exaggerate a little bit to make a point here. I mean, he has been fighting to drop drug prices both in his first term, and today's a great example of what he's trying to do by cherry-picking Pfizer and getting a deal with them. But at the end of the day, the public's going to have to really see that happen, right? Like, let's see the drug prices go down. The insulin prices he talked about never really came down to the levels that he was discussing. Certainly not 1,000%. Maybe they'd be paying you to take insulin. I mean, it's like, not sure what that was all about. But at the end of the day, this is also a good distraction from really the news of the day, which is we're 12 hours away from a government shutdown. And barely a peep in that long oratory of his to announce this about that, other than to just echo Russ Vought's plan. I wouldn't call it a threat. It's a plan to fire a lot of government employees if the government goes short of cash. So to me, it's a one-off for today. But you really got to wonder, scratching your head, what are we doing today to try and avert a government shutdown? Because it sure didn't look like there was much happening in the Oval Office around that.
Well, that's true. He was asked, Jeannie, if it was inevitable. He said nothing's inevitable, though he expects the government to shut down. I'm watching Pfizer shares were above $25 here for the first time in a minute, up 5%. So somebody's paying attention. Jeannie, I'm wondering what you think of the timing here, because anyone shows up at in the Oval Office, if you're a CEO with Donald Trump, your stock is probably going to be rewarded. Was the point of this to obscure the conversation about a shutdown?
Listen, we do need to lower drug prices. There's no question there. The second thing is, this is great PR for Pfizer. The problem is, it's not really good for consumers. Most experts say these direct-to-consumer sales, patients pay out of pocket, not through their insurance company. And he's doing this on top of these tariffs of about 100% on drugs. So potentially, if he addressed his tariff fascination, it may help consumers a lot more than this, which primarily is, again, really good PR for Pfizer, but isn't going to do much for consumers in the end at all.
Well, Bourla got a lot for it, Rick. A 3-year grace period from Trump pharma tariffs. That's enough reason to show up alone, isn't it?
Yeah, I totally agree with Jeannie. If you get an invitation to the Oval Office, come prepared to give and ultimately receive. And so Christmas is early for Pfizer this year. At the end of the day, though, it does conceal the real threat to consumers, and that is the 100% tariffs on drugs manufactured outside the United States. That's going to have a widespread effect. And the insurance companies aren't going to do much about it. I was surprised there wasn't much discussion of Trump RX, the direct-to-consumer label that Donald Trump and the government have launched to try and help support this drug price. Normally, that would be the centerpiece of anything the president would discuss if it had his name on it.
So, Jeannie, the shutdown is upon us. We're, less than 12 hours out here. Is there a late save in our remaining moment, or is this inevitable, as the president was asked?
It's hard to imagine a late save with the House out. So I can't imagine there is a late save, and the president seems prepared to go forward with the shutdown. And you heard there in that discussion on pharmaceuticals, we've heard it throughout the day, the continual lie by many Republicans that the Democrats want to fund health care for illegal immigrants, including transgender surgeries for people in Guatemala. I mean, the list goes on and on. It is nonsense. I am not in favor of this shutdown, but the lying, to Chuck Schumer's point on the Senate floor today, is utterly deplorable. And the president's video last night was racist and the cream of the crop in terms of this lie.
Yeah, that was a new level with the AI video last evening, Jeannie. We're going to talk to Congressman Mike Lawler from New York. The Republican will weigh in on this just hours away from the shutdown. Rick Davis and Jeannie Shanzano will stay with us as we welcome our global television audience to the conversation. Tyler Kendall's coming in too, so keep it right where you have it, only here on Bloomberg.
from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Less than 12 hours to go. Welcome to the Tuesday edition as the government careens toward an expected shutdown once the clock strikes midnight, but only after several votes take place this afternoon. I'm Joe Matthew alongside Tyler Kendall in Washington. We thank you for being with us here on the Tuesday edition of Balance of Power. The president, Tyler, says nothing is inevitable. He was just asked in the Oval Office, but it's pretty hard to imagine a way out of this with the House not being in session.
Right, exactly. President Trump saying himself that the government will probably shut down. We'll see how these last-minute negotiations end up going. If the government does shut down, it will be the first time since December of 2018 when we saw, actually, Joe, the longest shutdown. And that was under the first Trump administration.
That's right. That was the record, so we'll have something to compare this to. There are a lot of questions, as Tyler, as we've spoken on the program, about what happens once it's closed. How do you reopen it? What would be the motivator for Democrats in this case? We're going to talk about this, get the latest from Laura Davison, our Deputy Bureau Chief, and then we'll have a conversation with Congressman Mike Lawler, the Republican from New York, also watching the clock here. Having already passed, we should note, a clean CR that Republicans authored. It did not pass the Senate, nor did the Democratic version that came out shortly thereafter. So we are looking potentially at a shutdown just after midnight.
Right, and importantly also, that clean CR would only fund the government until November 21st. So
That's
again, we are still continuing this conversation about kicking the can down the road. Also worth mentioning that, of course, we're watching for the economic impacts here. Our analysts at Bloomberg Economics say that this shutdown in particular is raising the stakes on those impacts.
Well, and imagine, we might not see our jobs report on Friday. I'm actually deeply curious to see what Congressman Lawler, who's on financial services, thinks about that. So we'll get to it all coming up after a look at Wall Street. Let's get a quick check on the markets here. Charlie Pellet is at World Headquarters in New York. Charlie?
Hi, thank you very much. Quick check indeed. Also keeping a watch on the Dow, the S&P, and NASDAQ, because we have got hours to go, 3 until we wrap up the trading month of September, then on to October. Here's where we stand. S&P right now down 8, drop there of 0.1%. We've got the Dow down 114, down 0.2. NASDAQ right now down 0.2. 10-year at 4.12%, ahead of a shutdown. We've got gold, spot gold up $13 the ounce, 38.47 right now, up by about 0.3%. West Texas Intermediate crude down 1.1%, 62.72 a barrel. On a down day for the equity market, we do have drug stocks advancing. Pfizer, case in point, up 4.6% right now. Lilly up 2.6%. Merck up by 4.8%. You heard the announcement here on Bloomberg from the White House. Pfizer will sell some drugs at a 50% average discount on a direct-to-consumer website called Trump RX. Recapping, S&P down 0.1%. Balance of Power continues right now. And back we go to Washington. Once again, your hosts, Tyler Kendall and Joe Matthew.
All right, Charlie, many thanks. Live at World Headquarters in New York. Charlie will have more on the markets coming up in just about 20 minutes' time. As we follow the beat here in Washington, thanks for joining here on the Tuesday edition alongside Tyler Kendall. In for Kaylee Lines, I'm Joe Matthew. We don't want to waste time. We want to get right to the congressman. Mike Lawler is with us now. Of course, the Republican from New York 17th. We spent a lot of time talking about everything from SALT to, yes, government funding. And here we are again, Congressman. Thank you for joining us on Bloomberg TV and radio. The conventional wisdom is we shut down after midnight, and I'm assuming you don't see a way around it. What comes after the shutdown?
Well, unfortunately, it looks like we are barreling towards a shutdown because Democrats like Hakeem Jeffries and Chuck Schumer have changed their position entirely on keeping the government funded and passing clean CRs. Whether it was Joe Biden or Donald Trump, I have voted for every single CR to keep the government open and funded while we negotiate a final appropriations package. I think it is foolish to shut down the government. It is going to create chaos in the markets. It will create chaos for the American people, especially those who rely on the social safety net, border security, our military, veterans benefits, etc. This is entirely unnecessary and does nothing to actually further the work of the American people. It is pure political posturing by my Democratic colleagues because they are not in the majority. And from my vantage point, that is not what you do. I was against it when Republicans wanted to shut down the government. and I'm against it here when Democrats want to do it. So we will see what happens over these 12 hours. As you pointed out, Republicans passed a clean CR through the House. The bill is sitting in the Senate at the desk. It can easily be taken back up right now and passed. And Chuck Schumer refuses to do that, despite his many pronouncements in years past about the need to pass clean CRs and not pound your fists and stomp your feet when you don't get your way.
So, Congressman, I hear you on the future of a potential clean CR, but do you see any room for negotiations here when it does come to those expiring Obamacare tax credits? We did hear from House Speaker Mike Johnson in an interview this morning saying that there might be some negotiating room, but that would have to happen after a funding bill is passed, since the tax credits are going to expire by the end of the year.
Correct. And I am one of several Republican members who have signed on to legislation to extend the ACA subsidies for a year. Remember, these were put in place during COVID to try and help those who were losing their jobs or unemployed because the government was forcing businesses to shut down. We don't want people to be unduly hurt, obviously, by healthcare premium increases. But to try and shut the government down while negotiating some of these issues is foolish. We can easily keep the government funded through November 21st, finalize all appropriations for fiscal year 26, and come to an agreement on these ACA subsidies for the next year or two. There's no reason to shut the government down in the middle of those negotiations.
You wonder what would happen if Mike Johnson said exactly what you just said, although maybe there's so little trust it doesn't matter right now, Congressman. But what should come of these after? We've been talking about these extensions for some time now. Everybody's become an expert on this, or so they think. If this was a COVID-era policy, should it be extended forever, as Democrats suggest? You just pointed out a year. Should they come down? Should there be a gradual phasing out? What's the long term on this?
Well, I think, again, this is a negotiation and a discussion to be had. I think many Republicans would like to see an income limit, on these subsidies. Again, these were put in place during COVID. I think there's a larger point, though, which is if the Affordable Care Act was supposed to reduce health care premiums, was supposed to increase access, why is it not working as intended 15 years later, so much so that you need these subsidies to help people? Obviously, there's a broader issue with health insurance cost in this country, and I think that is something that Republicans and Democrats should work on together to focus on how we reduce overall costs. You saw the president today with the announcement with respect to Pfizer and certain prescription drugs and being able to purchase them at a much lower rate. That's important. When you look at the challenges facing the U.S. and Europe, part of the problem with prescription drug costs in America is that Americans are subsidizing Europeans with the price controls that have long been put in place on prescription drugs in Europe. So that is something that we should all embrace, reducing overall cost. But that's not something that you shut the government down over and really harm the very people that you're trying to help.
Well, sticking with this idea that higher drug costs are a political point on both sides of the aisle, I also want to ask you about some of the economic impacts here of a potential shutdown. You said, of course, on House Fin Services, our analysts at Bloomberg Economics estimate that the unemployment rate could reach 4.7% in a shutdown. I'm wondering, are the optics going to be difficult to navigate here, considering there's already concerns about the labor market? How are Republicans going to message around this when we know that economic impacts could really be one of those top concerns and priorities?
Well, we've seen in shutdowns prior, for instance, the stock market has generally grown. The biggest concern has been on GDP. We saw for Q2 revision a 3.8% growth in GDP, which far exceeded what many prognosticators were claiming was going to happen in Q2. So, certainly the economy is moving in the right direction. We got the tax package across the finish line. That was critical for tax certainty. We don't need a government shutdown to create unnecessary chaos as we are working to enact critical policies that move the economy in the right direction, that create jobs, that create wealth and opportunity. And so, look, unemployment obviously is a critical issue. We don't want to see layoffs. We don't want to see uncertainty in the market. Democrats have said for years, Chuck Schumer, Hakeem Jeffries, long on record about the impacts of a government shutdown and the need for a clean CR. They should look in the mirror, listen to their words of years past, including just last year with Joe Biden at the helm, and vote the right way, which is to pass a clean CR and keep the government funded while we work through all these other issues of concern.
What's your view on the Fed, Congressman, as you sit on the Financial Services Committee? To Tyler's point, if this affects the release of the jobs report, for instance, on Friday, if BLS can't kick out the jobs data, at what point does that become a problem for the Fed to make an accurate decision, say, by the next meeting, when it doesn't have a complete picture of the data? Is this something you're worried about, or you think government will be back open in time?
Well, again, these are all the concerns and considerations that go into a government shutdown, and why I fundamentally believe, regardless of which party is in power, shutting the government down is stupid. It doesn't serve a purpose but for a political one. And in this instance, Democrats are trying to use this for a political purpose, and that is wrong. It was wrong when Republicans wanted to do it in years past. It is wrong now. When you talk about the Fed, look, fundamentally, I believe the Fed has been late to the game, both when they needed to raise interest rates in the past, and now in terms of reducing interest rates. I think they need to cut interest rates far greater than they have. Obviously, having all of the data and information is important, but I think all of us recognize the need for them to cut rates. So whether or not they have that data, they need to act on the reality of the situation. Jerome Powell needs to advance rate cuts in a serious way so that we can continue to move this economy in the right direction.
Well, we heard from President Trump this morning saying that there could be, quote, a lot, in his words, of firings amid this shutdown. We know the OMB was circulating this memo threatening permanent layoffs. Do you agree with this as what seems to be emerging as a negotiating tactic between the White House and Democrats on the Hill?
Look, I said earlier in the week when that memo came out that I don't agree with permanent layoffs, but this is the challenge when you have a shutdown. The executive will make determinations as to who's essential, who is not, restructuring of departments and agencies based on a lack of funding. And I think if Democrats are so concerned about what they see as excessive executive overreach, then they shouldn't be playing games here. Pass the clean CR and keep the government funded, and then we don't even have to have that discussion. But unfortunately, they are playing games here and changing their previous position. Every single House Democrat, but for one, Jared Golden of Maine, every single House Democrat either didn't vote or voted no on keeping the government funded almost 2 weeks ago.
Do you take the White House quickly, Congressman, at their word when it comes to the layoffs?
Look, I don't think they're kidding around. If they intend to do that, they've made that clear. And again, why play with fire here? There's a very easy way to solve all this. Pass a clean CR and let's keep doing the work of the American people. Negotiate a final appropriations deal. What they should be asking for is a top-line number from OMB so that we can finalize the appropriations for fiscal year 26. That's what they should be asking for instead of trying to play political games here.
All right. Republican Congressman Mike Lawler of New York, thank you so much for joining us here on Bloomberg Television and Radio today. And for more analysis, we're lucky to say we're joined now by our Washington Deputy Bureau Chief Laura Davison. She's here with us in our D.C. studio. So, Laura, we've been talking a lot about the politics of this shutdown fight, but I'm wondering if you could just take us through the procedure. What are we actually going to see as we get closer to this vote tonight and that 12:01 Eastern deadline.
So we have two parallel processes playing out. One, what's happening on Capitol Hill, which is right now a lot of talking at each other, not talking to each other. There will be more press conferences later this afternoon, and as the hours tick on to midnight, we will see another vote on a CR. It is likely that that will fail, and then it will hit midnight, and the government will shut down. At the agency side, they are busy scurrying around, going through all of their shutdown procedures. Right about now, about a half day before the shutdown's set to go into effect, they are basically each employee is figuring out, what work will get stopped for an undetermined amount of time, what work will continue. They have to sign paperwork. So the roads in Washington were very busy this morning, as every single federal employee was going to their office to get everything all set up.
That's why I was sitting in traffic. That's good to know. So we get another vote on the Republican CR. Democrat version gets a vote as well. We're going to have a couple of votes to codify this before the day is over.
Yes, there will be these dueling CRs. Again, likely that these will fail. And it's also possible in the next couple of days, we're hearing Republicans say that they're not going to engage in bipartisan talks if there's a shutdown. They're instead just going to bring up this Republican CR every day and force Democrats to vote it down.
That's a new angle, right? So we'll vote every day on the thing we know is going to fail.
That's what they're saying. I mean,
Wow.
it's sort of a tactic. It's a hardball tactic to get Democrats to try to cave on this. Democrats say that that's not what they're doing. We heard Chuck Schumer say, "Look, we're not going to be bullied into this." The question is, when it's 2, 3, 4 weeks out, who's the first one to blink?
Well, we also had reporting that Schumer was potentially floating an even shorter stopgap measure, 7 to 10 days. But then yesterday he came back from the White House, and it appears that they're now abandoning that idea. Is there any sort of discussion happening right now about maybe a small extension just so that they can keep negotiations going?
That is sort of the one escape hatch they have in their hand. If they want to do that, they can get that through the Senate quickly and then have the House essentially approve it even when the members aren't here. The problem is that no one seems to want to sort of offer that up yet. They also, when you do these short, very short term continuing resolutions, just a couple days, you generally know that you are on path to have a deal at the end of that period of time, and you're operating good faith. Right now, there is no good faith, and it's all bad blood in between the two parties.
Boy, the question becomes then, what do you do once it's closed? How do you reopen it? You're talking about some show votes here. But a great concern, in some cases expressed on the air to us by Democrats, is we can't let this close unless we have a plan to reopen it. It doesn't look like they have one, Laura.
The Democrats don't. They don't really have a good escape hatch here.
So you could have another record length close.
Very, very well, so. We had, last night, Lindsey Graham, a Republican, was speculating that Democrats would cave in a few days. We'll see where that lands. The issue really is a short-term shutdown isn't that damaging. People will get back pay. The workers who are furloughed, CBO just came out with a report saying 750,000 workers. It's roughly about a third to 40% of the federal workforce will be sent home, but about 60% will have to continue working without pay.
Okay.
But it's when those workers have gone 1 or 2 paycheck cycles without a paycheck that people really start to feel the heat and the pressure. That's what we saw in 2018 when there was that 34-day shutdown.
Right.
Right. I also believe our analysts at Bloomberg Economics say that if this is resolved by mid-November, we're not going to see any impact when it comes to fourth quarter GDP. But ultimately, if this extends beyond, then the stakes get higher and higher. Of course, at the center of this, as we've been discussing, is the future of those Obamacare tax credits. I'm just wondering, from what you're hearing, is there actually room to negotiate on that, whether it's now or down the line, since we know we're up against a pretty hard deadline, which is the end of the year?
That does seem to be the area where there is some room to negotiate. Trump suggested that via Vance last night at the White House.
Great to have you by. And great to have Congressman Lawler with us. Laura Davison, our Deputy Bureau Chief here in Washington, helping us understand the stakes and the timetable. We're counting down to 12:01, and it looks like there will be a shutdown. Stay with us for more. We'll assemble our panel next, only here on Bloomberg TV and radio.
1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are lower at the end of a month, marred by shutdown woes. We have got just over 2.5 hours to go until we wrap up the trading month of September, then on to October. Right now, we are looking at a down day, a lot of red, with the S&P down 14, 66.46, where we stand now, down by about 0.2%. The Dow down 151, down 0.3%. NASDAQ Composite Index down 76. For NASDAQ, also a drop of 0.3%. Our Mag 7 Index down 0.6%, with a 10-year currently yielding 4.12%, with a 2-year 3.59%. Gold up 0.4%, 38.48 the ounce on the precious metal. West Texas Intermediate crude down 1.3% right now at 62.59 a barrel. Pfizer and other drug companies are spiking after President Trump announced a drug pricing deal with the company. You heard the announcement here on Bloomberg. Pfizer shares up now by 5.1%. Rival Lilly also higher. Lilly up by 3.6%, and Merck right now up by 5.2%. EchoStar shares are jumping as the satellite TV company engages in talks to sell some of its wireless spectrum to Verizon Communications. Shares of EchoStar, which uses the ticker SATS, S-A-T-S, up 2.2%. Verizon up by 1.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your hosts. Here they are, Tyler Kendall and Joe Matthew.
Okay, Charlie Pellet, many thanks. We'll have more from Charlie in about 20 minutes. Watching Wall Street for us here on the Tuesday edition of Balance of Power on Bloomberg TV and radio. Thanks for spending part of your day with us as we count down to a possible government shutdown. It's a story we're talking about all day, and we're going to have special coverage live from the Senate on the late edition of Balance of Power. I hope you'll join us at 5 p.m. as we talk to the lawmakers who will be voting on this legislation, likely to shut the government down before this day is out. Our eyes this morning were not on Capitol Hill, but on Quantico, as the Secretary of War, as President Trump now calls Pete Hegseth, joined the Commander-in-Chief at Quantico to deliver what was framed as a pep talk, one focused on esprit de corps and the warrior's ethos, as Hegseth likes to call it. He opened by saying FAFO, a warning to our adversaries, and spoke to the people who work in the building as he assembled a room full of top brass that flew from around the world to be at Quantico for this moment. Here's Pete Hegseth.
For too long, we've promoted too many uniformed leaders for the wrong reasons, based on their race, based on gender quotas, based on historic so-called firsts. We became the woke department, but not anymore. An entire generation of generals and admirals were told that they must parrot the insane fallacy that, quote, our diversity is our strength. Of course, we know our unity is our strength.
From this morning in Virginia, we want to assemble our panel for more on this. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is a Republican strategist, partner at Stone Court Capital, and Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. It's great to have you both here. Rick, I'm going to start with you based on your history working with the military, not only in your time with Senator John McCain, but since then through the McCain Institute. You spent a lot of time preparing nominees for their confirmations, and I know that you have worked with members of the Pentagon on any number of issues, including procurement. We've never really seen a speech like this, at least publicly shown, right? There were cameras there. You've got a couple of hundred officers in the room. It almost looked like a TED Talk with Pete Hegseth standing in front of the American flag. Was that message delivered? Were the gray hairs rolling their eyes? What did you make of the speech this morning?
Yeah, I was a little surprised. When they prepped for this speech, they told us, I talked to a number of the people who were going to be in the room.
Yeah.
And they said, it's probably articulating a strategy around this new Western Hemisphere concept they have about homeland defense, maybe roll out a little of the Golden Dome concept. I mean, things that actually would have been instructive for a group of general staff members, generals and admirals from all over the world. Instead, they got a hygiene lesson, right? I mean, and I'm sure they're all scratching their head going, I cannot believe I flew halfway around the world if you're, in a China billet, to show up in a conference room and basically see a performance by the Secretary of War. Really not much to it that they didn't already know. Right. He went through all these directives that he's setting out, most of which are already in the manuals of discipline and behavior. So I'm sure a lot of these guys are going to be disappointed that there wasn't something of substance that was actually discussed for this big a moment where it's so unusual to have all of them called together basically for a performance.
Well, Jeannie, given what Rick is outlining here, can you put into context for us just how unprecedented this meeting was, both in size but also in scope, as we heard both Pete Hegseth but also President Trump take the stage earlier today?
Yeah, I mean, incredibly unprecedented. There was an X post out not that long ago to which the Secretary of War responded, talking about the fact that this never happens. And so it's almost, Tyler, like a setup for like the Daily Show, because you're wondering, my gosh, they're calling in all of these people, these generals, these admirals. This is going to be big. Tyler, I tuned in, and to Rick's point, it was about like losing weight, cutting your beard or shaving it off completely, and this kind of nonsense. And then of course the reality is he talked an awful lot with a litany of his culture war comments that he likes to make. He even found time to plug his own book. And of course he talked an awful lot about things like, we're going to return to a time when we're all going to be judged by the standards of men. Well, that time never passed. Women in the military are always judged by the same standards as men. And by the way, Secretary of War, this is a new world. The Defense Department itself is saying the biggest threats we faced are cyber, drones, satellites, space. This is not back in the mid-20th century. So all of it was confounding, and none of it seemed worth dragging all these people in to listen to a talk about a new focus on the military warrior ethos.
That's why it was curious to hear President Trump, who spoke after Hegseth, float the idea of manufacturing battleships again, putting them into service, and reminiscing about how much he loved the movie Victory at Sea. Let's hear from President Trump at Quantico from earlier.
I've never walked into a room so silent before. This is very, don't laugh, you're not allowed to do that. You know what, just have a good time. And if you want to applaud, you applaud. And if you want to do anything you want, you can do anything you want. And if you don't like what I'm saying, you can leave the room. Of course, there goes your rank, there goes your future. But you just feel nice and loose, okay? Because we're all on the same team.
Nobody was nice and loose in that room. In fact, we saw a lot of expressionless faces when they left. Rick, I know you're trying to be careful with your commentary here, but some of the president's critics pointed out the fact that this was a political speech in front of a group of uniformed officers who were used as props today. Is that fair?
Look, I mean, Commander-in-Chief, he's given a wide swath.
Sure.
He made light of the fact that there was no applause in the room after Secretary Hegseth's remarks. There was not supposed to be, right? These are people who have grown up in an environment, these generals and admirals, that they are prohibited from showing any partisan activity in their professional
I think
life.
our audience needs to hear that, by the way. People think that he flopped today. That's part of the culture.
That's part of the culture. In fact, many of them will tell you, and they've told me this, that they don't even believe it's their responsibility to cast a vote on Election Day because they believe they've chosen service over the power of having a decision as to who your commander-in-chief is. So they take this incredibly seriously. And for the president to make light of it, okay, sure, he gets some, a little bit of laughter, but it is an administration that likes its pomp and circumstance. It is an administration that uses the military as a backdrop to strength around the world. And those are the things that the President of the United States can decide to do. But they cannot expect, in a political speech, they can give it, but they cannot expect anybody in that room to react to it in either a positive or a negative way.
And part of what we did here today did include a re-emphasis on some of the policies that we've seen put out by President Trump and Pete Hegseth, including, we heard Hegseth outline slashing as much as 20% of the U.S. military's highest-ranking officers. He did float this originally back in May. We know it was in tandem, Jeannie, with the Department of Government Efficiency, but I'd love your view here about the ramifications of that decision. Is this a realistic goal for the Pentagon? How could this impact really the optics going forward here?
Yeah, I mean, you just played the clip where the president said, you know, if you don't like it, you can leave, and that would be it. And Pete Hegseth said something similar in his remarks. I don't know if they will get to that number he has talked about, but he did celebrate to a certain extent today the people that he has let go, many of whom were people of color, were women who he said were really responding to previous administrations and to an ethos that no longer is part of the Department of War. And so I assume that that will continue. I think the most chilling things I heard today had to do with the idea from the president of sending troops into cities for training, including Portland, Memphis, Chicago. He talked about that. That is a chilling and not popular idea in the United States. And we also heard from Pete Hegseth, equally chilling, getting rid of the inspector general or diminishing that role. And of course, he himself is under review by that very inspector general. And so all of this in a context of a military that has suffered from issues like sexual assault and other things for a long time, you would hope in normal circumstances, Congress would stand up, people like Joni Ernst and others who have served so notably and so nobly. But yet I have no faith we're going to hear any pushback from Congress, which we absolutely should to some of these policies they floated today.
Rick, we've only got about a minute left. The president made the point of, and he repeated this a couple of times, enemies foreign and domestic. Domestic, he said, that's part of the oath. And I won't be the first president to use the military to keep our streets safe in this country. As we see troops now deployed to Portland, and a headline, the governor of Louisiana asking for deployment in his state as well. How did the president square that issue today that we've seen so much debate around?
Now, look, I mean, he preempted it by going out last week and declaring Antifa to be a terrorist organization. Yep. I mean, it's part of this overall war on America, you know, and this effort started with immigration, you know, and ridding our country of the murderers and the rapists, you know, as he described them, getting rid of the real hardcore criminals. Yep. And now, you know, a more domestic version of that by going after Antifa and other people who are protesting and causing either damage to property or other people. Mm-hmm. So it is a big gamble by the president to have this kind of military activity inside the U.S.
All right. Rick Davis and Jeannie Shanzino, our political panel today, both Bloomberg Politics contributors. We thank you. As always, stick with us. We have Congresswoman Susan Del Bene up next. This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow, the S&P, NASDAQ all trading lower right now as traders and investors keep an eye on any and all shutdown developments out of Washington. Keep it locked into Bloomberg for the latest. Right now, the S&P trading down 14, down 0.2%, 66.46 where we stand. The Dow down 142 on the industrials, drop there of 0.3%. The NASDAQ Composite Index down 78, a decline there of 0.3%. Our Mag 7 Index now lower by 0.6%. The 10-year 4.13%, with the 2-year currently yielding 3.60%. Spot gold up $13 the ounce, up by about 0.4%. West Texas Intermediate crude down 1.4%, 62.53 for a barrel of WTI. And Bitcoin down 0.8%, 113,440 on Bitcoin. Again, we have got the Dow, the S&P, NASDAQ all in the red, with the S&P down 0.2%. Briefly, Amazon shares down 1.4%. Amazon's rolling out new home security appliances from its Ring and Blink brands with an end-to-end push into 4K video. Another priority for Ring this year is a feature called Search Party, which uses Ring cameras within a given area to help locate lost pets. Again, we've got Amazon down now by 1.4%. Balance of Power continues right now. Back we go to Washington. And once again, your hosts, Tyler Kendall and Joe Matthew.
All right, Charlie Pellet in World Headquarters for us. Thank you so much. As Charlie mentioned, I'm Tyler Kendall here alongside Joe Matthew in Washington, and we have some breaking news crossing the Bloomberg terminal. Eli Lilly said to be in, quote, active discussions with the Trump administration on drug pricing. This coming in an emailed statement from a spokesperson after that White House event we saw earlier today, Joe, where we saw that announcement, President Trump with Pfizer in a bid to try to lower some prescription costs for Medicaid users.
Yeah, it's hard to tell exactly what the deal is. The president said we'd see drug prices dropping by something around 1,000%. So the math is a little difficult on this, but just seeing Pfizer in the Oval Office with Donald Trump earlier today had a real impact, sending the shares higher. They're talking about a $70 billion investment into R&D. And so, yes, indeed, we hear from Lilly shortly thereafter. And that news as well, sending shares higher. Lilly stock is up about 3.5% to retake $750. So we'll keep tabs on that for you. Maybe it's the next company we see at the White House.
Right, exactly. And it's shaping up to be, of course, a busy day in Washington, as it always feels these days, Joe. And, of course, we are now on shutdown watch. We are less than 11 hours away from a potential government shutdown. We haven't really seen any indication from either side that they're going to step away from what really feels like the brink at this point. We saw this high-stakes meeting yesterday at the White House. Republican and Democratic congressional leaders joined President Trump. But after that, we didn't really see much movement when it came to the negotiations. But to get an inside look, we're joined now by Democratic Congresswoman Susan Del Bene. She represents Washington's 1st District. She's also the chairwoman of the Democratic Congressional Campaign Committee. Congresswoman, thanks so much for joining us here at Bloomberg. I'm wondering, if the government does shut down, what are the contingency plans here? Is there an escape route for the possibility of reopening the government if that happens?
Well, I'm here at the Capitol right now. There should be work happening right now to find a solution to go forward. But House Democrats are here. House Republicans aren't even in town. They aren't planning to be in town for the rest of the week. They clearly don't think this is a priority. I guess they're looking for a shutdown. But we are here ready to work, stand up for the American people. That's our job. And we're going to be here all the way through to fight for the American people.
Well, it's a precarious moment, Congresswoman, and I'm assuming you are bracing for a shutdown here based on the rhetoric that we're hearing from President Trump. He was asked today if it was inevitable. He said he doesn't, well, nothing's inevitable, but he doesn't see a way around this. And the video that President Trump posted last evening following his first ever meeting with Hakeem Jeffries, I don't know if you saw this, an AI-generated deep fake in which Chuck Schumer is talking about Democrats' love for illegal immigrants, and your leader in the House, Hakeem Jeffries, in this faux Mexican garb that a lot of people considered not only offensive but racist. Where are we in this debate? How do we get out of this?
Well, the video was disgusting and racist and pretty much says exactly where the president is and Republicans are. They're not trying to work to fund the government. They seem okay with a shutdown. We need folks, we need leaders who are going to listen to their communities, who are going to come to the table, who realize that millions of people are losing health care and going to see costs skyrocket because of inaction from Republicans. Hearing it from all over the country. If Republicans were listening to their communities, they'd come to the table and make sure we protect health care and we keep the government open. That's why we're here. We're ready to work. Republicans seem disinterested, and the president definitely seems like he wants a shutdown.
But Congresswoman, just how hard would it be for Congress to pass an extension when it comes to the Obamacare tax credits? Realistically, how long do you think negotiations would need to last? Are we talking about weeks here in order to get a deal?
Well, let's be clear. The fiscal year always starts on October 1st. Republicans have known for a long, long time that we needed to have our funding bills done by now. They waited and waited. They were not focused on it. So unfortunately, they put us in this position. And what they need to be doing is working to make sure that we are putting the priorities of the American people first. And in particular, when we talk about health care and the premium tax credits for folks who get their health care from the Affordable Care Act exchanges, premium notices are going out in October. Open enrollment starts November 1st. While they're out of town and not interested, we actually know that premiums are going to skyrocket for people all across the country. In my state, about 80,000 people are expected to lose health care because we're going to see a 65% spike in premiums for folks on the Affordable Care Act because the tax credits are not being extended. This isn't something that can wait till later. This is something that's happening right now. The number one issue across the country that people want to see is costs going down. Affordability is an issue. Republicans are asleep at the wheel. They have done nothing to help address the needs of American families, and their actions have raised costs. Food, health care, housing, all going up under the actions of Republican Congress and this administration.
We spoke, Congresswoman, before you joined us with Mike Lawler, your colleague from New York, Republican, of course, serving in a blue state. And I was interested to hear what he said as lines are drawn here, right? Everybody's playing the blame game. He had his own take on this, but also let us know that he was in favor of negotiating around the extension of Obamacare subsidies. It's kind of a different wrinkle on the Republican line that we've been hearing. And I want you to listen to what he said when he joined us today on Bloomberg. Here's Mike Lawler.
I think it is foolish to shut down the government. It is going to create chaos in the markets. It will create chaos for the American people, especially those who rely on the social safety net, border security, our military, veterans benefits, etc. This is entirely unnecessary and does nothing to actually further the work of the American people. It is pure political posturing by my Democratic colleagues because they are not in the majority.
That was just a couple of moments ago, Congresswoman. How would you respond to him?
Well, first, I'd respond that Republicans have the majority in the House. In the Senate, they have the White House. They are in charge of everything. If he actually thinks the priority is to support working families, keep the government open, surprised he's not right here in Washington, D.C. We just had a pro forma session. Republicans weren't there. Empty side of the House. We tried to bring up legislation. Republicans refused to recognize Democrats, shut the House down. If he and other Republicans really care about standing up for the American people, keeping the government open, how come they're not even here?
Well, I am curious about perhaps what we're seeing as a messaging battle playing out when you had President Trump today over an hour speaking with reporters from the White House and announcing this initiative to lower some prescription drug costs when it comes to this agreement between Pfizer and also Medicaid. What do you make of that messaging and that push as the administration is trying to say that they're going to lower healthcare costs, and healthcare really is at the center of this debate on the future of government funding?
First of all, I don't think we have any information on what he's planned. He's also talked about doing 100% tariffs on pharmaceuticals. So I don't know where he stands there at all, but I do know that he is not fighting to make sure that we are protecting healthcare across this country. It's actions of his administration. It's the big, ugly bill that he supported that has cut healthcare across this country. Millions of people losing healthcare. That's a terrible decision for our communities. It's also a terrible fiscal decision. We have hospitals already laying off people, rural hospitals that can close, services being pulled back because folks are concerned about where the resources are to help support our healthcare system. When we have more and more uncompensated care, more people are using the emergency room, that raises costs for everyone. So if you care about healthcare, you wouldn't have supported the legislation they put in place, slashing Medicaid, $500 billion cuts to Medicare, now letting the tax credits expire for the Affordable Care Act. All of this, we're hurting the American people. People are outraged across the country. If you want to help, come to the table, fix the mess that you made, and let's put the American people first.
Congresswoman, we've seen when it comes to the extension of Obamacare subsidies, and I want to ask you this question as not only a member of Congress, but as chair of the Democratic Congressional Campaign Committee. It is your job to get Democrats elected to the House. I'm looking at polling from Republican pollster Tony Fabrizio, who warned Republicans about what some are now calling the Obamacare cliff, that if these extensions were not made, it would in fact mean the difference in the midterm elections. From a Machiavellian point of view here, is that one way that you see Democrats returning to the majority in the House if this is not handled properly?
Well, that's another reason why this isn't, just justifies why this isn't such an important issue for the American people. 65% increase in premiums in my state, 80,000 people losing health care just because the tax credit's not being extended. This impacts communities all across the country. So we have to put the American people first. Republicans haven't. Number one issue, costs going up across the country, tariffs, the big ugly bill. Republicans continue to raise costs, are not making a priority to lower costs. Is that a campaign issue? Absolutely. Democrats are running 15 points ahead in special elections across the country. We have great candidates who are going to put American families first. And it's a big reason why we'll take back the House next year.
So do you feel what's playing out now in Congress is going to impact the midterm elections? What we're seeing today on Capitol Hill could have these long-term ramifications.
The ongoing work of Republicans to rip apart programs that people depend on, rip apart health care, absolutely. You're hearing it from people on the ground already who want folks to stand up for them, and Republicans seem to only be focused on the wealthy and the well-connected.
Last full government shutdown was in 2013. That was 16 days. The record was in 2018. Of course, in that case, I guess we call it a partial shutdown. The Pentagon and other agencies were funded. Congresswoman, there are a lot of Democrats who have worried if this happens, we don't have a plan to reopen it. And then you see Russ Vogt on the other end of Pennsylvania Avenue. And many are wondering what would be more detrimental to Democrats and to the country in this case, a shutdown or mass layoffs of federal workers that could follow a shutdown. That's a pretty tough decision to make. How do you see it?
I think actually you've described exactly where Republicans are. Instead of working for the American people and listening to the needs of American families, they're trying to think of what they can do to hurt American families more. That's their response, not to come to the table to fight to help our communities. They're talking about what more damage they can do. That's clearly their priority. That tells you, I think, everything you need to know. We need folks who are going to stand up for our communities first. Democrats are here doing that. Republicans want to hurt communities more. They've talked about what they want to do to hurt communities more. And then House Republicans can't even show up for work.
Well, as Maya McGinnis calls it, it's fiscal New Year's Eve. Congresswoman, it's good to have you with us as we stare down the barrel of this likely shutdown. Susan Del Bene, the Democrat, of course, representing Washington's 1st District and chair of the DCCC. This is it, Tyler. It looks like the countdown is real. I'm going to make my way up to the Senate. You'll be here in our bureau for a special edition of Balance of Power. Starts at 5 p.m. Eastern.
Right, and we're going to speak with the lawmakers who are making these decisions really in real time as we gear up for this vote later tonight.
That's right, 12:01. You've got it on your dance card. Don't worry, we'll have the countdown clocks for you as well. As Tyler mentioned, we'll be speaking with the stakeholders who are making these decisions and voting on this legislation today. We'll go through it together. Starting 5 p.m. Eastern, only here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec. Live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. I want to look at you, but I feel like I have to stay glued to my Bloomberg because I can't tell you, this Tuesday has been crazy with the amount of headlines coming our way. A very good afternoon. Carol Master, Tim Stenovec, live here at Bloomberg headquarters. And Tim, 30 days have September. You know how that goes.
The government shuts down at the end of the month? Is that how it goes?
That's, I think, one version of it.
I thought that's what you were going to say. It doesn't have the same ring to it.
It does not. It does not. It is the last day of September trading, last day of the third quarter. Man, I got, an S&P 500 that's on track for its best September since 2010, but there is a lot still coming at us.
Yeah, short-term headwinds in the form of quarter-end rebalancing. Goldman Sachs traders expecting pension funds here in the U.S. to sell $19 billion of equities. We're glued to the Bloomberg, and we'll bring you anything that we see as it moves.
All right. So what's coming up in the next 60 minutes? We're going to get into the AI spend, man. That has been a big trade for the last 2.5 years here. Another big story today, CoreWeave, a Bloomberg exclusive, inking a $14 billion deal with Meta. We're going to get into the details of that and really talk about the AI trade overall.
Well, on that and on the concentration risk when it comes to the market, AI and more, we've got Charles Schwab's Kevin Gordon in the studio with us. He's going to be chatting with us in just a couple of minutes.
Also, the government shutdown and the architect behind the president's grand plan. That is something that is certainly top of mind. And then, Tim, when we talk about shifts, demographics, things that are going on when it comes to the management of money, we are definitely seeing a big shift when it comes to women. And really them controlling so much money going forward.
All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, a check of the day's trade and top business stories. Here he is, Charlie.
Hi, thank you very much. We got lots going on. We got you covered here at Bloomberg with the Dow, the S&P, NASDAQ, all declining here. Possible shutdown Tuesday. S&P right now down 11 for the S&P 500 index, a decline right now of just about 0.2%. The Dow down 130, drop there of 0.3%. And NASDAQ, the composite index, down 64, a decline of 0.3%. So stocks are dropping at month end, a month that's marred by shutdown woes, with the 10-year ahead of that potential shutdown, 4.13%. The 2-year right now, 3.59%. Gold up 0.3%. The precious metal, 38.43 the ounce, and a retreat for West Texas Intermediate crude down 1.6%, 62.41 a barrel. Pfizer CEO Albert Bourla says the company has secured a 3-year grace period from President Trump's promised tariffs on pharmaceuticals in a deal that would lower some of the company's U.S. drug prices. You heard the president make the announcement here on Bloomberg. Pfizer shares, they're gaining 5.6%, but rivals Lilly and Merck also higher. Lilly right now up 3.7%, Merck up by 5.2%. Again, recapping here, stocks lower, the Dow, the S&P, NASDAQ, they are all in the red. S&P again right now down 10, drop there of 0.1%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, let's get to it because we are certainly talking once again about the AI spend, and in particular, one of the dominant players, I feel like, safe to say this year. We're talking about CoreWeave. Shares right now are up about 12%. They were up as much as 16.5% earlier in the session. This on a Bloomberg exclusive that the company has signed a deal to supply Meta platforms with as much as $14.2 billion worth of computing power, underscoring, Tim, that massive costs of developing and running advanced AI models.
CoreWeave shares have been on a tear. It's been an outperformer this year following its IPO just in the spring. Shares up since then more than 270%. CoreWeave CEO Michael Intrater talked with Bloomberg's Ed Ludlow, the host of BTech on Bloomberg Television just last week, about demand from customers.
The challenge that we have is competition among our clients for the infrastructure that we have, right? It is not a question of giving up one client for another client because their demand doesn't completely absorb all of our infrastructure. It's just a question of we have 100 units of compute to deliver in the next 12 months. We could deliver all 100 to client number 1, all 100 to client number 2, or all 100 to client number 3. And the question is how are we going to divvy that up among those clients?
And it sounds like you don't want to be client number 4. All right, let's get to it. That is CoreWeave CEO Michael and Trader with Bloomberg's Ed Ludlow, co-host of Bloomberg, B-Tech, I should say, on Bloomberg Television. Of course, 11 to 12 every day on Bloomberg Television. Ed, right now in studio. Ed, it does sound like another big deal with what feels like it's got a big window on visibility for CoreWeave. Lay it out for us.
Yeah, CoreWeave has 33 data centers, mostly in the United States, some in Europe, and they are all humming and they're all being used up. And honestly, that answer in the context of the Meta news today was a bit of a cop-out because they are supply constrained. In other words, they have all these deals on paper that extend over a long period of time. In Meta's case, the deal that we broke the story on today goes through to 2031 with an option to extend to 2032. It's not yet real. There isn't a data center among those 33 that's going to, from today, run Meta inference or training workloads. But the thing to understand is that CoreWeave's magnificent run since its IPO, which Tim alluded to, if there was one piece of downward pressure on the stock that maybe was holding it back a bit, it was this idea that it only had one customer, which was Microsoft, accounting for 70% of revenues. And the simple answer to the move in the shares today is the market saying, good, we like to see diversity in your customer base, even if it will be a few years that this stuff comes online.
Why would a customer go with CoreWeave rather than another provider?
Because compute capacity, whether you're talking about literally the building of a data center or changes in generations of chip, takes many years and billions of dollars to come to fruition. The way that Michael explains it is they're not going to do a deal where they don't have some idea of which data center or even some idea of like the energy supply for it, right? But the reality is this is probably 2 years away from Meta running these workloads. And at the same time, Meta is also trying to build its own data centers.
Right.
It's just an acknowledgement that they will need more than anyone can do at any given time. And the thing you need to understand about CoreWeave that puts this all into one place is that largely what Microsoft does with CoreWeave is give it the workloads it can't handle itself. Microsoft has many of its own data centers. There's just too much.
It's kind of an outsourcing, or it is an outsourcing.
Exactly so.
One of the things I want to ask you is this kind of starting to feel a little bit silly in terms of the spend, the build out. It's got this also incestuous feel of the companies working together, supplying things to one another, benefiting by the partnerships. It's just starting to feel a little bit close. And some much smarter than me are suggesting that this doesn't quite feel right. Will the revenues and financial payoff be there after the spend?
This is what Wall Street calls circular financing.
Correct.
And you know the greatest example of that is OpenAI and NVIDIA, but it could extend to CoreWeave.
Well, explain the OpenAI and NVIDIA, because if OpenAI gets money from NVIDIA to then go and buy from NVIDIA?
Yes.
OpenAI received a $100 billion investment from NVIDIA.
Over a number of years.
Equity investment over a number of years, a decade. So it's actually defined by gigawatts of data center capacity. For each 1 gigawatt, it gets $10 billion in the form of, actually, we don't really know. That's the thing. We don't even know, like, is NVIDIA just going to write a $10 billion check or is it going to give it chips in lieu of cash? So anyway, the argument is that OpenAI just takes that capital in whatever form it comes to then buy $10 billion worth of NVIDIA chips.
Right.
So the critics and the bears would say...
Shell game? Oh, no. I'm not going to say that. As I said, some smarter than me have questioned this, and I'm just trying to be smart.
Like on X, people have used the phrase Ponzi scheme. So, like, I understand that.
At the same time, Tim and I are playing around with ChatGPT.
Don't bring me into this.
Using these tools and are kind of blown away.
The bear case is that the big picture forecasts that the market or industry for AI accelerators or GPUs, before you take into account electricity supply, concrete, labor to build data centers, is $4 trillion. That number's being artificially inflated by the circular financing mechanism. The counter argument to that is, well, there are plenty of software companies making a ton of money, higher margin revenue because of the investments they made in the last 2 or 3 years.
We see that in the earnings cycle.
Yeah. Start looking at debt, because a lot of this is underpinned by debt. And that's a little bit worrying to some in the market. Others are completely
sanguine. These neo-cloud companies, right? There's a lot of debt involved.
Yes, correct. And also, collateralized loan offerings, they need issuance. M&A needs issuance, but I would start tracking it on your fingers, or if you're lucky, use your Bloomberg terminal.
I was going to say you might have to start using your toes because it's getting so big at this point too. The flip side of that, though, Ed, is that there are those out there who argue that the productivity increases that we're going to see from these investments and the innovation that we're going to see from these investments, that's going to be huge.
Yeah, but like, oh God, I've missed you guys so much. Do you remember like 2 years ago, and I know it's hard to remember last week, I would talk about the money machine.
Yeah.
So like productivity and stuff, just like customers that have spent some capital expenditure or they've made some kind of licensing deal with OpenAI or whatever it is, what is their top line growth and bottom line growth been in the last 2 years? Is that evidence that they have had revenues in new areas? Some cases the answer is yes, some cases it's no. I don't, I'm trying to think of an example like Salesforce. Like, what does Salesforce even do? But like these are where you should look for evidence of that. Yeah.
All right, good stuff and good setup for our next guest, Ed Ludlow. Thank you so much.
He's here all week.
I know.
He's coming back.
2 shows nightly. Try the veal. Bloomberg's Ed Ludlow. So appreciate it. Co-host of BTech on BTV. Catch it at 11 a.m. Wall Street time on Bloomberg TV. We want to continue with the AI spend and so much more when it comes to the market environment. So great to have back with us Kevin Gordon, Chief Investment Strategist for Charles Schwab, right here in studio. There is so much coming at us. Let's start big, broad, and we'll get into AI. What do you make of this year?
Well, I think that in terms of the market's returns, I mean, that has been, a dominant theme. If you look at information technology as a sector, communication services as a sector, those are the 2 top performers. Utilities has also done quite well and pulled away from the defensive pack. If you think about,
which is kind of interesting.
Yeah, utility staples, healthcare, kind of being that trifecta defensive play. I think that has pulled apart over the past couple of years. So it's not just a year-to-date phenomenon. But, there have been other parts of the market that have done well. So it's not just the AI story in terms of a couple of companies or a handful of companies that are performing well and the rest of the market is not doing well. There is a difference, I think, and an important and a positive distinction versus maybe a year and a half or 2 years ago where there was more of a fraying, for the other 493, if you want to think about it that way, where there wasn't as much participation. I would say breadth has held up relatively well, especially, post-Liberation Day. We've yet to have an instance where the percentage of companies in the S&P 500 trading above their 50-day moving average has fallen below 50%. So despite some of the, rumbles over time, even some of the corrective activity under the surface we saw in the summer, it's still been a fairly good year if you were to date it maybe post-April 8th low.
But it was a rough ride.
Oh, for sure. Yeah, absolutely.
A little bit of a bumpy ride.
Completely the opposite of last year. But that's how we've been thinking about markets in this next phase of the bull market. What we've been telling clients is that don't get accustomed to what 2024 was, where you had kind of minimal scarring and volatility at the index level, but that was just really masking a lot of turmoil under the surface. We think that not that we think we get a 20% drawdown every year like we did earlier this year, but that's become more the norm, that kind of choppiness.
So let's go under the surface a little bit and talk a little bit about what we were talking about with Ed Ludlow just now, this idea of circular financing, where there is a little a relationship between the companies that are investing in one another. It seems to be the same names coming up time and time again. They're customers of each other as well. Yeah. Is that a risk to the public markets?
It's funny. Lizanne, my boss, and I wrote about this in a report published yesterday about AI, and at the bottom of it, we included a quote from Warren Buffett that says, "Nothing sedates irrationality, like effortless money being thrown around." And there is an instance of that, or an essence of that, where yes, you could look at a lot of this sort of circular financing, as Ed and you guys just discussed, and you could say there is a risk there. I actually always point to the fact, because you'll often hear people who are very bearish saying, look at the concentration in the market. This is so unhealthy to have 10 companies in the S&P make up 40% of that index. You'll have the bulls come out and say, and defend it and say, well, their earnings share has also grown. But you could look at that both and say, well, there's concentration risk in both areas. Right. Meaning if the earnings for those large companies start to slow or in the worst case, reverse, then you do have a material risk to the market. But I will say, if you're going to compare it to other periods, because I think the proxy and what a lot of investors do today is compare it back to the late 1990s.
Which makes me wonder if that's even right, but go ahead.
Yeah, I mean, I think there are so many differences in the economy, so many differences in the market that you have to pay attention to, which are not, they don't provide the evidence or the support for that direct comparison. I will say, though, I think the one lesson to be learned from that period, or any period where you go through some kind of craze, if you were to single out, the beginning of 2000 as an example, if you looked at the largest companies in the market at that time, at that time was sort of the big five that were in focus. It's not that their earnings just reversed and went negative. It's just that they couldn't keep up with that rapid pace of expectations and the expectations that kept getting ratcheted higher. So earnings in these kinds of parts of the cycle, it becomes more of a game of expectations and where you set the bar versus actual results just coming in positive. I think there's a really important distinction because you can get a lot of hype associated with that in terms of market performance.
So is that you saying then, Kevin, that the AI thing is real, it's happening, but folks maybe, rein in your expectations a little bit?
Yeah, because I think there are enough divergences, and I feel that the post-pandemic economy has really just been K-shaped the entire way. It really feels that way, especially when we go out and talk to clients.
And great if you're on the upper leg, but
Of
not
course,
if you're on the lower leg.
If you're generating income from assets, if you have a significant part of your wealth tied into markets, of course you've benefited a lot. But there are a lot of people that have struggled considerably, and I mention that because you can look at that split, and there's so many ways to do it and slice and dice it, but you can look at what's been done on the AI CapEx spend side of the equation for something like GDP, and then you can look at the slowdown in the hiring rate, on-farm payroll growth, the uptick in unemployment that you've seen for certain segments of the economy, particularly youth unemployment, which
you were sending posts about this just a couple of weeks ago. This is something you've been focusing on a lot about.
It's a huge focus for me. Of course, I'm biased because a lot of my peers and friends have been impacted by it. But if you just look at the increase that you've seen in the unemployment rate for the 16 to 24-year-old cohort, that has risen at a pace that is only consistent with recessions in prior instances. And I do think that there is certainly a unique nature to the cycle this time where there are so many indicators that have told us recession for years now, and it just hasn't happened. So I do think it is in keeping with this rolling recession nature that we've talked about a lot and written about a lot over the past few years. But there are definitely cohorts of the economy that have been struggling. So I think that, if that continues and you get more labor weakness from here, it's going to be harder to, I think, just say and point to AI being the only thing that holds up the economy. I do think it's been a significant driver statistically, mathematically, that has been the case. But if labor continues to soften from here, then you run into more issues.
So then you agree with the Fed recent rate cut, and that should the Fed do more?
Well, I mean, there's often a big difference between what we think they should do and what they will do. What I think that they will do, I think there's probably a cut or two left. But at the same time, I mean, you read all of the commentary and the comments this week, just in the past couple of days from Fed officials, the ones who are voting, who are actually, making the policy, they've pointed out almost ad nauseum all of the upside inflation risks that still exist. In addition to, downside labor market risk, of course. But I also think that, in terms of inflation expectations, which I will say in fairness, for now, look relatively stable. They don't, they're not setting any alarm bells.
But not at the Fed's target.
Right. So if you're the Fed looking at this where, potentially by the end of next year, they could be 70 consecutive months above their 2% inflation target. And if the labor market doesn't completely collapse and go into a recession, that would necessitate, cuts, which if that did happen, presumably would bring inflation back down to their target. It's not the best way to do so. But if you're looking at that dynamic, I don't really see how this Fed cuts aggressively, especially heading into next year.
We got to leave it there. Come back
Good
soon.
to see you guys.
So great to see you in studio. And I know we'll continue this conversation.
Thanks for having me.
Be well, be well. Kevin Gordon, he's Senior Investment Strategist at Charles Schwab, joining us right here in studio.
We're probably going to see Kevin before November, but we're going to see him out of Denver because we're headed out to Schwab Impact in the early part of November. So we'll definitely be talking to Kevin out there.
Looking forward to it. All right, coming up next, to shut down or not to shut down the U.S. government, that is the question. An update on that and a key player in all of this, key member of the White House. That's coming up next. This is Bloomberg Business Week Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, NASDAQ lower, but guess what? The S&P 500 index just turning higher right now. Little change, but in the green right now with the S&P at 66.63, higher by 2 points, up less than 0.1%. Dow Industrials down 57, decline there of 0.1%. And NASDAQ lower by 18, drop there of just about 0.1%. Our Mag 7 index down 0.3% with a 10-year ahead of a potential shutdown tonight. 10-year 4.14% with a 2-year 3.60%. Keep it locked into Bloomberg Radio and television for the very latest on a potential government shutdown tonight just after midnight. Gold up $11 the ounce, up 0.3%, $38.45 the ounce. West Texas Intermediate crude down 1.6%, $62.40. And Bitcoin now down 0.8%, $113,395 on Bitcoin. China's state-run iron ore buyer has told major steel makers and traders to temporarily halt purchases of all new BHP Group cargoes, escalating a pricing dispute that risks upending one of the mining giant's most important trading partnerships. BHP down now by 1.8%. Recapping, S&P 500 index higher, little changed, up a point coming up after the close of trading. We will be hearing from Nike. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week Daily. Carol Massar, Tim Stanovic. Hey, President Trump, as you know, threatening to fire or do mass firings of federal workers as the U.S. hurdles towards a shutdown with Democrats and Republicans at an impasse over funding the government. That shutdown would happen at midnight tonight. For more at what's at stake and who may be pulling some of the strings on what may happen at the executive branch if indeed a shutdown happens. Nathan Dean is with us, Bloomberg Intelligence Senior Policy Analyst out there in Washington, D.C., and right here in our New York studio, Max Chafkin, co-host of Everybody's Business Podcast, author of The Contrarian, Peter Thiel, and Silicon Valley's Pursuit of Power. Nathan, I want to shoot it out to you first. Where are we on the shutdown? What might cause this actual shutdown? What is it that the Republicans want or won't do? What is it that Democrats want and won't do?
So right now, both sides aren't really talking to each other. They're sort of in this weird waiting game at the moment as we get closer to midnight. Now, I think the Democratic, from their perspective, there are two wants going into this shutdown. The first is really being driven by the House progressives, and that is they want to be seen being very tough in combating President Trump on his policies. The other thing they want is they want an extension to ACA or Obamacare subsidies that are going to be expiring at the end of the year. From the Republican perspective, their wants are a little bit different. They've already passed via the House what is known as a clean CR that gets us through November 20th. And generally speaking, the party that passes that clean CR feels that they have a moral high ground. Now, I woke up this morning thinking that there was a chance that we would not go into a government shutdown and that something would happen to make a deal. But as we get closer and closer to midnight, it begins to sound like both parties feel that they are in the best political position possible and that both sides think that a shutdown will end up helping them politically. And that's usually what happens when you have a shutdown. So if a shutdown does occur, we'll wake up tomorrow and we'll have to deal with the short-term impacts because I don't think this is going to go more than a week or so. I think really the next real negotiation point, if the government shuts down, will be next week when the House Republicans return.
Well, Nathan, what are the political implications of a government shutdown? You said both sides think that a shutdown will help their own side, but what are the implications? We have a little bit of history to look to.
Yeah, absolutely. I mean, one of the best case scenarios is go back to the Tea Party of 2013. And there's this very similar playbook that it's happening to that. Now, from the Democratic perspective, they want to be able to essentially combat President Trump. Their approval ratings, not that good at the moment. And, there's plenty of time between now and November 2026 to be able to turn that messaging and at least start to build momentum off to that. Now, there is some local politics here at play. Virginia and New Jersey both have governor races in November. I would anticipate if President Trump and the Office of Management and Budget were to begin to follow through with mass firings of government workers, that's going to impact Virginia and Maryland pretty significantly. I would expect those policymakers to come in and say, maybe we should stop this and turn things around here. But if the shutdown occurs and Democrats start to take the blame, then I think you'll see those politicians in Virginia and New Jersey get a little nervous.
It's like you just, just delivered a ball into my court perfectly. You mentioned the OMB, which takes us to Russell Vogt. Max, you wrote an in-depth profile earlier this year, back in April. It was a big take. You talked about the architect behind President Trump's imperial presidency. Vogt, not usually out in front in the Oval Office or at a White House press conference, and yet he was yesterday afternoon, along with the Republican leadership. He was front and center. He went to the mic, made some comments outside the White House after that meeting in the White House with minority leaders. Tell us remind us who this guy is. He's very, very influential when it comes to the Trump White House.
Yeah, as you said, Carol, he is the head of the Office of Management and Budget, but I think more importantly, he is one of these kind of behind-the-scene intellectuals who helped shape this presidency, who worked on Project 2025, who basically, after Trump's last term, spent 4 years essentially planning for what this presidency was going to look like. And Trump, and we talked about this a lot, at the beginning of the year, but Trump was unusual because all these people around him had a long time to plan. And a big part of the plan, of course, is massive cuts to the budget and massive cuts, crucially, to the federal workforce. We saw a little bit of that, or more than a little, I'd say, with Doge and Elon Musk's efforts, and this has been going back and forth. But a budget shutdown, a government shutdown, would be a huge opportunity for Vogt and for people who are sort of aligned in this direction to do something that they've wanted to do for a very long time, which is essentially take a bite out of the federal government.
So what is this opportunity, Max, for him, for his role at OMB, but also his role in Project 2025 and shaping what he wants the presidency to look like? So
the ideological idea is that there is this kind of like fourth branch of government, like, you sometimes hear people talk about the deep state or something like that. This is the idea that there are civil servants who are operating outside of the realm of the president, who are just doing whatever they want. This is an attack, of course, that Donald Trump sort of pioneered during his first presidency when he would complain about the deep state. And Vogt's idea is to weaken this, and weaken it both by making it more responsive to the president, and like that's a key part. When you hear people talk about the unitary executive idea, it's the idea that the president, not these quote unquote unelected bureaucrats, should be deciding what the government does. But also because there's going to be they've wanted to fire people for a long time, and you're going to have a government shutdown. You could imagine Vogt and others inside of the Trump administration seeing this as an opportunity to do something very drastic and blame it on the Democrats and be able to say, hey, this wasn't, because it didn't really work during the Doge episode, because people got mad at Elon Musk, and you had a lot of Democrats sort of beating the drum about saying, oh, you're waiting for Social Security to talk to somebody at the Social Security office. That's Elon Musk did that, and that made Musk very unpopular. It also caused Trump to kind of back off. He had talked initially about using a chainsaw, and then he was like, oh no, we're actually using a scalpel. But now, if we have a government shutdown and the Trump administration is able to blame it on Democrats, then maybe that gives them the ability to try to do something more drastic they weren't able to do earlier.
So Nathan, come in. How exactly do these job cuts work in a government shutdown? And this isn't just something specific to a Trump White House, right? I mean, does any president have the ability to cut jobs, cut costs, if you will, in a government shutdown?
Well, obviously this is a new legal issue that's going to most likely come up if it happens. But one thing that we've already noted is that Russ Vogt, when he's provided guidance to agencies in terms of deeming who is essential and who is not essential, he said specifically that those individuals that are working on reduction in force plans should be deemed essential. And there's this theory out there that if the Congress isn't available to essentially do its job, then the White House has to come in and step in and do it for them. So I would say, though, that right now we're in the state between the Republicans and Democrats where both sides are essentially talking past each other, and there's a lot of threats going on. But I would also remind folks that Doge cuts weren't popular with just the average American because of the reasons Max was laying out there. And so even though you're hearing threats like 750,000 government workers will be furloughed and a lot of them may not come back, there is this ultimate decision that's going to be made by the president. And if Congress comes together and makes a deal by, say, early next week, I think they'll be able to get in front of the OMB and stave off a lot of these job cuts.
But it does make me think, Nathan, about the power of the purse and the whole idea of, a balance of powers. It's why we had these 3 different branches of government, right? And what does it mean if ultimately, though, the power of the purse is not in the hands of Congress?
Well, and this is what the Supreme Court is sort of moving forward with at the moment, with this idea of being able to claw back unappropriated funds and this pocket rescissions that we saw come forth right before the month of September. And what I would say here is that, Congress obviously does not like it. Republicans and Democrats alike do not like it when the White House decides that, yes, you've spent all this time appropriating and we're just going to claw it back anyway, which is why I think eventually we could be in a scenario where, this government shutdown may be the norm over the next few weeks, because even if we get a deal, it's not going to be a 12 appropriation bill sign-off full budget like we haven't seen in many, many years. It's going to be another kick of the can. And as we get closer to November and as we get closer to March, meaning the end of these Obamacare subsidies, and then further into the election year, both sides are going to want to play for more political points. And so even if there's a deal that's done next week, we could be talking about a shutdown again in early 2026.
Hey, Max, you wrote this story back in April about Russell Vought. To what extent is his vision for government coming true right now, and how much does the government shutdown play into that?
Well, I think
provide an opportunity
I think the point
for it?
that this is still in flux, and I think there's a question about. It's true that Russ Vought and people who are aligned with him would very much like to drastically cut back on the government. They don't care if it's politically unpopular at the moment. Trump, of course, cares a lot about that, and we've seen over the years that he can be responsive to pushback from either constituents or in polling and so on. And so I think we just don't, I think, know how this is going to play. I will say the question of the courts, like Vought has basically said that they plan to challenge this thing called the Impoundment Control Act, which is a 1974 law that Congress passed, essentially forcing the president to spend the money that had been appropriated and then creating this mechanism to ask for rescissions, like a legal mechanism. Vought has said they're going to follow the law, but he's also said that he believes that the law is unconstitutional. And so that could be where this is heading, like a legal battle that will pit essentially the Trump administration against Congress.
Hey, last question to you, Nathan. We have a terminal user sending me a message, and I think this is a fair one because he writes in, both sides have said the bloated federal government needs to be trimmed massively. Why should anyone be against that? I mean, there is something to that. And, it kind of begs the question, why can't everybody get along and figure out a smart way forward? Just got about 30 seconds here.
If it was easy, they would have already done it. I mean, we're talking about the Federal Register has over 430,000 pages, and this is all the regulations. So if you have to go through and you have to decide what to cut, you have to comb through 430,000 pages and ultimately decide if you're going to cut something, it doesn't break a statute or a regulation. It's just not easy because both sides said they would want to do it, but if they wanted to do it, they would have already done it.
Yeah, the answer to that question is voters. Voters don't want to cut, and when they've shown it over and over again.
Right, exactly. Just, somebody else, but not in my state or my territory. Guys, unbelievable. We wanted to do this yesterday. We had a lot of news flow. So glad we could have you back. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, Max Chafkin, co-host of the Everybody's Business podcast, author of The Contrarian. Unbelievable. All right, when we come back, we're going to talk a little bit about the demographic shift that's underway, Tim.
Yeah, when it comes to money, that as we continue on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got 1 hour and 20 minutes to go until we wrap up the trading month of September, then on to October. With the Dow, the S&P, NASDAQ right now, we are trading for the most part lower. S&P 500 index does remain higher now. A little change, swinging between gains and losses, but right now up under 0.1%. The Dow well off session lows, looking at a 29-point loss right now, down 0.1%. And NASDAQ lower by 12, down 0.1%. So stocks here limping into quarter end, all because of concerns about the shutdown. Right now, the 10-year 4.14%, with the 2-year 3.59%. Spot gold up $12 the ounce. The precious metal up by 0.3%. West Texas Intermediate crude oil down 1.5%, 62.48 a barrel on WTI. Speaking of crude oil, ExxonMobil shares down 1.9%. Exxon plans to cut about 2,000 jobs globally as the Texas oil giant consolidates smaller offices into regional hubs as part of its long-term restructuring plan. Other oil companies, oil majors lower. ADRs of BP, they're down by 1%. Chevron down by 1.1%. Again, ExxonMobil down by 1.9%. So recapping here, we're looking at the Dow and NASDAQ. They are both lower. We've got the S&P 500 index higher. Little change right now, up by about 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So women are controlling ever greater sums of money around the world, setting the stage for major shifts in wealth management and philanthropy. In the U.S. alone, McKinsey expects women to control $34 trillion, or roughly 38% of investable assets by 2030. That's close to double last year's total. The figure was just $7.3 trillion. That was 29%. That was about 10 years ago, Tim.
The worlds of finance, wealth management, and banking are all recalibrating for this great wealth transfer. With more in our new weekly discussion on women, money, and power, where we explore the economic implications of these changes and how to navigate them. We welcome April Rudin, founder and CEO of the Rudin Group, and Nick Rice, director at Brunswick. They're the co-authors of the forthcoming book, Wealth Management with a Difference, Your Guide to Achieving Client, Generational, and Business Success. It comes out late next month. They both join us here in the studio. Welcome to both of you. We've been talking about this great wealth transfer for quite a bit of time. I mean, purely demographics, when we think about aging baby boomers and then who ends up receiving those funds. I want to start with you, April, the economic implications of these changes and what it means for new trends when it comes to investing, saving, and of course, giving.
Well, it's huge. It's as you said, it's the intersection of all of these different factors coming together. There's never been a better time to be in wealth management. I would say the opportunities for financial advisors and for all firms that are serving in financial services, that sector of women is gigantic, because you have financial advisors that are retiring. You have women inheriting more money. It's actually more of a wealth transition we're going to talk about rather than a wealth transfer, because it's actually vertical, right? Women live longer, and so before that wealth transfer has happened, there's going to be a wealth transition.
Why is that an important distinction?
So I started my firm 17 years ago talking about the wealth transfer, and it actually hasn't really happened. You still, from those McKinsey stats, you have people still talking about it's going to happen, it's happening, is it happening? And now, and people were under the impression that the transfer was also going to go to Gen Z, right? But actually, it's going to go to Gen X, and Gen X are now in their 60s in retirement themselves, some of them. So I think it's more complicated than what people think, and so it's important to pull it apart and understand more about what's happening.
Nick, I want to bring you in. So how much do things change when it comes to the investing world and the approaches? Like, how much is going to be different? Because it's interesting that, we sometimes men versus women and the distinctions, but is it all that different?
Yes, so there's going to be significant change. I think all the data shows that women are very, very passionate about using their investments and their philanthropy to fulfill specific purposes and to ensure that they have impact in a way that might not have happened in the past, or they might not have had the tools to do that always in the past. There's been a strong trend towards philanthropy among older generations, but female clients, particularly the younger generation, are more focused on measuring that impact, generating that impact, and also making money through purpose-driven activities.
So where, on the impact side of things, where does that end up going?
So it varies, right? So you can look at it through a sustainability framework. A lot of clients prefer to look at a sustainability framework targeting things like the environment or social causes.
I thought we stopped caring about that.
Well, some clients don't choose to look at it through
sarcasm,
a sustainability framework, right? It varies depending on the client, but a lot of clients target the same underlying causes, whether or not they use a sustainability framework. You can target healthcare as a client through your investments, through your philanthropy. You can use the sustainability framework to do that, or you can not use the sustainability framework. There are various different ways of cutting the pie.
I want to bring you in on the same thing. Like, why is it so different? But we hear from Nick that, yes, it will be different.
Also, to your point, I think sometimes U.S. is very U.S.-centric, and whereas that might be true in the U.S., our book is for a global audience, and that has not died down in Europe and Asia. Impact investing, sustainability is really hot, and it's something very important.
I love that you went there. We're just coming off the UN General Assembly, and we did a big broadcast last Wednesday from the Plaza. Bloomberg does a big event, a global forum, and I felt like most of who we talked to, a lot of European officials, and yes, talking about alternative energy, renewables, how it financially makes sense, that nothing's changing, and that really struck me in those discussions.
Well, it struck us because here in the U.S., the changing administration has really changed the tone when it comes to renewables and also when it comes to foreign aid. And pretty much every guest we spoke to, Carol, at that event was talking about how to maximize the impact of foreign aid and how to maximize the return from renewables.
Yeah, I think it's kind of fascinating.
So that's one of the reasons why we went global on this book. And we spoke to 80 senior leaders across the world because more and more firms are global in nature and more people are mobile in nature. And so having a better understanding of what our world is and technology connecting us is truly important. Even visiting some of the headquarters of some of the firms, and you can see a huge difference where some firms are very traditional in the way that they look. Other firms have a more sustainable approach, as Nick was saying. You see firms that have more green, more exposed brick. You know, in London, they've purchased a building and have redone it, something we don't really see here in the U.S., where we're just going to, knock the building down and build something back up again. But there's an effort to create sustainability and demonstrate it through their brand.
What does this mean in terms of money flows? So we are Bloomberg, and that is something, whether it's a fund advisor, whatever, Tim and I constantly talk about where the money goes. So Nick, where does the money go potentially as we see this this wealth transition? Where does it go? Is it greener, sustainable efforts? Is it more global efforts? Like, how do you see it playing out?
I think alternatives are a big piece of this. We're seeing increasing capital flow towards alternative investments, specifically towards things like private markets, but also digital assets, right? And we've seen the rise in vehicles that will enable that, right? Be those through new types of vehicles that wealth management clients can more easily access, or also increasingly through retirement plans, right? We saw the executive orders the other week. That's an important part of it. Also, international is a very important part of it. I think people thought with deglobalization that it would just make people more domestic. In reality, it makes your international footprint more complicated, and we're seeing a lot of wealth managers retool in order to account for that greater international footprint.
Hey, Ron, I want to finish where we started with you, and you said that there's been no greater time to be in wealth management. If you would have told me 10, 15 years ago that would be the case for 2025, I wouldn't have believed you, because we saw the rise of robo-advisors, passive investing, the idea of setting it and forgetting it, which I thought millennials would be doing. Make the argument and make the case that people are paying that higher fee to get that personalized advice.
So it's really the confluence of all these different things happening. It's more and more advisors retiring. It's volatile markets. As the mother of 2 Gen Z kids, I'll tell you that they're more conservative than what people think. And I think they want to have bigger brands that they rely on. So I think there's an opportunity there. I think that there is a general need for more financial literacy and around that, because and even for financial advisors. I was just going to add one more thing, which Nick and I always talk about. There's been a real shift in who is a financial advisor and how to recruit people into it. Only 15% of the workforce is women, and traditionally finance majors have been recruited, and now not so much.
We have to leave it there. I hope we can continue in the future. April Rudin, of course, of the Rudin Group, Nick Rice of Brunswick, and check out their book, Wealth Management with a Difference. And also, we have a special event in London, Women, Money, and Power. Be sure to check it out.
You're listening to Bloomberg Business Week Daily